Hello and welcome to eOptions webinar, and we're excited to have you here. Thank you for taking the time out of your day to join us. We partnered with Teddy Keckstadt, a professional trader with over 30 years of experience, to bring you this webinar on protecting your stock positions in a bear market. My name is Gina Bocayas and I'm with eOption. And just to provide you with some basic information on logistics for the webinar today, the session will last approximately 1 hour. If you have any questions at all during the webinar presentation, please feel free to type them into the question box, and our speaker will answer those at the end of his presentation. Also, you can reach out to eOptions Trade Desk at any time if you have additional questions after the webinar. And for those of you just joining, we'd like to welcome you to eOptions webinar on protecting your stock positions in a bear market. Now, I'd like to turn our attention to our speaker now, Teddy Keckstadt. We're excited to have him speak today, and he's a seasoned professional trader, and he's ready to share his insights and his trading strategies with you. Teddy has over 30 years of trading and industry experience, and to tell you a little bit about his background, he traded on several trading floors in Chicago, including the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. He's also been an institutional market analyst for 25 plus years, and he currently serves as president of Forex Trading Unlocked. And he's also the author of a trading educational book called High Probable Japanese Candlestick Patterns. He also has a degree in finance from DePaul University. And so without further ado, I'll turn it over to Teddy Keckstadt. Thank you.
Thank you, Gina, and eOption also for sponsoring this webinar today. And without further ado, we are going to move forward with this webinar. So, bearish option strategies, how to protect your stock positions in a bear market. That's what our topic of the day is today, and especially with the environment that we've had over the past few months, it's a very fitting topic for sure. So, real quick, we just want to show you the disclaimer from eOption. This is just to remind you that this webinar is for illustrative and educational purposes. So, and also I also put in my company disclaimer as well, same type of disclaimer. And with that, so real quick, the bio was that Gina gave you, has told you about my background in trading and stuff, so we can skip through that. So right now, so you are a bear. So what do you do with that? So first you have to gauge your ability. Are you a beginner? Are you advanced? You know, what kind of rational expectations for the capital you have are you working with? You know, these are topics and ideas that you have to run through your head as you're figuring out which strategy you want to do. And one thing you can do is at eOptions, you have many tools that can help you develop these strategies if you haven't used them before through their Options Play platform. That's something that you can check out at their website. Now, one of the things you also want to think about is low volatility plays and high volatility plays. So what is the difference? When you have low volatility plays, buying may be better than selling. And then you have to think about, what are your goals? What are you trying to achieve? These are the things that we're going to cover as we get through these different strategies over the course of this webinar. And especially like high volatility plays, selling is your friend, but you still have to always remember that one question: what are you trying to achieve? I mean, ultimately, we know making money is what all of us are trying to achieve, no matter what you're doing with the markets. So as we cover these strategies, we're going to get into the intricacies as to how these actually play a very valuable role in making your decision on what you are going to do. So, first of all, let me discuss real quickly the topics to be covered today. We're going to breeze through some beginner setups. I know there was a webinar just a couple weeks ago, I believe, by eOption, where they presented a bunch of basic option strategies. So we're only going to breeze through them, but I've been trading for, like Gina told you, for 30 years. I still use some of the most basic strategies all the time. It doesn't mean just because you're an advanced trader that you don't use these things. And also it depends on the market environment, why you may actually use those. So we'll discuss that as we go along. Also, what play is good for each individual? There's different levels of traders. There's also a different level of capital that you have. You know, are you trading it? Are you just hedging your stock portfolio? These are things that we'll discuss. Then there's profit potentials, and there's also loss potentials. And there is no holy grail in trading, no matter what anyone may say out there, because they can't, because there isn't. So, but there are always opportunities, and making sure that you can limit your loss, knowing your loss, is something that you have to be aware of when it comes to your money management, which we'll also discuss. The why of each option play, that's what we're going to also get into. Using implied volatility as an aid. Now, a lot of people have math anxiety. We are not going to get heavily into the Greeks. We are not going to get into a bunch of math to make things really difficult. But when you get through this, you're going to have a visual representation where you actually are applying the Greeks in a way that makes sense for each different strategy. And then you can figure it out from there as we go along. So anyhow, time factors for and against you, we're going to cover that. That's a big part of option pricing. But once again, we're not going to get totally into the math, but we will explain how these strategies will work for and against you. And then making a play versus doing nothing. One of the things I tell most people when they say, like, what should I invest in as a stock, or what kind of trading, or what are you looking at right now? And I'm like, most of the times I tell people I'm looking what not to do, because that's really what you want to make sure you're definitely paying attention to. And sometimes there's a reason that you put something on, and there's a reason why you don't. So we'll go over that too. Rational expectations is another thing that we're going to talk about. Have an actionable trading plan, and also monitor your results. So with that, why be bearish on option strategies? Why would you do this? Well, there's many opportunities with varying advantages. There's also very versatile, these strategies. You can control your risk for stock portfolio, for your positions that you have in your portfolio. And also your ability to profit off of bearish market movement also is something that you can gain by using these strategies. And then the controlled level of capital necessary. That's another thing that's also very important. And that's why, even though beginner strategies may not be something that, think that it's kind of boring, but then you don't have to worry about margins. There's also different risk levels that are associated with these different strategies, and it'll all come clear as we get through them. So, disadvantages of bearish option strategies. There is, limited profit potential. There is a large selection of option plays, which can complicate picking a strategy for a situation, so don't think that just because there are all kinds of different plays that you need to use all of them. You definitely don't want to use all of them. So each individual has a different need. So most strategies involve creating spreads, which equals higher commissions because of increased transactions. Now, this is where a broker like eOption comes into play, because they have very low commissions for options contracts at 10 cents a contract. That's absolutely next to nothing. So and they also have the commission-free stock trading. So if you're buying your stocks and have your portfolio through there, you're already saving costs. And then if you use them for your option spreads, then you're also saving on your commissions. And commissions are a part of your cost. That is a negative component, whether you are profiting or losing. So you always want to keep that as minimal as possible. And that's something you can control, which you can by obviously going through eOption. So beginner, you have to start somewhere, right? No one just starts out knowing everything. And then even still, what are the basics? So we're going to go over a couple quick strategies. The beginner bear plays. The covered call, that's where you own the stock, okay? And for all of these, this is the strategies that we're gonna cover. We're assuming that you own the stock. So you own a block, so 100 shares. So that's what we're basing all of these strategies off of. So in the covered call, that's where you sell a call at a strike price. And that strike price, we will get into where that's at. Protect a put, that's where you buy a put at a select strike price. We will get into where that pricing is as we get into the strategy. And then there's the collar, okay? That's where you own the stock, and you're gonna buy a put at strike price A, and you're gonna sell a call at strike price B. These are very simple strategies. You can also learn about these strategies on the eOption website, where they have a free option strategy guidebook, which explains these in very good detail. So with that, let's get into our first strategy, the covered call. So you own the stock. So you sell a call at a strike price A. So the big question is right off the bat, why? So, well, the reason is you are neutral to bullish, but do not mind selling the stock. So what does that mean? That means that you like the stock in your portfolio. It's a stock that, whether the market is going up or it's going down, you find value in it. Maybe because it has a high dividend. Who knows what the underlying reason is for that, but it's something that you believe you want to hold in your portfolio over the long term. So why would you do the covered call? Well, you may be slightly bearish, and you may wish to pad your short-term losses by using a covered call. Let's say you've had a nice run in the stock, and then maybe that's what you would want to use. So, okay, let's get into the intricacies of this real quick before we get to a chart example. So, one, you own the stock. Number two, you sell a call at strike price A. So typically the strike price is below strike price A. So now you are bullish to stock long term, but are neutral to bearish in the short run. So you are willing to sell the stock if it reaches a specific level. Okay, so these are the factors that you initially have in your thought process as to why you would use a covered call. And when we get to the chart example, that's when we'll get to market environment and incorporate this into our strategies. So number one, our objective is keep the stock price as close to the strike price without going above it. And the call should be 30 to 45 days from expiration. Those are where you get the maximum bang for your buck for this strategy. Okay. So now we're not going to get into the overall pricing of options because that in itself could be a webinar. So we're just take it at face value that for the different strike prices and the different months that are offered out there for any option or strategy that we're talking about, this one, 30 to 45 days, gives you the best value. So maximum profit, how does that value? Well, the strike price minus the stock price plus that premium for selling the call. That's where your maximum profit is, okay? So if the stock skyrockets, you'll miss out on those gains. So keep that in mind. Remember, nothing is perfect. So even though the covered call is something where it's like a little bit of an insurance, you're bullish, you like the stock long term, but in the short run, you're expecting a potential either neutral market or a lower trading market. So now if the market all of a sudden, you never know with the stock, sometimes there's breaking news that comes out, you've already got this position on, and all of a sudden like there's a takeover for the stock, and all of a sudden there's a big, huge premium that explodes to the upside. That means your covered call, obviously you would lose, but you don't lose altogether. Your stock goes up, so you'll make that money, but you'll just be out that difference, which was the money you paid for the car. Excuse me, that you were out from the call. So now you have a break-even stock price also. Okay, that's the premium that you receive for selling the call. Okay, so that's your break even, and then your maximum loss is only if the stock goes down, then it's your premium minus the stock price, because obviously as the stock decays in price, that you are going to be losing an asset value until as long as you hold that stock, and as long as you haven't executed a sell to exit the stock. So remember, it's like an insurance policy in the short run, but it doesn't just totally hedge yourself. So that's something that you have to take into account. Time decay is your friend in this position. Okay, so a drop in implied volatility also helps to lower the call value. Okay, so remember that when you're dealing with implied volatility, implied volatility goes up, option prices go down in price. As implied volatility goes down, the option prices go down. So there's a direct relationship to that. So if you especially are in an environment where you sell the call in a high volatility environment, and then all of a sudden it stabilizes, for instance, the stock stays neutral, and the more neutral it stays, the more likely implied volatility will also stay the same. These are factors that work on your side. So real quick, we're going to use IBM for all of our examples, and then you'll start to see as we evolve from the simple strategy to the complex. So if you look at this real quickly, you can see that there's an entry date. Now this webinar, we made these charts from the recent activity, and we all know about the fundamental coronavirus that has impacted the markets. We know that caused a big sell-off during the last couple of months. So let's go back in time to when and why you would start to put on a bearish spread. So a simple fundamental is when markets are trending higher, you're doing what? You're consistently making higher move highs and higher move lows. So all of a sudden what happened back in February with IBM, after making a higher move high in the beginning of February, the market fell through and took out this last supported swing low that it made at the end of January. So that all of a sudden put the market into a neutral guideline. So let's say that you have IBM. When we're going to use IBM, it could be any stock in your portfolio, but this would be a scenario where you start to use bearish strategies. So on this day, you can see where the market had settled. It's right around $130. This is after the market had just been just below $160. This was a big slide that had occurred when the stock market started to sell off. Now, because of those fundamentals where you all of a sudden, you never want to try and pick a top or a bottom when it comes to the stock market. But however, when we had a crisis like we recently are going through still, That's a point where you know that there was a most likely there would be a downturn in the market, at least, or the market would be suppressed. So this is a good time to start using these strategies. So which call would you use? Well, here's what you kind of like get your guidelines. So the market we started out with, the market's at 130 as far as its stock price, where it's settled. And you want to know the next day, what options should I sell? Well, here's what you start to look at. One, we know that the option has to be above the market. So the closest strike price above the market would be the 135 strike and the 140 strike. Obviously, the 140 strike would be cheaper than the lower strike price. Now, which one would you use? Well, here's a good way of thinking about what you would think which one to execute on. You remember the time frame is 30 to 45 days out. You're still neutral to bearish, okay? So high volatility at this, or implied volatility at this time was very, very high. So that means you had a bonus of implied volatility, you have the bearish conditions, and either one, there's just a matter of which risk level you want to take. So now remember that when the stock price goes down, you'll make money off of the covered call, but it doesn't necessarily make up the difference of how steep the stock price goes down. That's why we use some of the other strategies which we get into, okay? So for one last thing is here was our level from the swing low. This is going to be our baseline that we're going to use for strike prices, because remember, where support all of a sudden fails, then it usually becomes resistance, which it actually did here. So it's easy in hindsight to say that, but when we were looking for the trade example, we wanted to give you the pricing to make it stick out. So okay, that's our covered call. So now here's another strategy for beginners, and that would be to use a protective put. Okay, so you buy the put at a strike price and you already own the stock. Why, once again, would you want to use this strategy? Well, you are neutral to bullish. Same thing, well, this is where you're neutral to bullish. However, you're worried about that the implied volatility is going to increase, kind of like what has been going on, you know, obviously over the past couple months. And then there may be a short downturn. So especially like, let's say with IBM, you're like, okay, even if the economy gets into a downturn and the stock market goes into a downturn, IBM is a viable company that is heavily entrenched in the technology sector and the cloud and blah, 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 all kinds of reasons where even Big Blue is something that nobody really talks about anymore. It still is one of the biggest technology companies in the world. So then you would say, why you want to be short-term, you're bullish, or bullish in the long term. So usually after you've had a nice run up on the stock, that's where you'd have this protective put. Now remember our example, and we'll get to that chart after we just cover these intricacies. So just to be clear, remember, you own the stock, you're buying a put at a strike price A, which is typically a stock price that will be, or the stock price will be above that strike price. So now you are bullish to stock long term, but now you are very worried. So remember the coronavirus variable, you know that you just took out a swing low. So in our situation of that day, what strategy would you use? A covered call. That's a great idea. Now we have a protective put. This is another way of playing that same trade. So you want the stock to go up strong and the puts to expire worthless. That's really what you want in this strategy. Ultimately, you want your stock to be worth more. But if not, you will profit on the put if there is a downturn in the stock, but you will lose stock value. But remember, if our premise for the stock is it's a stock that you want to hold in your portfolio, and ultimately you want to own it if you could. The question is, how can you manage owning that stock while we're still getting dividends and not having to take as much pressure and stress during any type of downturns in stock value. So the maximum profit theoretically is unlimited if the stock goes up. Okay, because then obviously if it keeps going up and keeps going up, you never know, it could split and keep going and be a bull for years. So that is a value that is, potentially, unlimited. The maximum loss is your stock price minus the stock price plus the premium paid for the stock. Okay, so this is where you have your premium. You got to remember you have a stock value that you start with. Okay, so when you buy the put, that basically raises the average cost of your stock price. So then, if the stock price goes down, you're losing more than you're down more money than you would had you never put on the strategy to begin with. In other words, or in the opposite case, you're making money where the stock totally appreciates and you're only out that little bit of a difference that you paid for the protective put. So the break-even price now, that's where the stock price plus the premium paid for the put. That's where we start your example. That's where the stock price has to elevate to cover that initial cost of paying for that put. So it raises, basically what it means is it raises your average cost for that stock whenever you put on a protective put strategy, okay? Now the good thing is there's no margin required after the option is purchased. So as we get into some option strategies, there's always strategies where you start to get leverage comes into play, and that's when you have to use margin. These are more advanced and intricate strategies, which we'll cover, but this is where we're starting out, where it's very basic. You don't have to worry about margin. That is not an issue. Time decay on this strategy, however, is the enemy because the option value decreases. Remember, in this strategy, you're buying the put option. So when you buy an option, time is always a negative variable, okay? Now, implied volatility is a double-edged sword. It can help if it's rising, but it hurts if implied volatility starts to decrease. So now we have our protective put. A protective put here would be below the stock price, and you would use 125 would be your first level. That would be the level you would use, and as you can see, the market deteriorated after this date. So the first you would have put on the trade, and for a couple of days, the market was hanging. Remember, you have this for a 30 to 45 day expiration, and within just a couple of weeks you can see how the market had decayed. You were obviously losing money on the stock price, but here's the difference though. When you buy the put, all of a sudden this 125 strike price, that becomes valuable. So now you're making money on the put. It cancels out the money that you're losing on your stock price. So you're putting in basically a hedge where you're only out the difference of that where you first initially got into the stock price plus the premium you paid for the option, but then you have a new value because your option price is going up because the market has gone much lower. So had you then executed either the put, or you would have sold the put out later, you would have helped to pad your loss for the IBM stock. Now here's the question, the collar. Here's another simple one. You own the stock. Now here you're going to buy a put at a strike price A, and you're going to sell a call at a strike price B. Why? Well, you are neutral to bullish and do not mind selling the stock if you ultimately have to. You are bearish in the short run and looking to capitalize on both the short-term call and the long-term put. Basically, it's like having both of the first two examples. So real quickly, you can own the stock, you're going to buy a put at strike price A, and you're going to sell a call at strike price B. Typically, the stock price is between these two strikes, A and B. Now, remember, you are bullish to stock, but you are very worried. So that would be like in the coronavirus issue where the market, you've been up in IBM and you had made lots of profits on your trade, and who knows how long you've owned it, especially if it's something you've had for years. And now you're in a situation where you start to get worried. This is where the collar comes in. This limits both your downside and upside risk potential. Usually investors use this to protect unrealized profits from a downturn. So this is like having the covered call, which we first covered, and the protective put in the last example at the same time. So what's your break even? Well, that is your stock price minus your net credit or of the stock price plus the net debit, okay? So that means that, remember, you are buying a put and you're selling a call. So the difference in whether you have a credit or a debit for that spread will be indicative of how your break-even price is. Because if you have a credit, obviously that lowers your stock price average, or it raises in the opposite for as far as where your break-even price is. Now, as far as maximum profit, where is that? Well, that's strike price B minus your current stock price minus your net debit paid or your credit received. Okay, so we'll cover that when we get to the visual example. This will make sense. For your maximum loss, your current stock price minus your strike price A plus the net debit paid or the net credit received. Remember, depending on when you put this position on and depending on whether you had high or low volatility, will be indicative of whether you're between buying the put and selling the call, whether or not you had a net debit or a credit. Now, here's the good thing is you're selling an option here, but you don't need any margin after purchasing the option since the call is covered. So that's a good thing. So now you're getting into a more complex strategy because you're using two basic ones, but you still don't have to worry about margin, which is a very good thing. Now, you do have time decay is neutral on this because since you bought an option and you sold an option, time really doesn't count. Irony of it all, it neutralizes it. Implied volatility also is once the position is on, no longer becomes a factor. So those are two things in option pricing that no longer have anything to do with the spread. So now let's see what happens. So in this example, what happened? You sold the call at 135 strike price, okay? Now, when you did that, the market was trading at 130. Now, you bought the 125 put strike price. Now, irony of it all, look what happened. You put on a strategy like this, unlike the other ones where you had only basically a one-way scenario to capitalize this market. The strategy, the market goes lower. As you can see, it broke down into March. Now, what happens? That means that the call that you sold at 135, that strike price, that money, that's a plus. You're not out that money. That money, that credit that you took in, that is your money. You don't have to worry about it. Now here's the bonus. That put that you bought at 125, now all of a sudden that put is worth money also. So you make money on both options, both ways after you put the trade on. Now this is because the market had broken, obviously. Had it rallied, it would be a different scenario. However, your risk would be limited, and we know it would be where your work would be capped at. So in a situation like this, we're looking at the same market, the same entry day, and these different scenarios. Now let's get to where you really want to see the experienced traders. What are you going to do? Time to take things up a notch. All right, well, here's what we're going to do. We're going to cover 4 very nice strategies for experienced bear plays, and I think you're going to like what we're going to talk about here. So the very first one that we're going to talk about here is the long put strategy. So now for the long put strategy, you own the stock, and then you're going to sell a put at strike price A, and you're going to buy a put at strike price B. Why would you do such a thing? So, well, in this case, you are bearish, okay? Risk is limited by implied volatility and market movement. Time is neutral. So this is where, as we get into these more advanced strategies, certain variables that you hear all the time, like implied volatility, and also, like we've said, the market movement, these things can be minimized and mitigated in certain ways, and then you're playing a certain variable on its own. So now let's go and look at this long put spread example. Okay, so in this example, you own the stock, okay? So then you're going to sell a put at strike price A, and then you're going to buy a put at strike price B. Now, when you do that, your stock price is below strike price B and above strike price A, okay? So now when you do this, the reason you put on this strategy is you are bearish and also have a downside target objective. So this is good when implied volatility is high. So like earnings season or the coronavirus event. Now here's another thing. Remember when we had the beginner options? This strategy as well is something you want to use only 30 to 45 days from expiration. And one of the reasons why I stress this is not just like my opinion. This is a fact because once you get beyond 45 days, or if you bought something that's below that, that's where time and implied volatility, they function on different ways. And I'm not going to get into the Greeks because once again, like I said in the beginning, that would be a whole webinar in itself. So we're giving you the best time frame scenarios for these spreads to capitalize on when you implement them. So this is not an opinion thing, this is a math thing. So, but we're just not going to get in and break it down for that. But if you want to know how to get into that stuff, there's all kinds of information on the eOptions website and stuff like that. And from the trading platform, you can access all kinds of ways of gauging how the implied volatility and these things work, and how, when you want to execute your trades and how they'll be impacted. So, but like I said, you have to go to their website to look that up. Okay, so now let's get into the meat and potatoes of this. Break even, strike price B minus the net debit paid. So now remember, you're selling a put and you're buying a put. Okay, so now there is going to be a net debit for this one. Okay, so this is a long put spread example. Okay, so now when you put this out, your maximum profit is your difference between strike price A and strike price B minus the net debit paid. Okay, then your maximum loss is your net debit paid. That's so if this position goes the wrong way, the only thing that you can lose on this position is your net debit paid. Okay. Now, another thing is that there is no margin needed after the cost of this spread. Remember, you're selling an option here, but then you're also buying an option. Okay. So that's a spread. Those cover each other, so you don't have to worry about any type of margin. Okay. Now, time decay is neutral. Remember that when time works against you when you are buying options. When you are selling options, it works for you. And since you are selling an option and buying an option, this neutralizes that effect. So time does not matter, but the 30 to 45 days from expiration, when you put the spread on, that does matter. So don't worry about time decay as far as a factor once the spread is on. That has nothing to do with anything. Now, implied volatility dropping does help if your stock is going lower. Okay, so now remember, these are bear market situations. So most of these spreads, they're either a way of gaining a little bit of positive interest while you're taking heat on your position and you're losing stock value, okay, or it's a way of hedging the direction, okay. So now in this case, it hurts if the stock goes up. Okay, if the stock goes up, you want implied volatility to rise. That would be the only thing that can help you out with this in this scenario. Okay, so now let's real quickly. This is where things get a little complicated for those of you out there that are not advanced options traders. Implied volatility helps if your stock is going lower. Okay, so if you put on the long put spread example, and when you have your stock position on, you execute this strategy, that will work in your favor. Okay, now, but it hurts if your stock price goes up. So now, if all of a sudden you own the stock, so that value, that is good. And remember, the only thing you can lose is the net debit paid. So what you're basically doing then is raising your average cost of your stock, or you're lowering your average price getting out if you were to execute to get out of the stock at the same time, you'd be lowering your actual true execution price because you have the debit that you had paid. So that's where that will take out a little bit of your profit in that case scenario, but you still would be making money on the bullish moves. You would only be trimming a little bit of your profits if the market goes up. Okay, so now let's look at the chart. So let's look at our example here. Remember, this is all the same entry day, okay? So we have the long put spread. This is where you buy the 135 strike price. And remember, that's right at our pivot point that we used that because that was a prior swing low where in support, where there is support. When the market goes below it, then usually that becomes resistance, just like the opposite, resistance becomes support. These are just basic fundamentals. So we're playing off that scenario and also the coronavirus fears and the big market sell-off. That's why, remember, we're using these strategies. So you buy the 135 put. Remember, your stock price is right around at 130 where it's trading. And then you're going to sell the 125 put strike A. So now in this is going to be a net debit for this, especially because look at where you're so close to the strike price for the call, or for the put price for the strike price B, because on the second entry day there, when you get into it, you can see how the market goes up into there. So your premium would be higher for this option here. So your net debit for this would then be, that's your cost. And that would be the most you could lose. Because remember, let's say that this market never did go back down and actually rallied and went back up to make new highs at $160. Well, then you'd be back up money in IBM, and you'd only be out that premium that you had paid for the debit for that spread. But that's it. You know your risk is defined. And that's something else you got to remember, especially the more advanced strategies that you use out there, always have defined risk. That's one thing I can say from my experience. If you want to know what helps to give you a future, not to mention just give you a chance, is that you have to always define your risk and be disciplined with that. I know plenty of people that had very large capital behind them, and it all disappeared just because of just that variable alone was one of the biggest things. That lack of discipline and defining risk meant that they were always taking trades where they just should never have taken it. You want to always have a good reward to risk ratio. You never want to risk more. That's a whole nother webinar in itself, money management. But these are things that you definitely need to consider. So now this one here, obviously the market went down, and so look at how this position ended up working out. So on the entry day, you were at 130. a month later, now the irony is today as we're talking, the market's actually $15 lower. So had you put this on back at the end of February and ridden this spread all the way out, here's what would have happened. You bought the 135 put strike price B. That would have been a winner. You would have made money off of that option. Then you have your selling 125 put strike here. What happens here? The market's below there. So that means in this case, you sold a 125 put. This is where now when the market goes lower, you have the issue where you can get exercised on. So whether you do, what you do here is remember, you don't mind selling the stock. Remember, you can always get into the stock. So now depending how long you held this, that would have been indicative of what you would have done as far as whether you would have liquidated your option spread and the stock, or whether you would have held it and then been executed on. But remember, here's the thing is that who cares if you sold a 125 put strike because you own a 135 put. So look at that. It doesn't matter. This one here is not a negative. It doesn't come back to haunt you. So that's why these strategies defines your risk. It keeps you it keeps you focused. You know exactly where you're at. Now, this is different than just doing a covered call. Okay, it's a big difference. There's a whole dichotomy between these trades where sometimes it's a good environment to do it. There's nothing wrong with those first couple of strategies that we use. This is a little bit more of an advanced strategy, and this is one where I think it's definitely for people that have been taking action in the option environment for a while. If you haven't been trading for, I would say, at least five years or more, or trading heavily, I wouldn't suggest starting to get into these spreads. I was looking more at the first ones that we had talked about, or a couple of the ones that are coming up. So now let's go and look at the short call spread. Here, this is where you own the stock. You sell a call at strike price A and you buy a call at strike price B. So why? You are bearish with high implied volatility and you wish to cap your risk. So once again, you own the stock. You sell a call at strike price A, you buy a call at strike price B. The stock price is usually below strike price A, okay? You are bearish, but neutral conditions are all right. Ultimately, you want both options to expire worthless. If A is one standard deviation out of the money, this will increase the probability of success. Now, that's something that we're not going to get into the total math of that, but just to let you know, just that one factor will help you out with this position. And once again, this is a position where you use 30 to 45 day out options. So your break-even price is strike price A plus the net credit received. Now, this one is a spread where you get a credit. Now, I love credit spreads. Now, credit spreads, whether you're bullish or bearish, this has been my experience, and both in equity trading and futures trading, I use these strategies, okay? When it comes to credit spreads, I love them. You have to get the good pricing, and it depends on what your volatility is, and we'll kind of get into that as we get through this example. So break even, once again, is strike A plus the net credit received. Your maximum profit is your net credit received at opening of the position. So after that, this position only goes down in value, but that's what you want, especially if you buy it back or if you let it go to expiration. Now, your maximum loss is the difference between the strike price A and strike price B minus the net credit received. And we'll show you that when we get into the chart example, okay? So now the margin is the difference between the two strike prices, okay? So now this is the first time when we have an issue where margin kind of comes into play, but not really. It's still basically kind of neutral. Time decay in this position is slightly positive. Now, remember, through these other examples we were talking about, whether you sell or whether you buy the options, it kind of wipes out the time decay variable. Not in the case of this one, and we'll get into that. Now, the reason time decay is slightly positive is because this is a credit spread. So right off the bat, you are taking in the option pricing when you start the position. The time value, no matter what, is going to decrease right after you actually put on that strategy. So that will always be going in your favor, okay? So that is slightly positive, okay? Just because of the fact that it is a credit spread. Now, the opposite would be if it's a debit spread. Okay, so implied volatility dropping helps if your stock goes down. Now, remember, you want the stock to go down in this scenario, okay? Now, implied volatility dropping helps because obviously as implied volatility drops, that also helps to reduce the price of the spread. Remember, you took in a credit. So even if you were to buy the spread back, if you have time, a couple of days of time decay, which helps you out, and then if volatility starts to drop, so even if you executed this strategy and then a couple of days later got out of it and the market hadn't really moved, you would most likely realize a profit just because of a drop in implied volatility and time decay. That's without any market moving. And then if the stock actually went down just a little bit, well, then for sure you would be seeing a profit on your spread. So that's a nice advantage to the short call spread. Like I said, credit spreads are a really big favorite of mine for my trading war chest. And I'll get into some examples of that once we get through into the next slide. Now, remember, if this the stock goes, implied volatility dropping helps if the stock goes down, but not if the stock goes up. Because remember, if the stock goes up, then it starts to go through your spread, and then you would be, your gain on the stock would not be as much because you'd have to give up the credit. And we'll get into how that works on when we get to the example here of the chart. So rising implied volatility will help if the stock price does go up, though. Okay, because remember, since it's a credit spread, if the price of the stock goes up, the credit spread, even though certain pricing values go down, implied volatility will work in your favor. So that's where if this position was to go against you, it actually wouldn't be as severe. Okay, now let's see what happens with this. So remember, this is where you're buying and selling two different strike prices. And usually the strike is it's right around, the stock is right around or right in the middle here. So here we have the market was right at 130. So we sell the 130 call strike price. Okay, and then we buy a 135 call strike price. Now, here's the thing is, a 135 call, since it's above the market, whether that's going to be at a cheaper price than one that is at the market. Okay, so this is where you're buying this, and when you sell this 130 call, that has more value. So that's where your credit comes in. Okay, so the only thing here that you know is that your risk is if the market goes up. But then what happens? Your risk is only the credit that you took in minus what you pay getting out of that spread, because you can only lose the difference between $1.35 and $1.30 minus the credit that you earn plus the credit that you already paid. So that would be your risk. So your risk is totally defined on this trade, which is fantastic. Now here's the beautiful thing about this. This market traded lower. We know we're using the same chart, same entry day, same stock for our examples. So what happens in this situation? The market eroded. So you're buying the 135 call strike price. You know that call went worthless. Okay, and then you're selling the 130 call up here. Well, that one obviously expires a winner. So your credit right there, that's good. So that was a little bit of a padding to your losses on your stock. Now remember, this started at 130. The market got all the way down to almost $90 a share. Now, in this example here, it got back to 117, which ironically is where it's trading at right now. Actually, I think it's at 115 today. So, and in this example, so that you would see that you would still be down right now $15 of value. However, you would have that credit plus any dividends paid. Now, I don't know if there was any dividend paid or anything like that. I don't think there was for IBM, but at least you know that you were in a situation where now you would still be down, $13 on the stock, but you would be actually down less than $13 because you have a positive credit that you made from the option spread. So once again, this is a credit spread, short call spread, one of my favorites. Now let's look at the long straddle. Okay, you own the stock, you buy a call strike at price A, you sell a put at strike price A. Why? Volatility is increasing and you are expecting large market swings. Well, this is great for the examples that we've been getting at, because guess what? Who cares if the market goes up or down? All it's got to do is it's got to move. You know that right now, you're looking at where the market has been, where you're at right now, and you're looking for volatility to drive the price of the stock away from where it's at. You're unclear. Like right now, you own a good stock like IBM, but then you have the coronavirus fundamental that's pounding the stock market. But then your IBM comes out with great earnings and lifts for whatever reason. These scenarios have you spinning. What do? here you go. You have a long straddle example. So once again, you own the stock. You buy a call at strike price A. You buy a put at strike price A. The stock price is at or near stock price A. So now what is the whole reason? Once again, you are anticipating a move in the stock price, but you are unclear which way it will move. Like I said, it doesn't matter. You don't even have to care. You just think that it is. You are definitely in a position where you think volatility is going to move, and whether it's bearish or bullish, something's going to happen. So this will boost your profits to the upside, and a large bearish move will offset your losses on the stock price. So this is something where, remember, you like IBM. Over the long haul, you want to own Big Blue, but you don't know what's going to go on with this, with the current market conditions. You want to be able to somehow ride the storm and at least protect your assets and at least have some sort of income coming in for your investment while you have a downturn, if you have a downturn. So what happens? Break even is either strike price A plus the net debit paid for strike price A minus the net debit paid. Okay, so what does that mean? Remember, you're buying a call and a put at the same price. So you are paying a debit for this trade. So when the stock price moves, whatever that debit is, that is wherever, if this, our example is at 130 for the stock price of IBM. So whatever, let's say you paid a net debit of $8. We're at $8. Okay, so then you know that has to move X amount, so it'd be 138. Okay, we're just using that as a blind number right now. So that would be where you guide your break even. So your maximum loss is your net debit paid. So the most you can lose on this position on the option spread is what you paid for the spread. You can't lose, since you're buying these options, you can't lose any more than you paid for it. That's the one thing that's nice about buying options. Now your maximum profit, okay, to the upside, it's unlimited to the upside, minus the debit paid. Remember, you paid for the spread. So the market has to move at least the price paid for the spread above the stock price for you to start to see a profit. But remember, let's say all of a sudden this IBM went to new highs, or just went back up to 160. So you would make all that money, plus you'd make money on your call, minus the price you paid on your put. And we'll get into the example when we get to the chart. Now, no margin is necessary after spread is purchased. Time decay works against you on this trade. Implied volatility helps if it goes up and hurts if it goes down. Okay, so for the long straddle, you buy the 130 call strike A, you buy the 130 put strike B. What happens? Well, okay, we know what happened. The market broke severely. So on this trade, let's say that you had followed directions, you did the 30 to 45 days out, as we've been talking about for these strategies. So as the market had gotten down, especially towards this $90 or $100 level, or even now, you would still be up on these spreads, or by now you actually rolled out of this spread. So where would you make your money? Well, you buy the 130 call strike. Obviously, you don't make any money on that. But on the put, that's where you make your money. And the best part about it is spread is right at the strike at the stock price, or really close to it. So since the market was trading at 130 or just above 130, that means anything below the strike price of 130, your put was kicking into gear. So that means you made money on this whole way down, and that's the way you covered. Remember, if you have a covered call, you only make the money that you took in as a credit for selling a call. That was the first example we started this webinar with. Now in this example, boom, you have the call and the put on both sides of the market. And when you actually have a move, and it actually, you didn't know whether it was going up or down, but guess what? It broke. And even right now, that would be still up money on your position. So your loss on your stock position would be covered by that. So that has a tremendous amount of power to influence what's going on with your stock portfolio and how you manage the risk with that, and covering it with a bearish strategy. So remember, I like those credit spread examples. I also love the straddle example. Now, here's another example, the long strangle. Strangle is very, very similar. You own the stock, you buy a put at strike price A, and you buy a call at strike price B. So they're not the same strike price. Now, why? Implied volatility is rising and a big move is expected. So basically, you're looking at the same thing as the last example. Now, here's the thing is, like I said, once again, you own the stock, you buy the put strike price A, which will be below the strike price. You buy a call at strike price B, which will be above the strike price or the stock price. Okay. Now, this is similar to the straddle. Once again, you are anticipating a move in the stock price, but you are unclear which way it will move. This will boost your profits to the upside, and a large bearish move will offset your losses in the stock price. And we'll cover that once we get to the chart. Your break even, this basically is the same formula as we had for the other example for the straddle. The only difference is that you are not using the same strike price. There's a gap between them. Okay, so the equation is the same as for the last one, except for the fact that obviously the pricing is different because you're using two different strike prices. Your maximum profit is limited to the upside minus the debit paid, the same as the last example, and the same as to the downside where it's your it's just your debit paid, and also that limits that cuts your profit potential. Your maximum loss is always just like the last one, your net debit paid. Your margin on this is not needed after the spread is purchased. Decreased implied volatility does hurt this spread, and rising implied volatility helps this spread. So it is same as the last one. So now here we have the IBM once again, the same example. Now remember, we were trading right around 130 for this position when this all these strategies are being used for. Now we have the buy the 135 call strike price above the market and buy the 130 put strike price right at the market, basically. So it's just slightly below where the market was trading. And once again, what happened, the market decayed. And just like in the straddle example, your put kicks into gear right away, and the only thing that where you're not realizing that takes away from your profit potential from this put is the price that you paid for the spread for buying the 135 call and also buying the 135 put. Okay, so with that being said, what you need to remember always with all these strategies is the impact of time. Time affects these strategies differently. Remember, you can go onto the eOption website and you can download their free option strategy guidebook, and it will give you all kinds of information on how to learn about the time and different variables for the strategies. Now, also maximum profit and loss. Remember, this is something you always have to take into account and be mindful of. Remember, there's a big difference between the covered call strategy and the straddle or strangle strategies that we just talked about. I like the straddles and strangles a lot, especially for this kind of environment. But once again, you got to be experienced with what you're doing. You got to learn how to walk before you crawl. And just remember always your expectations, they're going to be different. You know, what you get for a covered call is not what you get for a straddle, and vice versa. And then implied volatility. Remember, implied volatility impacts option pricing. That's one of the things you don't have to follow all the Greeks to know, but you definitely have to follow implied volatility and have a clue whether it's going up or down based off of which strategy you're going to do. Because remember, if implied volatility going up is good for your position, then that's one to take. If it works against you and you think volatility is going up, well, then don't do it, right? So with that being said, I want to thank you very much before we get to the questions. Once again, I wrote a book called High Probable Japanese Candlestick Patterns that Gina mentioned. And there's a whole section on bearish patterns and when you can go short the market or get out of positions. In this case, since you are holding a stock position, you want to hold that stock, but you want to put on a bearish strategy. So sometimes you don't know you're in an upward trend, you're still very strong in your opinion of the stock, but you think that, well, every once in a while I need to know when to cover myself. Well, when you have a bearish pattern that sets up, that gives you a timing situation where you're like, oh, maybe now is the time to put on a cover call, or maybe now is the time to put on a straddle or strangle. Let's say you're riding IBM and it's been railing for the past 2 months and you're up on all-time highs. Every once in a while, it might be a time to put on a straddle situation, and who knows? You find the pattern, all of a sudden it occurs, you put on that strategy, and then you see what happens. So with that, let's get to some questions that we have had here. So let's see, we have had a couple of questions. One of the most interesting questions are, what are some strategies to take advantage of low interest rate environment? Well, in a low interest rate environment, ironically, using high income ETFs, trading those and using options on them is definitely a great idea. One of the things that's nice about eOption is your stock and ETF trades are all commission free. So if you are trading ETFs in this low interest rate environment with high volatility and then putting on options positions, which are also you're putting on at a very low cost, I would say that would be a great start. Now, also with the low interest rate environment, here's what you have to take into account. Because the interest rates are low, interest rates are a function of option pricing. So if interest rates go up, then the price of calls will that pricing will start to go up, and the pricing of puts will go down. Whereas right now it's the opposite, where call prices are down and put prices are high. Okay, so interest rates do have a factor when it comes to options pricing. We could spend a whole webinar on interest rates. I started trading the treasury bonds 30 years ago. In fact, that one of the first markets I started trading was the bonds. And so watching interest rates is something that I've done for my whole career. Okay, so let's see. How can an investor use options to navigate wild volatility? Okay, well, wild volatility, once again, we talked about our straddle and strangle example. That would be where you could definitely manage volatility in a great way. Also the credit spreads. Now here's another thing. Let's say that your straddle and strangle is an idea that you like. And then here's another idea. You can do credit spreads the same way, where if, for instance, if you're bearish, you'll sell call spreads. So I see we have Cecil Chang raise their hand. I don't know what the question is, so I'm working off of these. Maybe they'll get it to me somehow. Let's see. How can your investors? Okay, so let's see. What are the most important lessons you've learned being a professional trader? I would say, first of all, one, you have to have a plan. Number two, you have to be disciplined about sticking to a plan always, no matter what. You do not waver from it. When you don't just willy-nilly put on a trade and then figure out what to do with it, you should have an actionable reason why you're putting on a trade. Also, risk management. You should have rational expectations. One of the biggest things I've encountered, and this can definitely get into where we've talked about strategies where you own the stock already. So you have that value in your portfolio, and then you're looking at it as a way to manage your risk with that stock. So that's a way of hedging or curtailing potential losses while we're holding that position. Now, when you are not doing that, there's other options trading strategies you can use where you don't own the stock. So then you start to increase your risk level. So then you definitely need to have not only just a strategy in place, but be very mindful of your risk. Remember that if let's say you start out whatever your balance is and you're down, let's say 5 to 6% on your trading account, you need to make like 15 to 17% to come back to even to become profitable after commissions. Let's see. Okay, here I finally got the questions here showing what are some key pointers to determine when to use strangle and straddle. Okay, key points for that is the volatility. For instance, whether it was even now, right now, where we're at in this market environment, it was funny because we've had a nice bounce in the stock market, and we were talking about first when we were coming up with this webinar and producing it, it was like, okay, well, let's take advantage of the current environment. We'll do this bearish strategies webinar. Now here, we're like, oh my gosh, the market's been bouncing for the past 2 weeks, 3 weeks. What do we do? Well, this is when you use straddles and strangles. You have no idea about market direction. You expect a move, you expect volatility. Like nobody expects the stock market pretty much to stay stagnant over the next few months as we come off of the effects of the coronavirus fundamental. And then we have earnings season, which we have had a tremendous turnout in certain companies where they beat expectations and they were a surprise. But we have this potential tidal wave of businesses that are closing potentially over the next 6 months. So this is where when you're trading, especially like the stock indexes or major stocks, for instance, put on a straddle or a strangle. Here's another one. You have a raging bull like Amazon that, it took a beating in the first month of the stock market sell-off. And then within literally weeks, it's like back to all-time highs, So, and this is something where you can, as a options trader, straddles and strangles, buying options now is something where volatility works with you. I can give you an example, like the .com era of the 90s was when I first started really trading equity options. And I still to this day tell people, I can't believe how it was like having an ATM every single day when you had stocks like Qualcomm, AOL, that these stocks were trading $30, $40, $50 away from where they opened up. So you could literally buy straddles and strangles on the opening and then sell them in an hour or two before the close, just like 5 hours later. And like you would make money every single day almost. And because not only did you get the market movement, but there's next to no time decay because you're only talking about a couple hours. The only edge you were really losing was between the bid and offer from not being on the floor, because I was working on a futures pit, so my equity options were being traded over the phone, which believe it or not, my first equity account was at Regal Discount Securities years ago, back in the day. So, which is now obviously Regal Securities and e-options. So let's see. Also, what data points should I use to determine the best strike price? Okay, what is the best data points to determine the best strike prices for straddles and strangles? Okay, well, for straddles, obviously you want to be as close to the strike price as possible. With a strangle, obviously you're going around it. Okay, so with that being said, usually you can find some, it's not too far away from the strike price, but I would usually try and go, like, especially like in this situation where you're looking for, most likely you're in a bearish market, like after you've made a significantly higher move high, you're making newer move lows, then that would be where I'd try and have the stock price be already be above the straddle and the strangle. Okay, so it gives you probably a little bit more edge. So if you're buying into a correction or placing the spread into a correction, that gives you a little bit more vig to the upside. And if you're right that the bearish movement continues, you're already leaning on the offer. So that's kind of how I would look at it for the best pricing on eyeballing it. See, the other thing is too, is you have to look at when you're on the when you're executing the trade, is what is your pricing. See, sometimes there's discrepancies where, like I said, I would pick this one scenario, but if the pricing tells me that the other option price is, like, for instance, if I am, in this case, I'd be buying. So if I can buy one straddle at a cheaper price than the other one, and I'm expecting the same market movement, I may actually be able to capitalize a little bit more on that. So that's hard for me to give you a direct answer without knowing the pricing at the moment you're putting on the trade. So there's a couple of variables you'd have to eyeball on that, but otherwise I go back with, like I said, have the market above the straddle point, or strangle point for that. Being said. And let's see. Oh yeah, how does an investor stay calm in the markets? What strategy you use to stay unemotional? Well, to stay unemotional, that's something I just became numb to a long time ago. So that's a little bit harder of a question to ask on how to stay unemotional. You just don't get emotional anymore. But as far as like what strategies to stay unemotional, like I love straddles and strangles for equity positions, just because of the fact that you don't have to worry about direction. You're just looking for volatility to rise and the market to move. And if you are right on those two variables, and usually the market movement is really the only one you have to be right on, that's the way to go. Let's see, when to use strangle or straddle. You mentioned implied volatility. Is there a recommended percentage to use on one or the other? Well, actually, no. For the straddles and strangles for implied volatility, remember that it's just a matter of defining your risk. The straddle and strangle are going to be a little bit different in price. So where you give up that difference because you're buying the options, that difference in price and where the stock is in between those two strikes, the volatility is going to be the same for each position. That's not going to make a difference. So you wouldn't choose one over the other because the implied volatility is rising or lowering. And as far as a recommended percentage, it's not the percentage that matters. It's the implied direction. So when you're buying a straddle or strangle, you want implied volatility to be low. You're expecting implied volatility to go up. Remember, for a straddle or strangle, it's not the direction, it's the fact that you get market movement. And if you do get market movement, a large market movement implies what? The volatility will go up. So, and with that being said, I think that we are probably out of time with questions, and I think that Gina might want to come back on. I'm not sure.
Yes, thank you so much, Teddy. We're going to wrap it up now. That was very interesting and informative and quite a lot of information, and definitely gave our customers and the people on the webinar a lot of food for thought. So thank you so much. I really appreciate it. We had a few questions. Wanted to let you know the webinar is recorded and we will make it available in a couple of days on our website at eoption.com. Also, as Teddy mentioned, if you go to eoption.com, we do have a free option strategy book that you can download, as well as we do have an education tab on our website where we have hyperlinks to all of these strategies that Teddy talked about. So you can click on the strategy like a long strangle, and it'll tell you when to use that strategy, and points to think about, and really get into specific details. So it's a great resource if you want to get a little more in depth in some of these strategies. Also, as Teddy mentioned, we do offer a tool called Options Play. It's an online trading tool, and it's free to all eOption customers. And basically what that is that'll help you to set up the right options strategy or the right trade for you, depending on your strategy, if you want to sell a covered call, if you want to generate income. So if you haven't checked out Options Play, I suggest you look into it and go to eoption.com and check it out. We do have instructional videos that shows you step by step on how to use it and get started. And it's a great tool whether you're a novice just starting in options or you're experienced, sophisticated investor. We find option traders of all levels find it particularly useful. And again, it is free for all eOption customers. And last, we do plan on having more webinars in the future like this. Teddy will come back and give more in the future. And if you like us on Facebook, you'll get advance notice of these webinars as well and get trading tips and market updates. So again, thank you so much for attending. We really appreciate it. And we look forward to seeing you in the future at another webinar. Thank you so much. Bye now. Hello, and welcome to eOptions webinar. And we're excited to have you here, and thank you for taking the time out of your day to join us. We're happy to partner with Teddy Keckstad, again, a professional trader with over 30 years of experience, to bring you this webinar on 10 ETFs every options trader should know. Some of you may be familiar with Teddy. He gave our last webinar about a month ago, and so we're excited to have him back. My name is Gina Bocayas, and I'm with eOption. And just to provide you with some logistical information on how this is going to work today, the webinar session will last approximately 1 hour. And if you have any questions during the webinar presentation, please feel free to type them into the question box at the bottom of your screen, and our speaker will answer those at the end of his presentation. You should see a little box at the bottom that says Q&A, and you can enter your questions, just type them in there. Also, you can reach eOptions Trade Desk at any time if you have any additional questions after the webinar. And if you go to eoption.com, you'll also find information on option strategies where you can type in the strategy or click on it and it'll show you basic information, as well as you can see our other educational videos and other webinars we've done in the past. And so for those of you just joining, we'd like to welcome you to our webinar on 10 ETFs every option trader should know. And I'd like to turn our attention to our speaker now, Teddy Keckstad. Teddy has over 30 years of experience in the financial industry, and he has years of trading and industry experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. And he's been an institutional market analyst for over 25 years. He currently serves as president of Forex Trading Unlocked Incorporated, and he also has a YouTube channel at Forex Trading Unlocked that you can also check out. He's the author of a book called High Probable Japanese Candlestick Patterns, and he has a degree in finance from DePaul University in Chicago. So without further ado, I'll turn it over to Teddy Keckstad, and we'll get started. Thank you.
Thank you, Gina, and thank you to the viewers for showing up for our webinar today, 10 ETFs every options trader should know. And I want to thank you very much for that great introduction. So since she gave the background for you guys, we can just skip past this slide right now. And real quickly, want to give you the eOptions disclaimer to remind you that this webinar is for educational and informational purposes only. And since every time I do something, I also have my disclaimer from my company as well, Forex Trading Unlocked. So let's get to what you guys are all here for today. First of all, you're going to learn how to maximize your option trading potential with ETFs and ETF options. So now how do you do that? Well, you use you use E-option for your ETF and ETF option trading right off the bat. There's a good start. One of the reasons why is you get free option strategy trading tools like Options Play that are available on their website. You have a free option strategy guidebook, which is available at eoption.com as well. So the strategy that we go over today and the ETFs that we go and the examples that go over today, you can actually run your own kind of examples and strategies through these things as well. You can sign up for a free paper trading account to test your strategies like the ones that we're going to go over today, and you can see how these might work in the future on different ETFs that you may particularly desire on trading. And also there's another reason to go with E-option, because ETF and stock trades are commission free, and also their option contract commissions are only 10 cents per contract. So they are right there with all of the majors, and unlike some of the newer ones that you might think, oh, it's a cheaper and better deal, well, you get what you pay for, and you don't want to, you want to have someone you can talk to, and you don't want a brokerage house that's going to go down either. So let's go into what you're going to learn on how to use these tools from E-option. Well, you're going to learn how to expand your opportunities in broader market sectors for one. We're going to cover 10 ETFs today. And I think that you're going to really like how a couple of them we really bring in how you can really see how you can integrate ETFs and ETF options in a way that will give you a chance to participate in broad markets without having the risk of where you would if you use other different derivatives and things. So your expanded portfolio diversification is something also that you gain by using ETFs and ETF options. So you, instead of just having outright stocks or bonds or funds, you can actually, like I said, participate in different ETF sectors, and we'll cover them as we go along. So now here's another thing we're going to talk about is how to maximize your potential returns with options on ETFs. Okay, and then we're going to also use simple option trading strategies that can increase your odds of success and protect your trades. So this is what we're going to get into. I think it's something that you're going to find that's valuable, whether you're a new trader or new to options, or if you're an experienced veteran trader like myself. So bear, bull, or neutral outlook strategies. Well, there's all kinds of strategies, and we're going to show how the strategy that we're going to use is kind of like a little bit of all three put together. So how E-option can help improve your bottom line. Well, like we said through the last slide, as far as being commission free and very cost effective on option trading, now we're going to show you how to use their products and their platform to implement these trades. Okay, here we go. So why ETFs and ETF options? Well, first of all, you lower your cost basis. ETFs are commission free, and at E-option, it is only 10 cents per contract, much lower than other firms. Now, here's the thing you got to think about. Let's say that you want to participate in broad market sectors, and we're going to get into some some examples of where there's metals markets, interest rate markets, equity markets. If you want to trade derivatives like the S&P 500 index and the futures and futures options, you have to be, one, a very skilled trader, have a very good amount of capital behind you, and understand the risks. But with this, using ETFs and ETF options, you can do the same thing without taking on all the risk, let alone having all the margin issues as well. So ETFs help you diversify your portfolio because you can trade broad market sectors through one product and without the high risk of leveraged derivatives, like I was saying. So ETFs allow smaller to larger investors the ability to capitalize on trending markets that are highly liquid. So for instance, like the S&P has been all over the place because of the coronavirus fundamental trade that was on for a few months. And then also we've had recently, because of other geopolitical things, especially political things within the United States, that have caused a lot of instability and volatility. How do you capitalize on these things? Well, let me tell you, as an ex-S&P guy from the floor, you don't want to be trading the S&P futures or futures options unless you really know what you're doing. I like it, but I would suggest most people stay away and look at the spiders, and the QQQs, which we're going to get into. So in both the ETF and option pricing, the spread is typically very tight. This is another thing where you gain an edge. If you're trading the futures or those leveraged products, typically the spreads are not always as good as you would get in the ETF market. ETFs are very, very liquid. They're just like your heavily traded blue chip and other heavily traded NASDAQ stocks and Russell stocks and things like that. They fall into a classification where even on a slow day, you have liquidity, which means your bid offer spread is very, very tight. And a lot of times you're basically getting in at the market, like at the actual price point. There's not much of anything. You're right at the actual cash price, which is very significant when it comes to your cost basis for trading. When you think about the spread getting in and out of your trade, the wider that is, that means that you're giving up, and the more edge you give up getting in and out of your trade, that goes against your bottom line. So your winners are less and your losses are greater. So using ETFs and ETF options helps to control one variable that is something that definitely will be indicative of whether or not your bottom line is higher or lower. Not necessarily that your trading is going to be higher or lower, but at least that one variable will be. Trading in these products is the same as trading in any normal equities. So for any of you that are used to just trading like IBM or Apple or, you know, Tesla or whatever stock you're talking about, and even starting to trade those options, ETFs are no different. It's kind of funny, like when you're new to trading, you start to hear about this market and that market, and like, oh, what does it mean? What does it matter? Like someone like me who's been trading for 30 years, I buy and sell numbers, so it doesn't matter if it's a futures contract and a stock price, stock market product, or an ETF or an option or whatever you want to call it. I just buy and sell numbers. But for now, you need to focus on what we're talking about, which is the ETF options markets. So trading these products is the same as trading in normal equities. Okay, so now 2 for the price of 1, the collar. This is the strategy that we're going to be using for this webinar. You own the ETF, okay? So we're going to go over 10 of the that are the top 20 ETFs that are traded. So these are all, like I said, highly liquid ETFs where you're going to have really, really good actionable trading results because of liquidity. So in this trade, you're going to buy a put at a strike price A, which is below the ETF price. And then you're going to also simultaneously sell a call at a strike price B above the ETF price. Now, this is because you are bullish to ETF, but you're starting to get a little bit nervous about the trend, especially over anyone that hasn't been in a coma for the last 4 months knows that 2020 is something where everyone's been nervous about every trend, no matter what market you're trading. But this is good for traders because we want opportunity. The only way you can have opportunity is if you have market movement and market volatility, which those are 2 things that we are not lacking right now. Time decay is neutral for the most part. The reason for this is, and we're not going to get too heavily into the Greeks because which are the different valuations on how you price out an option. But this strategy kind of is nice. Remember how when we started out, what are we going to learn today? How is this going to be a bullish, a bearish, and a neutral strategy? Well, the neutral part is that time is neutral for the most part. You're going to be buying one option and then you're selling one option. So where it fails, where time starts to decay on the option you bought and you're losing value, it's helping you in the option that you sold because it's losing value because of time decay as well. And then that also means you're being a plus side on that. Now, implied volatility is also fairly neutral because it does the same thing. So if implied volatility drops, meaning that whatever the ETF price was and options pricing was when you got into the trade, if the volatility goes down, the value of both those options are going to go down, but that neutralizes itself because the one you sold, you want that to happen. Obviously, the one you buy, not so, but they cancel each other out. So those are 2 things that you don't even have to worry about. Now, that's a very nice thing when you're putting on a trade. Now, the one thing we are going to have to look at for this trade is the options will be traded anywhere from 30 to 45 days out. This gives you pretty much the best pricing mechanism besides the fact that, remember, I mentioned about the spread. So getting into the spread for not just the ETFs, but the options, you'll get the best pricing, the best liquidity. And also, like, since time and implied volatility don't matter, the beginning part of the curve or the later part of the curve, these are all things that you would talk about if you're studying the Greeks on how to price out a trade. We don't have to worry about that. So we're making it very simple. So for all those of you who are wondering, is this a complicated trade? Absolutely not. Now, the funny thing is, it's actually 2 trades. When you sell a call, that's like you're doing a covered call position when you have a stock, okay? And if you're buying the put, well, that's when that's the same thing as when you're covering a stock, as if you wanted to see if it's going to go down, and you want to hold the stock indefinitely or for a long period of time, but you're nervous about its short-term potential trend position as far as whether you're going to continue to go higher or whether it's going to start to reverse gears and all of a sudden become a bear, and you don't want to give up your potential gains that you've already seen on your position. So now with that, now that we've explained everything, let's get into the first trade. So here we have the SPY. So what is the SPY? Well, this SPY Spider is the S&P 500 ETF Trust. So this is basically when you talk about the S&P 500, this is what it is, except this is the ETF that goes on it. Now remember, there's the S&P 500 index, there's the that's the cash, okay? Then you have the futures and the futures options. Now this is the Spider is the for the SPY is the ETF equivalent of the S&P 500. So when you hear the S&P 500 number on the radio or the news, and when they talk about the financial shows and the markets, the Spider would be something that is basically the same thing as the S&P 500. Okay, so with this trade, here we are on June 8th when I made this video for this webinar. I looked at the pricing and I figured, okay, we're going to take these 10 ETFs and how we're going to place these trades. So what are we going to look at? So here we have the market has been railing up into June 8th. As we know that while there's been all kinds of crazy volatility between the coronavirus fundamental and everything else, the stock market somehow bounced at the end of March and has continued to leg up higher, even though it has not made all new highs yet. So with this trade here, the market was trading at 321.19. So this is where the top is right here. And as you can see, this yellow line, this is the upward sloping support line that is maintaining the trend, okay? So we have the SPY 325 call that costs $498. Okay, and then we have the SPY 315 put that costs $781. So our collar trade is we sell the 325 call at $498 and we buy the 315 put at $781. And the reason is because we are long this Spider. We like the fact that we want to be long this, but we're getting kind of a little bit nervous about whether or not it's going to maintain this rally and stay bullish. Is it time for a correction? Well, corrections can happen at any time for one, but we have a lot of instability and reasons why, for instance, especially with the second potential wave for coronavirus and things like that that are going on. At least when this was made a week ago. So this spread, if you put it on, would cost you $2.83. So it's basically, it's $283 because remember, it's a $100 multiple, just like with a regular option trade, whether it was for Apple or Tesla, it's a multiple of 100. So this would cost you $283 to protect this ETF position if you were long the ETF. Now, what does this mean? Why would you do this? Well, this, like I said, you are bullish, but you're wondering that you're looking for a correction. Now, what happens if the market does keep on rallying? Well, if the market rallies and because you sold the call, it gets exercised, well, you're making money on the ETF. So the only thing you lose technically would be your debit of 283. So you just have to look at it. If the market, as long as it gets above $325, which is your strike price of the call, plus your debit of 283, then you've locked in your return, and you already know that the only thing that you did was it did not make $283 out of the max of the move if the market should rally higher. Now, should the market go lower, here's what happens, okay? So our maximum potential profit equals the call strike price minus the ETF price minus the net debit. So that was, like I said, the 325. You got to add 283 to that because that's what you paid. That's what you forego. Okay, so that's where you get your loss in would be just that, or excuse me, you would restrict your potential gains by that 283, but you lock in where you're at. Okay, so you wouldn't be losing money on this. You're just capping your gains. Now, if your maximum potential win, it's totally different, okay? Because remember, you're selling the call and you're buying the put. So if the market was to fall below the 315 price here, that would mean that the call that you sold would be obviously a winner. Then the put that you bought would all of a sudden become a winner as well. Now you would be simultaneously losing money in the ETF. Now remember that this is a strategy where you want to stay long the ETF. What you're trying to do is lock in either a potential return or limit your potential losses in the short run while the market is correcting, not necessarily completely reversing trend. You never know whether a market's going to, which way it's really going. But for instance, in this situation, you're looking to cover yourself. Remember, this is two strategies in one. It's a covered call, just like you have a protective put going on. That's why it's called a collar. You got basically both sides covered on this trade. So our break-even price equals the current ETF price minus the debit paid, meaning that if the market stays where it's at by expiration and doesn't move at all, then whatever gains you're up in the ETF would be minus this debit here. That would be what you would be down in that instance. However, you would have been protected. Obviously, this market would have to go sideways for that to happen. However, you would have been still protected for the 45 days. Now, since I've given you this example, you're like, oh, this is all fine and dandy. Well, what does that really mean today? How does this translate? So we're going to give you the answer to that question right now. So the same example here, we have the spider, but we had this updated to today before this webinar came on this morning. I wanted to see what would be the pricing and how this trade would have evolved for you. And you can see why you put these trades on because of the scenarios like we said. Remember, you are long these ETFs because you like these markets, okay? So being long them, if you didn't hit a target that you want to execute your target price and get out, since you want to maintain your long position, you need to hedge yourself, at least when you know that there's most likely an increasing chance of a market move, whether it's either going to accelerate your trend, which will be in your favor, which is good for you. You can't lose that way. But if it does reverse gears, you want to at least keep some of the profits that you have realized and then for either reevaluate and get out later, or you can put on another option strategy and readjust then. So this particular example here, remember we had the spider 325 call was at $4, meaning 400. And then we have the, the spider 325 call is now at $4, meaning 400. And the spider 315 put is now at 1129. So that's 1,129. Big difference in price, okay? So remember, our original collar trade here was we sold the 325 call at 498. So it's basically just under $500. Then you buy the $315 strike price put for $7.81 or $781. The net debit, remember, was $2.93. Okay, well, here's what happens. Today's open, the collar trade, the 325 call was priced at $4, okay? Remember how I said that? And at 11.29 was the put price. So that means the value, if you were to execute this, would be $7.29. Well, if you sold it out and all of a sudden you have a realized profit of $7.29, that's because then you take out your debit of $293. That means you're basically have a $4.36 profit on this position. So your original ETF price was at $320.79 when I made this video or the slides for this video. And this morning, the market was at $313.45. So as you can see this gray line here, this is June 9th, June 8th. This was when the first example was first made. The market has traded for the past week. And as you can see, remember that upward sloping support line? The market came through it. Now the market made a higher move low. So the market has been making higher move highs, higher move lows, and continuously, which is indicative of a bull market. However, we did take out this upward sloping support line from the main trend. This is the first bearish indication right here, meaning that you're set up not necessarily for a bearish slide, but for a neutral trade more likely than positive trade, okay? And now here's the other thing that's interesting. We rallied over the past few sessions, and now here we're back just above this upward sloping line, but we're below our put price. So now we'll have to see, we still have, because it's only June 6th, 17th, these options expire on July 17th. They're still a whole month away. So if you liked this hedge before, you probably still like it now, because even though you're down on your ETF price, you're up on your options hedge. So you're doing exactly what you want, and you're still long the S&P 500, which ultimately is your goal. Now, should you decide to get out of the ETF and not put down a different options play or whatever, this is all stuff that it would obviously be your decisions for your reasonings and for whatever your goals and trading objectives are. But for this example, we're doing taking the assumption that you want to be long the S&P 500 indefinitely through the ETF, and you're trying to figure out how to weather the corrections without getting out, instead of trying to time the market. You know how the people, a lot of people you hear on the major news financial shows, they say average person should not try to time the market. It's going to burn you every time. Well, this is a way of not timing the market by being long, staying long the stock market, but then capitalizing off of short-term corrections. In this case, you would be making, 400 over the course of the past week by holding the ETF and having put on this position, which would have cost you under $300, you would now be up over $400 on this hedge. So for the correction, you would be up that. Obviously, you would be down the difference on the ETF price, but you don't care about that because you want to stay long. You're just trying to limit your losses. And then remember, if the market is going to go back and makes new highs, then your ETF price goes higher, and then you also will be sorry about that, will also be up on that position as well. So whether you put another one on later at the end of the month, if at the end of July 17th is a whole nother topic of a conversation, and we can answer that question later if anybody wants to know that, because now it's time to move on to the next ETF. So now we're going to the QQQs. This is the NASDAQ, guys. This is one which is the high flyer with the tech stocks. If you want to participate in this market, like I said, instead of dealing with the futures, I would definitely look at these ETFs. So now this example, we have the QQQ 245 call, which costs $4.43. And the QQQ 235 put, which costs $6.52. Remember, for a collar trade, we are selling the call. So we would sell the 245 call for the price at $4.43 in this example, and buy the 325 put at $6.52 for a net debit of $2.209. So it'd be just over $200. Now, in this example, the market is trending higher, making higher move highs and higher move lows. Remember, your potential loss, once again, is your debit paid. It's your ETF price minus your debit paid. So if the market goes nowhere, the only loss you have is on the spread. You wouldn't have it on the ETF. If the ETF goes lower, obviously you would be making money on the spread. So in this case, you have the 245 strike price and the 235 strike price for your options, and the market is right in between these two. And remember, the maximum potential profit is if the ETF rallies above the call price, because then eventually you'd be exercised on your call, and you would lose your the difference you would lose would be the debit minus the ETF price once you're exercised out. So you still would be making money. You'd just be making a little bit less money than if you had not put on the collar trade and there is a big rally. However, if there's a break, then it's a totally different story. And remember, your break-even price would be if your current ETF price minus your debit paid. So that's where you're at with that. So your maximum risk on your hedge is $209, but you have a potential, remember, if the correction does come, to realize a nice little gain. So let's go to our next ETF, which is the GDX VanEck Vectors Gold Miners ETF. Now, this is a pretty interesting trade to look at here. When we made this slide, we looked at the calls and the puts, and I'm thinking, okay, well, that the call has to be above the market, the put has to be below the market. So ironically, the low from the prior session was right above this $31 put. So I used that as the base. So the put was $1.65 in price, and the GDX call was $1.35. Now, this is pretty interesting because the collar trade here, you sell the $34 call at $1.35, you buy the $31 put at $1.65, for a net debit of 30 cents. So we have a 30 cents debit. Can I put on mobile with a single click? I'll look at that question in a minute. So anyhow, this would be a net debit. It's next to nothing. It costs $30 to put on this hedge, which is kind of crazy when you think about it. But think about this. Gold is something that fluctuates in a big way. Now, when I was looking at it, I noticed, oh my gosh, while I'm looking at putting on a collar for the GDX ETF, look at what else is going on here. We have a head and shoulders pattern here. So for any one of you that is familiar with technical analysis, you can see how we have this initial bullish trend here with this upward sloping support line, this big yellow line, okay? And that's where the shoulder came up here, and we fell through this, which showed that the market wanted to go kind of neutral. And that's neutral to higher, neutral, and that's what a head and shoulders is. It's where the market starts to lose the velocity that it originally had, and even though it still is pressing through resistance and going a little higher, it's having trouble. So it looks like it's trying to consolidate and base, but it's still bullish. But then you're looking for the turn. So as you can see, here we have this head, and then we had this little break, and then we had this little shoulder. And I notice here's this little neckline. So here's the day I'm looking at the trade, and I'm like, we already have a head and shoulders that's already formed. So this is the perfect time for a trade like this. So just in case you want to know, as far as where the market goes, this actually had gone flat. So basically, the market right now, the gold market, is basically trading sideways over the past week. So not much has happened. So this spread cost almost nothing to put on. You still have a month to go, and the market is basically right there. So in a position like this, you're still long your ETF. You have a month to go, where if there is an upside breakout, and think about this, the reason I'm explaining this to you is that this is a head and shoulders pattern. So this line that's coming across here right around $32.59, this long blue line, which is right where the market was trading at when this example was made. Anything below here, below this put, that's all profit. So you'd be losing on your ETF, but you're definitely getting a short-term correction, but you're prepared for it because you have a head and shoulders pattern. And usually when you have a head and shoulders pattern, it results in pressuring support to some degree. Now, will it get the total maximum target? We're not even going to get into that. That's a whole nother lesson in itself, but this does have you in a bearish way. So remember, you like the ETF. Here's a situation where you have a head and shoulders pattern on. What a great time to put on a collar. So if you didn't like to put a collar on before for those other two examples, here's a reason where you're like, oh, you know what? Now I remember when Teddy showed an example of how the market was rallying, all of a sudden there's a head and shoulders pattern. What kind of a trade do I put on? Well, with this one, you don't have to get too complicated. You're pretty much looking for a bearish correction. You put on the collar, you're covered on both sides, and then if you get the break, you actually still get all the bang for your buck. You're still long your ETF, you make money on the hedge, and then you wait for the bounce, and then you're still long your ETF, and you figure out what you want to put on another options play or a different options play at that point. So that's why you use the collar. Remember, once again, the maximum potential loss and the maximum potential profit are the same. So now we're going to go to the EFA. So the EFA is the Russell 2000 ETF. So we've covered the QQQs, which is the NASDAQ. We've covered the spiders, which is the S&P 500. And now we're at the Russell, your middle of the road stock index, which covers a very broad base of stocks. So now for the EFA, we have the $66 call and the $62 put. So that means for the collar trade, you sell the $66 call and you buy the $62 put. This would be another instance where the market is slowly grinding higher. You're right in the middle of these two option spreads or these two option strike prices right here. And if the market does start to run out of gas, you know that you are protected and you know that you have the potential to still be long in this upward trending bull market. I mean, look at how we have this upward sloping yellow line right here. Here's the day that we put on the trade on June 8th. It goes all the way to July 17th. So we're still another month going on yet. Anytime that it falls below $62 and then starts to come, if it does come down towards this upward sloping trend line like it did over here, if it holds and goes back up, well, that's an ideal scenario for you on your ETF, because that means you've gotten a little correction, a little digestion, and a chance at another bullish move higher. At the same token, if you have this trade on, if you put it on this date, as the market comes down to this point, you have the ability to capitalize on that hedge and take a profit on those options and then stay long your ETF. So how you manage it and stuff like that, and the timing, that all is indicative of other factors in your goals and whether you have target objectives and what your strategy is for being long the ETFs. But in this scenario, this is what you would do. Okay, now we're going to go to the HYG. Okay, HYG iShares Box High Yield Corporate Bond. Now, this is something where now we're going to talk about the interest rate market. I started out trading sugar and the 30-year bond when I was well, a lot younger. It was the first two markets that I traded in the futures markets. And the interest rate markets I love because they're very tight. Typically, well, they used to be, especially some of your shorter term rates. Now, when you look at this, you're talking about corporate bonds. Now, we hear a lot about the Federal Reserve all the time. Once they have the FOMC meetings periodically, and you're always hanging on the decision on whether they're going to touch interest rates. Now, recently, we know with what's going on in the current market conditions with the coronavirus fundamentals that have been going on and stuff like that, you can see that this corporate bond ETF has been rallying since the middle of March. Now, one of the reasons this has probably been is because interest rates were cut and the Fed has started to do its open market buying operations, propping up the federal bond market. Now, then there's the corporate bond market. So the Fed came out last week and said, hey, we're going to prop up. The irony of it all is I made this slide, and a couple of days later, the Fed comes out and says that they're going to start buying the corporate bond market. So that's good for those that are holding this ETF. If you were insecure about holding the ETF and you didn't know what option strategy to put on, you got some good news there. That's on so many levels, I think it's actually more of a problem than good news. In the short run, I think it's good news. But it does tell you when it comes to this kind of a hedge, what can you do? So here we have the $83 put strike price and the $86 call strike price. So we have this upward sloping trend line. Remember here, you are bullish interest rates, you're bullish the interest rate pricing. Remember, when bond prices are going up, that means that interest rates are going down. So you're bearish on interest rates, meaning they're going lower, and you're bullish on the bond pricing. But since we're basically capped out at zero, how much more is there to go? Another reason why you want to have potentially a collar trade on or some other option spread to help you weather the storm as you are buffering up against a ceiling. I mean, no matter what, we could go, I guess you could go into negative territory. I mean, we have had synthetic negative interest rates, but I really highly doubt that the Fed is going to start to pay people to actually borrow money. It's not banks to borrow money, because then that's a whole nother issue on itself. But this is a good reason why we put on these collar trades. Okay, so this gives you another way to participate in the corporate bond market without the risk. When it comes to the corporate bonds, they're like evaluating stocks. When you're looking at the indexes and the broad base market like this, you have the ability to absorb the sector. And the sector is always a good way of dealing with this instead of dealing with individual like bonds, I would say, especially now since interest rates are so low. Let me look at the questions we have. Why would you not exit at the bottom 4 days ago? Let's see, that was, why would you not exit at the bottom 4 days ago? Well, how do you know that was the bottom 4 days ago? That's the first thing. Never trying to pick a bottom or a top. The main thing is, when do you exit? You have to have your target parameters involved. So for instance, like when you have corrections, what are you looking for? And I'm actually going to get to an example really quickly, and that will probably answer as we move on that question. Let's see, another question. Should you be worried about the sell call being assigned if it goes above the call sell strike price? No, absolutely not. And remember that the reason that you're putting on this trade is you like the ETF. However, if the market rallies above the call strike price and you get exercised, that means that you're making money off of the rally. The only thing you're losing is the debit that you paid for your option. So you can always buy the ETF again. So it's like this. I always tell people, you don't want to let a winner turn into a loser. That's one of the reasons why you do strategies like this. Now, if you have an upside target price, which in this case you do, if a market rallies above your call price, you're making money. So you don't lose money by taking a profit, especially when you blow through your target. So in that case, it's, you could say, well, I am out of the market, but you can always get back in. And the thing is that if you've gotten out of the market and you made money on your trade, there's nothing to be disappointed in. It's like when you're it's like when you're on the tee box of a par 3 and you hit the green and you still have a 25-yard or 25-foot putt. Well, how many people hit a hole-in-one on a par 3 consecutively? You know what I'm saying? So that's basically the same thing. It's like if you hit the green on the par 3, you're already there in par potential. Take your get it close, tap it in, and take your par. And be happy with being up a winner. Remember, pigs get fat and hogs get slaughtered. So you don't want to be a hog. You'd rather be a pig and eat nice and stay plump. So we'll get into the next example. I think it'll be a little bit more clear on this. So HYG, the high corporate bond ETF that we were just talking about. Look at what has happened since then. Since then, ironically, with the Fed not only buying the institutional debt market from the federal side and now saying it's going to back the corporate side, look at what's happened so far. This market, the day that we put on this first slide, was trading up near its highs. Now it has fallen below this upward sloping support line. So that's the first indication that we have a potential for a neutral to lower trade developing. It hasn't yet, because remember the high that we're coming off of and this low that was made a few sessions back here, this was a higher move low. Remember, when you have higher move highs and higher move lows, that's indicative of an uptrend. However, in the short term, this low, this higher move low, could potentially be the beginning of the new slide lower. Why? Because it took out this low back here. So we made a higher move low in the longer grand scheme of things, but we went lower than the last higher move low. And we are now no longer in this upward sloping support line here. So these are two neutral to bearish indications that there's a good chance that this market could go lower. Now remember, when you put this on, that you put this $86 call on, this $83 put, you sold the put, you bought the call for a net debit. Well, guess what? Right now, time has eroded. Remember, time doesn't really mean very much. Volatility doesn't move very much, but the market has traded lower. Now you're trading just above the strike price. So this is a situation where, and especially since we've just made this low the way we did it, if yesterday's trading, if this is the cap, if we don't get above 85.14 where the high was the day before this slide was first made, then what's going to happen here? We have the potential to take out these lows. And if we take out this 81.84 level here, you're looking for a nice corrective move lower, which means your collar trade would be good. So in this case, you're still long the high corporate bond ETF situation. You're very prepared with this collar trade right now, and you still have a month to go. And if the market does rally and all of a sudden finds a big gush of strength, well, then you get exercised on your call, you make money, and you just lose the difference of the debit. So you're still going to be positive on that scenario. Remember that when you blow through your call, you're making money no matter what. It's the downside that you're using this for, is to limit your downside exposure and limit your downside losses. So remember, if you get exercised once again on the call, it's a good thing. It's a good thing. Let's see. I did not see anywhere to select option strategy for trading. That's something you have to do on the eoption.com website, and I believe they have a support tab for that as well. So that would be in their strategy book line. So anyhow, that's the corporate bond ETF, the HYG. Now let's look at the XLF. This is the financial selector index. So this is a way of trading the financials, the bank stocks and the brokerage houses and stuff like that, in a way that instead of dealing with the individual ones, you deal with this one. And for this trade here, back in this, we did all these ETFs on the same date, on June 8th. This is one where you would have sold the XLF $28 call for 59 cents and bought the XLF $25 put for 63 cents for a net debit of 0.04. So you're looking at next to nothing to put this spread on. Now remember, when we were talking about maximizing your profits, and definitely by doing that by cutting your bottom line, because if you cut your bottom line, no matter what, you are either making your profits stronger or you're reducing your losses. So if you can put on a spread like this was on June 8th, it expires on July, and this one goes out to July 24th. You're looking at almost 2 months for this market to move away from the point where it was at on June 8th. Now, in this situation, obviously the market had been going higher. They're making higher move highs and higher move lows over the past couple of months. But remember, you're kind of shaky, the stock market and things like that, especially financials with what's going on. That's why you put on a trade like this. And think about that. For next to no cost, remember, it costs you only 10 cents an option. So you're talking about 20 cents for the option plus the 4 cents. I mean, you're looking at nothing to put on an options hedge where you have basically a covered call or a protective put, which equals a collar trade, all for it next to zero, and you have almost 2 months in which you have the ability for the market, if it just moves $3, I mean, think about the day that I did this, the market was trading at $26.54. The day before that, it was at $25. So it was $1.50 move right there. And you're looking for this market just to move. It's in the middle of a $3 range. It's not that it couldn't stay sideways for the whole time. However, with the way the volatility is going here and the way the market's trending, I think you can see where I'm getting that. This was a layup trade. I mean, this is crazy. It costs nothing, just literally dollars to put on a trade that within any time the market moves $3, $4, it's great for you, either to the upside or to the downside. Now, silver, this is another great one example we're going to run through real quickly about how you can participate in broader markets and not take the risk. Remember, I told you futures and futures options are for experienced traders, people who are capitalized, and you definitely have to have a trading plan. You have technology. There's a whole, I could spend a whole day talking about what you need to have before you're ready to do that. But if you want to participate, for instance, in the silver market, here's a great way to do it. You have the SLV, Silver Trust iShares. Now, when I put this trade on, once again, all these were done at the same time. I've looked at these prices and I'm like, okay, well, we had the day of the trade, we had looked like we were coming off a new higher move low. So I marked the last low here at 1570 because there was a 1550 put. So I'm like, oh, this is great. We'll use that as our base because if we're looking for a protection, we wanted to capitalize off of the put as much as we can. So this was a 1550 put, and the SLV 1750 call was above our most recent higher move high. So when we did this trade, SLV, so we sold the SLV 1715 call, bought the SLV 1550 put for a net debit. Now here is what's interesting on what was going on. Why would we do that? Well, the silver had a good run up. They do it for the same reason as all the other ETFs. You're bullish the silver market or the whatever the other ETF market it is, but you don't want to get out of it, so you have to put on a position. So when I did this, interestingly enough, if you look at this gray line here, this is the date that I put on the silver position. If you go back to here, see how it is June 8th, this is the date. See how it's above that upward sloping yellow line, that support line? Well, on June 8th in the futures market, it was there the same. Now the futures market the chart looks a little bit more full. You would wonder why, but that's because there's a difference in volumes and also pricing a little bit. Remember, the cash market is one, the futures is always at a positive, it's either at a credit or a debit above that. So one thing that I noticed on this date was that we had just made this high here, made a higher move low, higher move high. But then this date here, I'm like, this is a higher move low. I'm like, okay, so this will be our baseline, $17.39. This is good. You know, this is what was going on in the silver chart back then. Well, now this is today, or actually as of yesterday, because out of rulings, you can't have live futures data. Everything has to be in delayed. So this was as of yesterday. So over the past couple days, it took out the neckline here, which is a head and shoulders here, which is a sell signal. So you got a shoulder here, a head, and a shoulder here. Then you have a bearish engulfing line sell signal. That's this big down day right here, which also ironically was the same time that it topped out here in the ETF. So on the day when I looked at the ETF thing, I'm like, okay, I looked at the silver. I'm like, okay, well, here's this, but there wasn't a head and shoulders yet. It was just a bearish engulfing line. Then I looked at it today and I'm like, oh my gosh, I haven't looked at silver since then. And it turned out to be a full blown head and shoulders pattern, with this being the shoulder, and the past couple of days coming right down to this upward sloping support line holding up the silver market. So great time that if you're getting shaky being long the silver market, well, you have a head and shoulders sell pattern, plus you have the bearish engulfing line sell pattern. Not that these things mean that the market's going to go lower. However, if these things work, you have the market most likely heading down towards the 16 to 1550 area, not necessarily bearish, but a bearish correction. And that's why you put on a trade like this. So ironically, we looked at the silver and look at where it is. Here it is, a day that we put on the trade initially. That day, the silver ended up rallying for the next couple of days, set the shoulder, and then see, this is a head and shoulders as well. Came down, did the same thing, took out these upward slope, took out the neckline from the head and shoulders, sell signal, and then it took out this long-term upward sloping support line, and today still was below it. Remember, there's a discrepancy. Remember I said between the futures and the cash? The futures was still on that or above that line, but the cash, which is indicative of the ETF, was already below it and trading below it. So that means that the collar trade is a plus, and you have, for the same rationale, once again, being like you want to be long silver, but you're looking for a short-term correction. There's a gap to be filled here on the ETF. It wouldn't, like I said, get down to like say 1550, even down to 1450, get a nice little bounce, stabilize, and then there you go. So that's how you can trade another big broad market sector without using expensive derivatives and risky derivatives. Now we have the Russell 2000 IWM ETF as well. Here's another example where at the same time period we had the 160 call and the 150 put, which means your collar trade, you sell the IWM 160 call, you buy the IWM 150 put. You can see how this was in the same type of scenario. We marked a little last low, higher move low here as a support base and a target area. And this will be another market that has high liquidity, and it's a broad-based index that can help you participate and at a very low cost in these markets. Like I said, remember, if you trade the futures, you have to pay the commissions in and out on those things, but not on just the futures, but on the options. So you don't have to do that with ETFs. And also pricing. If you think that you're going to get as tight a spread in the futures market or even the Forex market or the futures options market, you will not get that like you will in the ETF and ETF options market. So where you may not get the full leverage capability, and you will not have the highest risk exposure, and your cost basis is also less. Remember, trading, you want to make money. Trading is a business. It is not gambling. Your whole point of investing in trading is to make money. So one thing you can always control is your costs. If you choose to pay high commissions, if you choose to pay high costs, you choose to raise your bottom line. That is a financial decision. However, if you choose to try and keep your costs down, which is a smart business decision, I think, and has been proven the test of time, then you want to cut your costs, which you can by trading ETFs for free, cut your costs by trading options for only 10 cents, and also cut your costs by having a tight spread getting in and out of these options. So here we have the S&P oil and gas market here. Now this is going to be one really good example as we wind down this webinar. So we have the $75 call and the $65 put. Look at how this market, remember how oil all of a sudden it came back off from March, exploding into June. All of a sudden we're paying higher prices. I mean, I paid $1.69 at the pump for a month and a half for unleaded, and now it's back up to $2.25. So this is where it was when I started this slide. Here's where the XOP was today. Look at this. The market tanked. So think about this. You would have sold your money. You would have made money on your $75 call, and also you bought the puts. You're up money up. You're up money on that. So you're still in the ETF had you exercised this trade and put this on, and you would be already up a really nice amount of money, and you still have. Look at this, July 24th. See how we made this higher move high, and we recently made this low 2 sessions back. Now we're kind of bobbling around. If this is a lower move high from yesterday, and we take out this bottom right here, that we made a couple sessions ago, that would mean that we do what? We made a high, we made a low, we made a lower move high, and then a lower move low. Very bearish, which would help to accelerate this the pricing on your collar. So remember, you got over a month to go. So time's not an issue, but pricing is. The lower it goes, the more you'll make on that hedge before it eventually bounces again. So, and now we're going to look at the EEM. which is also a July 24th expiration heading out there. Now this is the EEM is the iShares MCI emerging markets. So if you want to participate in your emerging markets, this would be the ETF to do it in. Now here, when we did this example, we found the 42.50 and 39.50. The market was right in the middle of this $3 range. So that's why we took this one, because the pricing came off of this last little low here, and it gave us the ability that if we come through this put price, we could come down this upward sloping support line, which would still would keep us in a bullish trend, meaning that we still want to be long the EEM ETF, but we would be profiting off of the collar trade, especially setting this up. So why switch from July 17th to July 24th? That was because of, for that particular ETF, because of the liquidity, because you could go out that far, and the pricing, it was worth it. That's why I looked at the July 17th. And there's some where you got to realize that they don't have all the same expiration dates. That's another thing that you need to take into account. The main thing is you want to be 30 to 45 days out. That was a way of stretching the longer out option for that example. Now, I want to say thank you very much. We're going to get into some more questions real quick, but I just want to give you one little plug for me. If you want to see more videos that I do, you can check us out on YouTube at Forex Trading Unlocked. Or if you want to learn how to exercise these high probable Japanese candlestick patterns, check out the book, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And oh, I see the edited probable didn't get caught there. That was corrected and then not saved properly. Oh well, so once again, for E-option, maximize your option trading potential. Use E-options for your ETF and ETF options trading. Free option trading, free option strategy trading tools like Options Play are available on eoption.com website. The free option strategy guidebook is also available at eoption.com. ETF and stock trades are commission free, just like all the major other competition out there. And eOption also has option contract commissions that are only 10 cents a contract, which is bargain below. You're not going to find a better deal out there, folks. And remember, you also get what you pay for. You want to be with someone with a history. They've been around for a long time. They've been in all kinds of markets up and down and through all kinds of geopolitical things. And as we move forward in technology, you want to be with somebody who hasn't been around for only 3 years or 3 months or whatever, because you will find that you're not going to do well when the markets really start to decay. One more thing is, apologies if it is already explained. Why do you do collar trade? You sell call at a price. What happens if the stock goes up to the stock price? Once again, if the market goes through that call price, you are making money on your ETF, and where you will get exercised on your call, and you'll just lose your debit, which will be that minus when you get out of your ETF when you sell it out there. That'll be the only difference. So you'll give up a little bit of your potential profit if it goes through your call price. But the thing is, you are making money, and you don't have to worry about when it goes to the downside. And the thing is that's the main thing, is that you want to stay long, and you're kind of shaky in terms of whether in the short run, whether you're going to see any real expected higher move highs. You're expecting the market to go sideways to lower, and that's why you put that on, because then when you do have a break, especially when we have right now where volatility is high, so where volatility doesn't affect your pricing for your trade, that's why I used the collar example. When volatility is high, like the VIX is high, this is a great reason to put those trades on, because odds are the market's going to move. And if you notice, most of those were only $3 wide, and those markets were trending in $5 moves. So the potential for you in that time frame to move $1.50 to $3 in either direction is high. So if it goes to the upside, you're making money, you're just not making as much. And if it goes to the downside, you're still long your ETF, you can still make, and you're going to make a nice little bit of money on the side as well. So with that, we have questions about the ETFs and options. I think we're right at the time limit, and we don't have any more questions. So
Eddie, there were a few questions in the chat room I just wanted to throw out to you. Someone asked, is the data you use real time? Is there a delay, such as 20 minutes for bets?
Okay, for the data that I use for the webinar, obviously this is everything. This webinar is obviously in delay. Everything was already, made up before. But the data that I used, the pricing from the options, that was all live pricing from the SIBO. And then I also used the futures, obviously was delayed for the silver example, but for the ETFs, that was just a 15-minute delay on that. So, but I used the opening prices for today's numbers to see the differences from, because I started on June 8th was the original slides, and for those examples to see how the pricing and the markets moved to show how they would have reacted. That's why I use those.
Okay, great. No, thank you for the explanation. And we just got one more question.
Sure.
That someone had just missed part of the webinar. And yes, this is recorded, and we will post it to our website in a couple of days. So if you go to eoption.com, under resources, we have a webinars and videos tab, so you can click there. It will be there in a couple of days. We will also email it out to each person who attended this webinar in a couple of days, so you can review it at your leisure. And just to wrap it up, Teddy, thank you so much for an interesting and informative webinar. And hopefully
you're welcome.
Everyone who attended, we got a few more questions in, so
okay.
Maybe we'll just try to address those.
You want me to? I saw one here. Would the concept still work for stocks versus ETFs, or is it more favorable for? No, absolutely, it works for stocks, especially right now with the volatility. I mean, you look at a stock like, for instance, Tesla. You're long Tesla stock. You put on one of these positions. Now, I would suggest probably straddles or strangles more for a stock like Tesla, because, I mean, every time Elon Musk says something on a video chat somewhere or something, the stock moves $10, right? You know, so that would probably be more of what I would suggest. But also with Tesla, especially with the market, if we get a big sell-off in the NASDAQ and things like that, Tesla is still going to probably take a hit for a little bit. So a collar would be a good example for a market like that, for a stock as well. But it depends. You know, for other stocks, I would say more of your bank stocks right now, your brokerage stocks, or you're probably even like your more tried and true stocks like Walgreens, Johnson & Johnson, the ones that will maybe have an initial sell-off should we have another second wave from the coronavirus and the market gets hit, because those will bounce back quick. So those are ones you probably want to hold. So the collar example would be good on that, because if it breaks, you're going to be hedged. You're going to have a little bit of juice while you're getting dividends too, you know, and then you are obviously either readjust different option strategies once you've had a correction, you know, so that's a totally different story, you know, and it's also about what your objectives are. You know, like I mentioned, you know, when I did these examples, it's under the premise that you're looking to hold these ETFs. Okay. You want to stay long these markets, but you are at least short-term neutral to bearish. But if the market rallies, you're willing to forego a little bit of profit because you don't want to lose what you've already gained for the most part, you know? So, I mean, if you're only giving up a couple % of what you've already gained and also have the potential to even increase your potential reward, then why wouldn't you do it? You know, so that's why you put these strategies on. So they do work in the stocks, to answer that question.
Okay, great. And then there was one more question. When you say long, do you mean owning the ETF?
Yes, that means you own the ETF for sure. So if you were shorting ETFs, it's a totally different topic. So, but this is what all these were under the premise that you want to participate in these broad-based market sectors. And while you've been long them, you've already been in a position, instead of just having a corrective stop in the market, which is one thing you would do. If you didn't have, for instance, if you didn't have a collar on or anything like this is something I have to say to all you viewers out there who catch this webinar. If you don't have a stop in your positions, you should. You definitely should. So, but that's why you use option strategies, so that you can take off the stop, don't worry about getting stopped out in the market, and take advantage of market swings. So it's a way of using the mechanism. Remember, there's all kinds of market mechanisms out there. Most people just choose not to use them. That's their choice.
Okay, great. Well, thank you so much, Teddy. We're going to wrap
You're
it up
welcome.
now. And thank you to everyone for attending this webinar and for taking the time out of your busy day. We really appreciate it. There were a few questions about entering option trades on our mobile app, as well as our trading platform, how you can easily enter spread trades. And so I would encourage you to give our trade desk a call, and they can walk you through it. And you can either email them, or the phone number is 888-793-5333. Again, 888-793-5333. And that will give you an experienced trading professional who would be happy to walk you through it, how to do it. And so again, thank you. And we'll be having more webinars on option strategies in the future, and we'll send you details. You're on our list now, so we'll let you know, give you advance notice of that. And you can also go to our website at eoption.com under resources, and you'll see the webinar tab there. Like I said, you'll get the video recording later this week of this webinar, and you can also see our past webinars, and we also have other instructional videos on there. And we also have a lot on option strategies. So if you go to our website and you click on strategies, you can hit the collar button. It'll walk you through exactly how a collar works, how to enter it, the advantages, and so forth. So we do have a lot of great education on our website, so please feel free to check it out at eoption.com. So again, thank you everyone for attending. We greatly appreciate it, and we hope to see you at our next webinar in the near future. Thank you. Hello, and welcome to joining eOptions webinar. We're excited to have you here, and thank you for taking the time out of your day to join us. We're excited to partner with Teddy Keckstead again, a professional trader with over 30 years of experience, to bring you this webinar today on Do You Think You're Priced Out of the Market? Think About Options. My name is Gina Bocayas, and I'm with eOption. And just to provide some basic logistical information on how this webinar will work today, the session today will last approximately 1 hour. Teddy's presentation is about 40 to 45 minutes, and then we'll take your questions at the end. You will see on your screen there's a Q&A box, so feel free at any time during the presentation to enter your questions in there, and Teddy will do his best to address all of them at the end of the presentation. You'll also see a chat box, but we ask that you put your questions in the Q&A box and not the chat box, as our speaker will not be able to see those in the chat box. And also, after today's session today, if you have any questions at all about the content or specific strategies, please feel free to call eOptions Trade Desk at any time, and our experienced professionals can assist you. And a popular question that's often asked is if there's a recording that will be available of this. And yes, we always put them on our website within a week after the session, and you can just go to eoption.com, and we do have a tab called Webinars and Videos that it will be directly there. So for those of you just joining, we'd like to welcome you to our webinar today on Do You Think You're Priced Out of the Market? Think About Options. And as eOptions name implies, we are a firm that specializes in option and stock trading. And we do charge some of the lowest option rates in the industry. Our options are just 10 cents a contract plus $1.99 per trade. And all stock and ETF trades are commission free. We also offer other products such as mutual funds, fixed income as well. So we also support option education, and we're glad you can join our webinar today to learn about using options to trade in this volatile environment that we're in. So now I'd like to turn our attention to our speaker, Teddy Keckstead. Teddy has over 30 years of experience in the financial industry and has also worked as a professional trader. Some of you may recognize his name from past webinars he's done for eOption, and we're very excited to welcome him back today. And to tell you briefly about Teddy, he has over 30 years of trading and industry experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. He's been an institutional market analyst for over 25 years, and he's currently president of Forex Trading Unlocked. He's also an author, and he's written a book called High Probable Japanese Candlestick Patterns. And he also has a degree in finance from DePaul University. So without further ado, I'll turn it over to Teddy Keckstead, and we'll get started. Thank you.
Thank you very much for that introduction, Gina, and thank you, eOption, for sponsoring this webinar today. And let me just get this slide going. Here we go. So do you think you are priced out of the market? Think about options. So we're going to skip past my little documentary since Gina already did it. So we're going to first show up our disclaimer to remind you that this webinar is for illustrative and educational purposes only. So please take a moment to just read this real quickly and just look it over. And there's information if you have any other further questions on it as well. And then I always have mine from Forex Trading Unlocked as well, but I can just briefly skim over that because we already had the other one. So maximize your option trading potential. Use e-option for your stock, ETF, and options trading. You have the ability to get a free option strategy tools from their website, like their options play. You also have their free option strategy guidebook, which is also available at eoption.com. And you also can start your own paper trading account also to test your option strategy off of eoption.com's website as well. So one thing you want to remember is the ETF and stock trades are commission free, and options, which we are going to talk about today, their contract commissions are only 10 cents per contract. So we are going to talk about what you will learn today. So we're going to talk about how to trade the big stocks without large capital allocations. I'm sure a lot of the names that we're going to mention today are very familiar to all of you. Even if you're not familiar with options trading, I'm sure that you are very familiar with these names, these equities that these options are going to be based off of. So one thing you can do with options is you expand your portfolio diversification, which is something everyone wants to do as they begin to grow their portfolios, no matter at what level you are at, whether you're beginning or even advanced. So then we have, we also are going to talk about how to maximize your potential returns with options. So you can have, with options, they are a mechanism for the markets in which you can maximize your return on your investment. And we're going to discuss that as we go through the examples today. And then we have this simple option strategy, trading strategies that can increase your odds of success and protect your trades. And so that's what we're going to talk about as we get into these strategies. They can be used for both bearish and bullish, and also there are ways you can apply these when you are in a neutral outlook also, and before you put them on. So how e-option can help improve your bottom line also is obviously something we're going to show you, because since they have such very low commissions for your options trading, that right off the bat is one way to help you with that. So why stock option strategies? Well, the first thing is you lower your cost basis. At eOption, it is only 10 cents a contract, much lower than other firms. Option spreads help you diversify your portfolio because you can trade a much broader range of stocks with your allocated capital. As we get into some of these names and you see how much these stocks cost, it'll become very clear to you how options all of a sudden make these stocks something that you can participate in a different fashion. So option spreads allow smaller to larger investors the ability to capitalize on trending markets that are highly liquid. In both the stock and option pricing, the spread is typically very tight, and this is a very important cost control. Why is it an important cost control? It gets back to how do we increase your bottom line. The more liquid the market, the tighter the spreads. That means that as you're getting in and out of your options contracts, that your pricing is going to be better for you. When your pricing is better, that means that your profitability is better. It also means that in the event that you lose, which losing is something that does happen, you don't lose as much. So that's something that you want to always take into consideration as, like, when we go over these strategies, the reasons we're looking at these particular examples isn't to promote these particular equities. They just happen to be highly liquid stocks, and they also have very highly liquid option markets. And once again, this is a way of controlling a cost. And when you can control a cost, that's something that's very important in trading, especially with options, because it's one of the few things that you have the ability to control, where you have the ability of whether it's going to be a good outcome or a bad outcome. So we're going to discuss that more with our examples. So trading in these products is similar to trading in normal equities, but with a higher potential ROI. So you will definitely see that in very simple math as we get into this. Today's focus, straddles and strangles. These are very, very simplistic option strategies, and we are going to give you a breakdown on how they first work, and then we're going to show you through some examples very simply how you can apply them and how you can expand your portfolio by using these strategies. So first of all, one of the main things is there's no margin. That is a big deal. So when it comes to option strategies and option spreads, there are some that will require margin. Margin means that you have to have more capital. The more capital you use, obviously, the less you can do, depending on what markets you're trading and how volatile things are. And especially right now, we have a very, very high volatile market. The VIX is something that is an indicator of market volatility. It's been very high for months for multiple reasons, especially we know from the geopolitical global impacts of the COVID-19 pandemic and things like that, how it's had the ripple effects. So defined risk, that's another reason why we're talking about straddles and strangles today. So besides the no margin, defined risk, this is something that's very, very big. Remember what I was mentioning in the last slide about controls? This is something else where you have the control. So outside of that, things start to get a little more sketchy because none of us can control the market. But if you can control your costs, if you can control how you get in and out of your trades, which is also part of controlling your costs, and then if you can define your risk, locking in what your potential loss is, or your capital that you're allocating for a potential risk reward, that is something that is huge. So these are variables that are all in your control. And they're also simple execution. That's the next stage. That's another reason why we like straddles and strangles. Very simply executed. And then also it's a volatility play. And this is where right now we're in a volatile market. And this is something where you can take advantage of it because volatility plays can go for you and they can go against you. And we're going to show you how these can work for you and actually how you use the current volatility with these strategies because it actually fits the current market environment. So with that, we're going to start to look at something visual that you're going to have more of something where your eyes will be like, okay, what are we looking at here? So Boeing Company, BA. Boeing is a company that is, if it's not on the radio, it's on the news, it's in the TV or somewhere every single day, it seems like, from the MAX Jet 737, right? And as you can see, besides the fact of the volatility that every market has seen over the current past 4 or 5 months, Boeing has not been any different. Now, when we started this, the idea for this webinar, now we're at the end of July, I picked the Friday, the July 10th, just to be our marker for the options. So all the examples we're going to use today are based off of August options, which usually when you want to put on a spread like this, you want to have 30 to 45 days out minimal. And pretty much that's a good range for most straddle and strangle plays. If you want to go out for much longer months, that would be a more advanced lesson. So, but for when you're considering the volatility, when we started this marker here on July 10th, it was a perfect time because we'd seen such extremes where the market had started to consolidate. And ironically, as you can see this gray line here that separates this whole middle of the chart, there's an arrow. It says piercing line buy signal. This is actually a Japanese candlestick pattern that is a reversal signal. So let's just say that whether you're bullish or not, because of the high volatility and expecting higher volatility at this point, this would be why we would put on a straddle or a strangle. So now the definition of a straddle is when you are buying and both a put and a call at the same strike price. Okay, so in our example here, you see we have our straddle. It equals buy the 180 call and buy the 180 put. So when our example here with this little black arrow here on July 10th, the market was trading right around $179.96, so just below $180. So 180 is a strike price for the options, okay, just like 175 is also. So there's the options are priced out in strikes of $5 increments, okay? So now when you do a straddle, what you're doing is you're trading both of the same strike price. You're buying both the call and the put once again. It's the same strike. Now, at the moment of this slide, when we first came up with this webinar, the market was trading just below 180. So the straddle would be the 180 call and the 180 future. Now, if you were to buy the stock, you would be paying just below $180 a share. Okay, so for 100 shares, and we'll get into the example, that would be our baseline for what we're looking at. Now, for a strangle is very, very similar. However, the strangle uses 2 option strike prices. So in this example, we would be using the 180 call, which is the same as we used in the straddle. So 180, when the straddle, we only use the 180 strike price. In the strangle, we use the 180 and the 175. And then so for when we buy the put, that's where we use the lower strike price. So your upper strike price is your call, and your lower strike price is your put when it comes to your strangle. Okay, so just remember, a straddle is the same option, and a strangle is where you use two options. Okay, so now at this point, for this example, the market's at basically 180. So what does that mean for this option spread? So when you buy a straddle or a strangle, you're looking for the market to move. Now you may be bullish, you may be bearish, or you may not have a clue about which way it's going to go, but you just expect volatility for one to increase and also for market movement to continue to increase. So now in this example, we have a potential buy signal with this one pattern. Now there could be other reasons why you would be bullish here, or maybe you would be bearish, because for either example, whether you're bullish or bearish, so let's say this buy signal is incorrect and it fails, well then it still works out for this trade. So for those of you that are following or didn't quite get that, yes. So in this example, let's say you had a buy signal, okay, and it fails. For both the straddle and the strangle, you would be able to profit off of that move no matter what. Okay, so now if the market goes nowhere, that's where you would not make any money. And the reason you wouldn't be making money is there's multiple factors in option pricing. One is your time decay. So no matter what, over time, you would be losing money. Now, over a couple days, it's not very nominal. Over the course of a month, especially for options like these that are 30 to 45 days out, then you're using up a big part of your time premium. So you need market movement to absorb time premium no matter what. Otherwise, that part will start to decay. And especially since you're purchasing these options, you want to sell them for more than you purchased them. So in order to sell them for a profit, you need to have market movement that will erase your time decay. And then also you have your market volatility. So in this example, the reason we pick for this webinar is we're in a market where we have high volatility with expectations of even increasing uncertain volatility. And that's a reason why you would use straddles and strangles as an option play for this market environment. So not only is it strategically aligned for the conditions of the market, it also is a way of, if you remember from the beginning of the webinar when we explained how the strategy works, there's no margin. So you only have the cost of the spread to put up, and we're going to get into that right now. So now that we've covered Boeing, the stock, okay, so remember we said for 100 shares at 178.44 was the cost. So that would mean that if you wanted to buy 100 shares, so that would mean that you would have to be bullish. So whether you would like that buy signal from that piercing line, or if you had some other reason that you wanted to buy Boeing, maybe you think that their MAX jet that is going to finally work and I pass all the regulations and new tests and what have you, or for whatever reason. And so if you wanted to, it would cost you $17,844 just to buy 100 shares. That's one block. Now, that could be a lot of money to some. It may not be a lot to others, but no matter what, it's not a cheap stock. It definitely is $17,000, almost $18,000 to put the position on. Now, if you buy the straddle, remember that is where you buy both the call and the put. In this example, if you were to buy at that same time period on June 10th, the 180 call, it would have cost you $15.70. Now remember, when it comes to options pricing, it's a multiple of 100. So we'll break this down as we get through this straddle. So the 180 put equals $17.92 basically. So the cost to buy the straddle would be 33.625, which basically equates to $3,362.50. So that's how much it would cost to buy that one strike price at both the call and the put. Now remember, in this example, if you buy the stock, you have to be bullish, or why would you be doing it? Because if the stock doesn't move, then you're just sitting on $17,800, and hopefully they are paying a dividend, which I think actually their dividend may be, if it's not reduced, it may actually be suspended right now. So I don't think buying the stock, unless it does go up, that's the only way you can make money right now, especially in the current volatility and the market, the way the market is trading right now. Now, if you buy the straddle and the market goes up, well, then you would make money just like you would on the stock, except you didn't have to put out $17,000 to do it. So now as the market does go up, obviously you would be making money on your 180 call and you would be losing money on your 180 put. So that's where you need your market movement to continue to move enough to cover the cost of your option straddle, for what you paid for it at the time versus what the value is as the market moves. So now in this example also, we have the strangle. Now the strangle is just like the straddle, but remember you use two strike prices. You use a call and a put from different strikes. In this example, we would use the 180 call because that's just above the stock price. And that's the thing, is that when you do a straddle, you might be right at the stock price, or you might be just above or just below the stock price, because you're using only one strike. They're both going to be relative in that perspective. Now with a strangle, you can wrap around, and that's a way where you can remember strangles versus straddles. Okay, so a straddle, you can remember it's all the same strike price, and it can be either above, right at the stock price, or below it. Now with a strangle, typically your call is above your stock price and your put is below your strike price. So in this example, the market was trading at 178.44. So that is right in between the 180 strike price and the 175 strike price. Perfect for this example. Isn't that nice? So now in this case, the 180 call would be 15.7, $15.70. Or basically $157. And then we have also your 175 put at 15.175. So when you add those together, you have a cost of 30.875. So it's a little bit lower than the cost of a straddle. And now that the price for that one at this time would be $3,087.50. Now, obviously, there's the price of your option commission, but that's only 10 cents. So there would be 20 cents right there, or $1.90 minimum if it's for, I think, one spread. So anyhow, in this example with the strangle, it does cost a little bit less. And then the market movements, you still need to have the market movement, but not quite as extreme as you do with the straddle. Okay, but then also the thing is with the strangle, for instance, let's say in this example, you were bullish. So instead of buying the stock, now the 170, the 175 put that you're buying is further away from the stock price than the 180 call is. So in that regards, you can see that the put is a little bit less than what you're paying on the call. So in that regards, where the 180 call appreciates, let's say, in your straddle example, let's say the market rallies $10, just to make it easy for you to think about. If the market rallies $10 in the straddle, well, you still lose more money on the put in the straddle than you would on the strangle, because the strangle put costs less. This one costs 15.175 versus the 17.95. So let's go into another example to make this start to look more easy. We'll go through keep each stock, and you'll see. In this case, Bank of America, once again, we have on the date of this July 10th, which all these examples are, we have a bullish engulfing line buy signal. Does that mean that we're bullish? No, we're not saying that Bank of America is a buy here by any means. But for this example, you could either say that, yes, this is a bullish time to get long Bank of America stock, or it would be time to put on a straddle or a strangle. One, because in this example, in all these examples we're getting to, there's been so much volatility that even if volatility was to drop off a little bit, implied volatility most likely isn't going to work against you too badly. And because markets typically don't just stop and flatline, odds are that you would still have, even if volatility starts to drop, market movement would continue, meaning you'd either have either an extension of a trend or a corrective move going the opposite way of whichever market has been trending. In this case, the market had been trending lower radically for a month. And that's the thing, is you got to look at the bell curve of the ranges. These stocks typically only trade, like this one, in $1-2 moves and ranges, typically on any given weekly period or even multi-week period. in this example, you can see that from the middle of May, the market went from $20 a share for Bank of America, or just above that, to $29 a share, to in this example where it had bottomed back to almost $22.50, and then here it's at 24. So this is all over the place. So there's definitely market movement, and that's what you want for straddles and strangles. You don't care which way the market goes. So this buy signal here, let's say you were bullish here and it fails. Who cares if it fails, as long as it continues to move and the trend continues. So the only thing here is we have different strike prices. This example is going to be a little bit easier for you to see, I think, than the last one. So this one we have, the market was at just around 24.14. We have the 24 strike price, and we have the 23 strike price. So for the straddle, once again, straddles are the same strike price for both the call and the put. You would be buying the 24 call and the 24 put, and then you would be buying the 23 strike and for the strangle trade. Okay, so for this one, you would be using the 23 and the 24 for the strangle, and only the 24 strike price for the straddle. So in this example here, 100 shares cost you $24. This is not such a big trade. This is not a big investment to buy 100 shares, $2,400. To buy the straddle, it's only 310. See, look at how this is. Where before we were talking about 17, this is only 1.515 for the call, 1.59 for a put for the straddle. That equals 3.105. You multiply times 100 for your pricing, and that equals $310. So for you to control the straddle on this stock, that's not very much at all. Think about that. So for your lesser, smaller capitalized traders and options traders, you may not be priced in for the first example, but now all of a sudden for this example, you have the ability to, where maybe you could invest the stock if you were bullish, but you're like, hey, I don't know if in this market environment, if I really want to wait, maybe there's going to be another big dip in the economy, another shutdown, who knows? And that's where these straddle and strangles come on. We've been living in 2020 where you can't pick your vacation 2 months from now, let alone try and figure out market direction in many cases. So this is something where we know the markets are moving, so we can take advantage of that, because that's what these spreads do. So in this case, the strangle here would only be $263. So that would be a cost, if you think about this, you're looking at 10% of that cost of what it would cost to buy the stock. You can control the movement going in either direction, okay? So now, here's United Airlines. I don't know about you, but I had one of my vacations canceled this year and been trying to plan another one, and it hasn't been that easy, although I have to say some of the deals to fly around the country are good. Of course, mine were to go out of the country, and those dreams are kiboshed. So for this one, though, United Airlines, you can capitalize on this. So the straddle at this time of this webinar was at 33, was our strike price for the straddle, and we used the 33 and 32 strike prices for our strangle. And why is that? Because the market was trading at the time of this example in between these two strike prices. Now, here's something I want you to look at too. All these examples I've been showing you, there's the middle gray line going through them. If you notice how just in a couple of days, the market moved significantly. And so the question is, how long do you hold these on for? So let's say United Airlines, let's say you were bullish this stock. You're going to put up your $3,200, okay, because remember, stock price is $32.67, so times 100. Or you could put on your straddle and strangle trade here. So remember, with the United Airlines, you're thinking, like, if you just think about what I just said, a lot of people are driving this year. Maybe not everyone's going to be flying across the country, so, and we don't know when these bans are going to be lifted. So it's really hard to be a bull with the United Airlines. If anything, is you'd be looking to probably buy the dips. Maybe it's already already factored in, and maybe the low, the best low for you all is already in place for a long time. Hopefully it is, as far as for the market's concerned, but we don't know, and we don't care when it comes to these straddles and strangles strategies. So once again, look at this. For $3,200, you can control a stock to be long, most likely not get a dividend, or it's a decreasing dividend, and have the risk of downside risk for quite a bit. Or you could put on the straddle and strangle for a relatively cost-effective pricing and expect the market movement. So now we have Microsoft, another high flyer. At the time of this slide, the market had just made a recent higher move high and was just floating right below it. So the 215 strike price is our single strike price for our straddle, where you buy both the call and the put for the 215 strike. And the strangle, excuse me, is the 215, 210 strangle, where the market is trading in between that. And you can see that from the day of when these pricing would have gone off on, just a day after, 2 days later, the market traded. I mean, it was trading between 215 and 210, and then it had gotten just above $200. So it had a 5% move within just a couple days. So this is the thing where these trades, you may have them on for a few days, or you may have the ability to have them on for a few weeks to a month and a half. And that's just something you have to think about. Like, as we get into some of these stocks where they're trading on their highs and have been railing and railing and railing, well, no market goes in one direction. These are great ways to catch corrective moves where you wouldn't be able to do with if you were just long the stock. In this example, Microsoft, $213.67 for the per share. So that's $21,367 for 100 shares. The straddle you could buy for just over $2,000, and the strangle you could buy for just over $1,800. So you can see that you have the ability to participate in market movement in Microsoft, where if you only bought the stock or you didn't use the options, that's pretty much the only thing you could do is buy the stock, and either if you're buying in 100 lot increments or whatever you could afford. Versus with the options, you can utilize the market movement and the current market situations and capitalize on that. And the good thing with this is you don't even have to pick the direction. So all it has to do is move. Not that the markets can't ever flatline. They do, and sometimes they do get settled into range bound patterns. However, right now with the extreme volatility, you're not seeing so much of that. So now we're looking at Tesla. So everyone knows Tesla because they see the cars driving on the road. So this was a great stock to use for this webinar, because at the time of it, Tesla had been just screaming higher. I mean, it went from $1,000 to over almost $1,800 in the period of just over a week and a half. That's insane. It's just absolutely insane, the volatility of this stock. The option pricing on this is where things get expensive. Now think about this. The straddle for this, when I made this slide, would be the straddle would be 1550. So you'd be buying the 1515 call and buying the 1550 put. The strangle would be the 1550 call and the 1540 put. So to put this into perspective, and think about this for all of you that you missed out buying Tesla for only $1,000 5 years ago, where you would have been able to buy a lot of shares. To buy 100 shares of Tesla at the time of this slide, it would cost you $154,465. I don't know about you, but to a lot of people, that's probably a lot of money. The straddles and the strangles is something that can help you participate in this market, but then even still, that's where you have some costs too, because volatility is so high in this market, and this is something that you have to think about. You don't want to buy straddles and strangles when markets are so overdone and over-exacerbated. The examples we showed you before, you had the potential with market movement to make money, and you had time on your favor. But when you have volatility that is so extreme, and I mentioned, in the last slide, I said that Tesla had rallied from 1,000 to almost 1,800 in a week and a half. That's ridiculous. That is absolutely extreme for any stock, especially a major industrialized stock. So to put this into more perspective, think about this. Your return on these options, this slide was done on a Friday. When this was done, the stock was trading at 1544. The following day, that following Monday, the stock opened up over $100 higher. To give you an idea of the type of market movement straddles and strangles can make, especially when they kick, the 1550 call, if you can look at in the center here, I'm circling at the 1550. It was 213 and a quarter for the puts, and it was 92. It was 205.65 for the calls. Now the difference of 1550, all you got to do is look at the negative and the positive. For the calls and the puts here, this was a minus 58.4. This was plus 92.8. This was an increase of over 25% on your options spread in the course of a weekend. That is an amazing return, basically overnight. Now, obviously for Tesla, you would have to have had a lot of capital up. So let's come back down to earth a little bit to something that, oh wait, this is another expensive stock. Not completely back down to earth. Amazon too, look at the volatility on this example. This example, the market was trading between 3,200 and 3,190. The market, Amazon traded to above 3,300 the following day and then settled lower, and then 2 days later was below 3,000. This is where it straddles and strangles, is where it can make you money. But when you're playing these big stocks, even these straddles, these spreads are expensive. So for here, the straddle would be, once again, the single strike price of 3,200, which would be the call and the put. And then we have for the strangle would be the 3,200 call and the 3,190 put. Now in this example, Amazon, and for 100 shares, it would cost $3,200. $3,200 a share, and that's $320,000 for just 100 shares. Very, very, very expensive. So this is even more expensive than Tesla, but Tesla's getting there. The straddles and strangles on this one, even though these numbers are big, $43,580 is nothing compared to laying out $320,000, right? So the funny thing is, think about this. If you put on the straddle that Friday when the slide was made, 43,580 gained over 25% within the course of, this would be on the close of Friday to the opening of Monday. That was just insane. And that's where, you know, you lose 2 days of time decay, but wow, when market volatility increases and you have that kind of market movement, that's when you see those kinds of return very quickly. And that's also when you would get out of those options. This is something you need to think about. These options, they cost a lot of money, whether they're this one or we have the examples where they're much, much cheaper. It doesn't matter what the cost is. Your profit is always relative. If you make a 20 to 25% return in a time period such as like these spreads have moved in the course of a few days, you get out of those spreads. If anything, you rotate into other ones, or you take your money and you run and you wait for another moment to put on new spreads. Reason being is every other variables that work against you. And when you have a high return in a short amount of time, that's the one time you can throw in a control on variables that you usually don't have the ability to. It's basically like if you're up at the tables in Vegas and you had a big run and you just got there, you stop right away. Most people won't do that. So that's the discipline you need to have, and it's rational expectations. If you made 25% on your money, whether it was $43,580 for the straddle or $42,000 for the strangle in this example, or if it was $400, why wouldn't you take your money and run? It just makes sense. So here we have Roku. Here's another example of a straddle and a strangle for you. This market had a nice run up since June, and is definitely one of those high-flying tech stocks that is in play right now. At the time of this example, the market was trading around $153 a share, and the strike prices that we're going to use for this example would be the 155 strike for the straddle, which is above that market price, and then also the 150.55 strikes for the strangle. So once again, you would buy and sell, or buy the put and the call at the 155 strike price for the straddle, and for the strangle, you buy the 155 put call, and you'd buy the 150 put, and that's surrounding the strike price of the market. Remember, usually, excuse me, you will have your stock price right in between those different options prices. Excuse me. So now let's look at the pricing on this. So coming back to earth here, $153 a share. Wow, it's much different than $3,000, right? It only cost you $15,300 to buy the stock, but the stock had a nice run up, and we have all kinds of uncertainty in the market environment. Unless you're looking for a super long-term investment, maybe buying the stock is not the way to go. Maybe buying the straddle or the strangle is the way to go. In this case, buying the 155 call and buying the 155 put, it would have cost you just over $3,500. To buy the strangle, it would have cost you just over $3,200. Now, the thing about this is to have a nice little movement, the stock, for it to move 5-10% when it's been moving 10% in swings over the course of just a few months, this is a situation where you're getting fine value. So even though these spreads are still expensive, it allows someone to participate in Roku and not having to worry about things that, remember, we're in a dividend cutting environment. Even if earnings are up, to maintain stock pricing up, it doesn't mean that dividends are going to be going up. And even if earnings are holding strong in many companies, they're not increasing their dividends. In fact, many of them are cutting them or putting them on hold. So dividends is something, buying stock is a different type of thing right now. You're not where you would be normally putting buying dividend stocks because of they pay dividends, and you want to do that in a harsh environment or an uncertain economic environment. All bets are off for this environment because we don't know how dividends are going to play into this, let alone if they're going to hold. So then buying is the only way to look at it. If you're just going to be long, that's one directional. If the market goes down, you're going to take heat, you're going to be down money, and you're going to have money sitting there that is not making you money. So the straddle and the strangle, once again, it gives you that opportunity in these more expensive stocks to be a participant in that market. So now then we have Facebook. So now this one here is, everyone is familiar with Facebook. For this one, we're going to use the 250 and the 245. Now for this one, we're using the 245 call and put for the straddle, and for the strangle, we're using the 250 and 245 strike price. In this example, to buy Facebook, 100 shares would cost you $24,500, a little over that. And for the straddle, you'd be able to get into it for $2,900, and for the strangle, $2,700. Once again, you look at the math on this one. Facebook, you hear everything from how their advertising revenue has been getting strangled because of certain regulations and things like that. You don't know if this is going to continue to be a high-flying tech stock, or is it going to get crushed because its earnings are going to fall apart. Then you have the whole thing with the election, which you can and can't run for ads, which goes into another thing. And when it comes to Facebook, everything they give away is for free for people to connect it, but they use it for marketing and for those ads, and that revenue is where they generate all of their money. And for that to be strangled, that doesn't make good for, even if the NASDAQ is going up, that doesn't mean that Facebook's going to continue to go up. So for this one, Facebook, exactly, straddle and strangle, talk about a great way to trade Facebook. Because if you're going to invest in it right now, being a bull, that's more of a long-term strategy that you're going to have to stick with, because maybe it goes straight up from here. I don't know. But right now there's variables that none of us can have any control over, and they're definitely going to be impacting the price of Facebook over the next 3 to 6 months. Knowing that even if market volatility drops, and Facebook volatility most likely is going to be up, straddles and strangles, once again, is another good way to go with this market. And look at the cost. You're looking at less than, or just over 10% of the cost of buying the shares. And in this case, you don't care if Facebook goes to the moon or if it pulls back 25%. You're just looking for some market movement. Same thing as with Apple here. Once again, with these other stocks where they had been very volatile, this market had been a bull, just trending higher, just like Tesla. Markets don't go in a straight line forever, and they don't keep going up forever. They definitely have corrections. So in this example, we would use the 380 call and put for our straddle, and we'd use the 385 call and the 380 put strike price for your strangle. For this example, you would be buying the stock at $383 a share. That's $38,368 per 100 shares. However, for the straddle and the strangle, your costs are much, much different. Once again, with this one, your cost would be $3,600, just under $3,700 for a straddle, and $3,400 for a strangle. And for this market movement, think about this. Apple trading on its highs at the time of this thing. It could be going, obviously, continuing to go higher. Apple is another market, too, that has had some issues with some pricing, and they have some lawsuits they're dealing with. But as a most part, their company is doing well. But who knows how things are going to go with the China trade deal and how things hold up with that. So, I mean, is Apple overdone? I think it's always looking for a dip to buy. And Apple right now, like I said, you don't want to be picking market direction. And with the high volatility, and if you see how the NASDAQ, has given reasons for a corrective move back, what happens if profit taking comes in, especially since we've gotten through quarterly numbers. Now it's time to, take profits and then see where things go, which causes corrections. Now, not necessarily turning this market to a bear, but it means that straddles and strangles of volatility play is something that's ripe for action, and buying this versus buying the stock, which unless the stock goes up, you're going to take heat. So now let's look at Netflix. This is one of our last examples here. In this example here, you would be buying the and buying the 545 call and the 545 put, and for the strangle you'd be doing the 550 call and the 545 put. On this example, you can see that the market was trading in between those strikes, and then the following day it shot up over almost $30, and then came back to settle lower on the day. 2 days later, it's trading below $500. Netflix, in the period of just 2 days, you would have been able to capitalize on both these straddles and strangles. Now, the reality is you can see how much volatility is going on in the market when the cost of this options. Look at this. $54,873 would be the cost for 100 shares. Now, the straddle and the strangle, both here, the straddle is at $7,900, the strangle is at $7,600. That's very expensive. That's not quite 20%, but remember before most of our options spreads were around 10% of the cost of buying the stock. This is much higher. So that shows you how much volatility is in this and how much movement is expected. So no matter what, the price of these options may be expensive, but movement, when you have pricing like this, it's usually a time when markets do not flatline. So Netflix at the time of this was at 548, and just to give you an idea, today it was trading at 488 this morning when I looked at it. So that is a $60 move in the course of just a few weeks that you would have been able to capitalize on this Netflix. And had you bought this stock, which everyone's bullish Netflix, you would be down right now $60 a share, $6,000, which would have been almost as much as what it would have cost to put on a straddle or a strangle that right now you could get out of at a profit. Isn't that something? Is this starting to make sense? We're ending on a note where I hope that you see how straddles and strangles are something, how you can participate in high-flying markets, make a high return, and capitalize within both a short and a longer-term target. And you have the ability to trade multiple directions with no margin, knowing your defined risk, knowing your defined cost, and knowing that you don't have to be right on direction whatsoever. Because if you buy the stock and you're happy with Netflix right now, over the past 3 weeks, you would be saying, oh, I guess I should have waited 3 weeks, or I guess you can buy more and spend like, only 50 grand a share, or 40-some thousand, or $48,000 for a block of that. So with that, I hope you've enjoyed this webinar. We're going to answer some questions now. And if you have a chance to check out the book, High Probable Japanese Candlestick Patterns, that's the book that I'd written that Gina had spoken about. You can check it out on Amazon.com in paperback and Kindle version, and then you can see how those signals I talked about in a couple of those examples, how you would trade them. And also, before we get to the questions, remember you can maximize your option trading potential. Use e-option for your stock, ETF, and ETF option trading. Free option strategy tools like Options Play are available to you. Free option strategy guidebook available at eoption.com. Free paper trading account to test your strategies. ETF and stock trades are commission free, and option contract commissions are only 10 cents a contract at e-option. So, questions about the webinar, option strategies and applications, anybody? And remember to like eOption on Facebook to get advance notice of future webinars, latest marketing news, and investing tips. So let's see, on the Zoom thing right here, I don't see any. Let me see if there's any. Oh, here we go. Sorry, I had this out the wrong way. Oh, now all of a sudden I got the questions. Okay, here we go. Real quickly, we have from Ken. Ken, does the call have to be in the money? Remember, when it comes to the straddles and strangles, you need them to be, well, for the straddles, it's going to be same option price, and for the strangle, you're going to have one is going to be above the market and one is going to be below the market. Now, as far as in the money, remember you're going to be trading 30 to 45 days out. So in the money, yes, you're going to have one that will be typically in the money. So that would be when you have your straddle, where you have the same option, it's the same strike price, one of the market, unless it is at the market, like for instance, for Tesla, or for example, let's say at 15.50 a share, if it's 15.50 and you're doing the 15.50 straddle, then you're buying the call and the put at the same, so they're right there, they're at the money. But for when you're using certain straddles, then if the stock price is above, then obviously you're going to be in the money for your call, or vice versa for your put. So I hope that answers that question. Then we have for Godfrey, normal option, the closer, you get to strike date, time kills value movement. Does this happen in straddles? Let's see, normal option, the closer you get to strike date, time kills your value movement. Does this happen in straddles and strangles? Yes, it does. But that is why for all these examples, I said that you always trade for this kind of strategy 30 to 45 days out. So in that case, you do have time on your side. And think about that. This is a very good question that Godfrey asked. You know how I said, like, some of these, because the extreme market movers like Tesla and like Roku, or even the last one we did with Netflix, when you have a market that has been up and just appreciating, not just on a monthly basis, but on a daily basis, just so exuberantly, markets go out like they come in. You know, they don't just go in one way forever, you know. So, and that's where when you put these volatility plays on the straddle or strangle, for instance, where 3 days later the market moves so far that you can make 25 to 40% on your option. Think about this. In a 3 to 4 day time frame, if your options, if they were shorter term options, like Godfrey would be saying, like if you had only a week or two left, you would be losing money on time decay. But when they're 30 to 45 days out and you've only used up 2 or 3 days, your time variable is next to nothing. So especially if you have extreme market movement, your time decay is nominal. So that's nothing. So that's something where, yes, you do have an impact with that. And that's why you want to use the further out ones, because unless you have to wait for 4 to 5 weeks for that market movement to be achieved, in which case, if it does, then you'd still absorb that time decay from the market movement. So very good question by Godfrey. That's really good. And that also gets back to why I said earlier, if you make 25, especially at 40% in 2-3 days or over the weekend, get out, take your money, call it a day, and look for something another day. Not to be rhyming there. All right, and that's for Mr. Anonymous. Can you share an example of profit potential in a straddle or strangle? I think I did in the last couple examples, especially as I got to the Netflix example where the market had moved $60 in the course of, from time when I did the slide to today, which was the course of the 2.5 weeks. So I think that should have been covered there, because that way you could see how the only way, if you had bought the stock versus putting on the options, you would not have made any money whatsoever. And versus with the option strategies, with the straddle or strangle, you would have capitalized significantly on that trade. We got 2 last questions to go through and then we're done. In the first slide, there was a buy point. Is it arbitrary? No. Remember, for the straddles, they're the same strike price. You typically want to have it. Now, if you're in a bullish market and the market has been rallying and rallying and rallying, then you might want to have it if it's slightly above the stock price and you're heading up into it. That would be a good way to do it. Or you could even go to the lower strike price, thinking that if you're ready for a turn, like if you had a sell signal, or like in this example, I had 2 or 3 of them with buy signals. In that case, you would want to use the lower strike price for your straddle, because you're looking for a rally, so you'd want to see the biggest return on your call and you want to pay the least for your put. So that's why you'd want to use the lower one in a buy, and the conversely for the selling side. Let's see, Majo, please walk us through why our strangles are not even at price of stock and more directional. Let me see, please, why your strangles are not even at price or stock and more directional. Why are they directional? Because they are directional spreads. You're not, when you, for the buy spread, that's why I used those, they weren't arbitrary. When you were, for the buying ones, those were put because you want to have the stock price in between your strangles. And usually when I have that sets my, my zone for what I would want to use for a straddle. So for a strangle, if I'm putting on a strangle and it's a buying situation, then where my call is at, that would be my strike price that I would use for straddles, and then strangles obviously surround the stock price. And conversely, for a sale, if I had a sell signal, I would use the lower strike price for my straddles, and then I would use a strangle in the opposite fashion. So with that, I think I can turn it over to Gina and Scott if he's there, because I think we're out of questions unless they have another one. Or oh, actually, sorry, I guess there is one. What is option website address? eoption.com. That would be your website address for to get this webinar and see the past ones and other information. And see, do you have a videos to learn how to use option software? That is also on the eoption.com website. And let's see, what's the web address? There you go. Okay, cool. I think everyone got those questions answered.
Okay, great. Well, thank you so much, Teddy, and thank you to everyone for attending the webinar and for all of your questions. And if you have additional questions, you can feel free to call eOptions Trade Desk at any time, and they'll be happy to answer your questions as well. Also, a recording of this webinar will be available on our website in the next week at eoption.com. And to all attendees of this webinar, we will send you an email with the recording as well, so you can view it at your convenience. And if everyone can mark their calendars for our next webinar, we are having, it's called Understanding the Greeks, Delta and Gamma, sponsored by the Option Industry Council. And we did have part 1 earlier this month. And so this will be part 2, getting into a few other Greeks, Delta and Gamma. So again, that's August 25th on a Tuesday at 1 p.m. Central Time. If you go to eoption.com, we do have a webinar and video tab, and you can sign up there. And if you missed part 1, it's not a prerequisite to attend part 2, but if you missed it, you can also go to our website and under eoption.com, and you will see a recording of part 1 there if you'd like to view that before the next webinar. And as Teddy mentioned, eoption.com is a plethora of information. We have lots of education on there. We have strategy links, so you can click on a straddle or a strangle, and it'll go into a chart, when to use it, the benefits, the market outlook. So that's a tremendous resource, and that's provided by the Option Industry Council. And we just recently updated all of that with them. Also on eoption.com, there are lots of instructional videos on various option strategies if you want to use covered calls or various spreads, or how to trade in a bearish market. And so there's lots of great information on there as well. Also, how to use our platform if you're new to eOption and you want to find out a little bit more about how to use it. We also do have free tools on there to help you set up your trade. As Teddy mentioned, we do have a wonderful tool called Options Play that scans through thousands of stocks every day and helps you set up the right option trade to meet your goals. And there is normally a fee for that, but that is free for all eOption accounts. And we get a lot of great feedback, and a lot of our customers do use that service. And we hope that you found this session informational, instructional today, and that you'll give us a try. And as Teddy mentioned, if you want to give straddles and strangles a try, our option trades are some of the lowest in the industry. It's just 10 cents a contract plus $1.99 per trade, where if you traded 10 contracts at eOption, that would just be $2.99 your commission, where a lot of the big competitors, that would be more than double for 10 contracts. And all stock and ETF trades are commission free. And as it says on the screen, remember to like eOption on Facebook. And if you want to get advance notice of more webinars like this, market news, investing tips, and we get a lot of great feedback. So we hope you'll connect with us on Facebook and stay in touch with us. So again, thank you again for attending. We greatly appreciate it. And thank you to our speaker, Teddy. And we hope to see you in a few weeks. Thank you. Bye now.
Okay, hello everyone. Welcome to our webinar today. We're excited to have you here and thank you for taking time out of your day to join us. We're excited to partner with Teddy Keckstat, a professional trader with over 30 years of experience, to bring you this webinar on get a directional view on the markets, consider options. My name is Sean Herron. I'm with eOption. To provide some basic logistical information, the session today will last approximately 1 hour. If you have any questions during the webinar presentation, please feel free to type them into the question box, and our speaker will answer those at the end of his presentation. Please use the Q&A box and not the chat box. Also, you can reach out to eOption's trade desk at any time if you have additional questions after the webinar. You can access the recording of the webinar in the next week on our website, and we will also be emailing you a copy of the recording. For those of you just joining us, we'd like to welcome you to get a directional view on the markets, consider options. As eOption name implies, we're a firm that specializes in option and stock trading. We charge some of the lowest rates in the industry, options 10 cents a contract with a $1.99 minimum. And all stock and ETF trades are commission free. We also support option education, and we're glad you can join us our webinar today to learn more about using options to trade in this volatile environment. I'd like to now turn our attention to our speaker, Teddy Keckstat. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from past webinars he's done for eOption, and we're excited to welcome him back today. Without further ado, well, a couple other notes here. Teddy, his background, he's got over 30 years of trading. He traded at the Chicago Board Options Exchange, Chicago Mercantile Exchange, and Chicago Board of Trade for 21 years. He's been an institutional market analyst for over 25 years, and he serves as president of Forex Trading Unlocked Incorporated. He's the author of High Probability Japanese Candlestick Patterns, and he has a degree in finance from DePaul University. And without further ado, I'll turn it over to Teddy. Thank you for joining us.
Thanks for the introduction, and thanks eOption again for hosting this webinar today. Got a directional view of the market, bullish or bearish? Consider the options. So first, foremost, you already got the introduction from already for the start, so you don't need to go through that anymore. And one of the things, though, we have to cover real quick is our eOption disclaimer for compliance purposes, to remind you that this webinar is for illustrative and educational purposes only. So take a look at that real quick, and there's information on the website at eoption.com also that you can see the disclaimer as well. And also real quick, I should always put up my company disclaimer as well. I can just breeze through that. Just wanted to have that popped up. So real quick, a plug for eOption. Maximize your option trading potential through the use of eOption for your stock, ETF, and options tradings. You can get free option strategy tools like Options Play available on their website. You have free option strategy guidebook also available on the eOption.com website, and you can also start your own free paper trading account to test your strategies out before you actually start to actuate those trades. ETF and stock trades are commission free, and option contract commissions are only 10 cents. So it's very good for your bottom line when it comes to trading options and stocks as well. So what are you going to learn today in today's webinar? Well, first of all, you're going to learn how to trade stock movements without large capital allocations. Then you're also going to learn how you can expand your portfolio diversification, how to maximize your potential returns with options, and we're going to be looking at very simple bear and bull directional strategies and how they would pan out and what you need to look for market movement to realize a profit, and for how those would compare versus doing other common strategies such as just buying a stock or trading in an ETF. And we also show you how eOption can improve your bottom line through these strategies. Okay, so why stock option strategies? Well, the first thing is you want to lower your cost basis. At eOption, it is only 10 cents a contract, much lower than other firms. So that right off the bat is how you can help your bottom line, whether you're in profitable or losing positions. no matter what, you do have a cost of transactions, which is very slight and small with e-option. Options help you to diversify your portfolio because you can trade a much broader range of stocks with your allocated capital, especially with the technology stocks right now that are just on a crazy run when you look at markets like Tesla and stuff like that. And we're going to get into these examples, and you'll see how options can actually benefit you as a trader and also as an investor, using derivatives such as options to give yourself more of an opportunity to take advantage of market movements. Options allows the smaller to larger investors the ability to capitalize on these trendy markets that are highly liquid, okay, which also helps out in whenever it comes to trading. You always want to trade a highly liquid market. This is a very important cost control because if a market is illiquid, you typically have high spreads getting in and out with typical options. In the major markets, the spreads are very, very tight, so you don't have to worry about any real slippage from the getting in and out. You're not giving up much of an edge from the entering and exiting of your transactions. So trading in these products is similar to trading in normal equities, but with higher potential ROI and controlled risk, so that you have a higher return on your investment potential, and you also have much more controlled risk. So now with that, let's jump into what we're going to focus on today. So long puts and long calls, very simple. You will be buying, the puts or the calls. The one thing that's nice about this kind of strategy, besides that it's a very beginner strategy, it's also used by advanced traders as well. The nice thing is there's no margin. So right off the bat, you don't have to worry about that. Your risk is defined. Your risk can only be what it costs for the price of the option and also your commission. So it would be that price plus 10 cents if you were using e-option per option. Then there's also simple execution, getting long and puts and calls. Very liquid in all your major stocks, so it's not a hard thing to execute. So right off the bat, those things give you an edge in the right direction, especially when because it helps to keep your losses from being exacerbated, and it also keeps your winners from being less than what you deserve. So the volatility, direction, and cost, the commission spread, are the key variables, and that's once again helps is why the simple execution, since we have such high liquidity, we don't have to worry about that. Now obviously, if you're trading a number like when earnings come out or some major economic number, at that time when the market starts to go haywire, you're probably going to have a little bit more of a liquid spread than you would have during the normal trading day, even if the market's in play. So that is something you do need to take into account. Nothing is steady 100% of the time. Those would be the only times you probably really have to worry about it the most. So that would be right around the opening and closing of the markets during the trading day, and then also, like I said, major economic numbers. So with that, let's get to our first example. We would get into our first stock example. So long stock and short stock. If you are long, you are a buyer of stock, okay? If you're short stock, you would be a seller, okay? So this would be the equity way of trading a call or a put, okay? So the difference though here is that if you're long the stock, meaning a buyer of stock, versus buying an option, your capital outlay can be very high. And through our examples, you're going to see the difference between some stocks versus some very expensive stocks or high volatile stocks. Then here's the thing is, if you are long the stock, you do have the potential for dividends. That's a plus. That's the only one thing that if you buy the stock versus any of these other things we talk about, you would have the potential for that. The one thing though is it ties up capital and limits diversification. Your risk is capped by your capital outlay and also your potential for margin. Now here's the thing is for short, if you were to short the market, the equities, you have your margin capital is very high and must be maintained. You will not have dividends like as if you purchased the stock. It ties up capital and limits your diversification as well, and your risk is unlimited. Not so good for anybody. So now options, long puts or long calls. For our This is the reason why we picked this strategy. It has a high potential ROI, which is a good thing. It has limited risk, which is a good thing. Flexible medium, meaning liquidity, which is a good thing. And potential rise in volatility, which is good. Because when you are buying options, the one thing that does always go against you is time decay. But if volatility goes down, that also hurts you as far as the price of the option. But then if you have the volatility goes up, it helps you as far as the value. So when you purchase it, if volatility goes up, it helps to maintain the price of that option. And we'll talk about that as we get into it. The negatives of these scenarios, though, is the time decay, the potential drop in volatility, and the fact that there's no dividends on this one either. So, like, once again, only if you were to buy the stocks would you get dividends. Now, the negative is that the potential drop in volatility would, just like time decay, would erode the pricing of the option that you had purchased. Because remember, you're purchasing these trades. So our first example is going to be old big blue, IBM. So we looked when we started to figure out what we would do this, the topic for this webinar would be. We picked the date, and then I figured, all right, well, let's start with that, and we'll look at the options that go out. So this is from a couple of weeks ago. IBM had settled at $123.31. So at that time, before the market closed or the next following day, the trade would be, if you were bullish, you would be buying the 125 strike call, or you would be buying the 125 strike put, conversely, if you were bearish. So that's that green line there that represents the strike price that we're talking about. So remember, if you are bullish, you would be buying the call. If you be bearish, you would be buying the put. Now, interestingly enough, when I pulled up this chart, the 2008 high, I went back to look and see how IBM has fared. You know, obviously it hasn't been doing well during the pandemic, let alone over the past couple of years. It's been trending lower. It's been kind of basing, I guess, for the last 2 years with some extreme volatility, obviously, over the past few months. Now, the one thing that we look at here for the strike price for the 125 is how much does it cost for these options. So if you can see right where I have the expiration, it's the October 16th, 2020 option expiration. The 125 call was priced at $395, and the 125 put was priced at $545. Now, if you notice these blue lines here, 128.95 is your upper break-even price for where the market needs to get above or be above at expiration for you to be in a profit should you buy the call, okay, the 125 strike price call. Conversely, if you were a bear and you bought the 125 put at that time, you would need to have the market down at 119.55 for the option value to be at break even or plus. So let's go to the next slide and give you an idea of what this all means. So if you were to have bought the stock at the time of that when we did the slide, the 100 shares at $123.31 would cost you $12,331. So that's just for one block of shares. Now, the nice thing about IBM is that it's not quite the glamorous stock that you hear of in the news every day, but believe it or not, it still has value and it's a big company and it's still out there. The nice thing is that because of that, the volatility typically is not running at the levels like the stocks, say, such as Tesla or Facebook or, you know, Google and things like that, or Apple. So let's say you look at the buy the call 125 strike. Okay, that was $395. So that cost equals $395. Now look at that. To control 100 shares of IBM for the 30 to 45 days that you would have on that option from the time that that was set, for less than you know, a third of a cost of the stock position, you could put on the option. You could buy the call, the 125 strike price. That's if you were bullish. Now the break-even price would be $128.95, and at that point, the call would still be worth at least what you paid for it or more, depending on how much time was left and the volatility at the time. Especially if volatility was rising in IBM, let's say, for instance, shot up to 140. Obviously, if that happened, you would be up all the money from the 125 strike price all the way up to say 140 minus the cost of the option, which would be that first $395. On the opposite end of this trade would be the put, which would be the 125 strike price put that was valued at 545. So that would mean that the cost would be $545. Remember that the multiples for option pricing for equities is times 100. So if it was $1, it was actually being $100. So now your break even on this trade would be if IBM was to break down to 119.55 or lower. So if you were bearish, you would be buying that put, and if you were bullish, you would be buying that call. Now think about the ROI on that. Now if you bought the stock, and well, then you have to be right for sure on the long side, because otherwise you're going to be at a loss as the market goes down. Now, granted, you can hold the stock for a long time, but then who knows how long, how much further it may break. If you were bearish this stock, but not overly bearish, it might just hang, for a little bit, so then you get a little trade there. And if you were bullish and it only broke a little bit, it could just hang for a little bit, and you may have time, maybe collect some dividends, but you may not, but your capital will still be lower than when you got into the trade. If you were wrong and you bought the call, all you're going to lose is $395. Now, I don't know about you, granted that you only have a month and a half for the option, but you could do that multiple times over the course of the year. And for 10% of the cost of buying the stock, you could always be long at the money call. Eventually, you're going to probably see some movement, I would think, over a 12-month period. So would it work every time you try to put an option on? No. I mean, usually if you're going to be long or short the market, you should have a reason to have a buy signal or a sell signal. So this webinar is not going to be concerned with why you would buy or sell it. It's just a matter of what would happen. And now the same thing is also on the opposite side. Like if you didn't want to buy the stock, well, shorting the stock definitely has a big cost to itself. And then you have your risk is unlimited there as well. Now with buying the put, you would be able to play the bearish role on that trade right there at $1.20 to 125 and see what happens over the course of the 30 to 45 days. And if you get your market movement, then it would be, you obviously are right on the sell side, which would be a good thing. And it would also be much cheaper than doing the short. So just to let you know how things worked out, IBM as of yesterday, the 125 call was priced at 139, so that's obviously a loser. The 125 put was priced at 633. Remember, it was priced at 545 back when when the first slide was made a couple of weeks ago. So that being said, the market yesterday when it closed was at $1.2051. So it was just about $1 above the break-even price for the put. So even though now see there's time left in this trade, this is the new pricing is 9/22. It still has almost a full month left. So you have, besides the volatility pricing in, you have the timing pricing in. So that's why this option is it's already worth more than what you paid for it, and hasn't broken below there. But the thing though is, if the market stays where it's at right now, the time value will start to erode, and because it's above the break-even point, this put will eventually become worth less than when you first purchased it. So that's something you have to be mindful of. That you still have to get the directional move. That's what the whole point of putting on this trade is. It's a way of being short without the risk of shorting the stock. So now let's move over to our next example. We have Coca-Cola. So in this example, we use the $50 strike price. The blue lines indicate once again the pricing for the upside and downside. So the 51.22 up here above the 50, that would be for your call, which is $1.22. So that's where your pricing is. For your put, it's $2.06. So that would put us down to $47.94. So these are levels that you have to breach to for the long and the short side for the option at expiration to be worth a profit. So now let's look at Coca-Cola. If you were to buy the stock the 100 shares at $49.53, it would have cost you just under $5,000. Now, if you buy the call for a $50 strike price, the price was only $1.22. That's very, very cheap. So that's for $122. You get to control 100 shares of Coca-Cola for up to 45 days. Now, the break-even point on that, like I said, was $51.22. Granted, the stock doesn't move like Tesla and all these other ones. However, it does move. It does move up. It moves down. So let's say you did have a reason to buy Coca-Cola, whether it's in front of earnings, you're positive you've got a really good hunch they're going to beat expectations, or just you have a buy signal for whatever indicators you use. Like for instance, let's say you had a high probable Japanese candlestick pattern, like one from my book, that was a buy signal for Coca-Cola. Then you would put on a call, and let's say that was the $50 strike price. So all you had to do was have the market go from the $49.53 where you started to above $51.22, and you are in the money. Now, if you were bullish the stock, think about that. $122 was the cost to put on a position that would be just under 5,000. Like your return on investment, which is your return, how much capital it takes versus your investment to give you your yield. This is where you make your money. Not only is your risk reduced, one, what your risk is always, because you're purchasing the option, remember, but it's much more reduced. Now, granted, risk brings on more reward. However, you're still controlling. The thing is, you got to remember, you're always only controlling 100 shares per option. So you got to figure out what's the value, in those options, and the same thing is with the puts. So let's say you had a sell signal for Coca-Cola. You're looking for a $2, $1.50 move. You're not looking for big moves here. But the thing is, you don't need a big move for you to make a profit. And that's the whole thing, is when it comes to trading and it comes to using options in a way of like this, where you're trading directionally, the whole point is to make money, So now if you were to buy the put and the call, that's a straddle. It's a totally different strategy. That's a totally different way. We did a webinar that actually discussed that a little bit. Look at the past webinars on eoption.com and you can find that out. But that's not what we're talking about today. Today, we're talking about whether you are a bull or a bear. So we're not giving you a reason to buy it right now, no signals, but if you are watching this webinar, we're showing you the difference on what you would do and how much you would cost. So your ROI, once again, with something that's a steady company like Coca-Cola, has really good potential here for the investor and the trader. Now let's look at the U-Haul. We all know that besides all the other airlines, United Airlines is no different than any other ones. It's gotten beat up really hard this year. A lot of volatility, and who knows what's going to happen over the next 6 months. Maybe the holidays start to bring people traveling, and then who knows, maybe we don't. But so we don't need to know whether it does or not. We don't have a crystal ball, and it doesn't matter. But look at this. It's kind of funny. The low for United Airlines in 2008 was $2.80. So it's kind of, we dipped down below $20 earlier this year, and now this market settled right around $36 when I did this example. So I picked the $35 strike. At that point, for the October 16th option expiration, the $35 call was $4.75. The $35 put was $3.65. Someone here was saying how to calculate the break-even formula. Is there a formula? Yeah, you can. I'm going to explain that to you right now in this example. So your break-even is always going to be the price of your option away from your strike. Like, what do you have to make? So, for instance, in this situation with the call, if you bought the $35 call, the price would have to be $4.75 away. So that would put it at $39.75. So at expiration, if the option was at that price or higher, that's the price, the value that you would have for that call. So that's where how you figure your break even. It's very easy to do. Now, granted, since let's say the market right now is trading at $40 and it was above the $39.75 threshold, it would be worth more than what you paid for it, obviously, because you have time still left. There's volatility priced into the option as well, because there's time left. So then it wouldn't have more value than it does, obviously, when it started off. But at the end, to make sure that you break even at expiration, the market needs to be at least that distance away. And conversely for the put, so this is $3.65, the the $35 put, you subtract that, that puts it at $31.35. If the market is below that, the put value will exceed the price you paid for it, and you would be profitable in that trade. Remember that right now, we're not saying you should be bullish or you should be bearish. We're just showing if you were bullish, what you could expect, where are your thresholds for break even, and how much market movement you need. Now, the funny thing is, on any given year, you might be like, well, I may not be expecting that much movement in United Airlines, maybe a couple bucks a month on average or whatever, maybe $5 range, $10 range for the whole month, especially if there was a lot of news. But look at what we've had this year. I mean, it was up just shy of $100. It fell off its high in at the end of 2019, just below $100, and fell below 20 just a few months ago. So the odds of it moving more than a couple bucks right now are pretty decent. So giving that, these trades like right here, this is where you get a big bang for your buck. So think about this. I think we answered that question. So let's move on to why the UL example is a good example of why you trade options. So in this example, the price of 100 shares is only $36. Remember, it was at almost $100 less than a year ago. So the cost to buy 100 shares of UL is actually not that expensive anymore. It's $3,600. Of course, remember 12 years ago, the low in 2008, and that wasn't a pandemic low. The price of the stock was at $2.80. I don't know, maybe UL is expensive, maybe it's cheap. But if you were to buy the 100 shares, $3,600 would be your risk that you would have. Now, if you bought the call, if you were bullish, United Airlines thinking that, hey, you know what? Pandemic aside, traveling is going to start to come back a little bit. People are going to start to move for the holidays and get things moving. And, so who knows, whatever or you maybe have a buy signal. So the $35 strike would cost $475, which means that total cost would be $475 for one option that controls 100 shares of stock. And the break-even price would be that $39.75. So you don't need a big move considering the volatility that there's been in the UL market this year. It's very likely that at least if you were to stay rolling a strike price for a few months, that you would see a movement of more than $3, I would think, especially when you have an over $80 range so far this year. Now, if you were bearish this stock, thinking that, hey, the airlines are in trouble, they're just not making any money, they're going to have to keep on laying off people, and even if they do that, it's not going to be enough to keep their books afloat. We could have a lot of bankruptcy possibilities propping up. So puts right now, and especially when you look at the pricing, because the call is more expensive than the put, if you use that rationale, this is pretty cheap, $365 with a break-even price of $31.35. So for the market to get below that, that's not that hard to do. So let's see, we have a question. Are the VIX and the VIXN volatility levels artificially kept lower by algorithms or formulas? Oh, wow, there's a webinar into itself. Are they artificially kept lower by the algorithms or the formulas? No, I think that what you get is a lag more than an artificial lowering. And that's a whole concept and topic for a whole nother webinar. So I don't want to drift too far off of the topic with right now of just directional trading. What I can tell you though is that the VIX and even the VXN, the rising and lowering of them and the levels where they're at, definitely helps you when gauging your volatility for trades. So we can kind of incorporate the VIX, since you brought this in, and show you how this would be even come in with this trade. So here, let's look at Microsoft. Microsoft is one of those stocks like we mentioned earlier in the webinar. I said we would get to and talk about volatility, right? I mean, just this year alone, it had its little swing in February and March, but boy, did it bounce. And of course, everyone's using technology. Everyone's working from home. The kids are at school is at home, blah, blah, blah. I don't have to tell you what you don't know. So the 2008 high for Microsoft was 37.50. That was right before the market tanked. And then now it has come not only back above it, it's accelerated to $200 above it. Now, the funny thing is back then, Microsoft just bobbled around $35 for years. It didn't go anywhere. I mean, they made their money off their operating system and blah, blah, blah. But as a whole, they don't have the footprint like they have now. They've definitely bought into a lot of things that have helped to accelerate their growth. How long can that be maintained? I don't know. So, but just to get into the VIX, because of this accelerated slope of this rally, the volatility index from if the volatility index is really high, that would coincide with this slope of this rally. As volatility drops in the VIX, you would be able to tell that or assume that it's very likely that the volatility component of the option pricing will drop. Now, when you look at an option like Microsoft at these levels, unlike Coca-Cola or even IBM that was trading at $100 and something, it doesn't have the volatility pricing in. And volatility pricing, remember, these options that we're looking at right now are the same expiration date as the ones we looked at before. Now look at the price of the call and the put here. The 225 call and put, so this green line here is our strike price. The market closed at 225.53, so it's perfect. It's right in the middle. The pricing for these is very similar. So obviously the pricing, the call is very bullish with the slopes. The call is a little more expensive than the put, but they're $12.55 and $12. That's $1,200 per option plus just for 100 shares. Now, obviously, because of the $225 share price tag, it's $22,553 just to buy 100 shares. So the cost of that call, if you look at it on a relative basis, is still very similar to the pricing of what we saw in those other stocks. However, it's starting to get more expensive. So now if you want to get long Microsoft, and you think it's going to catch a ride, and now here's the thing is, you got to remember, you're buying the 225 strike price. Now you need to have a break even of 237.55 to the upside. So that's what kind of a rally you need. Now, the good thing is if the VIX is in a situation where it looks like it's rising, okay, that helps to keep the stock price, or your option price higher. So that's a good thing, especially as it approaches the break-even price point, or even if it doesn't go anywhere, if it's just staying sideways. So that's a thing that the VIX, if it's rising, can help you. Now, if it starts to go down, that's where it can hurt you, the pricing of your option, which means if the market really needs to get closer to your break-even price or get above it for you to get your money back and become profitable in your trade. The same is for the put, because this market was settling right at the same price as the strike price. Your put costs $12, so it's $1,200. Your break even would be a break below $213 for the stock price. Once again, now the thing is, think about this. If you were right on the put, thank God you didn't buy the stock, right? Because at those levels, that's a big deal. And now as far as the pricing with the call and the put, because they're basically the same, the cost there's no difference in whether you which one there is as far as how much of your return on your investment would be. But you can still see that you're looking at only a 5% of your initial outlay if you were to buy the stock. So 5% to put on a call position, buy the long call, or 5% to buy the long put. All right, so now let's get to Tesla, our big explosive stock of the decade. So when I put this slide presentation together, remember we're using the October 16th, 2020 option expirations for all these examples. So here you have the 490 call or the 490 put. Now, remember we started talking about the options. Initially, they were like $1, $2, $3. We mentioned they were like 100 and something to 300 something dollars. Here we're talking about Tesla. A 490 call costs $77.20. A 490 put costs $68.35. Now remember, that is not $77 or $68. You have a multiple of 100. So to put on that Tesla stock, now this is great. Tesla just split in half, and still to buy 100 shares, it costs you almost $50,000. Look at that, $49,832. That's how much it costs to buy 100 shares. Wouldn't it be nice if you bought 100 shares a few years ago? Well, now you'd have 200 of them at that. So, which means you'd have almost $100,000. Anyhow, you can't do that. Can't go back to the past. But what you can do is see how much putting an option position would be. So if you're still bullish Tesla, and they just had the big battery announcement yesterday and whatever, you could have put on at this time when this slide was made, a cost of $77.20 would equal $7,720, leaving you a break-even price of $567.20 to the upside. So now it's kind of funny. You would think that looking for a almost $70 move within a period of 45 days in the stock, that's usually a lot to ask for or to even remotely think you could get. But when it comes to Tesla and the way it's been moving to the upside or the downside, if you had a buy signal and buying the call at that moment, that would be the call, your trade of the day, then that's what it would cost. Now your risk, think about this, to the upside is only $7,720. Obviously, if the market goes down and continues to break, you would lose money, especially if you waited towards closer to expiration. So that's the risk you would have. But if the market goes down, I mean, obviously, if you're looking for a $60 move to the upside, it could easily have a $60 move to the downside. $60 move to the downside, well, that's the same. That's why you want to have a put on versus a call, obviously. But that's a big deal because of how much you would lose if you would just own the stock. So buying the call, definitely better than buying the stock, especially at those volatile levels. Obviously, you have you only have the time available for until expiration, but definitely for bang for your buck, for 5% of the position to catch that ride to the upside, I'd like the options even at those prices. Now remember, when the question about the VIX, if you have volatility rising, and especially this already would be a volatile stock, that's why the pricing of these options is very expensive. So you got to really know what you're doing, because even though you may think you're going to get the movement, you're going to need a lot. You're going to have to get it or more because of the pricing of your options. So that's why those other ones like Coca-Cola and IBM may not be sexy or in vogue, but you know what? If you can get your ROI and be consistent, that's what really matters. That's something to think about. But if you want to trade these high flying stocks, buy the put or the call, it's $6,000, $7,000 a position. That's all good too. Just to let you know where it went to, look at this on the day of the slide when we started it. Remember, it was $77.20 for the call. The new pricing as of yesterday was $28.89. So think about that. You lost, over $4,000 on the call if you were bullish Tesla at the time of when those options were priced out at. Now, if you were bearish and you had bought the 490 put, it was $68.35 when it started, and it's all the way up at $93.20 as of yesterday. So in that situation, you would be making over $2,000 off of the put position just in the past couple of weeks. So now when you think about it, the position cost around $7,000, you make $2,000, and you're looking at a good 25 to 30% return on your investment within just 2 weeks, without having to put up the whole $50,000 of buying the stock. So just something to think about. Once again, we have Dow. Now, unlike Tesla, it doesn't cost the same amount. It's not 35 times greater. So here we have an example again. We take the $45 call and the $45 put. Look at this pricing, $2.70, $2.35. Once again, the stock may not be as in vogue as others, but it is a very good price point. Dow, $4,500 to buy the 100 shares. Not a bad investment. It's a good company. Chemical companies, they're never going anywhere, that's for sure. The $45 strike price call, though, if you were to buy it, think about it, it's $270. That's it. I mean, that is amazing for 5% of your investment to lay up to buy the stock. you could buy the call and trade and look for that break-even price of only $2.70, which would put you at $47.70 for this price for the break-even for the call. Or if you're bearish to the market because you think that there's going to be another second wave and the whole stock market as a whole is going to take a dip, the $45 strike price put at that point would have been $235 with a break-even of $42.65. All right, now we have Budweiser. Everyone's familiar with Budweiser. Kind of funny, you'd think that if anything, this would be really bouncing and rallying, but I guess it's not. It is going up and has been for the past couple of months. It has bounced since the big correction back in the beginning of the year from the coronavirus trade. So this market was at 58.15. When I pulled up the slide, we have the dotted line here once again as our option expiration. The $55 strike call and put. The call was $4.80. The put was $1.54. Main reason being is that the closing of the market was very close to the price of the put. So anyhow, that is, look at this, $480 or $154 for a stock that costs $5,800. Once again, this is where you make your money trading options. Your ROI, you're not having, you have defined risk. I mean, think about it. If you're thinking about trading Tesla or even Microsoft, not that I'm saying to discourage you from trading those options, but you can expand your portfolio and trade a basket of options like Budweiser, Coca-Cola, IBM, and tried and true companies that are very liquid, which gets back to our price point issue. And $5,800, good investment, good dividend paying stock, obviously beaten up right now. So the $55 call would have been $4.80, which is $480 with a break even of $59.80. And which was very close to where the market was at. And so if you were bullish, you would pop above that very quickly and give you a good chance to make a profit on that. The put, though, interesting enough, because the market's so far away from it, you really got a good value on it. So if you even do hit your price point, let alone get a significant slide below that, you would have a big value in the put. So that's sometimes like if you have a big sell signal and the market's rallying into it, this is where you can pick a strike where you can really gain your ROI. And this is something that you're not going to catch so much in some of your bigger high flying options. So in this case, if you were bearish, I'm not saying one way or the other that was the situation. We're looking at both sides and what you would get at, what you would realize for it. But your return on investment would be much better on the put in that situation. Now let's look at Allstate Corp. Insurance companies, do you think they've been getting hit? Let's see, what happens on expiration date if you don't sell beforehand? They expire worthless, or they're in the money, so it's a cash settlement. So, but usually you're going to get out beforehand, because if you've already made your money and you only have a little bit of time left towards expiration, why run the risk of all of a sudden losing on your position? So I would always say that you should try and look to liquidate a day or two in advance, maybe even a week sometimes, if you've already realized your profit and your target. Always have an objective too on your positions. That's a whole nother, obviously, thing when we maybe have a webinar where we actually define, like, certain buying and selling situations and how to define your risk with that and stuff like that. So anyhow, with the Allstate, we're going to do the 92.50 strike price call and put. The call is $2.55 and the put is $2. So for that, the break even, and for this would be $95.05 for the call, when the cost of that option would be $255. Now look at this, Allstate, $9,300 to buy 100 shares, but you can control 100, and this is the call or the put, because we're the 92.50 is right by the $93 closing price of the stock. For $255, which is really, really, really nothing. You're looking at, like, for 3% of your cost of controlling the stock to buy it, you can buy the options. I mean, at that pricing, you could roll it in every 45 days buying the calls, and that would be more effective, most likely, than buying the stock. You wouldn't get the dividends, though. That's the one thing you wouldn't get. And for the put price, also, look at that. I mean, $200 versus, for where the stock value is at. This is a lot of bang for your buck for ROI. So you don't need to have a big move. Just think if you have a 10% move in Allstate, You don't need to have a major move, but a 10% move with trades where you're using literally 5 to 30% of your capital that you would use for buying the stock. So whether you're being long or short by buying the call or buying the put, your ability to capitalize and build your capital base is just, it multiplies exponentially. Now let's look at Apple once again. Here we go. Here, the 130 call was $8.80, and the 130 put was $9.80. Now, that's actually not too bad considering the high flyers that these stocks really are. So 129, $12,900 to control 100 shares of stock, only 880. This is, for 8%, you could control 100 shares, and this stock definitely moves, not quite as much as the other ones. But if you're going to look at the high flyers, this is still somewhat of a reasonable trade for their options. The same is for the put price too. Now this one would have a break even where the market had to go from, it was 129.04. It would need to rally to 138.80, or it would need to break down to 120.2. So this one, a little more expensive, not as good as some of those more or less in vogue stocks. So one last one before we get to the last couple of questions. Abbott Labs, the 110 call and put is what we found for this one. We made the slides. The break even is $114.45 or $1.520 to the downside. Once again, this is a position that would have cost $10,000 to put on, only $445 or $480 to put on for your call or your put spread if you were bullish or bearish. Once again, the break even, you're looking for just a $5 move basically in either direction. Not hard to get in this environment, especially when Abbott Labs is up for all the coronavirus testing. So real quick, do a couple plugs and then we'll answer a couple more questions. Yes, I wrote a book called High Probable Japanese Candlestick Patterns. And for all of you viewing today, for the next 5 days, you can get this book for free in Kindle version on Amazon.com. So if you're already a Kindle Prime or Amazon Kindle user, you just go on there and you can get the book. I think you get it for a week or 30 days for free, somewhere around that time frame. So for the next 5 days from today through the 27th, you can download that book. I'm in the Kindle version only. Paperback is purchase only. So remember to maximize your option trading potential and use e-option for your stock, ETF, and ETF option trading. Remember, they have the free option strategy tools like Options Play. They have the strategy guidebook also available on their website. You can set up a paper trading account. And then remember, ETF and stock trades are always free and option contract commissions are only 10 cents. So let's see, we got some more questions here. I do not understand why he is doing a straddle for all options. Okay, I'm not doing a straddle for all options. We were showing the difference of whether you put a call or a put on. It was not giving any, those were examples of the market was where it's at and then what would happen if you put on a call or a put. And we also showed whether you would have a stock position on too. So that's why you could see that if you wanted to be long, one way would be by buying the stock. Okay, so if you bought the stock, there was the price of what your capital outlay would be, and then if you bought a call instead of buying the stock, which would give you the same ability to control 100 shares, but only for 30 to 45 days, because there's obviously an expiration date. So if you wanted to buy instead of buying the equity, you would buy the option, and that was showing the pricing and how the return on investment and how you could also trade multiple stocks versus only investing in one. I mean, think about it. If you had just enough money to buy 100 shares of Tesla stock, okay, that's $50,000. You're done. Unless the market goes up, you're going to be losing money and waiting for it to come back or waiting to figure out when you're going to get out of the trade a loser. If you were to buy the option, the call, then you would have to much less of a capital outlay, and you would also lose less. And like, for instance, at the time of the slide, if you would have bought the call, you would have been a loser, just like if you would have bought the stock. However, if you would have been a bear and you bought the put, well, then you would be up money, So this webinar is not about directional trading. Yes, if you were to buy the put and the call at the same time, that would be a straddle. However, right now we were just looking at the ROI on using those directional trades. Whether you were long or short is up to you. We were just showing what would happen to you in those scenarios at that moment. one versus the other, and also showing the ROI. That's the main thing, is to show you how with options, unlike with equities, see, if you were to short the stock instead of buying the stock, then you'd have to put up all the margin money as well, and you'd have to maintain that margin money. So that's why a put is better than shorting stock, and it's definitely much less riskier than obviously than shorting the stock. Let's see, do you have the full cost of 100 shares of stock in your account before you make the trade? Well, no. If you have the ability to, depending on your account, most people have the ability to buy on margin already. So now I would always say that you have to be careful about buying on margin, because then that's being just like when you short stock, you have to maintain that margin. So yes, if you were to buy on margin, let's say Coca-Cola, let's say instead of buying just 100 shares, you could buy 200 shares if you would be able to buy at 50% margin. But the thing is, if the stock starts to go down, then you better have extra money in your account to cover it. Otherwise, they're going to liquidate your position because they have to satisfy the margin. So yes, you do in the examples that we use, because that was the whole point, was to eliminate margin. If you bring margin into the picture for the stocks, then for sure that would be a totally different comparison for the options trades. But then also that would make your long stock position much riskier than it would be normally, which would also make your long call position so much better of position. So yeah, so actually it's a good question you asked. So I hope that that's clear about whether you do or don't need to have the full cost for the 100 shares. So if you have a small account, odds are you probably have to have the full amount. You're not allowed very much margin room. So I don't know if there's any other questions. The reason I asked you to go buy a call, that's, we already answered that question. Expiration date, I think that's it for the question. So if there's, oh wait, let's see, one more coming up, I think. Just waiting for this to come up. Nope, I guess not. So I want to thank you guys once again for having me for the webinar today. And also remember that you can get the copy of High Probable Japanese Candlestick Patterns on Amazon.com for free on Kindle for the next few days. So with that being said, I want to thank you very much. You have a great day.
All right, great. Thanks, Teddy. Very much appreciated for you taking time and putting the webinar on today. It was a great educational hour here. So we just want to say, everybody, thanks for attending. We have more educational content on our website. Go to eoption.com under resources, and you'll find past webinars, trading videos, links to option strategies, and free option tools like our options play tool that's very useful. Also, like us on Facebook to get advance notice of other webinars, latest market news, and investing tips. We'll also have a video recording later this week of the webinar today, as well as our past ones. And don't forget to take advantage of our low rates, zero commission for stocks, ETFs, and 10 cents a contract for options. On behalf of eOption, thank you again for attending. Take care.
Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here today with a bearish engulfing line sell signal webinar for you. And before we get into it, we just want to give you our disclaimer real quick to remind you that this webinar is for educational and information purposes only. This is in real time as the markets are trading right now, this webinar, so it will become evergreen afterwards, but right now it is live, and this is only for educational purposes only. So with that, we're going to go to our live action screen, and we have the www.forex-trading-unlock.com website. You can always come to this website. In the navigation tab, you go up to the Forex Trading Unlock workstation page and click on that, and that's what we have pulled up here. And you can look at different currencies and do analysis on them and see all kinds of information on them. So we have this chart that we've already created for you to speed things along. Now, last week, and as you can see right now, as Monday morning, right now it's 9:15 Chicago time, the British pound US dollar is having a nice little bounce. Now, the dollar index had been doing rather well at the end of last week up until Friday, but it really didn't have too much of a hit on Friday. But the dollar has been stronger versus the major European currencies for a little over a week. And it started here, the high was on October 12th, and then on the 13th, we had this bearish engulfing line sell signal. Now, what is a bearish engulfing line? Well, a bearish engulfing line, if I make this expanded for you a little bit, okay, so if you can see how this big red line is here, this is where the body of this negative close day is bigger than the body of the previous day. And it's also after that previous day had made a top or a new high. As you can see, the market had been trending since the middle of September into the middle of October to October 12th. It peaked there, and then on the 13th, as of the close of that day, and you have to wait until the close. You can't wait until you can't just see the market down and be like, oh, there's a bearish engulfing forming, which, yes, that forming is the key thing. If you're saying forming, then it is not a signal. If you say it has formed is in the past with a close, then that's the signal. Now, as you can see that the market, when it closed, it did rally almost all the way back. So there was a lot of bullish strength trying to keep this market up. But then it fell off that. It failed to make higher move highs and made lower move lows on an intraday level, not necessarily on a daily level. Now we have come back, and as of Friday, we tried to test support again, and it really didn't do very much. It was kind of like a blasé Friday, actually, when it came down to the currencies overall. But then this morning, as you can see, the market has been very, very strong for the British pound US dollar. So overall, with this sell signal, this is a bearish sell signal. So we did some Fibonacci levels here, just from this prior low here in September up to the high that was reached on October 12th. Now remember, we have a couple of key dates that are coming up. We have the U.S. elections, and we also have the Brexit date. Now Brexit is going to be on December 31st. So let's see. Oh wait, I already have this one up here for you. Okay, so this is a key thing to remember. So between now and, what is going on with this cursor? It's jumping around on me. Okay. All right, so between now and on December 31st, we have a lot of negotiations that have to happen for the UK. So this sell signal that we have here, this bearish engulfing line, right now has a downside minimal target of this $28.41 area. So basically, it's targeting a $28.41 down to $28.31. This little support band here. Now you can see that we've already come into the area closely as of last Friday and also last Wednesday. It tried to probe down there, and it's a prior low also here. So we have the 0.618 and a prior low all holding up the market right here. So this is a key little spot, and that's why we have these yellow lines here. So now obviously it's a bearish signal, so that means this is a short position. So the shorts right now, this $1.3086 level, this last high, this is your key risk level. Anything above here discontinues the signal, for one. Okay, so when you have a situation like this, that becomes your ceiling. So any trading above that means the ceiling, that the signal has either failed or it has completed itself. Now this one, from this low to this high, and then having a signal like this, the first target would be this initial area of like 50% to 0.618 on a Fibonacci level, which it's already come into this area. Now the longer term target is something totally different. That's when we go back to July all the way up to this high, and we actually have more of a trend move that has happened. And the reason we use these levels is because if this was just a corrective move here, so you got to remember the British pound US dollar has been in a rally against the dollar since the really beginning spike of the coronavirus outbreak, global pandemic back in March. And now it ended that whole rally at the very beginning of September. Okay, so this market has been breaking for the most part until the middle of September, and it had a nice sell-off. And the question is the bear market going to continue, and is this just a correction, or is the overall longer term bull market going to come back and this is just the beginning of a new wave higher? So, since we have this bearish engulfing line sell signal, we also have this longer term area. Now, where we had this wave here, we have a lot of Fibonacci harmonics going on here. So this is why I think we have a chance of still seeing this market turn back around, even though today it's higher. So this prior major low here was at a very strong Fibonacci pivot point. And then when we made this low to this high, we came into and already hit these key Fibonacci levels right off the bat. Okay, and they line up with the longer term one here that we have off of this low from back in July. So you can see that the 0.618 level here from July comes right in just above this more recent major low over here that was back in September. So this is another big support area, just like this critical low is here. So if the market reverses and continues with our sell signal back through this little first target area here, then it's very likely that we can see the pound US dollar get down into this area. Now, we probably will see a little bit of bouncing here because this was a key area of support for the pound US dollar. If this thing was to blow through it, well, that would be very negative. Now, markets tend to go out like they come in. If this is really, you could probably see us get back down to this $1.22 area here, where this little line, green line is here off of this low here that we had back in July. So this would be the longer term target for if this trend continues to be a bear, but that would be something that I would think would happen over the course of the next 2 months. It's not something you'd see over the next couple days or couple weeks. Now, the steepness of this trend lower, and just by attrition, we can take out this downside resistance. So right now, the fact that we're butting up against it today, and ironically, we did kind of hit the downside resistance level there, holding the day intact as far as the bulls, and if we're going to reverse gears, this would be a good spot for us to turn back around and then come back out and take out Friday's low over the next couple days. If we take out Friday's low, that confirms lower move highs and lower move lows, which is indicative of what? A negative trend. It confirms that follows through with our sell signal, and the negative trend is confirmed with newer move lows, and then that would have us targeting this lower support band of around $1.2831 to $1.2720. So you're looking at a good, right now, $1.30 even. So you're looking at a good $2 move upwards of, almost a $2 move selling into this rally right now. And your risk, right now, you're looking at, it's $1.30. So let's type this up here and make this really clear here. So your risk is 1.3086. Sell signal is on. Downside target is 1.2840 or 31, and downside target 2 is 1.2241. Okay, so now for the video, we got this here. So our risk, once again, for this trade is this $1.3086 level. That's this yellow line, which is this high, which was established the day before our bearish engulfing line sell signal. Now, a lot of times, the reason we're doing this video is that not only is this a high probable Japanese candlestick pattern, it's a one-day pattern, but it's a very, very reliable one when you've had a trending market like this. Like this market had been trending for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 days before this signal had occurred. Anytime you have at least 5, but usually you need more like 8 or more days trending or bars trending and this engulfing line sell signal happens, it makes it usually pretty valid for at least a short run. This one already has hit the minimal target, and now we're looking for it to continue back down to hit the longer term target. So the sell signal is on and will be until this market takes out this previous high. So if it goes above $1.3086, and this is where your stops would be if you were short this or selling into this. And right now see the sell signal is still on, and you're getting a chance to really get in at a better price than you could have had you entered right when the sell signal was triggered. So right now your risk reward ratio on this trade is very minimal. So it's 86 pips because right now the market's basically $1.30 even. That would be your risk on the short side, and your target is $1.2831. So right off the bat, you're looking for risking 80 pips to make, what is it, 170. So you're looking to make more than 2 to 1, which I always say you have to have at least a 2 to 1 ratio as far as what you're looking for to make on your trade, and 3 to or 4 to 1 is even better, but 2 to 1 is your minimal one, and that's when you use high probable situations and trading signals, which we'll get into in a minute. And now your downside target number 2 is $1.2241. Remember, that's this previous low area down in July, which I think that if you take into account that the UK has to make trade deals with the EU because of the Brexit separation, they also have to make trade deals with the United States. So this is not a political thing. This is a must-do by law thing between multiple countries. And what's going on with Brexit, we have nothing to do with Brexit, but because of it, we will have to make these things happen. So it doesn't matter who wins the election. The current president will be dealing with it. Trump has to deal with this is not a trade war with the UK or the EU. This is just a resetting of terms because of the fact that they are now separating in complete terms. So with that being said, I think today you have a little bit of positive news for the stock market, starting the week off, which that usually with the positive stock market and positive this and that for what's going on with the economy, that is actually short-term negative, the dollar. So in the short run, I think that's why today's rally is happening. Now, like I said, this is giving you a good opportunity on an ROI basis for a sell signal because you have the bearish engulfing line that had occurred last week. We are still below that risk level, and when you have in your ROI, if you were to go back and even just test the original lows, let alone get to this first target at $1.20, 28.31, and even down to 27.20. Like this 28.31 is the first part of this. This is a support band here. So 28.31 down to 27.20, that's already a nice bang for your buck, let alone if the longer term short gets all the way down to $1.2241. Now, what I would do is once you do have this, if it does come down into this lower area here, this downside target of $1.2831, immediately since right now you'd be able to sell it, put in a break-even stop, but I would probably put it more with at least a few pips of profit in it for you, or even put it just above like the where this became originally support. If we fall through this $1.2863 to $1.2841 area, which is this little band here, then I would use that as your risk level as the market comes into this lower thing, and then ride the trend. You never know. You could constantly keep on lowering your stops as you make your way down this. And now this trend line here, I don't think this is going to stay complete resistance, keeping the trend bearish on this slope. By attrition, we can come through it, meaning that just over the course of the next couple days, we can go sideways, and all of a sudden we will breach this downward sloping resistance. That just changes the slope of the bearish trend. That doesn't necessarily mean that we would have a bullish breakout. Like I said, you have to violate the $1.3086 level, this previous high, to negate the sell signal, let alone the trend change also. So this is where the bearish engulfing line is a really good reinforcement to what is going on in the market. Because here's the thing in reality too is if the signal fails, well, it's already actually hit the first minimal target. But let's just say that it does get above the previous swing high and negates the bearish outlook. Well, that's a good thing. It confirms bullish intentions, so then at least which side of the market you should be on. So because then that would confirm more momentum for the current trend that has been up for the last 2.5, 3 weeks, with only having the last week being more of a negative weight as far as the pound US dollar. So let's blow this up a little bit more so you can see it a little more clearly. And once again, here is our sell signal that had occurred on October 13th. Today is the 19th, so that's 6 days ago. And now we have Monday's trade, which is exploding higher. But look at, we're coming off of our highs. And the reality is now it's already 9:30, so the stock market's been open for an hour. Now remember, on Mondays and Fridays, the first and last hours, there's a lot of balancing that goes on. So you had the people that took on weekend risk. There's everything from margin calls, whatever, that's just normal balancing on Mondays in the equities markets and other markets. But this one is a trend-driven move. The dollar has been going lower since Sunday night when the currencies open. And this is a global thing. All the other currencies today actually have been stronger versus a dollar for the most part, especially your major currencies. And that's the one reason why this is an excessive move in the pound. So the pound is one of the biggest movers in the dollar index. So that's making that spike today as well. But also, like it goes in, it goes out. So, and if this trend really is bearish still, and the bearish pound US dollar traders are on the right side, then this market is most likely to have basically used up all of its momentum to the upside, and the bears are just slowly getting ready to drive this market lower and lower and lower and lower. So the sell signal's in place. Now, if you want to get an idea on how to get, now I used Fibonacci here with the sell signal. There's a better way to trade these high probable Japanese candlestick patterns, such as the bearish engulfing line. And I love this one. This is one of my favorite ones. Now, there's a book out there called High Probable Japanese Candlestick Patterns, which you can read. It's available on Kindle and paperback versions on Amazon.com. So you can check it out. If you go to the forex-trading-com website, you go back up, see we're on the workstation page here. You go to your products and courses and services, you go to high probable Japanese candlestick patterns, you click on that, and that will take you to how you can get a view of a short-term clip of the reading and learn about how you can exercise these buy and sell signals that have been used for over 400 years in the markets. So, and a lot of people don't like Japanese candlestick patterns because they have not been instructed properly on how to use them. In this book, you will learn the time frames to use. Most people use them for intraday, which you can't use them. And then they try and use lots of patterns that just don't really, they're not very valid very often. So I've put together the highest probable chance indicator patterns that they have developed over the years, and these work in all markets, whether they're forex markets, futures markets, stock markets, and what have you. So today our example is the bearish engulfing line sell signal for the British pound US dollar. If you like this video, please subscribe to our YouTube channel so you can learn about more of our lessons, and also when we do webinars on the forex markets and what's going on a daily or weekly basis, whenever we have signals are triggered, we let you guys know. And now if you want to learn how to actually trade them, though, you got to read the book. That gives you the rules to on your risk management, what levels how you pick your risk levels, how you pick your target levels. It is not done like I did here with just a Fibonacci. This is a more basic way of showing you how to find support and resistance, and it's also very quick on the charts. And if you want to know the proprietary stuff, you got to pay for it, and it's not that expensive to buy the book or read the Kindle. So but that gives you the full formula, which then you can use that to actuate trades in both, like I said, any of the currency markets, futures markets, stock markets, options markets, and what have you. So for instance, like this, we have the British pound US dollar, this bearish engulfing line sell signal once again, where if it's targeting lower levels. You obviously report on the next trading bar, the British pound US dollar, which now you have a chance to get in at a higher price, so selling at a better level and risking less. Now the signal already hit the first target, so getting in now is not necessarily a good idea. Usually you want to do it when the signal has occurred. But in this situation, if you are a bear, because the signal is still on, well, it gives you a chance to maybe have another run at support and maybe at least make a few pips off of it. And you also know that if it takes out this high now, that becomes a very bullish signal. So for bulls, you have a breakout level that you can have more faith in. So with that being said, when you want to figure out levels, once again, you like we used here for this for each wave. So you had like your major low here, your major swing high here. To find your corrective way down, we found the 50% and 0.618 levels, just like we did from the low back in the end of that rally, which was the rally that stopped at the beginning of September. And then these, ironically, the 0.618 level came in very close with where the low was for here, as well as the 50% came is really close to where this swing low here was. That's the basing of where we're trying to figure out now, are we going to be a bull or a bear in the longer term? Now, because of the fundamentals, once again, and this is kind of funny how when you get a bearish engulfing line sell signal, and we're almost done with this video, you usually have these occur at big events geopolitically a lot of times in the market. And because of Brexit and the finalization of that, going from now into December 3rd, the pound US dollar, even if we do get a spike higher, we're more likely to be setting up for a neutral to lower trade until these dates, at least until the deals are done. So if a deal gets done sometime between now and December 31st, that could be very bullish to pound US dollar. But until then, it's very bearish. Now, we also have the election coming up in the United States. That's the one part of the component that could give the dollar a lot of strength. It's right now, at least until the election is over, and even if when the election's over, Donald Trump is still president. So that's the one thing where dollar strength may hold up, where it's going to be neutral to higher, just because until he's out of office, either in January or he gets reelected, that's going to keep the dollar probably in a sideways to neutral to higher outlook against the pound. And then at least until the Brexit is over. After the Brexit's over, that's a different story. But until then, that's the most likely scenario. Now, should Biden win the election, that's a different story, because if Biden wins the election, that's very bearish, the U.S. dollar. In that case, then you're probably going to see a neutral to higher trade develop going into the end of the year, because it doesn't matter what kind of deals are set. They know that once Biden's elected, between the social and economic policies that they're looking to put in, it's going to have a big weight on the U.S. economy. And the U.S. dollar. So that will then take over as a very bearish thing, meaning that you will probably see the pound U.S. dollar up a bit, taking out these highs that we had in September in a very short time. So that was something to look forward to in another couple of weeks. But as we trade into the election, I think right now, and as you can see it on the hourly, let's go to the hourly real quick before we end this video. We're almost done. So you can see how we had an erratic the algos were kicking this morning when they first started off the day, and then bam, we had this nice little rally that came into our downward sloping resistance. That looks about like it's it. The last couple hours, it's been kind of really sideways and not much of anything to really be concerned about. And I think now that the stock market's open and the markets are open for the week, it's Monday. We have a lot of trading to look forward to over the next couple days. Not to mention the news, and actually, I have to go and do my early voting today. So don't forget to vote. It's important no matter which side you want to vote, but you can't complain if you don't vote, and if you do vote, at least then, you know what, you pick a side and you deal with it. You move on from there. So don't forget to do it. It's very important. And once again, like our video, please subscribe to our YouTube channel. Always check us out at www.forex-trading-unlock.com. And if you want to learn how to trade this bearish engulfing line sell signal, Read the book, High Probable Japanese Candlestick Patterns, available on Amazon.com. And through it, you can utilize the best buy and sell patterns used for over 400 years to give yourself a competitive edge against the markets. With that, I want to thank you very much again on behalf of Forex. Hello everyone, this is Teddy Keckstead from Forex Trading Unlocked, and we are here on October 23rd, 2020 with a Forex Trading analysis webinar for you, and we're going to see how things are shaping up as we enter the final stretch of trading for this week. Real quick, we just want to put up our disclaimer to remind you that this video is for illustrative and educational purposes only, and that is it. So please check out that disclaimer, and now we will go to our first plug of the day, which is High Probable Japanese Candlestick Patterns. It's a book available on Amazon.com in paperback and Kindle version. Through it, you can utilize the best buy and sell patterns used for over 400 years to give yourself a competitive edge against the markets. With that, let's not waste any more time and get to our live screen. Please remember to subscribe and like our videos to help us grow our audience and keep motivating us to keep producing these. All right, so we have the Forex-Trading-Unlocked.com website pulled up. We have the Euro US dollar chart already here for us, and as you can see, the dollar is under pressure again today. The euro is trying to make a run at resistance, although it's having a little bit of trouble here. So as far as direction right now, I would key off of the recent high from 2 sessions ago, as well as the low from last week. This is your major range here to look as far as a breakout for momentum. It looks like we're starting to run out of gas. I mean, overall, the dollar is under a lot of pressure. Right now, I think that the markets are forecasting or being prepared for a potential win, which would be negative the U.S. dollar, and I think that's helping to lend a lot of the pressure that's going on right now in the markets, because due to Brexit and a couple other things, and especially the European numbers, there's no reason for either the pound nor the euro, which are the two biggest components of the dollar index, to be gaining strength against the dollar right now. So it'll be interesting to see how things now move over the next week and a half as we head into the election day. So I would say that probably what you can expect is that right now we're going to run up around this area here, testing resistance going into the November 3rd election. Excuse me. So we have a few days left, a few trading days left. It could be just a sideways market, and then I think what you're going to see is if Biden wins, this goes up, you're going to have a breakout to the upside, and if Trump wins, you're going to have a breakout to the downside. Or, excuse me, if Biden wins, you're going to see a breakout to the upside with the euro US dollar, and vice versa if Trump wins, meaning a stronger dollar. So let's go back to our last recent low here and this recent low here. Oops. There we go. And now we'll take this high here, and we're going to put this in. Now you can see that from this high we did break out to the upside. But we're going to move this to right here and use this as our, like I said, upside breakout, downside breakout range. You can see this wedging, and it wouldn't be outside of the realm of possibility to see most of your trading range go trade in around this area going into the election. Once we get past that, like I said, that this is the date here. We go this way or we go this way. Okay, so this would be, oops, get rid of that. So here we have a Biden win. Oops, that's not what we need. Okay, that's that. And then here we have a Trump win. Dollar's been relatively strong while President Trump has been in office, and as well as the economic policies and things like that, that's why we've had a particular strong dollar for most of the past 3 years up until the coronavirus pandemic. So what we're going to look at now is what is going to happen. So on an hourly basis, we just kicked off the U.S. markets. You can see that we are now leaning on support a little bit after having spiked for the high of the day so far off the euro-US dollar. Now that the U.S. markets are open and everyone's digesting the debates, it's very likely that we'll probably see this market trade lower for the rest of the day, at least for the next couple hours. If we settle around where we're at right now, say like around another 15 minutes or so, then I would start to look at a dollar profit-taking rally coming into place. So let's go look at the British pound, U.S. dollar here. Okay, British pound U.S. dollar had a nice rally a couple days ago, and now today, like I said, like the euro is starting to fall back on support. The pound is running out of gas. Could be a profit-taking move after this rally, or it could be the beginning of a downward slide. Now, the same thing here is in effect as is with the euro. We're keying off of when the election happens and what is going to most likely occur. So the same thing here is in place. So you want to key off of the high from 2 sessions ago for a breakout to the upside, and then the low from last week as your breakout to the downside. I think going into the election, once again, that you're going to see things that are going to be relatively self-contained, unless we have some major upsetting, earth-shattering news, which I don't believe is going to happen. And then here's another thing for as far as direction. Should you get a Biden win, this would be probably your most likely scenario of where it's going to go. And should you get a Trump re-election, this is where the pound should go. Now, this is only short term. This is not something that we're looking at long term, but we are looking at this is the election trade. So Biden win, and then here we have a Trump win. Now, is this an absolute? Absolutely not. What it is the most likely scenario for the market to react to a win for either candidate. So not supporting either one, not guaranteeing that this is going to happen either, but this is the most likely reason why you would see something like this. And to give you an idea of why we're looking at this, let's go and take a look at, let's see, Exxon. No, X is not Exxon Mobil.
There are 10,000 different crypto coins. How do you know in advance which ones are going to move? Well, that's what I'm going to show you today. And just so you know I'm not full of it, I'm going to show you my trading account now where I've held every single one of the 10 biggest gaming crypto coins this year. Like Shiba Inu, which I bought for just 0.008 of a cent before it skyrocketed in price. Or Solana, which went from $1 to $230. Or Luna, which went from $4 to $42.71 since May. Or AVAX, which went from $2.86 to $67.48 in 2021 alone. Now, these aren't small wins. Just one of those is going to be life-changing for you. I've invented a method that automatically keeps you in the strongest appreciating cryptocurrencies all the time. It doesn't take a lot of time, and you don't need to know anything technical. So far, this strategy has delivered a 25x return, and even better, it's been steady and smooth as clockwork the whole way. In fact, after I pulled my first million from it, I automated my strategy, and now it's just press button, make money. In fact, this is so easy that my 77-year-old boomer father can do it. Doesn't take a lot of time, and you'll be up and earning in minutes. Actually, I just got done being on an episode of the Crypto Millionaire podcast, where I laid out my exact strategy for making millions from crypto on autopilot. You can check out the podcast by clicking the link below this video, or wherever that button is. Now, you might be skeptical to get into crypto because you're afraid to lose your money. And I get that. In fact, in 2018, I lost a pile of money trading crypto myself. I've seen it happen to other people as well. But if you'll jump on the podcast, you'll discover the method I invented to make it virtually impossible to get stuck holding the bag when the bull market ends. You see, I've been able to do some very advanced data mining on the blockchain itself, and I've discovered how we can predict the exact date the bull market ends so you can cash out at the perfect time. That makes it almost impossible to lose. Now, just look at the countless examples of people using my strategy to make literally millions and millions of dollars from crypto. If you want to join them, get on the fast track to wealth with me, just go watch the podcast I mentioned before by clicking the button at the bottom of this page. So click the link and I'll see you there.
Would you like to know how using nothing but the simple standard indicators that everyone has on their trading platform and a startup account with just $1,000 in it, I was able to generate over $5,600 in profits in just 58 days? Well, last year I gave myself a challenge. I decided to test something. I was launching a new strategy and I wanted to see if using just the standard stock indicators and my new methodology would give me more successful winning trades. The results were staggering. In just 58 days, I turned a small account of $1,000 into $5,645. And in this video, I want to show you exactly how I did it. Because my guess is you're sick of being told how awesome trading options is. And then when you open an account and start trading, you either lose money or it just confuses the crap out of you and you're left frustrated. And the truth is, most options trading experts aren't even teaching you the right strategies. They're depending on you already having a ton of experience or plenty of cash to burn, so you keep trading. But most of us don't have that luxury. We need a new way to trade options with consistency, so that with successful trade after successful trade, our account will not only grow, but we can wire out money each week without having to add funds to cover our losses. That's the main objective, isn't it? But the good news for you is I've discovered a new way to take advantage of the markets that lets anyone, regardless of experience, generate results like this, without knowing all there is to know about options, without taking ridiculous risks or putting on high-risk trades, without having to worry about crazy swings up and down in the markets, and without having to watch your computer screens all day. Hi, my name is Michael Love, and I'm not a former hedge fund manager or VP at Goldman. I'm actually an authored chef with a best-selling cookbook. I've been on Fox, CBS, NBC, ABC. I was featured in Ocean Drive magazine, and I've cooked for some of the hottest celebrities in Miami. And I've also been trading for 15 years. I've been an above-average trader, an average trader, and a below-average trader. I used to trade with tons of indicators all over my charts, search and scan for patterns and triangles and flags and all those popular methods you always hear about with mixed results. I'd have a good trade, then a bad trade, then a good trade, then a not so good trade. I think you get the point. Pretty frustrating. Here you can see a typical trade that I would take. This is Match.com. Perfect chart, trending upwards, higher highs, higher lows, a slight pullback in the stock, and I got in. You can see the green arrow where the stock gapped up, and I was a happy camper. My trade was up 80% at that point, until the next morning. It plunged 22%. I was wiped out on the trade. Here's Netflix, another perfect setup. Great earnings report. Got into the trade, it gapped down, wiped me out. I spent a fortune on books, courses, seminars, trading services. I had all the right indicators, scanned for the strongest stocks, upward trend, perfect setups, but I was still getting killed. What was I missing? Well, I knew somebody who had the answer. I called a relative of mine who's a professional options trader. We talked now and again about strategies, indicators, market stuff, but he always kept his trading methodology close to the vest. So finally I called him and asked him if he would share with me what apparently I was either missing or the markets and experts were purposely hiding from me and every retail trader. What special indicators and lists and strategies was he using? Turns out he used a set of standard indicators and specific price charts that you could pull up on any trading platform to create what he called a market forecast for the next day, a market weather report. And then using one simple strategy and setup would have winner after winner with very low stress, low risk, and tons of consistency. And this was what I was after. After spending a few days learning this trading workflow, he suggested I go back and look at all my successful trades over the past year and then run this market weather analysis on the day before I took the trade. What I found out made my head spin. Turns out over 85% of all my winning trades were in sync with this report, and all my losing trades were not in alignment with the report. So I thought, what if I go all in? What if I dump all my indicators and crazy strategies and setups, try just trading the market weather and this one simple setup? What if I ran this market weather report analysis in the morning before I trade, instead of scanning for stocks, instead of listening to the news? And that's exactly what I did. I ran this market weather report every morning. After a few days, it took me only 2 minutes to do. Then I ran the next weather report on the market sectors, which took me all of about 30 seconds, which led me to his personal stock lists within those winning sectors. So you can see I started with exactly $997 in a small account. This was my challenge. Could I turn $1,000 into $2,000 or $3,000 in 2 months? Well, my first trade was ZTS. In less than a week, I made $400 on that trade. The next few trades in a row were on the S&P 500. I pulled in $376, $228, and then $218. The next 6 consecutive trades netted me 77%, 100%, 82%, 83%, 309%, and 68%. This was what I was missing. And that's not all. Over the next few weeks, I had raked in over $5,600. My account was up 566%. In just 58 days, my small account challenge that I started with just $997 ended with $5,645. Because of the success of this challenge, this new methodology, my friends and family started asking, how did I do it? Finally led me to put everything down on paper. All the steps I took, all the methods and strategies I used. The result of that effort is a brand new program that I call the Trade With Me Now Market Weather Masterclass. Inside this masterclass, I show exactly why this technology is so powerful and that you can never again take a trade without knowing the market weather. It's like making plans to go to the beach for the weekend and then not checking the weather before you go. You'd never do that, right? So why take a trade without knowing the overall market weather? You're going to see how I analyzed the overall market direction and what sector the money was flowing into, how I chose the best stocks in the strongest sectors and narrowed them down to just a few juicy choices, the 3 indicators that showed the hidden setups that creates a winning trade with over 85% certainty by showing which stocks in those sectors are ready to explode, and the 8-step trading workflow that led to a $5,645 payoff. With this information in your hands, imagine being able to finally understand how options really work. Imagine having a market weather report that will provide an 85% certainty in trading direction. Imagine building a small account by finally having consistent, successful trades using one simple set of indicators. And imagine wiring out profits from your trading account to your checking account every week. And that's exactly what I'll show you how to do inside my Trade With Me Now Market Weather Masterclass. And the good news for you today, it's ready for release. So let me tell you everything you're going to get inside of the new Trade With Me Now Market Weather Masterclass program. Number 1 is the core of this program, the Market Weather Report Masterclass video modules. This is where you're going to learn everything there is to know about the overall market weather, the sector market weather, how to set up your charts for it, everything. You're also going to get my basic options video library. Not everybody knows everything about options, so for beginners, this is awesome. Over 5 hours, including 16 videos of information on things like what's the difference between stock and an option, how do you buy and sell an options contract, how to read a chart, what the moving averages are, what Fibonacci extensions are, and how to read them. It's totally complete. Next, you're going to see how I used one simple set of standard indicators to consistently deliver winner after winner in every type of market. I'm going to show you my 6-star setup that helped me rake in over $5,600 and consistently delivers winning trades for me and my members. Probably the most important module is the 8-step trading workflow. I'm going to finally let you in on how professionals use this methodology to quickly and efficiently trade the markets. You'll get my sector money flow system that tells you within 30 seconds where to look for stocks that are about to explode, plus a whole lot more. You see, with Trade With Me Now Market Weather Masterclass, you can finally learn how to trade options like a pro, even if you're starting with zero experience. With my trade alerts that come with precise trading instructions, you can earn while you learn to become a rockstar trader in your own right. And you will build your account with successful trades while simultaneously taking profits and wiring them into your checking account. This masterclass alone is a $997 value. Plus, when you purchase the Trade With Me Now Market Weather Masterclass, I'm going to throw in the following trading courses completely free. And the first one is a brand new training called the Trade Tracker course. You see, inside of this training, you're going to see what most amateurs don't do and is typically overlooked, but not by the pros. I'm going to show you how to track your trades efficiently and professionally, 25 trades at a time. This customized and personalized trading sheet will do all the calculations for you, show you your good trades, your bad trades, your profit calculations, and serve as the basis for your personal trading plan, which is crucial to your success. Now, if we add that to the Trade With Me Now Market Weather Masterclass, you're also going to get the Trade Tracker course, a total of $1,146. But I'm also going to throw in the custom trading plan for pros. In this training, I'm going to show you how to create your personal trading plan. Even the top quarterbacks in professional football have a playbook and a game plan for each Sunday. At halftime, they make adjustments. No team and no player is without a game plan, and no professional trader is without a personal trading plan. This course goes hand in hand with the Trade Tracker so that trades that you take stay in alignment with your plan. Then you make halftime adjustments as your plan evolves. This is literally the one secret I use that kept me out of bad trades when my emotions were out of check and got me to stick with the winning trades when before I would have bailed before they made me any money. It's priceless. So now you're going to get the Market Weather Masterclass, the Trade Tracker course, and the Trading Plan for Pros, a total value of $1,295. You're also going to get my Advanced Options course. Here's where you take things to a new level. After completing the basic options video library, the Market Weather Masterclass, and you're starting to take trades, you will now learn the low-risk, high-probability strategies that give our members an edge. These videos alone can make you $10,000 over the next 90 days. So now you're going to get the Masterclass, the Trade Tracker, the Trading Plan for Pros, and the Advanced Options video library for a total value of $1,694. And finally, I'm going to add my 3-2-1 liftoff indicator. I've taken the 3 simple indicators that generate explosive moves with over 85% certainty and created one easy-to-read, color-coded indicator. It works on the most popular platforms, and I'm adding it to this package absolutely free. So to sum up everything you're going to get, number 1, the Trade With Me Now Market Weather Report Masterclass, the Trade Tracker course, the Trading Plan for Pros course, the Advanced Video Library, and my 3-2-1 Liftoff Indicator package that includes videos on how to maximize its potential, a total value of $2,393. And I'm going to add our Trade Alert service for 30 days at no cost. Like I said, you'll get a text alert every time I place a trade. You'll get the exact trade, the entry price, the target, and another alert when I exit the trade, along with my market commentary, all in real time. That's for 30 days included in the package. But I'm not going to ask you to pay $2,393. What that means for you is I'm going to slash the price all the way down to just 2 payments of $47. So to get access to all these trainings and start receiving my trade alerts for just 2 payments of $47, just scroll down below and fill out the form. And like everything else I offer, you're backed by my 100% 30-day money-back guarantee, which means if this course doesn't deliver on what I promise, it just doesn't meet your expectation for any reason, just let me and my team know and we'll refund your entire investment. To get instant access to this course right now, just fill out that form right down below and you'll receive an email with a login and password to your members area. Before you fill that out, I want you to remember what having this information is going to give you. Number 1, you're going to learn about options the right way, not all the fluff, not the confusing math. You will learn what you need to know in order to feel comfortable placing a trade, closing a trade, as well as a step-by-step program that will teach you all our concepts, methods, and the strategies that put $5,600 in my pocket in 58 days. You'll be able to trade with confidence, not being nervous about when to get out of a trade, but totally confident on how much to trade, when to get in, when to get out, how to track it, plan for it, and confident in your ability to be an options trader. You'll finally be able to string together a series of successful trades. And if you've been trading for a while, you know exactly what I'm talking about. You'll be able to achieve a consistency that eludes most people when trying to make money in the markets. And finally, the huge payoff of wiring out of your account each week instead of in. Just scroll down below this video, fill out the form, and you will instantly have access to all the trainings in the members area. And I'll see you on the inside.
All right, so ExxonMobil has been dropping. I know why we're looking at an oil stock when this is a Forex thing. Well, believe me, currencies impact all kinds of things. So since we've been getting closer and closer to the election, you've had the oil stocks tanking because even though oil has been strong, oil stocks are tanking. Why is that? Well, defense and utility stocks such as oil and stuff stand to suffer greatly under a Biden election. I would use caution with this. If Biden wins, excuse me, the most likely scenario is that you're going to see oil stocks continue to tumble. Now, here's a monthly. As you can see, look at how this has been going down here. Now, this was because of the price of oil drastically reduced, especially when he had here the big sell-off at the beginning of the year. We're back down to the lows of where we spiked when oil was being produced at massive production rates between the Saudis and the Russians. Now we're hovering right at those lows once again. This is what's I think is most likely going to occur. If you have a Trump re-election, you're going to see an accelerated move to the upside. Okay? And then the opposite will be true if Biden wins. If Biden wins, you're going to see ExxonMobil become a dog, and it'll probably be a very sick dog for a while. They're going to work on the Green New Deal. They're going to put so many restrictions on the oil industry that the long-term outlook for companies such as Exxon, they're going to be constantly bleeding, let alone as production levels are forced to slow down. You cannot just shut off the machines in that industry. It costs more to turn them back on than it does to keep them running. So this is going to become a confluence of what's going to most likely become turmoil should Biden win. Now, here's another thing you want to look at while I'm looking at these stocks real quick. Northrop. Oops. Let's get this right. Sorry about this, folks. Northrop Grumman. It should start to pull up. Okay, here we go. NOC. So just like we have, come on. NOC. Okay, here we go. Now it's loading. So Northrop Grumman is also the same thing. Since we've been entering into the election phase, this is a defense stock that is, look at this. It is just tanking. Key thing is here is we had made a nice little solid bounce here earlier in October. We failed through here. This, I believe, is the pre-election jitters going on with this cycle as well. So notice that Northrop Grumman, which is a big defense contractor, this is getting hammered. Now, granted, it's an expensive stock, but still it's because a Biden win means that defense contracting and defense spending will go down once again, and this is the way you can continue to look for the forecast for this stock if Biden becomes the next president. The opposite is true if Trump wins. If Trump wins, that guarantees that the military will remain strong for at least 4 more years. The military has been built up under his watch, and there's no reason to think that all of a sudden he's going to pull back the reins on that. So these are cases that are just like the Forex market. You can see how the election is becoming a big staple with what is going on. So let's go back to British pound, US dollar. As you can see, this market has, we have our little reactions as far as Biden win, Trump win. The currencies, like I said, are most likely going to start to go sideways over the next couple of sessions going into the, oops, this goes to November 3rd. Okay, there we go. Here's our election target date. Most likely we will see a consolidating, wedging going into this date, and then once we hit this, this will be the explosion. We're not going to even get into whether or not the election is going to be contested or not, or how the polls are running. We'll see what happens after that date. But right now, as it stands, this is our outlook. So let's look at the U.S. dollar Swiss. Any questions out there? We have some viewers, but no questions right now. Just want to double check that to make sure that we're not missing anybody. Let's see, I'll put this out on the chat. Any questions? All right, there we go. All right, now we have the U.S. dollar Swiss pulled up here. And this market also, like the euro, is pretty much weighing heavily on the dollar. Now, if we get a big turnaround in strength, for instance, obviously with the, you can tell the tone is that a Trump win goes up and a Biden win goes lower. So with this one, let's do this. So, Trump win doesn't necessarily mean that this is going to start to head back towards parity or something against the Swiss franc, but it should shore up the Swiss. Remember that the Swiss and the U.S. dollar are both flight to quality currencies. Currently, they're some of the only flight to qualities left. All that we have left now for flight to quality is gold and U.S. dollar and the Swiss dollar and the yen in some cases, because interest rates are pretty much off the table. Short-term interest rates are almost locked bid. There has been a break in the bonds, which is very disturbing. That's another reason why I think that come election time we have these significant changes and shifts in direction should you have a turnover in power from Trump to Biden as far as the presidency is concerned. So I would key off of this low here and this last swing high right here. This is probably going to contain your trading over the next couple of sessions as we head into the election. The Swiss doesn't move as violently or as much as the euro, or let alone the pound as volatility is concerned, and we have a big base here. So as much as the dollar's been trying to get beaten down by these other currencies and has, you can see that with the Swiss, it's been in a pretty tight range over the past month and a half. I would expect that this is going to be contained once again as we head into the election, but if we do have a breakout from these levels, then obviously that would be something that is confirming the shift in momentum is where we are going. So right now, Swiss also very neutral going into the election trade. So the euro and the pound have a little bit more of a ability to develop a swing trade. But like I said, over the next week, use caution, wait till November 3rd, because believe me, you're going to have swings like there is no tomorrow, and it doesn't matter who wins. So that's the beautiful thing about trading is money doesn't care about politics at all. Another reason you can think about consolidation happening in some of your major currencies is just like by watching what's going on with the Canada as well. This is the same type of scenario going on. I would key off of this major low here. It could flirt around with the low from last week. The high from last week or a week and a half ago I don't think is going to get triggered, but you never know. Right now I would say don't count on it until after the election. After the election, I think it is going to have a big impact on what's going on, because right now Trudeau, the Prime Minister of Canada, is doubling down on his actions with the United States, considering that he is awaiting a Biden victory. May not happen. So now here's the question is, where do we go from here on the election? Well, it's the same scenario. I think that if we have a Trump win, you're going to see the U.S. dollar climb versus the Canada in the short run. And also the opposite is true for a Biden win. So even though they are our neighbors to the north in America, that doesn't mean anything. So a Democratic turnover in power would most likely like I said, give the U.S. dollar bears a lot of fuel to work on, especially because as you see certain sectors in the stock market unravel and profit taking happen because of the promise that he's made to turn over the taxes and to basically start just trashing anyone that has any investments in the markets. Expect that to fuel a lot of volatility and definitely a lot of profit taking. I mean, if you got cash and equities, you have between this upcoming tax season and then when Biden overturns everything, you'll have one last shot for the year 2022, and then your capital gains are going to skyrocket astronomically. So if you're going to take profits, you're going to take it between now and then if he wins. Otherwise, if he doesn't, then you're not going to see a forced sell-off because you're going to have a lot of retirees. They're going to say, well, I'd rather take my money out now and only get taxed at X rate than getting taxed at more than twice that rate in the future when they need the money, you know. So, I mean, you think about this, even if the market doesn't move, it's going to cost you more to take your money out of your retirement account with the Biden win in 2 years. With the Trump win, it's secure where it's at right now. The new levels that were imposed that went into effect this year, that people have been enjoying, will finally stay for a while in that scenario. So we'll see what happens. So this one I would be very cautious. I would expect a sideways trade to really, really chop people up. So see how this little area is here? How you have just this little consolidation for a few days, and it's just a tight little range here. Well, I would expect that you're going to see something like this go right into here as well. Okay, so this little spot here probably will turn out to be like this. You can maybe extend it like this, you know, and this is also another key level here to low from this week as far as breakout. But I would use caution with this one because a failure from here just continues this short-term downtrend. But this is going to be key support down here. It's going to be hard to get through this before the election, unless it continues to show that Biden is leading in the polls and it starts to lean towards a Biden victory. Well, then I can say that you most likely are going to see this happening, where you'll see the U.S. dollar Canada continue to batter support. But like I said, going into the election, there's no real reason to send any shock waves, and especially after now the debates are over. We've already had 10% of the population in America already come up and out to vote. So we'll see. The good thing is we know that people are definitely placing their bets on the election, and people are voting, which is good. It's a right that you should exercise. You have it. You should be fortunate and happy and grateful that you do, because you don't have those rights in many countries, let alone even if you do, they don't count. So U.S. dollar JPY, let's go see what's going on in the Asian area of the world. You can see that there was a harsh sell-off in the yen the other day when we had our little Wednesday, our normal Wednesday spot on TFNN.com, our 940 Wednesday spot. We were talking about this slide. Overzealous sell-off, but the thing is that this was when the U.S. dollar was rallying against some other currencies, and this one took a dive. Typically goes the opposite. Now the funny thing is that while the other major currencies are running out of gas, remember it is Friday, so it may be a very lackluster trade. Another reason I would say is because it's raining like crazy in Chicago, and when that happens, it's kind of like you buy the grains when it's sunny in Chicago and you sell it when it's rainy. When it's rainy for some reason too on a Friday, it just seems to slow things down. So I wouldn't expect any really erratic things to happen. Although we do have 9 o'clock coming. We'll see if the algos start to kick up something. If they don't kick anything off here in another couple minutes, then I would say that you're probably going to see not much. In fact, since we are about to roll the hour, let's go jump back to the Euro US dollar and check out that hourly chart and see if the sell signal looks like it's going to stay in place. Okay, we are here. It's almost 9 o'clock. You can see that we're pretty much in the middle of the range for today's trading for the Euro US dollar. And here we settled here with this little bearish and going, yeah, I can see that we may not have much of a trade today, but it definitely looks like it wants to leak on support and pretty much do that. I wouldn't expect very much to downside, but definitely it looks like the euro has run its course to the upside for the day today. So now back to the US dollar yen. What does that mean for this? Well, it looks like it's shoring up a little bit, and at least that's on the hourly. Let's go back to the daily. There we go. So same as for this, the Asian markets are closed and the European markets are getting ready to shut down. So it's going to be just the American traders going on for the what is the end of the week here. And like I said, I would not expect very much of action for the rest of the day. And then also as far as what goes on here, now here's the interesting thing. You know how we've been leaning towards dollar positive Trump, dollar negative Biden. The opposite is would be the fact here with the Japanese yen. Reason being is that the Japanese yen typically runs the opposite. So if Trump wins, you could see a stable to lower yen. And then if Biden wins, you could see a stronger dollar versus the yen. Now, there are all kinds of other variables that will come into place. But I think that unless you have a breakout there or we hit support again here, I don't think you're going to see much activity. This market is in a bear market. It's making lower move lows, lower move swing highs. So this is going to be key what happened recently. So we have our containment range going into the election. This last swing high and this most recent swing low are going to be huge for direction. A failure here has us continuing the downward trend. But like I said, right now the markets are pricing in a Biden win right now. So I think that this could be a situation where we made a lower move high, now we made a higher move low, and the question is, are we neutral, getting ready for a bullish explosion? Is Biden going to take it? Or is it going to be neutral to a bearish implosion if we see a reversal of the consensus and Trump wins the election? So very interesting stuff. This is like consolidating just like the rest. And it's something you have to be very careful of. There's going to be lots of numbers coming out next week, just like any week. But as we get closer and closer to the election, you're going to see these erratic moves where the algos kick in, and then it's going to dry up. Volume will just completely dry up, most likely. That's usually what happens in these situations. So why would this be any different? Now, here's an interesting scenario, too. We have the Australian dollar, US dollar, where we had been making lower move lows, lower move highs. Now we've made a higher move low. So we're going to key off of this one here for direction. And we'll use this right here. And then we have obviously the downtrend, which is in place here. And we are wedging into this. Now, Australia has had a big issue with lockdowns and coronavirus and whatever. So, not to mention stable price of oil, the fact that gold prices have stabilized and have had a little rally recently, but they're pretty much just hanging sideways. This doesn't bode well for Australian dollar versus the US dollar. Takes it off the really strong bullish campaign into a neutral to bearish campaign. Even though, once again, when it comes to the U.S. dollar, this is a situation, too, where if you have a Biden victory, you'll probably see a continuation of strength with the Australian dollar versus the U.S. dollar, and vice versa. You'll see, with a Trump win, a turning, a reversal of that with the dollar having strength. The one thing, like I said, just like we have the U.S. dollar yen, which acts differently than the other currencies we were looking at, the first four currencies we looked at, the European and the Canada, they all have their own nuances here. And as far as strength, the U.S. dollar strength, if we have U.S. dollar weakness coming into play, that can help to aid with the Australian dollar rally that has been in place and help to kick it up to make necessarily, because like I said, Australia has their woes of their own, and as long as you have to watch the CRB and watch the metals markets, if you have gold, silver, oil that are under pressure and hanging on support or being neutral to lower, that is weak, the Australian dollar, no matter what the other currency cross is, like the dollar, it could be the euro, it could be anything. And the opposite is true, is if you see gold prices going up and you see oil prices going up, that lends support to Australian dollar. And if you also see a reduction in coronavirus cases in Australia, let alone a easing of the lockdowns that they have there, then you will probably see also a resurgence of bullish strength to the Australian dollar component of whatever cross it is versus the Australian dollar. But right now, they're looking at it in a weaker posture. So even if the dollar is weak versus, say, the euro and the pound and the Swiss and even the Canada, you may still have dollar strength versus Australia. So be careful. There's a lot of divergence that hit the currencies this summer. They don't all trade the same way, but we definitely want to keep these variables in mind. Like I said, here we have the New Zealand dollar, US dollar. So what we were talking about with the Australian dollar is similar scenarios as far as election wins and things like that. However, New Zealand doesn't have quite the coronavirus issues. They don't have lockdowns like Australia has. So it's very possible that you could start to see where, let's say that Biden wins the election, okay? You could see that New Zealand dollar, US dollar would remain bullish, but there's other variables that come into place also. And that would be where you could see the New Zealand dollar, US dollar go up with a Biden win, but the Australian dollar, US dollar would go down with a Biden win. It doesn't matter who wins, Biden or Trump. So just remember, there's a lot of divergence. This is another market where I think you have to key off of recent levels for your direction. The low set a few sessions back here. Obviously, we spiked high today. This market is grinding this correction higher, but remember, on the overall, here's this swing high, here's this swing low. This keeps this market in a bullish market, but it's running out of gas. Also, like I said, remember, this could continue higher versus the Australian dollar. So we'll see. I think right now it's showing strength because of dollar weakness and the projected Biden win. And like I said, if you go this way, we're going to do this for Biden, and then we'll do this for Trump. So I think that this is another one where the election is going to become a big factor as far as direction, or as far as a big component of direction. So this one will be like the European currencies and the Canada. Remember I said that the Australian dollar has so many of its own other issues that might have a different take. So it wouldn't be surprising for me to see, say, in another 2-3 weeks, let's just say that Trump wins, to see this could still be neutral, okay? And it could even rally, even though it's a Trump win and not a Biden win. But you could see the Australian dollar going south and this one going higher. So look, if you trade the New Zealand dollar, in fact, let's take a look at the New Zealand dollar over the Australian dollar and see which one is stronger. And just like I thought, this is continuing to pressure highs, whereas the Australian dollar is obviously on the losing end of this. So when you want to look at, like we just looked at the Australian dollar and the New Zealand dollar versus the dollar, when you want to gauge strength in either one of those currencies, check them against themselves. So New Zealand dollar, Australian dollar is indicating a bullish market. Now look at this algo spike from a couple days ago. That is some serious volatility, but boom, it made a incredible comeback here. Back to our New Zealand dollar, US dollar. So once again, New Zealand dollar over the Australian dollar, we are positive. New Zealand dollar over the US dollar, we are still in a bullish mode. And Australian dollar, US dollar, we're in a bearish mode. I mean, lower move lows, lower move highs are indicative of what? A bearish market. And then we come back to New Zealand dollar, US dollar. We have higher move highs and higher move lows. These are indicative of a bullish market. So in the short-term pattern here of September, New Zealand dollar is going this way and Australian dollar is going the other way. So it'll be interesting to see what happens after the election. And I really think that after November 3rd, you're going to start, especially as we head into wintertime and the coronavirus, if it starts spiking huge in Australia, get ready to see that New Zealand dollar, Australian dollar bull continue to blast through resistance. Now let's go and check out our US dollar, TRY. As you can see, US dollar in one of these smaller currencies here continues to gain strength and strength and strength. So this is the one thing that, forget the election, when you get to your more medium to lesser currencies, the dollar probably is going to remain a bull for a while. I wouldn't think that even with a Biden win. Now, the one thing is with this here, a Biden win on this one could have a correction here, just because under Trump you had very strong Middle Eastern diplomacy. You have, like it or not, it's the first time we've had peace or peace-ish type environment in the Middle East in, well, my whole lifetime, and I'm almost 50. So, I mean, you have ISIS that's been eradicated. You have the peace accords that are growing. You have Arab countries that would never talk to Israel or even deal with us at the table before, and they are. This stands to be a big thing. If Trump gets reelected, you can expect more of the same and stability in the Middle East, which is something, like I said, has never existed in my lifetime. And if we have a Biden win, and this is not politics, it will be more of the same, and then you will see a reversal. Israel is our ally right now. We backed them hard under this presidency, where other presidents, especially the last one, refused to and just completely ignored them. So why would the partner of that president be any different? So I think that your Israeli-U.S. relations will completely collapse under Biden, and you're going to see Middle Eastern strife grow at a record rate. So that's just my prediction. So hopefully that doesn't occur no matter who wins. But you can see that the market is pricing this in here. So let's look at the U.S. dollar, Mexican peso, before we get back to the euro, and see what's going on here. So U.S. dollar, Mexican peso, this one's breaking. You know, this one's factoring in a Biden win, because a Biden win means lots of tourism to Mexico. It means the opening of the borders again, because right now things are, you know, the pressure with Trump and what have you, with as far as immigration and things like that. But I would expect you to see that should we have a Trump re-election, then you're probably going to see the peso get another rally, bouncing back up to this 21 to 22 and a half, maybe even 23 pesos to the dollar. And with the Biden win, excuse me, I haven't had my morning orange juice, so my voice is a little bit rough. So anyhow, U.S. dollar, Mexican peso under a Biden win most likely will continue the move lower. So euro, U.S. dollar. Now we have the U.S. markets that have been open now for a little over a half an hour, and as you can see, we have a lot of going nowhere here with the euro, U.S. dollar. It's after 9 o'clock. European markets are closing soon and wrapping up their days and their positions and what have you. And now it's going to be just America and the algos left. And like I said, right now it's shaping up to be a quiet trading day. And like I said, once again, when it's rainy in Chicago and stormy, typically on a Friday, everyone's lethargic, running out of gas, and not paying too much attention to the markets. And I think everyone's digesting the debates as well. So if there's no more questions, we had a couple little ones here. We answered those in our analysis. So with that, I think we will just check it out. We have one thing on the chat. Let's see. Okay. So put that in. We'll give this guy 1 second to operate. Now, once again, please subscribe to our YouTube channel, like our videos to help to encourage us to produce more, and definitely pass it on to your friends. And don't forget to also check out the book, High Probable Japanese Candlestick Patterns, on Amazon.com in Kindle and paperback version. Through it, you can utilize the best buy and sell signals used in Forex markets, futures markets, stock markets, options markets, you name it, you can use them. We do have, interestingly enough, we had yesterday, even though it was a very small trading day, this was a short-term sell signal. This is a bearish engulfing line right here. The thing is, it only went from 1, 2, 3, 4 days, 5 days. And that's the minimal you want to see. And this is another reason why I think you're going to be contained to sideways, is because of this bearish engulfing line right here. The bearish engulfing line should put a short-term, engulfing, there we go. So the short-term sell signal, this bearish engulfing line right here, will help to contain us into this wedge. Now, how much of a sell signal is this? Because this is a intermediate short-term wave, there's not much to look for here. In fact, you can see it from here to here. So we're looking for a breakdown to somewhere. Now this is just off the short-term move, right into this zone right here. Let's get rid of this, make it a little clearer. So see this little green band right here? If this sell signal is a valid sell signal, we've already touched the upper half of this support band. This is probably where you're going to see the trading to gravitate. I would be very surprised if we have much of a breakout in this range. So let's move this up. There we go. So somewhere in this little pocket here, this is what I would expect for us to settle into next week. Now, obviously, if we take out this upward sloping support and then we start leaning on this level here and take this out, well, that besides the Trump-Biden fundamentals that we're putting in here, then you have a technical break that would definitely help us to go back to our short-term neutral to bearish outlook for this market. Remember, we had a gigantic head and shoulders that occurred here, gave us our first break. This could be our leg 1 down, our leg 2 correction as we set up for our leg 3 downward trend move. And especially if all of a sudden you start to see Trump gain momentum, or once we hit the election day and the numbers really are leaning towards a Trump victory, I would say that you'll probably see the euro US dollar fall out of bed, you know, and then we could have us really easily leaning on this $1.16 area and maybe even have a correction down to $1.14, somewhere in this area, which is really what we're looking for in the longer term. This is a technical outlook, not an election outlook. So bearish, the euro US dollar, definitely technically and fundamentally, but right now we have short-term fundamentals that are keeping it neutral to positive as the market weighs in a Biden win. Now, the nice thing about this is it doesn't matter what your political skew is, you can capitalize off of these things. So just like I showed you ExxonMobil and Northrop Grumman, think about this. Biden wins. If you hold those stocks, you know it's a good time to get out of them. If you don't own these stocks and Trump does win, it's a good time to buy those because they are so beaten up, you know. So it's something to think about, and remember, we'll be looking at this and watching this as we get closer to the election, and we will have election trades too coming up for you next week. So we're going to come up with actually this weekend for next week. So we're going to have our breakdown of what happened with the Forex markets when they close after today's session, and then we'll also have an outlook for next week as well as our picks for the election. Wait for that one. We're going to have a special webinar, trading picks for the election, that we're going to produce for next week. It's going to be a very interesting webinar. I think you'll like it. It's going to have Forex, futures, stocks, options, the whole thing. We're going to lay out a trading plan for the post-election. So it doesn't matter who wins, we're going to have a plan. All right, so it's always good to have a plan. Read the book High Probable Japanese Candlestick Patterns, and it'll teach you a plan right there on how to trade all markets. With that being said, I want to thank you very much. I'm Teddy Keckstedt from Forex Trading Unlocked. Please check us out at our website, www.forex-trading-unlocked.com every day. Check us out at our YouTube channel, Forex Trading Unlocked. Please subscribe and like it. And also follow like our videos and pass them on.
Inspired by State Farm's surprisingly great rates.
It's so cheap, yeah, got a great rate on the down low, 'cause Jake isn't your average Joe.
Like a good neighbor, State Farm is there.
Hello everyone, this is Teddy Keckstedt, and we are here today with a Forex Euro US Dollar bearish engulfing line sell signal webinar to show you what's going on with the on today 11/11/2020, And before we get into our sell signal webinar, let us just post this disclaimer real quick to remind you this webinar is for illustrative and educational purposes only. And since we're going to be discussing a bearish engulfing line sell signal, we're going to give you a little plug for the book High Probable Japanese Candlestick Patterns, which is .com in paperback and Kindle versions. Through it, you can utilize the best buy and sell patterns used for over 400 years to give yourself a competitive edge against the markets. And also remember to subscribe to this YouTube channel so you'll be alerted to when we come out with other videos. And with that, let's get into our euro. Okay, so on Monday, we had, on Monday, November 9th, a bearish engulfing line sell signal formed. We had formed a higher move high after having made a higher move low, which puts us into a neutral bias. The market had been kind of in a bearish way since September, and then we had a nice little bounce right around the election, and we screamed out to make higher move highs. So the question is, what do we do? Well, we know that if you're making higher move highs and higher move lows, it's a bull market, and inversely, if it's lower move lows and lower move highs, we have a bear market. With this is an indication for indecision. Obviously, we know the U.S. elections are still undecided. There is no clear transparency on what's going on, so we have that going on. But then the euro, besides having the U.S. elections that impacts the dollar, the euro has Brexit coming up. That's here on December 31st. So the UK and the EU have to come to some sort of agreement as far as trade, as well as with the U.S. So all these things are coming to fruition in the next well, now it's already, today it's 11/11. We have under 2 months for all of this to happen. So we will have a president-elect or incumbent president confirmed as the new president again, or we will have also exit decision as well. Now, the Brexit is going to happen no matter what. The question is how does trade happen? And the biggest thing is that they have to come to some agreement, because after the 31st, things will stop. So they just on a contract basis, it's a legal thing and all kinds of other issues. So they will have some sort of agreement. What it will be as far as the whole piece of the pie, I doubt it. I think what they're going to do is put together a outline that they can function off of and then evolve it as they go along. And the same with the U.S. It's pretty much similar to what's already been in place, except for a couple other tones. But it's just a matter of basically dotting I's and crossing T's when it comes to the U.S. But this does all have to happen, and because of that, we're going to have pretty much a sideways motion. But the sell signal right here has us leaning on support, and this $17.24 level, this red dotted line here, this is a key pivot level, which comes right above this upward sloping support line. It's been holding this trend intact for multiple months. So we did dip below it briefly on this day here. This was on the day after the election overnight, and that was crazy volatility that day, so that low really doesn't count. That's an algo spike. So we're looking off of the day beforehand as our major support pivot point for this trend as far as an actual major low, if you will. And right now we are wedging. So as you see from that upward sloping support line, and then we have the sell signal that we had from Monday, we're coming back towards this upward sloping support line. Now, from the high that we had from a few days ago, and the high that we had set in September 1st after this head and shoulders sell signal, we had this market in a neutral to bearish posture. What it's really done is establish a range over the past few months, not really outside of the realm of it's not really any rocket scientist to see that this is what's happened or why it's happened, because we knew that going into the election that there would be a lot of indecision. There's for the most part, everything is divided in the U.S. as far as what the election is concerned. Coronavirus is also on the table. That's the thing where things in the U.S. weren't going well, but now things in the UK as well as in the EU are not doing well either. These are all things that are weighing on the euro. So I think what you're going to have to key off right now is this $19.22 upside breakout pivot and this $116.03 downside breakout pivot. And this high at $19.22 confirms higher move highs, which would be very bullish, not in the sense that we're looking for a screaming rally, but I would look for the euro-US dollar to continue to pressure resistance should we take out that high. Also, should we take out the low at $16.03, I think that we have a really good chance of settling down into this bearish target zone. most likely with this bearish engulfing line sell signal that we've had here, if we get below this key pivot level here at $17.24, then I think you're going to have the bears really grinding this thing down to this low that was set just last week. And if we fall below $16.03, then I think the $15.25 to $13.62 price targets down here, these are these tan dotted lines, that's probably where you most likely see the market to gravitate to on any forced or harsh sell-off. I think right now what you really have to key off is we're wedging right now. If we take out the upward sloping support line, and especially this key level here, I definitely think we have a good chance of following through. And once we take out $16.03, well, then we will have made a high here, which if you really look at it on the longer scheme of things, even though we made a lower move low and a higher move high, which is neutral, if we go back to September, this could have been the low that we broke down to. We set a high here being a lower move high, because on the longer term time frame, it could be actually the beginning of another big bearish sell-off, which then would have us coming down into this bearish target zone. So the bearish target zone here, it goes from $15.25 down to $12.16. Now we also have this other upward sloping support line that comes in from the multi-month chart, and it comes right through this bottom half, almost actually lower third down here. This would be a really nice area to find support and see the market actually start to bobble around. And like, it wouldn't surprise me for this market to spike down in here somewhere around this $13.62, maybe even tag this upward sloping support line and then bobble around it. Now, especially if we get down towards the Brexit date, this would be a very harsh sell-off for it to occur between now and then. Not that it wouldn't occur, but it could. I mean, as long as coronavirus doesn't really escalate, I think there's no reason to expect any major trend moves. And that's the thing is I think you need to be leery of. We have the sell signal. We're looking for support to get tested, but we're not looking for any major trend moves. I'm not saying that we're not going to have volatility. I think on any individual day we're going to have some extremes that the market swings around in. I think range traders, for the most part, on most days, selling into selling into highs and buying into newer move lows will probably be something that may work out for them. For swing traders and trend traders, be very cautious. Like right now, we have a sell signal. So if you're bearish, like I would definitely be mindful of this $19.22 area. Any rally above here, I think your goose is cooked and you're on the wrong side of the market. And conversely, the same as if you are a bull and you're looking to buy into this current sell-off over the past couple days, this $16.03 would definitely be your threshold of being right or wrong when it comes to being long. So I would be very mindful of those pivot points. And what I really want you to concentrate on here is that if we fall below $17.24, this dotted dash line, this gives us a good reason to hang on support and come into this bearish target zone. But if we stay above $17.24, this market is hard pressed and sideways going up to $1.19. And you can see the bulk of the trading going back to August that, let's see, if we go, let's put in a nice steady line here. We'll put this in here, and then we'll put this right in here. Well, let's drag that down right to about there. Okay, so see these two purple lines here? That's the bulk of the trading. So I would expect that most of the action that you're going to see will be somewhere between these two pivot points around $18.85 and $16.15 going into Brexit. After Brexit, that's a totally different story. One new year, deadlines are met, agreements, whatever they are, will be made, and then we'll be ready for not necessarily renegotiation, but for tweaking when it comes to the UK and the EU. But the thing you got to be mindful of is with the coronavirus escalating in lockdowns, it's going to be hard for the euro to find a lot of bullish strength. Dollar, when you're looking at the whole world, and especially these major currency crosses that are biggest components in the dollar index, actually the euro especially, it's not likely that you're going to see any major trend moves. So that's one of the big things here with this video today I want you to take away from it, is that it's not that we just have the sell signal. I'm not saying you want to go sell the market, the euro, US dollar, or whatever. The trade is already on. So, and we are definitely through most of what it would be on the short-term basis as far as a target level. That's where this key level is here at $17.24. But the longer term, especially if this is a truly lower move low from this high that was set up here, and we actually have a neutral to bearish true trend, if you will, that's going to continue to manifest itself, then I would say be very mindful of the fact that this upward sloping resistance or support line, as well as this key pivot here, is going to be most likely taken out, and then we'll see the bears pressing this 116.15 down to 116.03. Below there, it's a hop, skip, and a jump down to 115.25 to fall into our bearish target zone. Once we strike into that area, it would not be out of any real big surprise that the market doesn't snap back into our range that we've been in for the past few months, bobble around, and then continue lower. And we'll see how that manifests itself over the next week or so, and especially the next couple days as we head into the midpoint of the week right now into Friday. So right now the bears are in control, and you're in control too, because you can actually subscribe to this YouTube channel, so that way you're aware of when we have new webinars coming out. So we have this sell signal today. I want to thank you very much. We don't have any questions on the chat right now that weren't really answered from our little discussion here. So once again, we had the sell signal on Monday. We're looking for a little bit more of a bearish follow through for the euro US dollar, and check us out at forex-trading-unlock.com for all your forex needs. There's all kinds of free charting, free information, and all kinds of benefits as a forex trader that you can access without any membership or anything like that. You just go right to the website and go right to it. And then also remember to check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com, and through that you can learn how to trade this bearish engulfing line sell signal. You can find out where to put your stop, what your target would be, and also how to manage the signal. And right now the bears are in control of this move, and we'll see how this manifests over the next couple days. So stay tuned to forex-trading-unlock.com. You have a great day, and take care. This is Teddy Keckstead from Forex Trading Unlocked, and we are here on November 11th, 2020 with a US dollar Forex buy signal analysis trade for you. We're going to take a look at what's going on with this Forex currency cross, but before we do that, we want to take care of some business here. This is our disclaimer reminding you that this webinar is for illustrative and educational purposes only. So with that, I just want to remind you that this is where you're just here to learn and not execute, but even though we have already. Now we're going to also give you one real quick plug. We have a buy signal. It happens to be a Japanese candlestick pattern. If you want to learn how to trade these signals properly, read the book High Probable Japanese Candlestick Patterns, available on Amazon.com. It's available in paperback and Kindle version, and through it you can utilize the best buy and sell patterns used for over 400 years to give yourself a competitive edge against the markets. And with that, let's get to our live in here. We have the forex-trading-unlock.com website pulled up, our workstation page, and we already filled in the lines and the analysis. And let's see what we got going on here. So on Monday, we had a bullish engulfing line buy signal, like a balloon underwater. This market took off after setting a new low. Now, it hasn't made a higher move high, but one thing's for sure, this market's been trending lower for a very long time. And look at this volatility. It absorbed 1, 2, almost 3 days, all in one day's trade on Monday. Now, the funny thing is, the US dollar yen trades typically inversely to the other currencies, meaning that if the other currencies are bullish and strong versus the dollar, typically the yen isn't, and then the opposite is true. When they are weaker versus the dollar, typically the yen is stronger versus the dollar. There are times when the yen trades in tandem with the other currencies. This is not an always situation, but when they are just free floating and not so much, how can I say it, being motivated and driven by the same fundamental factors, being obviously falling or strengthening against the dollar, then that's when the yen, or excuse me, the Swiss rather, has these moves. So the US dollar Swiss is the flight to quality currency for Europe, and this one, the reason I was bringing up the yen, is it had a inverse move to this market, and we'll get into that in just a second. So we have the US dollar Swiss. It had this bullish engulfing line buy signal, big rally, continued to follow through for the past 2 sessions, and right now today, as we are heading into Thursday's trading, it's just hovering below its highs. Now, this key level here at 91.76 is a big breakout point. Now, the reason I was talking about the yen is that the US dollar Swiss is the #1 flight to quality currency next to the dollar. The next one is the US dollar JPY. Now, why is that? What does that have to do with the Swiss? Well, when the US dollar is, like I said, trending one way, typically these currencies, when they band together, they will have similar moves. Well, this one here is amazing that the US dollar yen exploded massively, and this market has been trending lower just like the Swiss. Now, this one had planted a lower move low. It did make a higher move high. Now, this volatility is something I want you to take a look at. This is a very extreme move that happened over the course of one session into the others, meaning that dollar strength really prevailed. Now let's go back to the US dollar Swiss. The US dollar Swiss chart looks very similar. Remember, because the US dollar is the first currency in the cross, so that's not flipped over like the euro US dollar. So now obviously the euro US dollar is weakening right now versus the dollar, so is the Swiss. But so is the yen. Now the reason why I'm saying this is because they're flight to quality currencies, the Swiss and the yen, and the dollar is also a flight to quality. If these two are weak, then that's a big signal of dollar strength. Now, does that mean the dollar is going to become a major bull? Absolutely not. But it means that as far as the big flight to quality currencies, we've hit that buffer zone, meaning that the Swiss and the yen have pretty much planted a line in the sand saying that we're not going to have the dollar become that weak against us. They're not going to be that strong against our currency. Now, why would this be? Well, the reason this would be is that the Japanese government and the Japanese central bank, when it comes to their currency, there's times they want it to be strong, there's times they want it to be weak, but especially right now, the weaker the dollar becomes, the stronger U.S. exports become, and the less the demand is for U.S. imports, meaning countries like Japan, their goods become more expensive and less likely to be sold in the U.S. Now, the Swiss don't have that problem. However, there is the flight to quality financial sector issue, and that's where I think you have to really look at how these markets exploded on Monday with these radical moves. And just to give you an idea of what this volatility is about, let's take a look at the euro US dollar. Now remember, we're focusing on the Swiss. Now the euro US dollar, it made a high on Monday just like the other ones made lows. The dollar has been gaining versus the euro over the past few sessions, but not that extreme. When you look at it, this has moved over the past few days, and it's only retraced a little bit of this move. It set a new high, and now it's heading right in the middle of its range. Go back to the US dollar Swiss, however, and look at what we have. We made a big newer move low, and we just fell just shy of a higher move high just yesterday. But look at this. We took out 1, 2, 3, 2.5 days worth of trading all in one day, just like the US dollar yen. So I think the odds are, because of the fact, like I always say, the best indicators for a market is other markets. We already breached this 91.76, this little dotted line here. I think if you get above 92.04, this is going to be the big breakout area. If we get above that, we're already coming into this downward sloping resistance right here, trying to neutralize and take out the trend that we've been trending lower in for quite some time. Doesn't mean that we're going to be overall bull. There's no reason why this have a big correction to the upside. Remember, it wasn't that long ago the dollar was flirting with parity with the Swiss, and for a long time. Now it just bounced off of below 90 cents to the dollar. These are things to take into account. You really want to watch, because when it comes to, like I said, once again, the flight to quality and where currencies do set certain bottoms and tops. Now, does it mean that this currency can't go lower than where it just set a low a couple days ago? Absolutely not. But right now, because of what's going on with the US dollar yen and how the dollar has been basically falling versus most currencies up until Monday, I would say that you really have to take this buy signal into account and look at this, get ready for a breach of this 92.04 level with a nice upside target of around 93.30, like right in the middle of this bullish upside target zone. I don't see this market really getting above any further, like up by this 94.40. Could it on an extended or overzealous rally, especially coming off a low like this? Absolutely. But when you really look at the bulk of the trading, what's happened for the past couple months, the market fell below it for a couple days by a little bit, and now it's just trading. We're basically just in the higher end of the range where it's been for the past couple months. Still bullish. We're not looking for any real bearish move here right now. We definitely are looking for a follow through and definitely for a more flirting with this 91.76 area. Once again, 30 things to key off of, we watch the US dollar yen. If you see the US dollar yen trade continue to rally, odds are you're going to see the US dollar Swiss continue to rally as well. And remember that what's going on in the EU, the euro and the pound especially can't move very much against the dollar until trade agreements are made. The Swiss don't really care about the trade agreements because they still have their currency, so what happens to the euro and what have you, and it does impact them, but like I said, they have their own currency. That changes things, meaning that you will probably see, like I said, the US dollar Swiss and the US dollar yen continue to rally for the short run and then start to stabilize as we head into the middle of December probably and into the end of the year. While the same token, you will most likely see an inverse trade going on with the euro and the pound because it's likely to be very restrictive as far as capping the action in the euro as well as the pound versus dollar. Both of them are short term, and right now I think that you're going to see them to come off these highs and basically set a range. And if they set a range and don't have any major moves, the Swiss itself probably doesn't have any major moves to go off of. So, but the main thing you want to look at is this US dollar Swiss as a bull. So real quick, just to give you kind of an idea about Swiss strength and weakness, CHF over JPY. So as you can see, that's very neutral. Swiss JPY, when we're talking about those two, they're sideways. There's no real trending there. But let's look at the CHF versus the euro. So the CHF versus the euro. In the past couple days, set a bottom, is trying a little bounce. The Swiss fell off the euro. So what does that say? The euro is falling off the dollar only by a little bit. If the Swiss fell off the euro, that's why the US dollar Swiss is a big buy right now. So you always use the other markets as an indicator, and that's kind of it is confirming where we're at with the US dollar Swiss, and we would like to see the US dollar Swiss continue to go higher over the next few sessions into the next week or so, challenge those little target areas, and we'll see what happens. Really, as far as if you're bearish this market, I would just definitely make sure that you be mindful of this 92.04 level. Anything above here, if you're short, you're, besides being on the wrong side, you're going to just get beat up. Now, if you are looking to pick off this market and sell into these highs, thinking that the rally is going to fail, now is actually a low risk sell trade, because you look at the markets trading at 91.60, you risk 91.60 up to 92.04. You're looking at 45 pips risk to look for a break that could potentially get back down to, I mean, it can make new lows, but odds, I would say, more likely get down to 90 half to 91 even, somewhere in this area, continue back down into downward sloping resistance lines. But I think there's also a very valid argument that this buying thing, besides having the fundamentals, technically we're coming into by attrition, where we're going to breach this downward sloping resistance line that's keeping the trend intact, which then puts the US dollar Swiss into a big neutral. Brexit, does it impact the US dollar Swiss? Yeah, only because of its relationship to the other currencies, but Brexit as a whole is not the biggest deal as far as concerned for the Swiss. So I hope you like this analysis. If you want to learn how to trade a buy signal like this bullish engulfing line buy signal, remember to read the book. High Probable Japanese Candlestick Patterns. It's available on Amazon.com in Kindle and paperback version, or you go to forex-trading-unlock.com and you can find the link that gives you information and a little bit of a free read on it as well. So with that, I want to thank you very much for your time. You have a good day, and always remember to check out forex-trading-unlock.com and subscribe. We're here today on November 11th, 2020 with a Forex analysis for you with a US dollar JPY buy signal that was triggered just a couple days ago. Before we get into that, we want to pull up our disclaimer to remind you that this webinar is for illustrative and educational purposes only. And we're going to be talking about a high probable Japanese candlestick patterns, which by the way is the name of a book. Once again, High Probable Japanese Candlestick Patterns. It's available on Amazon.com in Kindle and paperback version. Through it, you can utilize the best buy and sell patterns used for over 400 years to capitalize in all different kinds of markets, especially the Forex markets. With that, let's go to our live action webpage here at forex-trading-unlock.com. We have a yen chart here. Now, if you'll notice this purple line that is coming right across the middle right here, this is a key directional pivot that we are buffering right up against. Now, this market's been in the bear market for a while, and like the Swiss, the US dollar, Japanese yen, like a balloon underwater on Monday, came up and just exploded to the upside. Both of them had similar volatility, whereas most of the major currencies where they fell against the dollar, the yen and the Swiss, they really just crushed it, or they got crushed by the dollar. Now you can see that this buy signal here, with just off of this low that it set, it took out 1, 2, 3 days of trading all in one day, and now it's been hovering right there. So our upside target zone, we've already come into it. We fell just shy rather of where we want to hit as far as our target, which would be this 105.75 area, and then this 106.12 area. This is a key pivot above here. This means that we will have made a lower move low and a higher move high, taking the US dollar yen off that major long-term bearish trend to a short-term neutral to happen, obviously. But right now this market is ripe for continued challenge of resistance. I think as far as the upside targets, it's very likely that over the next month or so we can see a challenge of 106.54. This 107.30 area up here, that's going to be rough. Now, one of the things I think that we have here with this US dollar yen trade, besides the fact that we have divergence in the currency crosses where they're all not just being bears or bulls simultaneously against the dollar, the yen, there's a lot of fundamental and technical reasons why it would continue to go higher. One, the BOE and Japan are looking to keep the yen from gaining so much strength against the dollar, especially right now in the wake of past lockdowns for the coronavirus and now new ones being imposed. As the dollar, remember, as the US dollar falls, that means US exports become cheaper. The rest of the world buys our goods, and US imports from other countries become more expensive. Japan being one of our biggest suppliers, that does not bode well for them. And remember that Japan, unlike China, they don't have a currency that they just basically fix the rate and just say it's worth whatever it is. They have a free-floating currency that is in the real mix with the rest of us in the real world. So the BOE, excuse me, not the BOE, the BOJ, Bank of Japan, definitely has its policy. They're trying to keep inflation low. Interest rates are obviously staying low, but they are doing, I would say, for the most part, they're probably one of the biggest buyers going on with this trade, just because I think they're putting a line in the sand. Because you got to remember, folks, as the US dollar yen, if it continues to deteriorate the way it is and the Japanese yen becomes strong, that means that Japanese companies all of a sudden are no longer exporting as much or making as much money off of their goods as they would like to, which means that then it puts stress on the Nikkei. So a weak dollar yen is negative for Japan. It's a double-edged sword. It goes both ways in a lot of different fundamentals, but long-term wise, that is a big deal, especially when you're looking at a situation where we're in right now with the coronavirus lock. Key levels here is this 103.17 area that we rallied off of a couple days ago. So that's a big wage. You got to come back down there before we really get bearish. The reason I say that is as we were coming through here, we came down, we fell off this high back in the early October. We made this low just a couple weeks ago on October 29th. We rallied up to on election day, just after that, November 4th, came up here. We made a lower move high after a lower move low, made this lower move low, and then whammo, in one day we took out this lower move high and this lower move low. This is a key signal day here, this bullish engulfing line. Now, a bullish engulfing line is when it encompasses the whole body of the previous day. Not hard to do when you consider the length of this body here. If you really want to learn the true mechanics of how that signal works and how to set up your targets, you have to read the book, High Probable Japanese Candlestick Patterns. However, what we're telling you right now is the pattern is on, the trade is on, and we've already actually come close to our target. So we'll see how things are going with this. I don't think you're going to see this kind of volatility to the upside continue on very many days, but it's not unlikely that we will see this market kind of go sideways for a couple more sessions and then spike up into this area, take a breach of this 105.75 pivot area, and that's a key directional pivot. There's multiple reasons why this is here. It goes back on the chart. It goes to weekly and monthly charts as well as daily charts from a long time back. So all I could say is that this is a key pivot, and especially since we're hovering underneath it right now, that is capping this rally. If we can get a sustained trade above it, it also takes out this downward sloping resistance line, another bullish indication. Like, think about that. If we can get above, let alone settle above these downward sloping resistance lines, keeping the downward trend intact, that would be very, very bullish. It'd be hard to be a bear when you do something like that. Not that the market won't turn on a dime, but I think what you're going to see is more and more volatility, where you're going to start to see higher move highs and higher move lows, and the sideways that you encounter is just going to be dealing with certain short-term extremes. So let's see what else. The key level is definitely, once again, to watch is this 105.75. Above that, we're going to be pressing 106.12 and then 106.5. Like I said earlier, to 107.30, probably going to be very hard to reach. Now, if you're bearish, like just because I have this bullish signal, and you want to say, let's fade Teddy and Forex trading a lot and just go the other way, well, then if you're going to do that, definitely make sure that you're short against this 106.12. Anything above that, I mean, forget this key pivot area. Anything above this swing high, if you're short, you're on the wrong side and you're going to get munched up. I think that especially this 105.75 area, this is a key level because it falls right into this downward sloping resistance band area of these two lines, as well as this little key pivot level right here. So selling it right against this, up to above 106.12, but that gives you a good ratio, because if the bear trend truly is intact, you're looking at one of the last great selling opportunities before you continue lower, bang out new lows, and then retrace back somewhere up to this area. And then who knows, maybe that'll be a different situation as far as changing from bull or bear to bullish. So the trend is your friend. We'll monitor this trade. We still have a little juice to the upside, and we'll see what goes on with it. And it's also key for us to get some understanding of what's going on with the other markets as well. So with that being said, I want to say thank you very much for your time. Always make sure to check us out at forex-trading-unlocked.com. Subscribe to our YouTube channel so you are notified of when we come out with other videos. And also remember to read the books available on Amazon.com in Kindle and paperback versions. Thank you very much. You have a great day. Hello everyone, this is Teddy Keckstaff from Forex Trading Unlocked, and we are here on Monday, November the 16th, 2020 with a live weekly Forex market analysis for you for the week of the 16th through the 20th. And before we really get into anything, we want to pull up our disclaimer just to remind you that this webinar is for educational only. So we also want to do one quick plug for the book High Probable Japanese Candlestick Patterns, which is available on Amazon.com in Kindle and paperback versions. We have a couple trading signals that you can learn about in that book that we're going to be going over today that happened to have occurred in the Forex markets recently. So back to our live action screen. If you haven't subscribed to our YouTube channel, please do so now so you'll know when these are coming up. So we have the forex-trading-unlocked.com website pulled up, and from our market analysis and education tab, we have our workstation tab already pulled up. We have the U.S. markets that have just recently opened. Today's numbers for the U.S. dollar obviously are retail sales. We have export-import numbers for Japan, which is a little bit, I wouldn't say that important, but it is something to kind of pay attention to right now for the Japanese yen. Tomorrow we have, let's see, or excuse me, on Wednesday we have CPI for the UK, so the British pound, and we'll have that plus the PPI for the British pound. Then we have a couple euro numbers, but more importantly, we have Canadian CPI. We'll be going over to Canada also as well today. We have housing starts and permits also going on for the US dollar. That'll be a big thing for Wednesday. And then we have on Thursday, let's see, we have, if I remember right, it's not, there's, let's see, there's the existing home sales. That's the number to watch. Could get the bond market and the currency market moving around a little bit, plus the CPI for the Japanese yen as well. And then we have, let's see, on Friday we have sales for the UK, which will also be very big. But consumer confidence, I think, ending the week could shake up the euro. With it's not so much what the expectations are, but if it does continue to be in a negative slant with growing margins, I would say that we're going to see a big shift in probably the euro US dollar and the US dollar Swiss. Maybe not so much the pound, but definitely those two could see some action on Friday. All right, now we have the dollar index pulled up here. Let's expand our chart a little bit, make this a little easier for you viewers to see. Oops. All right. So dollar index had set off a bullish engulfing line buy signal a few days back, and it right now is pretty much trading where it settled the week, right around 92.72. I'm not expecting much action in the early morning today. However, I do see that we could probably, like I said, with some of those numbers as we head into the week, start to get a little bit more volatility. Not like volatility is something that's lacking, but we're getting off of just the coronavirus stuff. We definitely have more fundamentals that are coming into place with the currencies as we head into the end of the year, especially because we have Brexit to finish out, which is going to be all about getting trade deals established between the UK and countries around the world, including the US as well as the EU. It looks like they're going to do a rush Brexit, so we'll see what happens. We're going to put a vertical line here for Brexit just so you can see how much time we have. So where does this leave us? Well, right now we're going to use key off of the low that was set with this bullish engulfing line buy signal the other day, and that's where our directional bias will remain. We have a very, very slight slope here for support that's increasing. We do have this downward sloping resistance from the beginning of the wave down for the dollar index that goes all the way back to May. So it is kind of, I would say, wedging by attrition as we head into Brexit, but before we get there, I think we're going to either test new lows or break out to the upside. I'd key off of the high from 2 sessions back on Thursday to for if we get above 93.20 in the dollar index, it's a good chance that we'll most likely be pressing this downward sloping resistance line. The key breakout area would really be is if the dollar index could get above this area, this 94.34, because you had kind of a double top here when we were making lower move lows and lower move highs. Now we still have been making lower move lows and lower move highs, so until we really take out that 94.34, don't expect to see any really major bullish action in the dollar index. But it does not mean that we may not be having this set up to have this occur. So we do have a sell signal going on in the euro US dollar right here. This is a bearish engulfing line right here. This one, this little red line. Now we came into this little support term bearish target area already. I still think we're going to fall back into it and make newer move lows. Most likely until we get to Brexit, which is here to deadline, we're going to trade it between this 119.21 and 115.98. Now, I think that besides the fact that we've been in that range for most of the last couple of months, I think that there's nothing really that's earth-shattering that's going to shake up the euro from this area. Now, why is that? Well, remember we have this. Let's get this down a little bit more. There we go. Okay, so from this range here up to here, this purple zone. I don't see us really breaking out of that for any real major reason. Just like we have the dollar index coming down with its support and very short resistance. This downward sloping resistance right here is kind of our buffer zone. We have been making higher move highs and higher move lows, so even though it's not really bullish, it is doing what is considered the main fundamental of a trend, right? Higher move highs and higher move lows for a bull trend. So as long as it's doing that, we have to assume that it is a neutral to higher. But right now it has the correction and rumblings of being neutral more than bullish. So that would also have it kind of bearish in the short run, a very short run on the more couple days wise. So we'll see how things shape up today. Like I said, we already came into our target zone here. So the question is how much further can we press this move? So only if we get above 119.21 do I see us really starting to break out again. And even then, I think we'll be spiking and falling back more than anything else. But even if we have a dip down towards this 115 area, I wouldn't get too grounded in the fact that we have a bear market with the euro US dollar. So we need to have something that shows some real confirmation of US dollar strength before we would get excuse me, overly bearish the euro US dollar. Now with the coronavirus lockdown and Brexit coming up, there's a lot of things that they're going to be rushing through, which is kind of good because they're finally doing something, not just because they have to, but because they have the coronavirus motivator, because they have other issues they need to tend to and work together with. So I think that it's going to benefit the swing traders that are more on the intraday and range traders. If you're a longer term trend trader for the euro US dollar, you may be in for a lot of chop for the next couple months. Now if coronavirus excuse me, really hits Europe hard and they go into some major lockdowns where they're saying they're not going to open up for like 6 months or something like that, 8 months, which probably will be next step, I guess, in global lockdowns. If that's the case, then I would probably see the euro tanking versus the dollar, because you'll probably see flight to quality where dollar will be supported in that situation. If things get that grave around the world, the Swiss will be supported to some degree. We'll be looking at that in just a couple minutes. So very neutral to bearish in the short run. We did hit the short-term bearish area, so we got to key off this range. Not much expectations here right now, and that's because of the global political landscape that we have to deal with. It's not just the U.S. elections, that's for sure. So now we are looking at on the pound. Actually, what we'll do is real quick is go back to the dollar index. So remember how we spiked here? This is the same day that we had the sell signal in the euro. So these are all reinforcing each other. So we'll see how this kind of interplays with each other over the next few sessions, but I think that we have a good mounting point for where we have a turn going on. The same thing is having here with the British pound US dollar, obviously. Now, as far as Brexit is concerned, the climate between the US and the UK is not so riddled with strife. It's probably going to be a pretty smooth transition. It's most likely the UK trade deal is going to mimic what we have that Canada has with them and that we have with Canada to most of a degree. Wouldn't expect much craziness there. However, in lieu of the lockdowns and everything else, we did have a short-term sell signal up here. This is another high probable Japanese candlestick pattern. It's called dark cloud cover. With this little slide here, we still have a little more room to the downside. Now, the market tried to be higher today with the bulls grabbing the bull by the horns, no pun intended, to get the pound US dollar off to newer move highs on an intraday basis. But as you can see, as of the US market opening up, that it's relatively flat. I would say that most likely, even though this has been making higher move highs and higher move lows, that we are getting ready for the big neutral to lower trade. And not that it's bearish, but it's setting a lower range until these agreements and things get done. We have the U.S. elections that most likely will not be decided until the December 1st. Could be a little bit before that, but we still have one more day where votes are coming in. So, so until after tomorrow, tomorrow in the mail is done, basically Wednesday, we know that's when official counts will be locked in, and we'll know by December 1st for sure. Not much to interfere with the pound US dollar. So like I said, with the euro under pressure, Not that there we have dollar bulls going on. It's going to be really hard for the pound to gain momentum to the upside. So I think it's running out of gas here. We'll see how it today. Like I said, right now it's pretty neutral. Wouldn't expect much more out of this today because the European markets are closing soon. And I think they want to really get a good view of what's going on in the United States with as we start this week for the as far as where the global currencies are going to be going. So the U.S. dollar is Swiss here. Excuse me. Haven't been talking much this morning yet. U.S. dollar is CHF. Let's get the symbol right. Okay, so the Swissy here has been in a very bearish way for quite some time. Last week we had this buy signal here. Now this is a bullish engulfing line, all a monster rally. This is something I think you really have to consider when it comes to the dollar putting a landing point as far as how far it's going to go down. So not that we're bullish the dollar, but I think you've hit the, especially with the coronavirus thing going on. So if we have Brexit going on, even though it's not really totally involved, but it does affect the Swiss. So we're getting close to that deadline. I think that the low we have planted here last week is the extreme for any bearish sell-off as far as the dollar versus the Swiss. And that also means what? If the dollar is now grounding itself versus the Swiss, and they're both flight to quality currencies, it's very likely that that's going to confirm more weakness in the euro and the pound versus the dollar, at least in the short run. So I would key off of the high from past from last week here around 91.89. Anything above this would be a nice bullish breakout, confirming strength, meaning higher move highs and higher move lows, which would mean neutral to Swiss, and that would also most likely add a little bit of pressure to the pound and the euro as well against the dollar. We'll see how this manifests. Key off of that high, like I said, from last week. Now remember, we had a big rally to start this move back. We set a lower move low, and yes, last week we made a lower move high. So that's why that high is key. If we take that out, that is our breakout point and our confirmation of a new potential trend. So now let's go skip across another pound and go to the U.S. dollar yen. This one also on the same day as the dollar index turn. The funny thing is, the day the dollar index turned, the biggest move was in the yen and the Swiss and a couple other markets. It wasn't in the pound or the euro, which are the biggest components of the dollar index. But when these currencies plant, that means that most likely you're going to have a big trend with multiple currencies in one way versus the dollar, meaning that they're going to probably be under pressure. Is it the coronavirus lockdown? Is it because this trend has been going lower for so long? It could be all kinds of things. There's all kinds of fundamental and technical reasons, but who cares? We got the signal and we're looking for it to go up now. Now, U.S. dollar yen is right here in this little middle point here. So coming off of this major rally, the trend has been making lower move lows and lower move highs. So if we just set a lower move high, so it's the key area. If we break out to this upside target range, this confirms our change in direction for the U.S. dollar versus the yen. Now, there's a lot of reasons why Japan, especially because, see, the yen, they don't want the yen to get too strong, especially right now where exports have been decreasing and global demand has been down because of the coronavirus. The Japanese economy, to keep the Nikkei from falling apart, has to keep the reins on the yen. And the yen's been getting very strong versus the dollar through this whole thing over the past 6 months. And I pretty much think that this bullish engulfing line buy signal isn't just profit taking from the bearish trend that's been going on, more where it's actually a buy by the Japanese banks, because that's one of the things that they need to do to keep their economy from slipping any further than it has over the past few months. So that's just a fundamental reasoning that governments do this to help their economies along and protect their own currencies. Is that what they're doing? I don't know. We'll find out. I mean, there is some measures that they've been doing that definitely has it in that direction. So we'll see if they continue to follow through, and I think that we will, because you already have the Brexit stuff going on. You have the U.S. election stuff. So one thing they can control is the fact that they're not in any chaos when it really comes to anything. They're dealing with the global situation, but they're not in any chaos when it comes to anyone dealing with them. We don't have any issues with the United States and Japan. Japan doesn't, except for China. They have some issues, but as a whole, they don't have any of those geopolitical issues going on, so they're kind of neutral. But I do think that as we head into global lockdown, dollar like the Swiss, now the yen is a flight to quality currency, so it's not, you're probably not going to see a major rally with the U.S. dollar versus the yen. But I think that even the Japanese right now will be buying dollars and selling yen in the wake of a second major wave for coronavirus globally. So now let's go look at the Australian dollar, U.S. dollar, which this one has definitely been a wild ride as of late. Now this has failed to make longer term highs, but it has been making. It made a higher move high after planting a higher move low a week and a half ago. So I would say this is in the big sideways. And the one thing you have to really think about fundamentally is Australia's biggest challenge now is the fact that they're getting cut off by a lot of Chinese interests as far as their commodities. The Chinese cut out a whole range of normal staples that they purchase from Australia. China is the biggest customer to the Australian, the whole continent of Australia, as far as multiple businesses are concerned. So I think that it's going to be really hard as we head into Brexit and these other things and the global shutdowns, that the Australian dollar is going to remain firm. If we have a breakout of 73.41 up here and make higher move highs, well, then that's a confirmation of higher move highs and higher move lows, meaning bullish trend, and then that would end this corrective move that we've had to the upside, and then, or excuse me, to the downside, confirming that this Australian dollar is that strong versus the U.S. dollar. I only see that if the dollar index starts hitting its lows again, and all of a sudden you see, if you have a breakout to the upside in the pound and the euro, and especially if you see the Swiss, the dollar collapse against the Swiss, well, then I'm bored to see Australian dollar make long-term highs come up in the not-too-distant future. But because of the rationale that I gave you, I don't see that happening. Now let's go to the New Zealand dollar, U.S. dollar. So the U.S. markets are now open almost a half an hour. Here we have strength. Now this one has been stronger. Now this doesn't have the issues that the Canadian dollar has. So this one's a bull. I would key off of the 68.08 level for support and direction. Anything below here, I think you get a nice sell-off still. Not that it would be bearish because this thing's been making higher move highs and higher move lows. We do not have a major sell signal. I mean, we do have this. This is a short term. Let me move this over so I can get this done. The high that was set here, this is a short term sell signal. This is a dark cloud cover. So this would be your real line in the sand. Like if you want to be an aggressive bear, selling against this level is probably not, it's a low risk trade. You have a good area of, to break back down to. The question is, though, with this momentum, is it going to really be able to manifest itself? So I would key off of the high from 2 sessions ago and the low from Friday as your bias for which way this market's going to go. If we take out this low here, then I could see a nice corrective move going back down towards this 67.5 area, even get down to 67 even, and take out this upward sloping support line. It is pretty steep, this trend, if you think about it. If we take this out also on a longer term basis, that would confirm more strength in the U.S. dollar than most people are giving it credit, and probably setting a tone for a range with the New Zealand dollar, because like I said, I don't see this becoming a very big bear versus the dollar. Australian dollar, totally different story. I think that 2021 may be the year of major divergence in major currencies, because we've been having a major trend as a whole versus the dollar with all these currencies. I do not see that continuing. And especially once we find out what's going on with the U.S. elections. A couple more weeks away, though. U.S. dollar Canada planted a low a little over a week ago, but it is overall a bear. It set a lower move high 2 sessions back. Now you can see today it's kind of on support. It's right in the middle of its range for the day, but overall this market is a sideways, neutral at best trade. We have an upside target band, and this is the key. If we do break out above the high of a couple sessions ago at 131.77, I can see us nudging these pivots here, trying to figure out whether or not just a retracement to that upside, or whether we do have the brewing of a U.S. dollar rally versus the Canada. Below $1.3177, I find it hard pressed to be very, very careful selling. Selling against this area is good. but buying against it right now, it's just choppy and it's too tough to tell. So I'd be very cautious with the U.S. dollar Canada trade. So Euro US dollar, which is where we started off this video, let's see where it's at. It is still negative on the day, kind of sideways, not a big range. What's the range for today? It's a high of 118.69 to 18.14. You got a 45 pip range there. It's not very much. So not very much action on a Monday morning as the U.S. markets evolve. Let's see what happens with that, see if they can shake things up. Key off of these areas, like I said, that we have here, and we'll see how things go. We have the beginning of the week happening. We have a lot of areas to look at. Remember, only a rally above $1.1921 has us on an upside breakout. And downside breakout, you gotta get down to 115.98. So we could be in for a yawner as we head into the next couple months. Be careful, wait for a signal. Like I said, we had this one here. We hit the target zone. So now, if you want to sell against this, well, the trade's already been done. But I think you want to lean still towards that bearish side. So anyhow, remember to subscribe to our YouTube channel and check us out every day at www.
Amazon employees earn at least $15 an hour, but $15 is just the start.
Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here with a plug for a book called High Probable Japanese Candlestick Patterns. Before we get into that plug, we just want to give you our disclaimer real quick to remind you that this video is for illustrative and educational purposes only, although it is a promotion for our book. So before you do that also, we want you to subscribe to our YouTube channel, Forex Trading Unlocked, and now we will get into what the book is all about. High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. So let's get to our live action screen. We have the Forex-Trading-Unlocked.com website pulled up, and if you go to our Products, Courses, and Services tab, you can pull up the High Probable Japanese Candlestick Patterns page, and on that page we have a video that you can watch that will describe the different patterns and methodologies and things that you'll learn in the book. We also have a little copy of the book on the web page here for High Probable Japanese Candlestick Patterns, where you can either buy it or you can share it, but first you can preview it and check it out. And then at the bottom of the page you can also join our email list and subscribe to that if you would like, and you can also find access to other parts of our website from this page as well. So one of the reasons you want to read this book is so you can learn how to trade these signals. Now if you look at the US dollar Swiss chart from recently, we had a bullish engulfing line buy signal that had occurred here back on November 9th. We also have today a buy signal forming. The trading a day is not over yet, but if this market settles where it's at or higher, that would complete either a piercing line or another bullish engulfing line buy signal. If you want to learn how to trade these buy and sell signals, then you go back, like I said, to our webpage and access High Probable Japanese Candlestick Patterns, preview it, and start learning on how you can actuate these actual trading signals. Now, ironically, Japanese candlestick patterns, which obviously come out of Japan, these methods have been used for over 400 years to trade the stock markets, Forex markets, currency markets, option markets, you name it. Well, recently, when we had back in November, we had a bullish engulfing line buy signal here that had stamped a nice low on a daily basis. And now we have today, we have another high probable Japanese candlestick pattern forming, but we have to wait for the close and for follow through. Now, if you want to learn how to apply these trading signals to either your system or to use our methodology, you read the book High Probable Japanese Candlestick Patterns, and you'll be able to find out how to actuate these trades. Now, these signals, they occur often in many markets. They happen all the time. Just as you can see, just in the month alone of November, we had here in the US dollar yen trade, we already had a bullish engulfing line buy signal formed. We have another pattern forming here. We go back to the US dollar Swiss, and we have one forming again. And one of the nice things about knowing these signals, especially like on a day like today, when you have the US dollar Swiss and the US dollar Japanese yen forming signals at the same time. They're not always the same signal, like a bullish engulfing line or a piercing line or whatever. Or maybe that's what you get. In one market you have a bullish engulfing line, another one you have a piercing line. But when these all line up, that gives you a good sentiment about where, especially like the dollar, would be going, because all the currencies are based off of the dollar. When you have a signal, say in the U.S. dollar Swiss, the U.S. dollar JPY, and then also say in the Euro US dollar, if you all have buy and sell signals where for the dollar or against the dollar, and they all line up on the same date or around the same date, well, that's usually a good indication of where dollar strength or weakness is, and you can use that for options plays, for spreads, for futures, as well as the outright Forex markets itself. These can also be used in stock markets and what have you as well, but especially in the currencies, they work fantastic because you don't necessarily have to be a yen trader or a Swiss trader or a pound trader or whatever you are. But if you are trading, let's say you're a Euro US dollar trader, and all of a sudden we have this US dollar buy signal for the Swiss, and you also have a sell signal in the pound, you have a buy signal in the US dollar yen, odds are that the Euro US dollar will be trading, in at least in the short run. If there's a dollar buy signal or sell signal, that will follow through with that as well. So we'll have to learn more about that when you read the book. Or you can subscribe to our YouTube channel, Forex Trading Unlocked, because we have videos that post all kinds of analysis on the daily and weekly basis, and whenever we have trading signals from the high probable Japanese candlestick pattern book that evolve, we usually highlight them in a short-term video, which you can find by subscribing to our Forex Trading Unlocked YouTube channel, and we have all kinds of them on there. And also, once again, check out the book High Probable Japanese.
Try cheesy, crispy Ritz Cheese Crispers.
Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked on November 30th, 2020, and we're here for a Forex market analysis for November 30th through December 4th. We're going to see what's up in the week ahead, and before we get into that real quick, we want to post our disclaimer up for you, so to remind you that this webinar is for illustrative and educational purposes only. And before we get into our video, we're going to just give you one quick promotion here to remind you to subscribe to our Forex Trading Unlocked, and also to check out the book High Probable Japanese Candlestick Patterns for the 21st Century Online Trader. You can find this book. It's available on Amazon.com and in paperback and Kindle versions. Remember to also subscribe to our YouTube channel. And with that, let's get to our live action screen. So we have the Forex-Trading-Unlocked.com website already pulled up. We have our workstation page, which we got to from our navigation bar. We're going to skip past the economic numbers. Now, as you can see, the euro has had quite some action today. It had a very, very nice rally early this morning, and after the U.S. markets opened, all of a sudden, dollar strength came out of nowhere. As we go through these markets, you'll see how the euro, U.S. dollar, through many other currencies, have been just really, really giving the dollar bears a nice little boost in momentum to start the week off. But now the dollar bulls seem to be looking to put up a bit of a fight. So as you can see something here, we have our key directional pivot level here for the euro US dollar, right around $1.18 even. So this is a key swing low. Now, interestingly enough, if you look at the low from November, and then we come all the way up to our high that was today, that comes right in harmonically at a 50% level for Fibonacci, meaning that from this low to this high, it's harmonically Fibonacci locked in right now. So it's a good stopping point. And now I would say that this high of today is going to be a very, very key level as far as breaking out to the upside. So we had a nice surge, and it really, really extended this rally up. As you can see, the slope has been very severe. We went from 118 up to, what was it, just shy of $1.20 just within the past week or so. That's a big move for the euro US dollar right now, especially when you have things like Brexit coming up, which we're going to put that, this is a reminder here, right where we have our key directional pivots. Let's move this right here, make it a little clearer. Okay, so this line right here, this little vertical line, this represents our Brexit date, which we know is happening no matter what. Something we've been talking about for not just months, but actually the past couple of years, ironically. So it's kind of funny. I think the tone for 2021 will no longer be talking about Brexit. We'll be talking about post-Brexit. And you just can't get rid of that term, right? Anyhow, so we're looking at the rejection today. I think that you're going to have to key off the high. I think the bulls are running out of gas, and we're set up for a short-term correction. Now let's see how the close is today. Right now we are only in Monday's trade so far, with the U.S. markets only open for the past 2 hours. So we'll see what we can see. With any luck, we will have a very good move to the downside, getting rid of the little profit-taking move, and then I think what's going to happen is we'll start to see a little bit of congestion and digestion for the next few weeks as we head into the end of the year, end of fourth quarter, and also as we cross this Brexit date. So I wouldn't, unless we take out the high from today, and especially if you look at this purple line across at $1.2012, this is a key resistance level that's holding back the euro US dollar bulls. And being rejected today, just falling short of it, also helps to lay more credence into that level. So I wouldn't have very high expectations for major swings over the next 4 weeks as we get through December. Or 5 weeks as we get through the end of November into the end of the year. But I would see that most likely it will see a consolidation here between $1.20 and $1.18. So now let's look at the British pound US dollar, the second biggest variable in the dollar index next to the euro US dollar. And as you can see today, the pound did not make new or move highs. This market here also has the Brexit date, obviously, because Brexit has to do with the UK leaving the EU. So this date will be big for them. And as you can see, this market did not make these new highs like the euro did. So I think the dollar bears kind of overdid it today to start the week off. And it wouldn't be a surprise to me to see it contain now for the next week or so, especially because we're coming into confirmation of U.S. elections soon, which will definitely give us a better course of direction for what's going to happen as far as trade deals. Remember that the EU and the UK must make their initial trade deals by the 31st, and they've already committed to no longer stalling on so many things, where they're going to basically say, we're going to pass what we can pass, and everything else will remain the same, and they will adjust it as they get into the new year. Probably a good way to go about it. So with the British pound US dollar right now, like I said, we did not make higher move highs. We have just a little bit of an outside day from Friday's trading, and we're only slightly positive on the day. So we're going to have to see how this closes today. My guess is that's the way the dollar has done a reversal of fortune over the past few hours. And let's see what the hourly looks like here for the British pound US dollar. Yeah, there was a good sell signal 2 hours ago, and not that we're literally looking for a big sell-off, but I think you're most likely going to be contained now for the rest of the trading day. I wouldn't expect the pound or the British pound over the dollar to break out of its definitely its high, let alone maybe even make new lows. So trading's kind of calming down for the day. There's a lot to digest out there. My expectations really for the next, like I said, the next 5 weeks is very similar to the euro. I expect the pound pretty much to stay within this above $1.3104. This is a key level here. Any failure from here would have us really looking for a slide. In fact, why don't we make that here? Key directional pivot level. All right. I think that's all clear for you guys. Okay, so this level here at $1.3104 is what's containing the bullish momentum for this market, but we could be set up for sideways. It's been rallying since the end of September, and now, like I said, the euro making new highs and the pound not making new highs versus the dollar, it's a little bit of a divergence, and it's also showing that the bearish dollar momentum may be running out of gas. So now let's look at the U.S. dollar Swiss real quick, complete our triangle of European currencies versus the dollar. Now this one here, we had a big bullish engulfing line back at the beginning of November. It spiked up, made a lower move high, and now we started sliding. But look at this on the day. We made a lower move low today, and now look at how much higher we are. Now this is what gives me a little bit of I wouldn't say resistance to the fact that dollar bears are in control. But when you have the dollar being pounded like it was so far today against all the other currencies, the pound did not make a higher move high versus the dollar. The U.S. dollar Swiss did make a lower move low, but look at what's going on here. We have a very bullish rally that's occurred since trading started last night. I would say wait until today's close. We'll get a confirmation of a signal, and if we were to have a close where it's at right now or higher, then that would be a potential, that would be a buy signal after the close of today's trading as we head into tomorrow. So why don't we put a little directional, and we'll put this here. We're going to have a buy signal forming. It hasn't happened yet, so don't get all overzealous, but you have to watch how the U.S. dollar Swiss ends the trading day today. All right, so that's what we have going on right now in the European currencies. U.S. dollar Canada, talking about falling below the floor. Look at this spike today. It came all the way down and made a newer move low by just a few pips. That's it. Tagged it, but now look at it. It's basically unchanged on the day. We're going to have to watch this close also today. We have a potential double bottom forming right now, which is something that you want to be aware of if you're a U.S. dollar Canada trader. Now this is a potential bottom forming. We have to wait until the close of today to get a confirmation. What would be a confirmation? Well, especially the fact that if we were to get a rally that would take out the opening of Friday's trading, then I would say that that would be a very strong signal that the U.S. dollar Canada is putting in a short-term base. And it doesn't mean it's going to get bullish, especially this is one currency I'd be very, very cautious about becoming a long-term bull if you want to fade it. But we're looking for a low-risk buying opportunity right here. It's a high-risk sell right now. I'd be very careful before. If you're already short, I'd work them and keep your stops lowered and protect your profits on any short trades you have right now, because especially with a spike low like this is a big deal. I know it's starting in the week, but if you look at the volatility, to be able to push through those pivot points and then to fail, that's a big deal. That really, really shows us that that we have probably a profit-taking move that had occurred earlier today. It was really ripped into things, and now it's time for the dollar bulls to go ahead and make a move as well. So we'll see how that's going to shape up. Today's close is going to be very important for us. Now let's look at the U.S. dollar JPY. U.S. dollar yen also, look at this. Now this had a buy signal back in the beginning of November. We had made a lower move high, but look at this. We made a higher move low, and look at today's trading. This is what really gives me the suspicion that we have a creeping bullish dollar momentum that is about to explode to the upside. I really have to say that when you have extremes like this to start off the week where it really, really looks like the sky is falling, and then you have a turn like this after the U.S. markets are open and then the European and Asian markets are now closed, that's a very good indication that currency traders around the globe, especially on the heavier side, the institutional side, is unloading, meaning that they are reversing gears. So if we have a positive close today with the yen, U.S. dollar yen, I would say we are most likely going to make a run for this 104.78 level, which would be a catalyst for a bullish upside breakout. Now this key is this current low from a couple weeks ago. If we fall below 103.62, that's a very bearish downside breakout level that I would be cautious trying to buy into any slide below there. So this is really our key little congestion area, which we may just stay in for the next couple weeks. Brexit doesn't interfere with this. the new turn of a president will. But our relationships with Japan are pretty good, and so are our trade deals with them. There's nothing really in the mix for that. So just as a dollar flow, and here's the thing is, when the dollar is typically falling versus the other currencies around the world, usually it has strength versus the yen on a longer term level, not necessarily on a daily short term level. But the fact that we have dollar bearishness that snuck into the market here in the yen, but not much. It made a higher move low, and now it's reverse gears. So especially if we can take out this high here and go above 104.78, that would mean dollar strength, especially in the yen for the longer term, putting on a for sure sideways to bullish outlook as we head into the last month of the year and wind down the quarter. Now, if you look at the Australian dollar, US dollar, here's a market that has been very resilient against the dollar for quite some time. This market today did something else. It made a higher move high versus the dollar today, but now look at it. It's lower on the day. This is a very big potential sell signal right here for the Australian dollar, US dollar. I would be very mindful of how today's close happens. This could touch off a nice corrective move lower for probably the next week or two and give you a really nice, I would say, short-term, low-risk sell trade. Again, we have to watch how the close of today is, but let me give you an indication of what I think as far as for levels. If we settle where we're at right now or lower today for the Australian dollar, US dollar, I think you're going to have a very, very good chance at coming down and testing the 72.55 area. This would be the area where if it's going to be support, then it's going to come in and it's going to be a sideways trade or resume the bullish momentum. This is where you're going to see action come in, a lot of buying. If we fail through here, that is very, very negative. So we're going to keep our eyes on the Australian dollar, US dollar as it trades today, and then we'll see what happens when we go to into tomorrow's trade. We're going to see if these signals actually manifest. New Zealand dollar, US dollar, here's another major bull against the dollar that spiked high today, and now look at this, it's lower on the day. We're going to really have to watch this one as well. We'll see how things shape up. Now, if this one happens to take out the low of Friday, and especially settle below there, I would say that you're going to see another correction here in the New Zealand dollar, US dollar, and it's all these line up together. If you have multiple corrective signals coming into place with multiple currencies all lining up together, that tells me that we have a really good chance of seeing, at least for the next 2 to 5 days, a corrective slide, meaning dollar bulls will be coming into the marketplace and starting to really set up a nice correction. So we are going to watch this for the close today. After the close today, we will no longer have the potential sell signal thing here. We'll either have a sell signal or we won't. Now, don't be overzealous. Remember, we need a close for all these things. Don't try and jump in front of these things because it's 10:30 right now. We have a few hours left before this trading day is over. This market could reverse gears, and all of a sudden the dollar bears come back and you make new highs in all these markets against the dollar. So definitely be very mindful of that. We've gone through most of the currencies, but I want to look at the US dollar Mexican peso real quick just to see how this is reacting. See, this is another reason why I think dollar strength may be coming in. This market bottomed 2 days ago. It really didn't hit the dollar at all, and now it's higher on the day and looking like it's trying to base here. That's a good indication when you see the lesser currency crosses where all of a sudden the dollar is a bull there, but it wasn't against the other currencies. US dollar, Turkish lira, here's another one. This has had a lot of volatility over the month of November. This is probably due mostly because of the potential problems going on with Iran that are brewing, as well as the fact that you have all kinds of issues with Turkey, Syria, and a whole bunch of countries around that region where you have refugees that are in limbo. Turkey seems to be dominating the control as to what's going on, not necessarily the best direction for how to manage these things. So I would say this is another market where if you see dollar strength creeping in, it wouldn't be a surprise. So let's go back to the Euro US dollar where we started our video today. All right, this market is still lower on the day. We're going to be watching this one. This one here, like I said, is a very good high harmonically with Fibonacci. We do not have a sell signal here in the Euro US dollar. And even if we were to plant this high and leave it where it's at today, we're not necessarily bearish, but since we are having this little signal thing going on with multiple markets, we'll see how this manifests. I mean, for all we know, we could have a major sell-off here, especially since we say that the US dollar Swiss turning around. If that rally continues to manifest itself over the next few days, it would be very likely that you'll see the Euro US dollar trading back around this 119 to 118 half area. I would not expect very much out of the Euro US dollar as far as a correction. Only if you see a meltdown in most of the currencies around the globe versus the dollar, meaning a big dollar bullish rally, would I expect this market to take out this key directional pivot at $1.18. I really think that we're going to be contained in this two-handle range, $2 range for the next probably week and a half to 2 weeks. So we could see a sell-off, inch our way down to 18.5. Now, should we take out this 18 even level, then all bets are off. It doesn't mean that we're overly bearish, but we're in a neutral to bearish range then, where we would probably come back down to this 117 to 116 half area. Still not a major sell-off that we're looking for. So with that being said, we don't have any questions on the chat room. Let me just double check real quick. Let's see, in our chat room on Twitch, we don't have any questions. Oh, you know what we didn't do? I don't think we took a look at. We have XAU US dollar. Here's a gold chart real quick that we want to take a look at. Reason being is that this gold chart here has been a question of some of our followers on both Twitch and on YouTube. So the gold market has been in a bearish phase now for quite some time. As the month of November, it just unwound itself, propelling the bearish slide even further down to this new move low today. Now, just like we have a turn in the currencies going on, we may have a turn in the gold market as well. We'll see how this closes. This is really reflecting, I think, a lot of how the euro is trading right now. Should we get a big dollar rally, that may actually be good for gold in the short run. It's had quite a sell-off over the past few months, and especially over the month of November. And as we're coming into the last trading day of November, remember, monthly totals are coming in today, so there could be a lot of profit taking. Any funds and big institutional traders for their numbers, probably if they were short gold, are now buying it back. Or also, like when it comes to most of the currencies where they've been short the dollar and long other currencies, now they're doing the reversal of gears too, taking profit. It doesn't mean that tomorrow they're not going to go back on the same direction they were before going into today, but just to have your month-end numbers, your mid-quarter, and we only have 1 month left in the year, I think you're going to have a lot of people that are trying to just get their averages up. It's just a technical function of the market. It's not as far as balancing. So as far as unwinding trades and then resetting them the next day, this will bring in a lot of volume and potential volatility as we spike into these highs and lows. So once again, we have the gold trade there. Let's see, do we have any other questions? We do not have any other questions on the chat room. So real quick, we go back to our Euro US dollar. Remember, we're going to be keying off this. If this market settles where it's at today or lower, that most likely those other currencies will set off those signals. And if you want to learn how to trade those signals, by the way, there is a very easy way you can do that. You can read the book, High Probable Japanese Candlestick.com, in paperback and Kindle versions. And if you don't want to read the book yet and you want to see how these signals pan out, subscribe to our YouTube channel, Forex Trading Unlocked, and you'll know when our next videos come up, and we'll see how these buy and sell signals come to fruition. So this was our weekly Forex analysis video. We are now going to also put out some individual currency cross videos, a little bit shorter as these trades manifest, and we'll see how the week goes. So good luck with your trading. Remember to always follow the rules and use good discipline principles in your trading. Always use stops and good money management techniques and things like that, which you can also read about in the book. So once again, thank you very much. This is Teddy Keckstedt from Forex Trading Unlocked. You have a great day and a good trading. Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here today on November 30th with a British pound Forex analysis for November 30th through December 4th. Before we get into it, I want to pull up our disclaimer to remind you that this webinar is for illustrative and educational purposes only. This is not to encourage you to do anything, it's just to teach you. And real quick, we want to give you a plug, remind you to subscribe to our YouTube channel, Forex Trading Unlocked, if you haven't already. And also, we're going to, there's a book called High Probable Japanese Candlestick Patterns available on Amazon.com in paperback and Kindle versions. Check it out, learn how to trade those signals. It'll definitely be a boost for your trading, I would believe. So let's go to our live action screen here. We already have the forex-trading-unlocked.com website pulled up. We have our workstation page pulled up, and we already have a little stuff drawn up for you here. We're closing in on the December 31st Brexit date. Today, the US dollar bears really hammered the currencies, or the dollar today versus most currencies. There was a reversal of fortune, though, after the stock market opened 2.5 hours ago. All of a sudden, dollar bulls came out, and while most of the currencies were making new highs or lows versus the highs against the dollar, the pound did not break out to the upside, and this is a key thing to watch out for. This $34.03 level, if we get above here, this is a bullish breakout level, confirming momentum, and obviously the odds of seeing much higher levels in the pound versus the dollar. One thing I think that's going to contain that, though, is Brexit right here. I think we're more likely to stay contained now that we did not make a higher move high, and even if we pierced it, we'd have to close and really maintain a trade above $34.03 to sustain any bullish momentum. Now, we are looking at a kind of rejection here at resistance. But for the most part, I think you're going to see a digestive trade. We'll see how the market settles today, especially if the pound does settle lower today. I would expect to see follow through and stay within this range here. $31.04 to $34 even here. I think this is where you're going to see most of the trading for the month. The only thing that would really, I guess, change that outlook would be if we have some reason for the dollar bears to really add fuel to the fire, but I think they're kind of out of gas. Now remember, we're at month end, so maybe that might be why the dollar spiked and all of a sudden dollar bulls are coming in, where it's not really dollar bulls that are coming in, but profit taking by the big institutions and things like that. So I'd be very leery of being too much of a bull or of a bear versus the pound versus the dollar rather. But I think that right now you have a low-risk selling opportunity to take advantage of selling rallies right now. Let's check out the hourly chart. Now, we looked at some other currencies in our weekly analysis, and all of them seem to have fallen off on over the last couple hours. Now, as you can see, on a daily basis, this has been quite a volatile trade. It sold off initially, rallied, tried to make a higher move high on the day, but it failed to do so, and then it collapsed back down to where it's basically, not too far from unchanged on the day. Very neutral behavior over the past couple days of trading. That's why I believe that as we head into Brexit, especially for the pound, you're going to most likely see a very tight consolidation forming. Like I said, above $34, it's really hard. If you look at this last high here prior, we can put this horizontal line in right here. This kind of comes in right there. You see, like we spiked above it here and then fell below it, and that's when the market fell apart as far as the pound US dollar. We could be contained from this high to this low. Maybe this huge area here is going to be our range for the next few months, but I think in the short run, the next couple days into next week and into December, as we end November and start the last month of the year and the fourth quarter, it's most likely that we're going to see some bearish momentum kick up its heels. But right now, we don't have any reason to be overzealous on that, but I would say key off of the dollar index. If you see the dollar index start to really rally, if you see the euro falling apart versus the dollar, and especially if you see the Swiss falling apart versus the dollar, then most likely the pound will be in a neutral to bearish position where it will be hitting support. So right now, we're waiting for some signals. We have to see how today's trading ends, and we'll have to get back with you later on after the close, and we'll see if we have any trading signals. But while you're waiting, always go and subscribe to our YouTube channel right away, and then also go to Amazon.com, check out the book High Probable Japanese Candlestick Patterns. It's on Kindle and paperback version, or you go to our website, forex-trading-unlocked.com, go to that one menu page, at the top, which you can find under products, courses, and services. And as you see, when you highlight that navigation bar, it comes down in here, high probable Japanese candlestick patterns. If you click on that link, you will be able to read a short little piece from the book and get some ideas about what to expect in the readings. Obviously, the high probable Japanese candlestick patterns is pretty self-explanatory as to what the book is about, but it teaches you how to a methodology and how to actuate those trading signals and a disciplined way of money management and trade projection techniques to maximize the benefits from those trading signals. So once again, we're going to wait for the close here for the pound US dollar. I want to thank you for your time. Always check us out at forex-trading-unlock.com for all your Forex needs, and good luck with all your trading today and into the week. On December 8th with a Euro US dollar Forex analysis for you. We're going to break down the Euro US dollar and see what's going on. Now, before we get into that, we have to put up our disclaimer to remind you that this webinar is for illustrative and educational purposes only. If you have any questions on the chat room, please feel free to leave them, and we will, or ask them, and we will answer them while we're doing this analysis live for you about the Euro US dollar. So, and before we get into that real quick, we're going to have some signals that we're talking about, and you can learn how to trade them if you read the book High Probable Japanese Candlestick Patterns. It's available on Amazon.com in paperback and Kindle versions. With that, let's go to our live action screen and see what's going on here. The Euro US dollar, as you can see, is slightly positive on the day. However, on Friday, we had a dark cloud cover sell signal. With that sell signal, the market is targeting the $1.1957 area. And if we can get a little ounce of dollar strength, we might push this slide all the way down to $1.1892, maybe even $1.1818. Remember, the slope of this rally so far has been very extreme. We had a low in November at $1.1602. We had a high on Friday of $1.2177. We had more of a range in November than we had in 2019, basically. So and we did that in just under a month. That's kind of significant as far as volatility is concerned. So weakness in the dollar is definitely prevailing as far as a major currency like this. Remember, the Euro US dollar is one of the key components of the dollar index. To give you an idea also as to how things are moving with this market, let's look at the hourly. So besides having a sell signal on the daily, we have a short-term hourly sell signal that was triggered here yesterday. That's a bearish engulfing line. That also had the market targeting down towards this $2012 area. Right now it's in kind of a neutral trade, and we're watching it really go nowhere as the European markets are now closed, the Asian markets are closed, U.S. markets are obviously not doing very much. However, the one thing I have to say is that we do have an interesting pattern setting up here. The way we're holding on to the support level here on this inside day, that has us definitely still in a bearish, neutral to bearish posture. So unless the hourly chart gets a rally and takes out the high of a couple hours ago, that would be right around 2133. I don't see this market getting any strength, at least today. If we were to take out the $1.2133 area, then we would be targeting this $2141 area. A breach of that level definitely has an upside breakout targeting higher move highs. Don't see that right now because the daily signal is still intact. So we have a daily and an hourly sell signal that are pressuring the Euro US dollar to continue to test the lower and move lows. So it's not overviewing it right now as a downside corrective move, but definitely we're looking for a continuation of selling pressure in the Euro US dollar. On the daily basis, you can see how when we made this high on Friday, it barely took out the high from the previous day. Yesterday, it tried to make a higher move high again, settled lower on the day. Today we have an inside day, so the market, the coil is winding for the Euro US dollar. We're getting closer to Brexit. Odds are that as we head into the middle of December and start to approach the holidays and the end of the year, you're probably not going to see very much volatility in the euro, the pound, or those crosses with those two currencies. The main reason is this is because Brexit has a deadline date of December 31st, as you can see on this chart here. It also has a month deadline due over the next couple days and another one next week, which they seem to be fairly on target for meeting them. And it seems like they're both on the same page that moving forward, obviously time is not going to stop for anyone, so they will get done what they can get done, and they will resolve whatever they have not resolved in the following new year. So as far as the dollar index as a guide, I would be very careful looking at that for direction for the pound or the euro US dollar. The main reason is the other currencies around the globe are very bullish. Some of your weaker currencies are very bullish against the dollar right now. And as long as that's happening, I believe that that's why you're seeing the dollar index pressured as much as it is being, especially considering that the euro and the pound are lower versus the dollar over the past few days on a net basis, and the dollar index continues to drop. So that means that it's definitely the overall batch of currencies versus the dollar that are pushing the index lower. And that's something you have to be mindful of, is that now we have divergence. This is good for volatility, and if you are a flexible trader, there's multiple options to go out there for you. So the thing you want to key off of right now, once again, is this market is in a bearish way, targeting $1.1957. And if you look at your risk here at $1.2175, that's the high. We're at $1.2111. So you're looking at less than 80 pips when you're looking to make, this is you're basically looking to make 160. So you're looking at a 2-for-1 risk-reward ratio, minimal, upwards of a 3-to-1 ROI potential, especially considering that your risk level is $1.2175. A rally above that would negate the sell signal and have us off the bearish tone. Remember, we're looking for a bearish correction. We're not looking for a big turn in the market. So especially as we head into Brexit and we still do not have a resolved election in the United States. So with that being said, if you want to learn how to trade these signals, remember to check out the book, High Probable Japanese Candlestick Patterns. It's available on Amazon.com in paperback and Kindle versions. We don't have any questions on the chat line, so those of you that are out there, don't forget to subscribe to our channel if you haven't already, and share it with all your Forex friends out there. I want to thank you very much for your time. We're going to have another video on another currency coming up in just a couple minutes. So I'm Teddy Keckstedt from Forex Trading Online. Take care, and always check us out at www.forex-trading.com.
Get a new set of tires in just a couple clicks at Firestone Complete Auto Care.
We're here on December 28th for Forex Trading Unlocked with a Forex analysis of the New Zealand dollar US dollar. We have a signal that was triggered in that market. Before we get into it, just want to remind you this video is for illustrative and educational purposes only. And before we get into the analysis, we're going to get on to our book promotion plug for High Probable Japanese Candlestick Patterns. We're going to discuss one of those patterns in this video and the sell signal that has been triggered. You can read the book. It's available on Amazon.com in paperback and Kindle versions. And also remember to subscribe to our YouTube channel, Forex Trading Unlocked. And now let's go to our live action screen. We have the New Zealand dollar chart here pulled up on the forex-trading-unlocked.com workstation page. Bearish engulfing line sell signal. That is what we are looking at here. So 2 days ago, on Friday, the market had failed to make a higher move high, and it signaled this bearish engulfing line. Yesterday, the market traded a little bit lower and probed lower move lows on the day, and now we have an inside day with just a slightly positive look. Let's look at the hourly chart, won't we? Let's see how things are shaping up with this. All right, so we initially had our high that was set back on Friday, and the market continues to make lower move lows and lower move highs. The key level to look out for here is this 70.64 area right here. If the New Zealand dollar US dollar breaches this level and rallies above it, it's most likely going to take another run at this high at 71.03 if it gets above that level. Now, right now, today's trading, I wouldn't expect very much more until this evening once the Asian markets come online, and odds are you're going to see a lot of that kind of trading over the next couple of weeks, where most of the action is going to happen overnight. And you can see there was a lot of indecision. It opened up yesterday afternoon, and obviously morning in New Zealand time, but afternoon US time. Traded up, tried to make a higher move. It fell apart, made a lower move low, and now here it is still trying to make a higher move high, and it's not happening. So remember, lower move lows, lower move highs are indicative of what? A lower trending market. So even though the market is slightly positive on the day today, a test of this low from yesterday, and if it falls below here, that helps to add momentum to our bearish engulfing line sell signal, adding selling pressure that will most likely have the market coming down this 68.78 area. So we're looking for it to get down to the top end of this downside target area. It'll be rough to get below that just because of the overall strength of the New Zealand dollar versus the US dollar. Remember, do not for months. That's just it. This last wave up, it's gotten very extreme. So just like when it came into this area here, we'll probably start to see something like this occur that happened from August into October, but only at these higher levels. Meaning, once again, that we're looking for a test of support, not a big one. This would be a good, now think about this, where this area was the highs, and then we breached that, we rallied above it and sustained this rally up here. A corrective move back down towards the 68.08, somewhere between that and the 68.78 area here, the upper part of this target area. Great place to find a base and then see the market chop around, go neutral to higher as we end the year and head into the first quarter. And once again, if you start to see any really big sell-off in the dollar versus the majors, like if the euro rally and breaks out to the upside further than it has right now, and if the pound especially gets a big rally to the upside heading into Brexit and the beginning of the new year, you would most likely see the New Zealand dollar trading probably, right now we're trading at 70.44. We'll be probably trading up at the 75 level, and that's no joke. And that probably would happen within the next few months should that rally occur. But right now, we're looking for a bearish correction to lower levels, targeting this 68.78 to 67.08 area. So with that being said, I want to remind you once again, if you want to learn how to trade this bearish engulfing line trading signal, read the book, High Probable Japanese Candlestick Patterns, available on Amazon.com and paperback and Kindle versions. And we were going to end this webinar now, but before you do that, I want to remind you once again to check out Forex Trading Unlocked for all your Forex needs. And you can find us at www.forex-trading-unlocked.com. And after this video, Forex Trading Unlocked, and we are here for a weekly British pound US dollar analysis for December 13th through the 18th. So before we get into that, we just want to show you our disclaimer to remind you that this webinar is for illustrative and educational purposes only. And we're going to just want to remind you also to please subscribe to Forex Trading Unlocked if you have not already. Share it with your trading friends also. We would appreciate it. And we're going to talk about some sell signals and some buy signals. And if you want to learn how to trade some really good signals, read the book High Probable Japanese Candlestick Patterns. It's available on Amazon.com in paperback and Kindle versions, written by yours truly. Yes, I wrote the book. So, and with that, we're going to go to our live action screen here. We have the forex-trading-unlocked.com website pulled up, and we already went to our market analysis and education tab and pulled up the workstation page. Our workstation page here has a bunch of the economic number calendars and a bunch of other things on the page, but we're going to focus in on the chart that we already have prepared for you. The British pound US dollar has been in a bullish mode since middle of September, and actually going all the way back to March. Interestingly enough, let's see how these things are shaping up and what's going on. Now remember that the British pound US dollar is one of the biggest components of the dollar index. The longer term trend, look at what happened as of Friday. We have this trend here from September and October. That's not a steep slope. It's a pretty decent upward slope to maintain a neutral to higher posture, which it has been doing. But then we have this longer term trend here. Let's get that lined up a little bit better. And we'll change the color of this one. Let's make it yellow. So there we go. We can see it. All right. Interestingly enough, the long-term trend that goes all the way back to when the dollar spiked high and has been trending lower versus the pound, Friday it closed just above that. Pretty interesting, isn't it? We had a sell signal back here on December 4th. December 4th seemed to be a little turn for most of the currencies that were bullish versus the dollar. Not all of them, because other ones are making new move highs versus the dollar, not as we speak because it's Saturday morning right now, but they have for the past few sessions, whereas the pound, and just like the euro, has sold off. This sell signal here had us targeting this $32.12 area down to $30.04. Interestingly enough, it had come close to it a week ago, right after the sell signal came really close, and then it rallied, and it looked like it was going to fail. But what did it do? Well, here's what it did. It came down, almost hit our target, then it rallied up, made a lower move high, and then as of the next couple sessions from Wednesday into Friday, close, this market came off a lower move high, made a lower move low, and then settled right on that line. So we know that if you have lower move lows and lower move highs, that's indicative of a downtrend. So short term on the hourly, we have a coinciding daily sell signal after a higher move high, but from that higher move high, we've made lower move lows and lower move highs on the hourly basis. So I think that we're going to maintain that short-term trend of lower move lows and lower move highs on the hourly basis. One thing I would use as your biggest guide here for that would be watch the $33.22 area and also watch this $34.79 area. Trading above these two levels would have us off the short-term sell signal. Now remember, on the daily here, we already hit our downside target of $32.12 for this sell signal, and we almost hit $31.05, which is right in the middle of our target range. So has this signal been completed? For the most part, yes. If the right thing to do here would be, if you had multiple positions on, we had two on. We took one off at the first level at $32.12. So now we're riding one more short, hanging on, looking for $31.05. However, we were in here at well, we didn't get in on the close here. We actually got in later, so we got in at $34.09 here. So we're in a good spot. We have already moved break even plus a little bit stops down to this $33.45 area. So as long as we don't pierce that, our second trade will remain on as we look to get an extended move down towards $31.05. So remember, on the hourly basis, we do have this market remaining in a bearish posture, and we're going to remain to do so, especially if we can take out somewhere on Sunday or Monday this $31.32 area. That would be a really good indication that this bearish momentum will build. Now remember this number, $31.32. Let's go back to the daily here. So $31.32 would be where? $31. I'm just going to put that right there, and we'll just make it $31.32. Here's our line. Look at this. Our red line for the hourly. This is a big deal. Okay, so let's go back to here. $31.32. This is that hourly low. That is the daily low from Friday. If we come below that, if we hit this, take this $31.32, remember that takes us below the overall slope of the trend that has kept this market in a bull market for the past 6 months. This has us definitely confirming a corrective phase if we trade back down through this area again, making lower move lows as we come down to try and test this upward sloping support here. This is the more evenly sloped support line holding this trend intact. If we fail here, well, then we're going to be definitely looking to hammer this $30.04. Beyond that, we have to wait and see what happens as far as any type of signal. We don't have any to go off of that. Remember, we're coming into Brexit. Odds are very good that as we get through this week, if we're going to have any real extreme move, it will happen this week, and then we'll probably start to settle into a very quiet, neutral, sideways trade where range traders are the only ones that are going to be making money as we go into the holiday market. So this week ahead is our last full trading week. The next 2 weeks after that are going to be broken up because we have the Christmas and New Year's holidays where we're going to be losing a day of trading no matter what. So that's something you need to be very mindful of, and the fact that a lot of people are on vacations and what have you and traveling. I know in this coronavirus world, people will not be traveling like they normally do, but we do know that people still will be traveling over the holidays. So since we have no questions on our chat box, we will be back with another individual Forex market weekly analysis video soon. And check out, remember to go to our YouTube channel if you have not already, to subscribe to our Forex Trading Unlocked channel, and hit the little bell too, so you know when you'll get emails of when we have new videos coming out. And check out the book High Probable Japanese Candlestick Patterns to incorporate the best buy and sell patterns into your trading systems and methodologies. And this book is available on Amazon.com in paperback and Kindle versions. I want to thank you very much for your time, and always go to forex-trading-unlocked.com for all your Forex information. Everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here today for a Forex Euro US dollar weekly analysis for December the 13th through the 18th. And before we get into that, we just want to remind you with our disclaimer that this webinar is for illustrative and educational purposes only. So once you read through that real quick. And then we also want to do a quick plug to remind you to subscribe to our YouTube channel, Forex Trading Unlocked, please, and definitely share it with your Forex trading and other online trading friends. And if you want to also learn about the trading signal that we're going to talk about in this video, read the book High Probable Japanese Candlestick Patterns. It's available on Amazon.com in paperback and Kindle versions, so you can also read it if you are an Amazon Prime reader as well. So with that, we're going to go right to our forex-trading-unlocked.com website, where we have the workstation page already pulled up, and all you have to do is go to the nav bar at the top of the website, any page, and you go down to you hit the Forex Analysis and Education tab, then you hit the Forex Trading Unlocked Workstation tab. On that page, you can see all the economic numbers that come out for the week ahead. As far as the euro is concerned, we do have wages, labor, total trade balance, and construction output coming out on the 14th. And then we have CPI, retail sales for the US dollar. So that might have a little bit of movement for the market for those on Monday. And then let's see what we got going in here. December the 17th. Yeah, we're kind of through most of the major numbers for the beginning of the month. And we have the holiday, unemployment, and there's a couple of euro numbers that will be coming into play, but nothing really too big this in the week ahead. Now remember, this is the last full trading week ahead of us before we start to head into holiday markets. So as far as the euro is concerned, what do we have to think about? We got someone in our chat room. Rod Room, awesome, and thanks. Cool. If you have any questions while we're talking about the euro US dollar, definitely leave them or put it down there, and we'll answer them as we go along. So to start off, the euro US dollar had a dark cloud cover sell signal back on December the 4th. Since then, we traded down into this current week that just passed, and we had a nice little bounce on Wednesday, rallied up and peaked on Friday, and then had a negative close. So right now we have made on a hourly basis, and let's show you this, we have made lower move lows and lower move highs consistently. Now we had a nice little rally from Thursday into Friday. Like I said, it peaked, and then Friday, as you can see, we ran into a wall at the top there. We have a short trade from $1.2147 that we had. Our initial stop was at $1.2175, and now we lowered it to a positive stop at $21.40. Our downside target is $20.45, so that's down below the chart here. So the risk-reward ratio on this trade is pretty strong. So right now that's in place. We have as long as the market doesn't get above this 2140 area, we'll still have it on, and I think that with the way it settled on Friday, that we have a good shot of the market coming down, at least down towards this 2090 to 2080 area sometime on Sunday into Monday night, or Monday morning rather. Now the nice thing about this is, remember when we started out, we have the daily sell signal in place. So on the hourly, we have also a sell signal in place. Now, keynote that you want to really pay attention to is our downside target here for the hourly is 20.45. Now, let's take off this hourly chart, go back to our daily here, and what happens if we hit the 20.45 area? So let's put a horizontal line right at 20.45. So we can make this a 45. See how easy we adjust this? With our charts, you do this right on the website. No login. You can do your own analysis and figure this stuff out for yourself. Anywhere you are, you just need a computer with a mouse. That's it. So once again, we have our dark cloud cover on the daily signal. We're targeting down towards $20.45 area from the hourly. Let's make this a different color since it's our hourly. We'll make this a reddish line because anything below here would definitely have us on the sell campaign. Okay, so there we go. All right, so here's our levels and our things that we're watching. Now, Brexit is coming up on the 31st. Negotiations between the UK and the EU have started to, well, they haven't been, I've been talking about Brexit for years, actually. I actually go on a couple of different financial shows, and we were just talking about how within a couple of weeks, we will no longer be using the term Brexit. We'll be using the term post-Brexit. So, but it doesn't look like they're going to have much guidelines hammered in by the 31st. They're coming into a little bit of an impasse between Boris Johnson and Angela Merkel. So we have the daily and the hourly to have sell signals in place. What does that mean? Well, what happens if the hourly is right? Let's just say that our short-term hourly sell signal gets followed through on Sunday into Monday, Tuesday. If it takes out this low right here that was made on Wednesday, then that would be very, very bearish. Why? Because that would mean that we would have made a higher move low, a lower move high, and then a lower move low, which would have us, at least in the short run, on a daily basis, it would confirm a bearish to neutral posture. Only in the short run, not the medium or longer run, but definitely in the short term. Now, since we're coming into, like I said, this is the last full trading week of the year. After that, we have 2 holiday weeks that are going to be broken up. You're not going to have a lot of market participants in the marketplace during those 2 weeks. You're going to have a lot of just algos kicking around, so it's just the machines. So make sure you pick your points and know what's going on with your levels. If you don't, you're going to get hurt. I promise you, it's not going to be a pretty thing. So our bullish breakout level will be this $21.61 area. Oops, that's not where it's at. Excuse me. It's the high right here. Excuse me. $21.77. There we go. That got moved when I moved that name sake there. Okay, so here, let's move this chart down a little bit. So here we have 2021, the first quarter of 2021. Where are we going to go? Who knows? But we have this upward sloping support line here that right now is keeping the trend intact. Now, it had been very steep from the beginning of November into the beginning of December, which is when we had the sell signal triggered. You should be mindful of the fact that this low back in December, or November rather, was at $1.1602. Our high a week and a half ago was $1.2177. That was more volatility and more of a range within a month's period than the euro had had for almost a year and a half before the coronavirus hit earlier this year. So it's very significant that on the yearly basis, or in this year, it's not the biggest range because the euro's been all over the place. But to have that kind of volatility in a month heading into Brexit and the holiday markets, we have this short-term sell signal. I think we're really ripe for a correction now that will keep this $21.77 area intact, most likely keeping us sideways to lower as we head into December 31st. December 31st, after we pass that, obviously then it will be post-Brexit. Once we're talking about post-Brexit, who knows how long they're going to have to figure out deals, but they will be, and Brexit is in full motion. So the extreme I'm looking for right now is, let's see a test of the low from last week. If we fail there, that confirms lower move lows after a lower move high, and then we will be probably pressing $1.2045 right away. A failure from $1.2045 really has us on edge then, targeting $1.1957. So now, like I said, if this happens next week and we have that kind of a trend going, that would be something that would kind of fulfill a nice short-term correction, blow off a little bit of the steam from the volatility that it's had over the past month and a half, and then probably go into a quiet neutral trade as you go into the holidays. The holidays could be volatile, they could be swinging all over the place, or they can dry up like there's no tomorrow. Always be careful of a holiday trade, especially between Christmas Eve and New Year's Eve, and especially around New Year's. You're going to have the algos kicking. You're probably not going to have a lot of participants. Usually the ones that are playing around on the holidays are either traders that are extremely bored and have very bad discipline when it comes to trading, or they're newer traders that just don't have the developed the discipline yet to stay away from markets like that. So with that being said, let's go once again back to the hourly to prepare you for next week. So on the hourly basis for the Euro US dollar, we are looking for a follow-through break to take this market down towards $1.2090, $1.2080. If it fails from here, it should continue to press forward towards lower levels, targeting a downside target of $1.2045. If it gets above $1.2140, we're out of this trade, but really it has to get above $1.2177 for us to be off the bearish campaigns, because remember that the hourly trade, once again, this is the hourly signal. This has a short from $1.2147. This is an hourly signal, so this one can be negated while the daily trade is still on. The daily trade is off if you fail from $1.2177, because this daily trade here, we're in at $1.2120, or actually $1.2119. So for that one, so we have a position on the daily basis. We also have one on the hourly basis to coincide with each other, and especially if the hourly hits. Now we will take off the position with the hourly once we hit the 2045. So remember to always be disciplined. We have two trades on. This hourly trade, if it hits $1.2045, it is over. It's done. It's gone. But it doesn't mean that the daily trade is off. So we're hoping to have that get down to that lower area. And let's see, do we have any questions? We don't have any questions in the chat room for our Euro US dollar weekly analysis. As the week unfolds this week, especially once we hit the 2045 area, because then we'll have to take you off the hourly and just maintain the daily, which at that point, if we do make lower move lows after having made this lower move high, the stop that we have in for the daily signal will also be brought down, because that one we have at 2175. So we got a lot of risk on that one, but we're looking for a bigger slide on the daily basis for that trade. But once it falls and makes lower move lows and hits our hourly target of $1.2045, then our $1.2119 trade we will bring down to a break even plus 3 to 5 pips, depending on how extreme the market is when we get to that area. So once again, we don't have any questions on the chat. If you guys want to hang around, we're going to come right back with the British pound video, but this one is our Euro US dollar weekly analysis video, so we'll be right back with a fresh one, and we will be focusing in on the British pound. So I want to thank you very much for hanging in there, and just want to remind you to subscribe to our YouTube channel, Forex Trading Unlocked, in case you haven't already. And if you want to learn how to trade that dark cloud clever sell signal that we were just talking about in the daily, read the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And also check out all your Forex trading needs at forex-trading-unlocked.com. We'll be back in another moment. This is Teddy Keckstedt from Forex Trading Unlocked, and we are trading analysis, trading signals and analysis. We are going to cover the Euro US dollar. We are also going to cover the Euro pound, the Euro yen, the Euro Swiss, the Euro Australian dollar, the Euro New Zealand dollar, the Euro Canadian dollar, and even the Euro Bitcoin. So if you have any questions while we're going through this webinar about any of these Euro cross rates, just let us know. Okay, you can leave it on either Twitch or YouTube or whichever one of the social medias that we are broadcasting to, and don't forget to like, follow, and share, and spread it to your friends. Once again, I'm Teddy Keckstedt. We're going to have this is all about the Euro cross rates. Just to give you a little background, I've been in the trading industry for over 30 years, trading Forex futures, stocks, options, and binary options. I have a finance degree from DePaul University, over 20 plus years on the trading floors. I started at the CBOE, was mostly at the CME, and then also at the CME Board of Trade when they did the merge. I'm also the president of Forex Trading Unlocked and author of the book High Probable Japanese Candlestick Patterns. With that, we just want to give you our disclaimer to remind you that this webinar is for illustrative and educational purposes only. All right, today's focus is going to be Forex market analysis, trading signals in the various Euro cross rates, trade management, Forex trades, futures options trades, binary options trades, ETF trades. All major euro cross rates are covered. Once again, the euro US dollar, the euro pound, the euro Swiss, the euro yen, the euro Australian dollar, the euro New Zealand dollar, the euro Canadian dollar, and the euro Bitcoin. Maximize your Forex trading potential. Find Forex trading opportunities. Get a microscopic view of what the euro cross rates are doing. The best indicator, I've always said, is the market. And so when we're going to look at the euro, we're going to use the other cross rates to get a bearing on what it's doing. And also have a little Forex trade management, futures options trades, binary options, and ETF options trades. With that, let's go to the euro US dollar. We're going to pull up this chart for you right now and see what is going on. So we have the euro US dollar pulled up here. All right, we have the market has made higher move highs today, especially on the hourly basis. As you can see, we had a spike high early on in the session. Since we spiked high up there, just above $1.22.10, we have been trading lower for the most part all day, and currently trading near session lows today. On the daily basis, though, we spiked high, because you can see we made a higher move high after having made a higher move low. This low from a little over a week ago at $1.2056. This is going to be our big bearing for direction. If we have a failure here, then odds are we will be pressing the $19.83 down to $91.15 areas right here. Critical support would be right around this $18.47 to 40 support band right here. I think any extended corrective sell-off, and right now any sell-off, will be viewed as a short-term correction right now. The dollar is a definite aggressive bear, grinding lower again with most of the currencies. See how this pans out over the next couple months. But remember, we do have Brexit, which is going on, and then the 31st. Irony of it all, the UK and the EU, as if we didn't know this was going to happen, have not come to too many deals as far as the end of the year. Just some very short-term preliminary things. Irony, the UK has solidified trade deals and all kinds of geopolitical structures as the UK regains its sovereignty, with 57 plus countries, and EU and its confederation of countries has yet to really stabilize anything and is still putting up a fight. So that's pretty interesting how the rest of the world is moving forward, but the EU is still trying to clamor and hang on to that. So not affecting the euro, or is it? So let's see what is going on here with the euro. We move over to the, let's see what's the next topic here. We have the euro US dollar. Let's go to the euro pound. Okay, so for the euro pound, let's pull up our chart again, and let's see, here we go. Where did we go with this? Here it is. All right, so for the euro and the pound. The euro pound, as you can see, has been in a very volatile wide range trade for the past couple of sessions. It topped out around was it 92.31 and had a low of 89.82 just a week ago. So it's crossed a lot of territory back and forth. This is one where you can obviously see where the euro strength has started to wane. Today it's a little more positive on the day. Maybe that's probably because of what it's doing to the dollar. But as far as this currency cross is concerned, the euro pound looks like it may have set its range for the rest of the year. Remember that we do have the Brexit coming on, so this would be the 31st. I think that you're probably going to be contained within this area. Remember, next week is going to be a shortened holiday week, as well as the following week. We're heading into the end of fourth quarter, end of 2020, the year we all want to get through, and especially with the Brexit, no Brexit deals on the table still, I think you're going to see a lot of consolidation in the euro pound, not necessarily in the euro versus other currencies. Now we have the euro Swiss. What do we have going on in the euro Swiss? Well, this is a different case. The euro corrected against the Swiss, and as of last week, set a nice little short-term bottom. It has rallied and continued to press higher move highs for the most part, except for 2 days where it settled lower, but still it made a higher move high before doing so. Today we made a higher move high. We're trading just below this $07.92 area. This, I think, is a critical pivot point. Trading above this will have a sustained bullish momentum. I think that's going to target this $08.20 to $08.40 up in this area over the next couple of weeks. The euro pound may settle into a consolidation range, but I don't think that the euro Swiss is. I think that the euro right now in the short run has a good chance at still maintaining upside momentum, just as it is in some versus the dollar and a couple other currencies. So the Swiss is not getting, it's making new move highs against the dollar as well. But it's been in a much steeper slope, meaning that it's been trending and really bashing the dollar for the past couple of months, whereas the euro has been creeping higher, except for, obviously last month it's had a $6 move. But even still, as the severity of the other ones seem to be much more drastic versus the euro. Now let's see, we have the euro Swiss here. We made a lower move or higher move low. And then if you see like the main chart, we've been trending higher since November. We spiked all the way up here. So we came back here. This is a higher move low, and now we're short run, still making another run at the bullish moment resistance. Like I said, if we can sustain the trade above $07.92, which we're hovering just below, then I think you're going to still find a lot more buying momentum to catapult this back up to this $08.20 to $08.40 area. So the next currency on our agenda will be the Euro JPY. So the Euro JPY, what's going on in this one? Let's see, the Euro Yen. Okay, the Euro Yen has kind of settled into a range trade in front of the Euro Pound. The Yen has been a little bit neutral versus the dollar. It kind of bottomed. The dollar has found a little bit of strength in the Yen, where it's been getting really crushed by most of the other currencies globally. The Yen, it has not been so severe. It had already been in a bearish trend for a long time, and while the past few sessions, especially where the dollar has been getting hammered, the Yen has been rather gentle on the dollar. I think that's where you can attribute this Euro Yen consolidation, and also with the Euro Pound coming into a consolidation over their trade deals. Like I said, the UK and Japan is already locked in theirs. They're one of the 57 countries that the UK has gotten pretty much through the negotiations they need to after regaining their sovereignty. The Euro, however, like I said, I don't know for sure how much that changes any of their deals with Japan. I think that just because the UK leaves doesn't really change anything with them. So in that regards, I think that gives you stability. So the Brexit, no Brexit, where it has a little wide range in the Euro Pound, I think in the Euro Yen, you're not going to see that very much of anything. Now, should the pound start to, should the yen weaken more against the dollar, then you may start to see the euro climb against the yen even more, especially if the euro remains in the US dollar and its highs. You know, if we don't have a big correction in the euro US dollar, and it's definitely if you see the dollar remaining strong versus the yen, then I think you're going to see this euro yen challenge this $26.75 level. Only below, we made a little move for lower move lows today, but we're holding positive on the day. I think that if you key off the lows from last week around $25.76, that will keep the market afloat. If we have another failure here, again, like we did today, meaning euro weakness versus the yen, then I think you're going to probably see this a correction that will take this market down below $1.25 half, targeting this $1.25 area. The slope of this trend currently is rather steep, even though it's widening, it's narrowing out right now. But we had a really aggressive start to this rally. We had a decent correction that was absorbed once again, especially as this month has been going through since the end of November into the middle of December. So is it toppy? Could be. We'll see. Like I said, you have to key off of these two levels here: the dollar 126.75 and the 125.75 areas. Now let's see what we got here. We have this one next, and let's see, where do we go with the euro yen? Okay, where is that chart? Where is the chart? What do we do with it? Oops. Okay. Where did our euro yen chart go? Okay, well then what we do is we'll pull up a new one. So we have Forex Trading Unlocked. We pull up this and we go to our Forex markets. This is the nice thing about the forex-trading-unlock.com website. You pull up this little tab here, and now we can go down to any of the cross rates that we're talking about. Now, since we are talking about the euro, okay, now let's see, we are going to the euro Australian dollar. Okay, the euro Australian dollar. This has been an interesting trade. The euro, of all the markets that's out there, is getting just crushed versus the Australian dollar. This is very similar to the US dollar or the Australian dollar US dollar trade. The Australian dollar has been very strong versus the dollar since March. The fact that it's so strong versus the euro gives me a kind of inkling that we're going to see a lot of divergence in the cross rates in January. So after we get through Brexit, and we have the post-Brexit that occurs, and we also now we have a confirmation of the election in the U.S., I think you're going to see so much volatility in the currencies and all the definite, some of your lesser traded cross rates. So we'll be doing more of our in-depth analysis now, doing these breakdowns for each one, like the euro US dollar with these other crosses versus just looking at the dollar versus the pound and what have you. We're going to have a much more micro outlook now from as we move into the new year. So once again, the euro Australian dollar, this thing is getting hammered. It's been trading lower since the end of October, trading near its lows right now. Now it's tried to spike higher today, and now it's falling apart. This is where I have to say, like, when it comes to overall euro strength, it would take a big rally here to confirm any type of change in trend with this one. So I think that while you are going to see euro strength versus the dollar, it's going to be very sideways versus the pound and the yen like we looked at. Probably a little weaker versus the Swiss. The Australian dollar, at any upside move, I would have to say you're going to have to view as a corrective move. So I would look pretty much trade off of this area here, the $1.61.79, and then the low from last week around $1.60.36. So that's for that part. Now let's go and finish up the Asiatic zone, and once again we'll just go to our little thing here. We pull up the euro New Zealand dollar chart. So see how fast we can load this up on the forex-trading-unlock.com website. So the euro New Zealand dollar, now this is a little bit different. Remember here we have the Australian dollar, it's just hanging above the lows. The euro New Zealand dollar, on the other hand, had a nice bounce a couple weeks ago, made a lower move high. Now then last week it made a higher move low, and it's rallied since then. Today it made a higher move high over the past few sessions, but has yet not taken out this one here. So let's put this horizontal ray right here, and then we'll put another one here. So we're short-term bulls for the euro New Zealand dollar, looking for this correction to get extended. A breach of $1.7282 here would target this $1.74 up to $1.75 area. A failure, however, from $1.7068 would be very negative, and then I think you would see this $1.70, $1.69 area getting penetrated in a very, very quick fashion. So let's see what we got. Next, we have the Euro Canada. So the Euro Canada, oops, we brought the wrong one here. The Euro Canada right here. Let's see. So Euro Canada is that widened out. Now the Euro Canada, this is an interesting trade. So you think that the Euro US dollar, which has been a relentless bull, would look similar to the Euro Canada, and not so. This has been a very wide range trade for quite some time. So what does that mean? Are we bullish? Are we bearish? Yeah, we don't really have much of an opinion on the Euro Canada whatsoever. The UK and Canada, they settled. They're already settled with their trade deals and things like that. Once again, I don't think that between the EU and Canada things really change very much. So there's pretty much stability there. There's the Canada is very strong versus it's hard for the euro with the Canada being so strong versus the dollar. It's hard for the euro to really be that much stronger versus the Canadian. If you see the Canadian dollar all of a sudden give up ground to the US dollar, in that point, then I think you would see the Euro Canada start to get a rally. Right now, I wouldn't touch this thing with a 10-foot pole. It's a big, choppy range trade. Basically, I would say if you look at the range over the past few months, key off of these levels, somewhere between $1.5450, which we are now trading above here, and then up to $1.56. So in this little area here between $1.56 and $1.54, you're not going to have very much fun. It's like I said, it's going to be for range traders, not much of good swing trading opportunities to look forward to. All right, so now let's take a look at the euro and the Bitcoin. That's right. You can buy and sell Bitcoin in multiple currencies, the euro being one of them. So the euro Bitcoin, just like the US dollar, Bitcoin has been rallying, making new highs, especially today, going up to over 16,000, actually over 17,000. The high was 157 euros. So we have the market pressing higher move highs. Now here's the funny thing is, if Bitcoin is stronger than the dollar, and it's stronger than the euro dollar, meaning that's where the bull is, those are being the opposite ones, where would euro strength come in? Well, I guess if you see a big slide in Bitcoin, then you will probably see also a little bit of relief in the dollar and also in the euro, which obviously I guess the crypto whales out there are ditching euros and also dollars, and they're buying Bitcoin. So at what point do they want to take a profit, and does it start to come out the other way? Well, that'll be an interesting thing to see, won't it? I would say that as we pressure new highs and get back to above, sustained above this 20,000 level, and for the U.S. Bitcoin, and now with the euro Bitcoin being back about just around 17,000 euros, as it pressures on to 18,000, we'll see if people start to take profit. You got to remember that Bitcoin just a few months ago was under 9,000 euros. So this is a very vertical slope. We've had some big swings, especially if you just look back not too long ago, back in November. This thing was all over the place. It had a high of just under 16,400 euros and got down to 13,600 before bouncing again. So no market goes in one direction. We'll see when the profit taking comes. I would expect to see some swings that whatever the short-term new high does become, that you'll probably see a 1,000 to 2,000 euro correction at least, probably even more in the lines of 3,000 to 4,000 euros. Then find as some sort of a basing. And now let's see, what else do we have here? We have the euro US dollar. So let's go back to this one and see, since we're ending our webinar here, to find out where it's going, where it's trading at right now. So since we've been talking, the euro US dollar actually has fallen back a little bit. And look at the volume here. This is very interesting. Volume's been dropping off as we're heading towards these holiday markets. Like when we bottomed the day after, that was when there was a huge spike in buying. That's a lot. And now we don't have very much at all. This is very interesting to see how the volume is decreasing. So with that, what are we going to go to now? Now we're going to go to our quick reminder. So, trades to watch. The euro US dollar, we're bullish. The euro pound, we're neutral between 0.9230 and 0.8982. For the euro Swiss, we're bullish above $1.075, targeting $1.082. For the euro yen, we're neutral between $1.2675 and $1.2575. For the euro Australian dollar, we're bearish below $1.1618, targeting $1.16. For the euro New Zealand dollar, we are bearish below $1.7285. We're bullish above that level. The euro Canadian, we're neutral between $1.5714 and $1.5402, or euros rather. And for the euro Bitcoin, we're obviously very bullish. So as far as futures trades for the euro US dollar, I would say that buying dips is the way to look at. Now here's the thing, we're coming into futures and options expiration. So as far as futures and options trades, I would say until we get through expiration and actually through the holidays, I would stay out of those markets. They're going to be very, very thin. Okay? So if you're going to trade the Forex markets or the currency markets, the Forex cash is the most liquid and best way to go. Be very leery of the next couple of weeks as we head into holiday markets. For futures and options traders, if you're going to go into directional trades at all, I would say put on vertical spreads, meaning a credit spread against whichever direction you want to go. So if you're bearish, like right now we're bullish the euro US dollar, so that would be selling the near puts and buying further out puts for a credit, and watching the time decay erode, which would be fairly neutral, but it will still be working a little bit in your favor, and the volatility, I believe, as we're buffering the highs. And then that would be if you're gonna get into the futures options, that's what I would do. I'd still stay away from the futures because you're gonna have a lot of erroneous trades because of the spreads unwinding. Then there's the binary options. Obviously, we're bullish, so I would say look to buy dips if you see a little nice correction, especially of a point, $1 to $1.50 in the euro. Bringing it back down towards that $1.19 area. Look for binary levels around there to get long. And I would say that those would probably be the trades. You only have a couple days left in the session this week, so be careful with that. And then also next to shortened holiday week, just like the following week, if you're going to trade binaries, they don't go through the whole week. They don't go as long as the cash does. So I'd be very leery of the binaries also as we head into the close. So with that being said, do we have any questions? It looks like we don't have any questions on... let's see, do we have anything on Twitch? We do not have any questions on Twitch. Do we have any questions on YouTube? Let's see, do we have any questions on YouTube? We're looking, screening. We have some viewers, but we don't have any questions. So it looks like we're all through with the Euro US dollar breakdown for you. But just please, just as one last reminder, remember to subscribe to Forex Trading Unlocked on YouTube, and also check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. Thank you very much, and always check us out at forex-trading-unlocked.com.
Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here on January the 9th with a little Forex market, net market in there for the week of January 11th through the 15th coming up. So before we get into it, I just want to pull up our disclaimer real quick to remind you that this is for illustrative and educational purposes only. And also, before, if you haven't already done so, subscribe to our YouTube channel, Forex Trading Unlocked. And also check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. We're actually going to start off here at the Forex-Trading-Unlocked.com website. We have the workstation page pulled up already. And we have the Euro US dollar. It ended the week on our note. The dollar actually got a little bit of a bounce Thursday into Friday's trading. Right now we have a bearish engulfing line sell signal that was triggered on Thursday. And we had a nice little follow-through break that happened on Friday. As you can see, the short-term trend is very vertical from the beginning of November to the beginning of January. We went from $1.16 all the way up to over $1.23 in the Euro-US dollar currency cross. And it's quite the move. You're having a $7 range in just 2 months. That's very, very, very extreme. So, and what we have now is we had a higher move high that was set a few sessions ago, and then on Friday we made a lower move low. So we have the sell signal from Thursday. Friday we made this lower move low. Now we didn't settle below $1.2215, so this is going to be our big directional pivot with $1.1974 down to $1.1882 as our target band to the downside. So right now we have a little bit of a spark of bullishness. Now remember, every time this market's pulled back a little bit off its highs, it grinds its way higher. So this market isn't a bull market. It's been overall making higher move highs and higher move lows. This is kind of an intraday thing, so we'll see how this carries through. If we continue to get follow through and especially get below this like $21.20 to $21.75 area, another sell-off like we had on Thursday and Friday, if we get that on Monday and into Tuesday, then that's probably a good indication that, well, besides a short-term turn, we have a good chance at pushing a nice size correction down towards this $1.18 level. Remember, it seems like a big move because, I mean, the Euro-US dollar was trapped in a $5 range for over a year and a half. Now, with the advent of 2020, this thing's been swinging all over the place, and I think that this is just a sign of things to come. We could be getting set up for some other major trends, obviously, in the currencies this year. We have to wait for the U.S. inauguration and everything to get through in January, towards the end of January. Plus, we have to see how the lockdown measures in the UK and the EU are going to impact the economies over there, because it seems like it's starting to finally hit those things. All right, now let's look at the British pound US dollar. So we had a sell signal in the Euro-US dollar on Thursday. The British pound started trading lower already a week ago. This one has been grinding lower. It's been a major bull versus the dollar for months now. The overall trend is not as severe as the euro. However, it's still pretty wide range. I mean, we have an upside breakout level of $1.3703. Back above here, we have higher move highs confirming the trend. As far as buying into the slide right now, I would wait for a valid signal because it looks like we are grinding this correction lower. But as you can see, this market, it'll spike down and it flies right back. So I don't know if the dollar has really turned yet. Once again, we have to see how things happen with the lockdown measures in the UK and also in the EU. And remember, I know that the Scottish issue with the UK is pretty much brushed under the rug, and I think it is pretty much that kind of a matter as well. But as long as it is still newsworthy, it's probably a little tension on the pound. And also, I think the argument's ridiculous because I don't see how Scotland would be able to maintain itself without the UK as a source of resources, for one, especially financial ones. So right now we're a little bit bearish on this one in the short run, especially on the hourly, in the short term, a couple days going into the new trading week. We'll see what happens. I think that if the Euro-US dollar continues its plunge, and if the dollar continues to maintain strength versus most other currencies, which, remember, the dollar's been beaten down for so long now that we're going to have bounces. So right now, we may be in one of them, and there's only been a 2-day bounce. You know, in this case with the pound, it's been a 5-day bounce. But even still, it's grinding. It's holding. And it's trying to hold this support here. So is it going to flip back to the upside? We don't know. We'll see. We're waiting for a signal here. So let's look at the US dollar Swiss. Let's look at our flight to quality currency and see what's going on here. Well, interestingly enough, the dollar has had a nice rally versus the Swiss over the last 2 sessions, which ironically, because of the euro move, it's not typically where you're going to have an opposite reaction. That would be ironic if you had an opposite reaction in the Swiss. So this is kind of coinciding with the euro, as well as a little bit of heat that the pound is taking as well. So is this a bullish sign for the Swiss, US dollar Swiss? Probably not. I would say that even if we have strength in the dollar versus the euro and the pound, don't expect that much out of this one. This is pretty beaten up. I would be surprised if you see this thing making a run for parity anytime soon. But even though this isn't a big downtrend, it's not in that steep of a downtrend. And just by time and attrition, I could see us get back. If we take out this 189.20 level here, that would be a nice sign of neutral potential, where I would say that we could probably push a higher range back up to this 90 to 91 cent area, and then start to bobble down between 91 cents and 87 cents as the dollar and the Swiss probably will find some sort of stable range, I would say, in the first couple months of the year to see how the transition of power in the United States goes, as well as the fact that we have transition of all kinds of stuff in the EU and the UK. Now let's look at the other flight to quality currency on the other side of the pond, on the other pond. We have the US dollar, Japanese yen, which has had a nice little follow-through move to the upside. This one started already back on Wednesday. And interestingly enough, on Wednesday when the market was railing, it was pretty strong. And you see typically a divergence when the dollar is not in play, meaning that, say that the euro and the pound are going up versus the dollar on any given day. At that point, typically, if they're not really a dollar-related move, the U.S. dollar yen will go the opposite way. Doesn't mean that it's going to trend overall, but typically on the day, if you have a weak dollar versus many currencies, you'll see the dollar rally versus the yen. And conversely, if you see a dollar rally versus other currencies like the euro and the pound and the Swiss, then typically you'll see the US dollar actually go down versus the yen. It's just a fundamental reaction of how these currencies will move when they're not, like I said, not being dollar driven. Now, when it's a dollar driven trade, obviously then that's a totally different story. I mean, you can see that the US dollar yen has been in a bearish trend for months now with the yen as well. It wasn't that long ago that the dollar was very strong versus the yen. Right now, not so. So, and that's something that we'll have to watch for the next couple months, and I think it'll be interesting to see if we're stabilizing the yen now and the dollar relationship. I think you're going to have to really key off of gold. Also, interest rates at 30-year and 10-year notes, watch them. They've started to kick up their heels the last two sessions. It's very important. Remember, interest rates are a function of currencies. The 30-year bond is in play right now. Excuse me. That is a very, very big deal. So the 30-year, no matter what, sets the tone for interest rates all across the board, all across the globe as well. And that has to deal with it with the currency pricing. So if we have rising yields and rising bond prices, that's going to definitely impact the dollar. And that could be why you're seeing the spike in the dollar right now, is that because the market is dictating much higher rates on the U.S. dollar, there's a reason to all of a sudden have money in dollars because of the interest rate. So it's a carry trade thing. All right, let's see. We got Jericho here on the mic here. Hi, GBT short the next 2 weeks. Any thoughts? Okay, Jericho, this one here is for you. We're going to look at the pound Swiss. So we looked at the pound dollar. Let's really go back to review that real quick so we can see. The pound is weakening versus the dollar. So now if the dollar is gaining strength on the Swiss, then I would say that the British pound Swiss should be going lower. Just my... Let's see. We've had the last two sessions. Yeah, a little spike there. Looks like a kind of a neutral trade. Now, here's the thing: is the Swiss, because the dollar has been in play, that's why there's such a major trend. The Swiss versus the pound. Here's the thing: is that Brexit doesn't really impact very much with Switzerland. Okay, even being part of the EU, it's still kind of irrelevant because of their own currency. So I think that's why, I mean, if you look at over the course of December, you've had a decent range in this one, in this market, but you found a nice bottom here in the middle of December. Since then, you've been making higher move highs and higher move lows off of this low. However, you haven't taken out this high here. So let's see, you want to know short on the H2 out next week. Okay, so let's see, we'll put this level right here. This is going to be our key upside breakout level as far as risk. If you're short, I don't know how long you've been short, if you're short around the close or whatever, but I would say anything above 21.24, you're definitely going to be on the wrong side. Cautious with that one because you have these highs up. You take this high out here, you're looking at a confirmation on the short run over a few weeks that the trend is definitely bullish with momentum looking to breach resistance and continue higher. So then 122 and taking out these highs becomes very likely. But you want to see where to go maybe on this trade. Let's say you're short from the close. So here's your risk level. I would say minimally, and this will be a good support area, would be the 50% level. There we go. Right around there. And then we'll take this to right about there. Okay, so this here, if you're short right now, I would say is your initial target area. Right into this little spot here. Should we slide down into here, which would be good for you? You're short, obviously. I want to see you make some money on this trade. I would be cautious. This will probably be an area where you're going to start to see some consolidation, just because you can see it over here back in October. So between this $1.18 to $1.19 area, if it just bounces off of this, this is going to probably be good support to where it's going to come back and make a challenge of these highs again. In which case, I would say make sure you're keeping your stops tight as you move forward over the next week or so. And then also, I do like your trade because the pound, if the lockdowns continue in the UK, which I don't see them not continuing, at least for a little bit longer, and we haven't seen what kind of on the economy. In the short run, I would say it would be kind of obtuse to think that it's not going to have a negative impact and a drag on the UK. They are not as big nor as resilient or have the abilities to bounce out of things like, say, we can in the United States, or even the EU can absorb because they are bigger. It doesn't mean that they don't have things that they can do economically, but I would say you're probably going to see the pound continue to be under pressure with the Swiss too, because the Swiss and the U.S. dollar probably are not going to, like I said earlier, are not going to be as impacted as much as, say, the pound and the euro. So, yeah, I like your short here on the British pound Swiss going into the new week. You want to take a look at the hourly real quick? Let's see. Okay, so here we have the hourly. All right, so this is nice here. So you want to key off of this last high here at $1.2037, and we settle right where we need to get below. So this would be, I would say, the warming up range between here as far as on the hourly is concerned, and if we get below here, that would be a big deal. And if you look at this on the trend line basis, here's the trend. It's not that steep of a trend, but I could easily see that the pound Swiss taking out this area, testing this upward sloping support line, and especially if we can keep on pressuring support down to here. If you take out $1.1968, all bets are off on pound Swiss, that would be good for your short. So there's some numbers for you. I hope you got something out of that. Any other questions on any other markets there, Jericho? You got any other positions on besides the pound Swiss? All right, let's go back to the daily. All right, so there's your target range there from $1.1901 down to $1.1846. It's not a bad little range there. If you look at it, if it takes, let's say a week and a half to get down there. I would say maybe. I mean, the thing about the pound with any currency and any currency cross with the pound, excuse me, there's always a decent range on most days, and when the pound kicks up, it typically is very, very low. There's a lot of potential, definitely to the short side. Just be careful. Like I said, anything above $1.21.24 probably is not going to be in a good way. All right, so let's use US dollar JPY. All right, so we ended coming here by the US dollar yen. We are still right here. We settled above this big pivot right here, above this high. So we made a lower move low and a higher move high. This is not bullish, but what it is setting us up for maybe a challenge of this downward sloping resistance line, or at least a sideways to higher trade over the next few sessions into the next week. This has had a big bounce, as you can see how this one here accelerated. Look at how big, strong this rally was. It hung out for a couple days, and then it's been trending lower ever since. Is that going to be the case right now? Who knows? I do believe that as long as we can hold trading above a dollar at 103.90 here, 104 even, that you're probably going to see this market drift sideways and try and make a challenge of this downward sloping yellow resistance line. Not much upside am I looking for, but like I said, I think in the short run, you have a good chance at going sideways to higher. We have the Australian dollar, US dollar here, which is just continues to hang under its highs. This thing is such a bull. Now, here's the thing about the Australian dollar. You're going to start to see, I think, in 2021, a major divergence in currencies, meaning that let's say we have a pound and euro sell-off because of the economies slowing down over in Europe. Okay, that would shake up that trade zone. That would be that would impact the dollar, would impact the Swiss, it would impact the pound and the euro. However, the Australian dollar, Australia and New Zealand are commodity countries. And right now, we have a big, you're welcome, Jericho. We have a very big rally going on in all of the physical commodities, meaning that you have coffee that's rallying, you have natural gas that is going up, gasoline is going up, oil is going up, wheat futures are going up, corn futures, soybean futures, live hogs, live cattle, gold, silver. Now gold had a little sell-off, so did silver, but if you look at copper prices right now, it's insane. Now, you got to realize that because Australia and New Zealand are commodity countries, meaning commodity driven, that's what their biggest export is. So that being said, this is impacting the Australian dollar because so much is done in Australian dollars when it comes to gold and what have you. So because gold is strong and because oil is strong, because all these different things are rallying, that means that Australian dollar has some credence to remain a bull versus the dollar. So I would be very careful of any sell-off in the Australian dollar, US dollar. It would be only if there would be big problems in Australia, such as with their economy or something like that. The slope of this rally is fairly steep. It could be a little bit more, a little lower of a slope would probably give it a better chance at being a nice strong bull for a longer period of time. But this thing can start to go sideways, bounce off of it, and just continue higher. Like, it looks like it's going to continue to do so. I would look, if you're going to buy this thing, I would wait for a slide and then wait for a buy signal. And I would really, really use caution trying to sell into this thing. The trend of this market has been swallowing up the bears for a while. I mean, you never had a chance to make money on the short side on this market except for a couple times in the past 2 months, like literally. So I'd be very, very cautious. The fact that it didn't make new highs on Friday and it's just kind of holding while the other ones seem to be more correcting, that just gives credence to the strength in the Australian dollar, US dollar. Let's see, do you think copper will become worth more than silver? All right, you know what? That's a really good question, and why don't we take a look at that? So when you go on the forex-trading-unlock.com website, you go to markets, and you go to, since that's a commodity and you want to look at the metals, we're going to go to commodities, okay? So we're going to take a look at copper and silver real quick. These do have an impact on the currencies. So, very, very good question. I like it when I get questions like this one. Okay, so here we have our metals chart. So we're going to take a look at copper real quick. All right, so we are pulling up the copper chart. Now, I don't know, Johnny Garb, if you're familiar with TFNN.com. They're my guys down in Florida. Every Wednesday I do a Forex spot for them. But the one head guy, Tommy O'Brien, he's a big gold guy and metal guy. And we've been talking about this copper rally already for months. You know, back already in October, where I was saying, you know, with gold and silver going, I'm like, and then with the industrial growth of potentially coming back online in 2021, we were looking at how copper, especially because of supply chain issues, could have some big rallies. Obviously, it has. So let's see what's going on here. So copper on the daily, let's go to the monthly. Now this is the futures. Okay, so this gives you an example of what kind of a move this thing has had just in the past couple of months. So back in March, in just 9 months, this copper has gone from just under, I mean, it had a low of 197.25, and now here it's at 367. Now let's pull up a silver. You want to know more than silver. Okay, now copper becoming more expensive than silver is going to be a little bit tough. Here's the main reason for it, is that silver, especially in kind of like the old school way of protecting yourself from risky environments. I know that the millennials are into buying Bitcoin, but gold and silver is still something that people buy. Silver obviously took a dump, as you can see. Now, here's the thing you have to look at. Okay, so silver, if you look at this, okay, so back around 2011, 2012, look, we had got all the way back up to, we were at $49. Now, silver tends to spike and eventually hits a point where it's not going to grow anymore. But you have the potential right now. Let's just say that silver went from where it is now up to these highs. You're looking at 24 to 48, so you're looking at literally a 100% return. So now let's look on a relative basis. Do I think that copper can become worth more than silver? Absolutely. Okay, so now here's what I mean. All right, so we take copper. Historically, especially going back in the last around 20 years, the high is up here at $4.50, something like that, just over $4.50. If you look at this long-term chart here, we've made consecutive longer-term higher highs and higher lows. This is super long-term. Okay, so if we're at 367 right now, to double would be at $7. And that is very, very reachable. Basically, because if you look at it from here, from this high to this low down here, if we were to project from this low up beyond this high in a super long term, you're looking at copper being up around between $5 and upwards of $7. Could that happen? Absolutely. It totally can happen. And I would say that, see, here's the thing is especially with all of the repairs that need to be done and to catching up on, remember, the United States and the EU have been in big lockdowns for, at least half a year for the most part. There's, especially when schools start coming back online and what have you, buildings that haven't been used really properly are going to have all kinds of issues. You can't just let buildings go idle, let alone warehouses and what have you. So yeah, I think you're going to see a big jump and see copper around $7. So on a relative basis, yeah, do I see copper going to $50 an ounce? No, that would be extreme. And I think if copper's at $50 an ounce, you're going to see silver at $150 an ounce. But I think in a relative basis, you could probably see a higher return. Okay, John, let's see. One, I asked because copper has become harder to get, especially since it's being used in EVs. Yeah, so now then there's a technology aspect. Here's the one problem I have with that one, though, is market's correct. I mean, the more expensive that copper becomes, and they're not going to just replace copper, but they may. I mean, copper can't get more expensive than silver because you would start using silver, and even like a lot of gold alloys and stuff like that. So, I mean, like you still use in especially high-end components and technology and stuff like that, like satellites. They don't use copper in satellites unless it's, well, they do, but they use a lot more gold and platinum. So, but I do hear you with the EV technology. But remember, here's the thing is too, is that whole industry is changing so radically that, I mean, now you're going to have cars that besides, being electric and charge, where you have charging stations either at your home and what have you, now they're going to be able to charge themselves with their own solar cells built into the carbon fiber bodies and stuff like that. Like, the technology is changing so rapidly that I think in the short run, yeah, the run on copper for technology looks like it's a big scare. But then it's also the cost. You got to remember is the more it costs to make something, the less people are going to buy. So there's kind of a caveat there that you have to be. There's a pinnacle point where you're going to have diminishing returns. So that's another thing too, is that you can't get ahead of yourself. All these things have to be made, delivered, and being in use. So, and that's another problem too. But I do like you being bullish overall. I think that your outlook with the technology idea is on the right side of this trade. But here's the thing is that that's because of technology and construction, and that's where the demand is. And now this is where copper could become an issue, is you have coppers being mined. A lot of it comes out of South America, okay? With the plummeting dollar versus a lot of these South American countries, that is driving up the price of copper as well. So it's not just the fact that there's been a demand function. Like, this whole rally in copper right now that you're seeing isn't because of demand, and it's not because of technology. This is because of a move. That's what's going on here. The dollar's gotten beaten down so much. It's why coffee is going to become very expensive. Companies like Starbucks in the year ahead are looking to have a very, very, very tough time remaining as profitable as they are. That's why they have such a diverse menu, and also, have smoothies and don't just sell coffee anymore, because coffee itself is becoming more and more expensive for them, and there's no way to hedge themselves out of it, because it is what it is, So, all right, cool. So we got those questions answered. Back to the Australian dollar, which we were just talking about. So as you can see, it's hovering below the highs at 78.19, and like I said, it has to break out one way or the other. I think above it, you can't fight this bull. If you're long, I would say keep your stops below 76.43 here. Anything in this territory sets us up for sideways to lower. New Zealand dollar, US dollar is also looking a little bit like it wants to at least pause for the cause. This here actually is a sell signal. We have what is called a three inside down sell signal here. This is a 3 pattern sell signal. It's a high probable Japanese candlestick pattern. Let me write this down here so you can see it. 3 inside down sell signal. All right, so for the Asiatic trading zone, we do have one market with a sell signal, which is a 3 inside down sell signal. Where does this have us targeting? Well, initially it would be this upward sloping medium trend line, cutting the trend and holding it up, and is not that steep of a slope. So even if we were to fall through this, I think you would have something like, this, where it's more like by attrition, by time, or just slightly falls through it, and then it wraps back up and sweeps back up again. this is also in a similar situation like the Australian dollar is. I would be very cautious. Anything that takes out the high from Wednesday here, 73.19, anything above here, this thing is a bull. You cannot fade this thing. But right now, this has a short-term sell signal. Does that mean that the Australian dollar is going to go with it to the downside? Maybe, maybe not. I think that you got to still take this one on its own. New Zealand is not Australia and vice versa. They're in similar situations, but Australia, I think, is a little bit more reactionary to China and some other things, whereas New Zealand is not quite as heavy weighted on that. Gives them a little bit more leeway. And then I think also you got to realize that dollar strength, if it is coming into the market, probably would have more of an influence on the New Zealand dollar than it would on the Australian dollar, especially in the midst of a major commodity rally that's going on right now. All right, now let's go to the U.S. dollar, Canada, come to the United States, and now we'll see what's going on to the northern border and then the southern border. So U.S. dollar Canada had a little bit of a bounce, just like the other currencies, but pretty neutral to lower. This thing is a bear. It's been trending lower for a long time. It made lower move lows this week. Anything to the upside right now is considered a correction. This downward sloping resistance line, even if we get through it, I think it'll be more from sideways trading going into February than a rally. Only if we get above $1.2964 do I see this market even remotely going up to higher levels. All right, can I do the NZD-JPY? Yeah, Johnny, I can totally do that. So we got the Canada. There's nothing really there, like I said, except for those pivots. So NZD-JPY. All right, this one is for you, Johnny. NZD-JPY. All right, this one is a major bull. Okay, so this is interesting because I'd like to know where you're living because you're trading cool crosses. Most people don't, definitely in the United States, don't talk about crosses like this. New Zealand dollar, Japanese yen here, you can see the strength. Now, this is kind of, you can see kind of why this trend is evolving this way, and it is so strong. The New Zealand dollar is strong versus the dollar, okay? And the yen is strong versus the dollar overall as well. So normally you could look for weakness and strength there's a triangle of crosses. So in this case it would be the New Zealand dollar, the yen, and the U.S. dollar. But how do we find out New Zealand dollar JPY? Like how much of a bull is this thing? Okay, well the key to this one is to go and look at the NZD versus the euro. Okay, so we have strength in the New Zealand dollar versus the euro. It's been going lower, trending lower, but in the short run, it's been a bull over the past week and a half. So let's look at the New Zealand dollar versus the British pound. New Zealand dollar versus the pound, same thing. It's gaining strength, it's starting to look very strong. Now let's look at the New Zealand dollar versus the Australian dollar. And the reason we're breaking this down, oh, you're in Florida. Okay, Johnny, cool. So if you're in Florida, you might know those guys from TFNN.com. They're pretty popular down there. All right, now we have New Zealand dollar, Australian dollar. Now this is where it's pretty neutral. It's very, very neutral. It's kind of ironic how New Zealand dollar has been trending versus most currencies and swinging just like the Australian dollar, but against each other. So that's because they're pretty much locked in the same environment. They're both commodity countries. They're both often, well, not in the middle of nowhere, but I think you know what I mean. So, all right, so as far as here, this one doesn't give us any indication of strength. It just pretty much has it, but doesn't have it as being weak either. So then we go to New Zealand dollar versus the Canada. Remember, to Canada, they're very close to us. All right, so New Zealand dollar is being strong versus the Canada. So, okay, so let's look at these currencies, where the strength is and where the weakness is. So you like the New Zealand dollar, yen, okay? So as far as strength for the New Zealand dollar, that is there because any other major currencies, for the most part, it's very strong. So now we got to look at, let's go back to the US dollar JPY again, just to take a look at this to remind you where the strength is and where the weakness is. So US dollar yen, and this is on a monthly, okay, on the daily. Here we go. So here we have the strength here in the US dollar and the yen. Now let's just do JPY over euro. We're just setting the cross to find the strength and the weakness. So the yen is strong versus the dollar, and the yen is weak versus the euro. Okay, so that means that the yen isn't necessarily, I mean, it's a flight to quality currency, but it doesn't mean that it's a totally strong bull. So if the yen is weak versus the euro, and the New Zealand dollar is strong versus the euro, remember? So New Zealand dollar, euro. So once again, if the New Zealand dollar, or if the yen is weak versus the New Zealand dollar, and then we have New Zealand dollar strong versus the euro, if the yen is weaker versus New Zealand is stronger than the euro, then the New Zealand dollar, JPY, will probably continue its trend. So I would say that you're seeing it spike here. I would be careful about selling into this. I think that's probably what you're looking to do, is to short it. The strength is in this market, so I would look to buy a dip. If anything, probably look for, let's see, find the 50% here between, oops. Why am I not getting, running a little slow here. Okay, there we go. So just eyeballing it really quick. Yeah, okay. There we go. So yeah, down in the 74, 171 area. This would be a good little correction. So if you're short, I would say this would be a nice short-term target to the downside. This here, this low, would be your key breakout level to the downside. If we take this out, that's a lower move low after a lower move high and a big spike. Markets go out like they come in. This is a pretty strong rally. I could see it at least correcting into this area. So, let's see, maybe, let's see. Yeah, there's no, I mean, longer term, I guess we could go down to here and see what you would get. Well, yeah, see, this area comes right into a 0.236 area. And this low here, this critical low here, is right around a 0.382. So harmonically, yeah, you could see the market get back down into this. If it took out this area back down to 72, I don't think it would get below 71. But yeah, I think right now I'd be very cautious being a bear here with this New Zealand dollar yen. You might see a couple-day break, but I don't think it's going to last for very long, at least from what we looked at. Remember, the best indicator for any market is the market. So looking at those crosses, the strength seems to be in the New Zealand dollar versus the yen. So now, if all of a sudden there's a major move in the yen, and here's the thing is, the Japanese aren't exactly making waves when it comes to the world of finance the past year. They're very stable. They're trying to ride the coronavirus thing and trying to just get output back online and have people, buying stuff because that's what they need. They're an island, So, and it'll be interesting to see how things pan out. The good thing is they're stable. They're probably one of the most stable currencies out there. So the trend, like I said, is pretty reliable, and that's what I would stick with right now. Okay, so I think we got that one. Now let's go back to US dollar, Mexican peso. So for one last little thing we're going to look at here, we're going to look at the US dollar, Mexican peso. We had a big buy signal on Thursday. We had a bullish engulfing line. So this thing has been beaten down for months. I would not try and catch a falling knife. I think that you're going to see a short-term bottom here. Now here's the reason why. I'm going to go with, besides the fact that this is a bullish, and oops, forgot a letter here. The letter B, all right, and engulfing line. And this is a buy signal. All right, so here we go. All right, so why would the US dollar Mexican peso maybe start to bottom right now? Well, what if spring break doesn't happen? I'm just saying, okay? Is there traveling to Mexico? Yeah, there's traveling to Mexico. Is it going to stay? Well, they may not allow us to come into the country. It depends. It depends on how coronavirus grows, especially with the new strain. And I think that you're going to have to see wave 2 because that's just what's going to happen no matter what. Doesn't matter what your take is on the situation or how the world is going to handle it, but lockdowns are. So, and if that's the case, it's going to be very hard for the U.S. dollar Mexican peso to stay where it's at, meaning that while everything was looking like travel was going to open up and what have you, the peso went from, up at around 24, 23 pesos back down to 20 pesos and bobbling around in this area because everyone's like, oh, people are going to Mexico. They're going there for Christmas. People are traveling. Well, yeah, but how much? Not very many. And the question is how many college kids are going to be traveling to Mexico for spring break? To pay for it on their own? Yeah, the ones who have to wait for mommy and daddy to pay for it, well, there's probably going to be all kinds of issues with that, I'm sure. So I think that could be the spike. And we're going to see how this is going to be with the dollar. I think we'll find out over the next week or two, once the election has been completely done and we have a new president in the United States, then we will see whether or not what kind of lockdown measures are going to be imposed. Should they be what they've already stated, you're going to have a 150-day mandatory federal mask ruling and lockdowns on a bunch of businesses and restrictions. If those things are closed, people don't have jobs, people don't have money to travel to Mexico. It's just that simple. So, and they rely on the U.S. tourism and U.S. dollars. So with that being said, I think you're going to probably see the Mexican peso continue to grind its way higher, back up to like 22 to upwards of 22 and a half pesos to the dollar. So if you were planning a vacation, the good thing is you'll probably be able to buy your pesos at a better price in the next month, 2 months, as we get towards spring break time. So for those of you who are going to go, I think you're going to arguably get a cheaper rate on your trip and be able to pay for more with less money because of the conversion of the dollar and the Mexican peso. This would also kind of have to mean that there's a little bit of a dollar rally, which the dollar has been beaten up so much as we make a changeover into the new president, and especially since we went over this with the metals and also the interest rates, that we are going to probably see more buying of dollars just because of and as we move into the next month or two. Are there Chinese currencies on Forex? Well, there is the yuan and the Hong Kong dollar. So, in fact, if you go to our website, forex-trading-unlock.com, when you go to, oops, not this one. Wait, we got one already pulled up. So let's go to here. Okay, so we'll go to here. All right, so we go to markets again, and then you go to the Forex thing. And we'll just skip over this ad. Okay. So this Forex page here has all the markets where you can just click on the different currency crosses versus each other. You just got to toggle down. So for Hong Kong dollar and the Chinese yuan, we have these. So as you can see, the US dollar, Chinese yuan has been in a free fall. We'll get rid of that and make it a little easier to see. So this is the Chinese, and then we also have the Hong Kong dollar. Okay, Hong Kong dollar. It's loading up. Now, as far as can you trade these? Absolutely. I don't know what broker you have, and so there's limitations. I know that there's no futures on it. It would only be in the cash in the FX market. As you can see, a lot of volatility in the Hong Kong dollar here. Very, very, very spiky. So I would be very cautious trading this one, that's for sure. And then here's the other thing too: is when it comes to Chinese currencies, they fix they're not free floating currencies, and they are what they basically say they are. So and that's a whole nother story of whatever. Here's interesting to look at though. Look at the obviously the Chinese yuan and also the Hong Kong dollar are radically different. I mean, the Chinese yuan has a much more stable trading over days and months than does the Hong Kong dollar. But then remember, Hong Kong has been in complete chaos for a year, so that could probably have something to do with it. But let's look at the monthly, just to get an idea of strength and weakness. U.S. dollar, Hong Kong dollar, you can see. All right, so just in 2020 alone, we dropped huge. That was just monstrous, this drop in value. So, and here's the irony of it all is that because of this big drop like this and this big drop like this, all the goods from China become more expensive. Isn't that great? So the Chinese aren't exactly, I'm sure, liking the fact that the U.S. dollar is tanking right now, or has been for months, and that their currencies have been relatively super strong versus ours, because that means that while they've had, I wouldn't say trade restrictions, but now that there's fairer tariffs on Chinese goods, with the compilation of a weak U.S. dollar, that means that everything from China has gotten super expensive. How about that one? Huh? Pretty interesting. So we'll see how this impacts the currencies as we move into 2021. It was nice to actually get some good questions like that, Johnny Garb. Thank you very much. So, but yeah, the Chinese currencies, as you can see, they've been overwhelming the dollar as well. And who knows, maybe we're starting to find, I mean, this is a big drop, so I don't know. Who knows, maybe we're going to start to see a rally unfold. Remember that currencies trend, and we do have a new president coming in, well, I guess supposedly 11 days. We'll find out. So New Zealand dollar, JPY, we looked at that. Let's go back to the Euro US dollar just to end and remind you that we do have the one sell signal here, bearish engulfing line, and this is going to be a key one. If the dollar index is going to get a bounce, and this is what we didn't even look at, let's just do this on an end note, it's going to be because of a turn in the euro and the pound. And then the one thing we have going on here is that in the dollar index, we have a bullish engulfing line. All right. So, does that mean we're going to have a big bounce in the U.S. dollar? Who the hell knows? No, but no, I think we are going to have a nice correction that's going to probably follow through for the next, I would say, half a week to a week. And like I said, it's a correction. So that's all that we are looking for right now. It could be the very bottom of the dollar for the next 2 years for all we know. But right now, it is just the start of you'll see how bullish this dollar can become, or whether or not we just can get, who knows, maybe it's profit taking. You know, you got to realize you got all these markets are overheated already. I mean, and we're just into the first, we're heading into the second trading week of the year. So we'll see how things go. Let's see. With that, I'm just going to remind you real quick once again that if you haven't subscribed to our YouTube channel, to do that, please, and pass it on to your friends, and check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And for those of you that are still listening, Johnny Garb, this is you, and maybe Jericho, if you want to check out this book for free, starting on Wednesday the 13th through the 17th for 5 days, you can get the Kindle version for free to use for a month. So you'll be able to check out the book and read it if you want. It doesn't cost you a Hello everyone, this is Teddy Keckstaff from Forex Trading Unlocked, and we are here with a Forex market analysis for the week of January 17th through the 22nd. So we have a lot of interesting trading signals going on in the market. So real quick, let's just get to our disclaimer to remind you that this webinar is for illustrative and educational purposes only. And just to let you know also that please, if you subscribe to our YouTube channel, if you have not already, Forex Trading Unlocked. And also, there's a book called High Probable Japanese Candlestick Patterns that I wrote that right now, if you go on Amazon.com, you can get the Kindle version for free for 1 month to check it out. So that's available today and today only. and there's also going to be a bunch of high probable Japanese trading candlestick patterns that we're going to be going over. So right now we have the forex-trading-unlock.com website pulled up, the workstation page, and we have the dollar index, which check this out. So we had a buy signal the other day, a bullish engulfing line buy signal. Now, what is significant about this signal? Well, it's one of the strongest signals that you can get after especially a long trend in either direction, going up or down, as far as being an engulfing line. Now, where is this going to go? How much of an impact can this have on the dollar index? Well, let's just take a look at this last high up here and bring it down to here. And let's pull up just on a Fibonacci basis. If we go on a Fibonacci basis from this last low and we get a decent correction in the dollar, which remember, the dollar has been beaten up for a very long time, and I know that I am not necessarily a dollar bull, but when you've been going down for basically a year, usually you get a nice little corrective bounce. We've had a couple, but not very strong. So anyhow, right now we have this little target area that we're fixed on right now. Is for our upside target zone for the dollar index. So this is our 50% level. This is our 0.618 Fibonacci line. From this current big wave down, we have this bullish engulfing line. Now, if you read the book, High Probable Japanese Candlestick Patterns, this is not how you set your targets. This is a longer range, kind of just trying to figure out how an index, because this is not an actual currency, it's the weight of the euro and the pound predominantly, and then obviously all the other global currencies. So speaking of that, let's get into it and see what kind of signals we have going on right now. All right, so we have the euro US dollar. We had a bearish engulfing line sell signal that was triggered a little over a week and a half ago, and Friday of this prior trading week, boy, did the market end on its butt. Now remember, we have a holiday market in the United States where we have some limited trading for certain markets on Monday. So as the world comes online on Sunday for the Asian and European markets, it'll be interesting to see how much volume and volatility we really have in front of that. So I would expect most of your trading action to occur probably from Monday night into Wednesday as we head into the inauguration in the U.S. After that, then we'll see, once the inauguration is over, what kind of reaction we get in Asia and Europe with their markets, and that will probably set the tone for the dollar for probably at least a couple of weeks for direction. But right now we have this bearish correction. We have taken out this upward sloping line. Now remember, the euro US dollar had a big move. I mean, from November up into the beginning of 2021. It had a move from $1.16 all the way up to $1.23 plus. So that's a huge move in just a short amount of time. That was a bigger range, or more volatility and more of a range in that 2 month period than we had in the whole year and a half before 2020. So the market is definitely swinging, and this is why you're getting a big kick in the dollar index. So you've had a nice move in the euro versus the dollar already. It's a 3-handle move already, and it's hanging on support. Now, this upward trend was pretty steep, so I think where we're coming in, especially at this target 1 in the downside target range of around $1.1975, this is most likely where you'll see most of your support come in, at least as far as the way we're looking at things right now. Now, this target number 2 here, $1.1889, I think that's most likely going to be the extreme for any type of sell-off that you have currently, just because unless we got to get through the election and whatever. So the next couple days, I think there's a good probability that we could hit this $1.1975, but I think that absolutely target 2 is going to be the extreme for any downside correction in the short run. Because remember, this is overall a bull. We're looking at a corrective move right now. We are not looking at this as a change in trend. So we have the dollar index that is giving us a buy signal. So that's overall, as far as the index against most currencies, that's giving dollar strength. The euro US dollar right now is showing us for sure lower move lows and lower move highs on an intraday basis, which confirms the short-term trend is bearish. Intermediate term and long-term trend obviously are bullish, that's why we are looking at this as a corrective move. A short-term top obviously is established, and we'll key off of this high up here also as far as our breakout level to the upside. This is our risk right here. Anything above here, it is a major bull again. Okay. All right, so that's for our euro US dollar. Now let's go on to the British pound US dollar. Now the pound, interestingly enough, topped out 2 sessions ago and was not chasing the dollar bulls or running from the dollar bulls like the other markets have. So, but we did have a bearish engulfing line sell signal to end the trading week on Friday. We have 2 downside target areas. This initial $1.3423 down to $1.3351, I think, is the initial support where it definitely has us in the short-term bearish mode. Intermediate and long-term are very bullish for the pound US dollar, but with the increased lockdowns, this may be the beginning of a corrective wave where we're going to start to be neutral to lower. And even though there may be dollar bears out there, I think that we have to see how the transition of power happens in the U.S. this week, but the lockdowns aren't ending in the U.K. anytime soon. At least that's the way the news was looking this weekend with the surge in the hospitalization rate. So hopefully that does start to subside a little bit, because that would be good for everybody and the people. We don't want people getting sick, but right now, the way the numbers are looking, I think that's going to weigh on the pound. We've gotten into 2021. Post-Brexit deals have pretty much come to fruition. Now it's everyone trying to see how they can stay healthy and defend against this unseen virus. So, all right, now let's look at the US dollar Swiss. For the other case in the European trading zone, this had a bullish engulfing line buy signal over a week and a half ago, just like the euro had a buy signal or for the dollar versus those currencies rather. Right now, this is trading under a key pivot level here at 89.23. I think you're going to see a lot of resistance and jittering there. If you see a huge sell-off in the pound, especially and the euro, then I think you'll probably have a good chance of piercing this key pivot level. Closing above it and sustained trading is really necessary, though. So it may be a grind. You got to look at this. We have this low back here. This could be an interference level right here. I would be very cautious right here. This could be very tough to sustain a trade to get through here. So we may spike at this initial 90.26 target zone, but unless the dollar really gets a raging bullish move against a lot of other currencies, I think the Swiss is going to hold pretty steady, and we'll see how that manifests over the next week. It's going to be interesting. Like I said, this week we have a holiday market. We have the transition of power also in the U.S., so it's going to be definitely interfering with global liquidity over the next few sessions, but we have lots of opportunities. Now let's look at the U.S. dollar JPY. Once again, we have another reason why the dollar index is bullish, because we have a nice bounce in the yen. The U.S. dollar yen has been nothing but a bearish trade for quite some time. Let's make this a little clearer. So as you can see, it's been trending, making lower move lows and lower move highs for quite some time. So what we're going to do is we're going to have to key off of this high from last week. If we can get above this level here, then that confirms strength and higher move highs, which would have us targeting this upside target zone here. 105.36 here, I think, is where you're going to start to run into a lot of resistance. It's going to get really toppy and choppy here. If for an extreme, I would say 106.23 is going to put a cap on any corrective move here. Now, does that mean that this market is getting ready for a turn? No, but like I said, the U.S. dollar is due for a nice correction. So this would be a good area for the dollar and the yen to pretty much run out of gas in if there's an extended correction. It may not get there, though. This may right now just be establishing a lower move high. If we get into this upper part of the target zone, that would be higher move highs, confirming at least a neutral market. Overall, we are not bullish the dollar versus the yen in the short to intermediate term, at least right now. There's no real reason to even think about any change in trend. And it has to do more with global politics and everything else, because we're pretty stable with Japan. Interesting here, Australian dollar, US dollar is finally starting to show some weakness. We have a dark cloud cover sell signal that occurred just a little over a week ago. Right now, it is hovering below these lows. So this is tough. Australian dollar, US dollar has some things going for it as far as variables of pricing that doesn't really exist in a lot of other markets. One of the biggest things that Australia has going on right now is there's a boom in the commodity markets, especially in a lot of precious metals and ores that Australia produces. So with the global demand increasing for a lot of this stuff, And with China coming back online, if they truly are producing an output that they say they are, that's strong for Australian economy. As long as there's no big lockdown measures that come into place and their trade with China it continues to flow, it's going to support the Australian dollar. So short term here, we are a bear. We're going to take this here from the high, and we're just going to go down to right around here. And this is where I think you have to just look at this on a basis of this. We're going to put here at the 50% line, and then we're also going to take this a little bit lower, and we'll bring it down to here. And we'll bring it down to this 50% line. So we're just going to give you two downside targets here for this market. It's very hard to say that this trend is going to really be broken for any extended period of time, just because of how bullish it is. And it's not just geopolitical issues. Now, as you can see, it's hovering along this slope here. This is not the steepest slope right here. It's fairly level. By attrition, we're coming through it, not just by breaking markets. So I would say that you're probably going to see the bulk of your trading in this area. Let's move this over here a little bit. Oops. Okay, got to bring this in. Bring it up like this. So pretty much here, where we're in this little zone here, that's only because of the fact that the CRB is holding up this market. If the CRB starts to fall apart, if you start to see gold and silver really start to tank, if you see oil really start to fall back on its lows, if you see especially a lot of the food is also something, grain markets and stuff like that impact them as well. If we start to see a correction there, then I think you'll see weakness in the Australian dollar for a nice corrective slide. Unless there's major dollar strength that comes in for whatever reason that really rams all the currencies, this is one where we're not looking for a lot on a correction. Now let's look at the New Zealand dollar, US dollar. We have the New Zealand dollar, US dollar. We have a dark cloud cover as well. This market here is not on quite the same campaign as Australian dollar. Reason being is that they're not so reliant on China trade as Australia. The slope of this market also is not too bad. By attrition, it would be coming through it, which it has. It has made lower move lows as of Friday, and this is also a very powerful selling day. So I think that what you're seeing here is a little release. This downside target area with 69.14 pretty much being the buffer. I think you're going to get choppy down here. If you're short and you can hang on to this first target level, I would say take your profit and don't get greedy on this one. Now, like I said, if there's a huge dollar strength surge for some reason, that could hammer all the other currencies and blow off a little bit more of a volatility to the downside. But that's only if you have a real strong resurgence in the dollar, which I don't think that's what's going on right now. I think right now it is just a corrective rally in the dollar, which it's every top and bottom starts as a correction. But right now, because of the trend, the overall trends, they're telling us that right now it is just a correction. So let's look at this area right here for any selling pressure to kind of really unload. One of the key levels to really watch out for, I think, would be this last low here. If we fall through here, you got a good shot at hitting this. If it gets below 70.05, 70 even basically, you got a good shot extending the downside momentum to 69.14. Aggressive bears 68.22, but keep your stops tight. And once you get down to 69.14, definitely use 70 even as your risk to stay, because you do not want to be long in case you get a slingshot back. This market could be, here's the thing is if this is only a dollar correction, which it's being viewed as, once it does start to bottom, just like you can see now how it's really turned really fierce, all these currencies gave signals within days of each other and are all helping to lift the dollar index right now. It's because it's been beaten down for months. So we'll see how this manifests over the next couple sessions in the next week, but that's really where we're looking at right now. Now let's look at the North American trade zone, US dollar, Mexican peso. We got spring break coming up. I'm sure lots of people are wondering, like, is it going to be cheap to go down to Mexico? I don't know. Be lucky if we can go to Mexico. First of all, we've got to hopefully get everything opening up. So, but what we do have here is a bullish engulfing line buy signal that happened. The low from the prior day is your risk level down there at 19.60 pesos to the dollar. This market could really go sideways for the next couple months, and it would not be surprising. We have a buy level here of 20 pesos, or even basically. Right now, it's a losing trade, our risk, but it did not fall through our risk level. So right now, we're still long this trade. We're looking for another rally up to this lower target zone, around 20.5 to 20.79 pesos to the dollar. It would be not the hardest thing to achieve. So if the dollar continues strength into the next week or two, I would think that you're going to have a good chance at seeing this upside target zone be reached. That's probably all you're going to see, because then we're coming into spring break time, and like, let's put a little vertical line. Let's just go from mid-March into the end of April here. This here is spring break time. So from here, I would say you're most likely going to see us buffer off this upper zone here and then stabilize around 20 pesos to the dollar. So we do have a buy signal in place. Aggressive bulls right now, you don't have very much risk. You can buy the peso at 99.77 and you're risking 99.60. It's not a lot. So for aggressive bulls, you're getting another chance to buy in at this buy signal. One thing about bullish engulfing lines and or engulfing lines in general, where they get you into the trade, you've already hit a big gush. So sometimes the market retreats and gives you a second chance to buy in before we take out another wave higher. Now, one of the key levels to watch out for is the high from last week. Anything above here confirms our upside breakout and our buy signal and has us pushing into this upside target zone. So we'll see. Once again, it is going to be a holiday market starting off the week in the United States, which will probably slow things down. U.S. dollar Canada, look at this on Friday. Finally, a bullish engulfing line buy signal. Now, this is where I really am starting to say that you probably want to watch the dollar continue its correction kind of in a grind of a way for the next few sessions until we have the inauguration pass. Once that happens, who knows it's going to be very volatile. But the short-term trend in this holiday trade, I would expect this little bullish buy signal to happen on Friday to get some follow through into this key resistance area. We have this last high from last week that we need to get above. This $27.90 to $28.30, I think, is the huge area to look at with this key pivot, which is just above it. So if we can get above here, which I think it's going to be tough, this could be what holds back this bounce, and as we go sideways. But the U.S. dollar Canada has been in a free fall for a while. A breach of this area, this key resistance area, definitely would have us on a rally campaign and looking for a corrective move that extends all the way up to $1.30.06, and then it'll probably be touch and go if there, like I said, if there develops a very major bullish move and momentum across the marketplace, then you might see some of these signals hit extremes. Otherwise, I think you're going to stay at some of these lower target ranges first. Let's see how they react, and then look for further follow through after that. So once again, the Euro US dollar, it's when it started all this stuff, it's the biggest weight in the dollar index. And as you can see, these other markets are coming in line with that, where they're starting to pull back versus the dollar. These could all just be profit-taking corrective moves. Remember, right now, we're not looking for a bottom in the dollar and a big dollar bull to come back. We're just bullish the dollar in the short run as we head into the next trading week and into the transition of power in the U.S. Once we get through Wednesday, and it will be, a crazy week for sure. But after this week, you're going to start to see stabilization. We will be able to start to have direction for sure, because the election is over, the transition of power is over, and then shabam, we can get back to just focusing on currency movements, geopolitical things. Brexit's over, folks. Remember Brexit? We talked about that for years. So we are done with those topics. We are moving on, which is nice. And remember, once again, since you listened to this presentation with all these high probable Japanese candlestick patterns, Check out the book on Amazon.com in paperback and Kindle versions. And to thank our listeners who are checking out this video today, Sunday, January 17th, you can get this book for free in Kindle version for 1 month to read. So check it out at Amazon.com. We really appreciate your time. Once again, this is Teddy Keckstedt from Forex Trading Unlocked. Good luck with your trading, and we are here on January 25th, 2021 for the last trading week of January. For a Forex market analysis, we're going to give you a breakdown of what we're looking for Monday through Friday of this week. We have a bunch of trading signals to go over. So here's our disclaimer, just to remind you that this is for illustrative and educational purposes only. So now let's get down to one little plug. Please subscribe to our channel, Forex Trading Unlocked, on YouTube and Twitch if you haven't already, just so you know that when we're coming up with live stuff and when all our our new trading signals are going on. And with that, let's get to our live active screen. We have the forex-trading-unlocked.com website pulled up with the workstation page all ready to go for you. All right, let's see. We have the Euro US dollar chart here. Let me make it a little bit bigger here. Oops. Alright. Let's see. There we go. Okay, I think you can see that a little bit better now, right? Okay, so how often do you trade? Well, I let the market come to me. That's the question here from Spondy on Twitch. Well, when you see these signals go off, that's when I trade. Otherwise, I don't force anything. You always let the market come to you. So let's see what's going on here. So we had a bearish engulfing line sell signal that was triggered earlier in the month. We came short of hitting our downside target area of $1.1975. This is our target 1 and target 2. Now, interestingly enough, we did have an hourly sell signal that was triggered last week on, what was it, Thursday into Friday, that did come into fruition today and is ending. So right now the euro on its hourly posture is very weak today. So as well as the other currencies, the dollars are getting a little bit of a boost today. So we are looking right now at this as a beginning of another wave lower. So we're looking for this low from last week to be taken out here. This will be kind of a critical pivot for you to watch out for, as well as the high that was set on Thursday of last week. So this $21.96, this would have us getting a little bit more bullish again in the short run, but right now medium term we're neutral to bearish in the short run. We're looking for another test of support down to this $20 half area right here. If we can fail and take out this low, that means a lower move high will have been established, another lower move low, which is indicative of what? A lower moving trend, a bear market, and lower moving trading prices. Let's see, Broken Doctor's in there. Hey, how are you doing, man? If you guys got any questions as we're going through this stuff, you just leave them here, and then we will get to them in this webinar. So we're just reviewing the Euro US dollar right now. We still don't have anything really going on with it except for a short that we had already in place on the daily. Let me show you this once again. We have a daily position that was taken in. This was already over a week and a half ago, where we sold $1.2268, and we have $1.22 even as our stop in. So we already have a profit on that one. Our hourly trade from last week, that one already was hit today. We hit both our initial targets here of $1.2133 and $1.2194 or 19 rather, excuse me. So with this bearish action on the day, I don't know if for the rest of the day, I think we might probably be riding the lows to neutral trading. I wouldn't expect very much action right now. We do have some numbers coming out the rest of the week and some news that we're kind of hanging on, especially like what's going on in Europe with between the EU and also the UK with their lockdown measures and stuff like that. So I would assume we're going to see a little bit more under pressure. And now that we have that little lead up, let's go and look at what's going on in the rest of Europe. So we have the British pound USD dollar. All right, we had a sell signal on Friday. This is a dark cloud cover sell signal. These sell signals that I just went over in the euro and now this one are high probable Japanese candlestick patterns, which you can learn how to trade if you read the book, High Probable Japanese Candlestick Patterns, available on Amazon.com. So anyhow, we are getting follow through to the downside. They tried to lift this market higher earlier today and failed. So the way I'm looking at this is still an overall bull in the long term, medium term, and the short run. This is a counter trend sell signal. Now, you always want to trade the action, not the reaction, so be very cautious, but this is a low risk sell right here, where you risk the high from Thursday. Right here, we're on $1.3745. The sell level was triggered here at $1.3675. So right now you're a little bit 25 pips, 20 pips above, below, excuse me, where the entry price is. We took the signal on Friday just before the close. I would say that the euro one is in a much better position. Obviously, it was triggered weeks ago. If the euro does continue to go lower, then would assume that the pound actually will start to see a little bit of a drag. Now, this market is due for a correction. It doesn't mean that I'm bearish the pound US dollar. I think you're going to notice that 2021, we're going to have a lot of trade zone issues where that's what's going to dictate the direction of these different currencies, where it's not going to be just a coronavirus trade anymore. So you're going to have the European trade zone, your Asian trade zone, and also your U.S. trade or North American, South American trade zone. And you'll see this as we get into these other markets. So, all right. So the British pound US dollar, right now we're looking for it to break down to this $34.37 to $33.63 area here in this downside target area. This key pivot level at $1.3524 is huge. Should we take that level out, we're very likely going to hit this downside target area. Will we reach this upward sloping support line that's been holding up the trend? Maybe, maybe not. This is not a very steep trend, so by attrition, we can start to come into it. I think the big thing is that if we take out this key pivot level, that confirms a higher move high and a lower move low, which definitely puts the short-term trend on neutral to pause and definitely has it leaning on support. So we'll be watching this trade. Now, if this market gets above $1.3745, all bets are off. The bulls are in motion, and it's going to be a grind. So it's a tough long. So if you're already long right now, I would say this key pivot level, this is your risk level if you're long. If we make higher move highs, it's probably going to be a grind higher. To the downside, I think that's where you have your most reactionary of a trade that can develop in the short run, especially if we get a short-term turn. I don't see this market stretching the bull like it has, or as strongly as it has. I see it being more of a neutral trade as we head into the next couple months, unless the lockdowns really start to hit the UK, which they're all in a little bit of a crisis going on there. There's a big wave in the bond markets across the globe that is starting to shake up where currency pricing is going to be. So no matter how bearish you are on the dollar, which most of the world is, the reality is the economies around the world are in a lot of jeopardy. So, and there's a lot of debt that's is a part of that issue because of the fact that there's a lot of money that hasn't been paid over the past 6 months, going on a year now in a lot of parts of the world. So we'll see how that impacts the currency prices as we go along. We're just looking at it technically. All right, we had a bullish engulfing line buy signal in the US dollar Swiss trade a couple weeks ago in the beginning of the month, and now today, look at this. Now this is significant. When you have the Swiss, which is, you have your three flight to quality currencies. You have the US dollar, you have the Swiss, and you have the yen, for the three different trade zones. The fact that we don't have that big of a move in either the pound or the euro, but the Swiss has a big rally, that's a show of strength for the dollar. We fell off of these highs last week. We've been buttoned up, but we couldn't get above this key level of 89.23. This is a good area that if we breach this week, we could see a challenge of this 89.78. We have this upside target zone. This is a medium-term directional target zone. We're not looking for this to rally in a couple days. This most likely, should this be a bottom here, and you already have a potential inverted head and shoulders going on right here, which makes this key pivot level huge. We get above here, odds are we're going to have a breakout that should get us up into this upside target zone. But you're looking at being into March, maybe even into April by the time it gets there. I mean, I don't think you're going to see a rally like this, how this slid here. I doubt you're going to see a big rally like that.
especially if the pound and the euro don't start to really hit bang new lows. Now, if the pound starts to collapse and the euro starts to really hit new lows and takes out our lower target zone, then there's a good chance that for sure we'll see the US dollar Swiss maintain a probably neutral trade once it gets into this area. We're not looking for any run at parity or any major dollar strength, but we are looking for a US dollar rally when it comes to the European trade zone. Now let's go and jump over across the other side of the water. Oops. Okay, let's see. Okay, now we got the signal in right. Okay, so we had a piercing line buy signal that also occurred in this market at the beginning of January that is continuing to give us something to look at. This market overall is a long-term bear. We are just short-term looking for this correction to continue, especially after last week's little turn of events. It's higher today, not as much as the other markets. Remember, we were saying how with the Swiss, that's a flight to quality currency. So is the yen when it comes to the Asian currencies. So this one right here, it gapped open higher. It did come and fill the gap today, so that's good, and it's staying positive. This market, after making a lower move high, made a higher move low. So this is the low that you have to watch out for, the one from Thursday. If we fall from here, odds are this bearish market continues to go lower. Trading above $1.331, though, however, keeps this market very positive, at least where it should start to continue to batter resistance. I don't think it's going to be an explosive rally, but I got every reason to believe that, especially if we take out this 104.41 area, that we will gradually make our way up into this upside target zone here. This is probably the extent of what we'll see. We're not looking for any major bull, but the dollar's been beaten up for quite some time, and it's looking, I think, right now set up for a nice corrective move in the dollar for the next few months. All right. So we have the dark cloud cover sell signal that happened in the Australian dollar. The thing that's holding up Australian dollar, I think, is commodity pricing. You have to realize that since it made this high, it made a higher move low, a lower move high, a lower move low, a lower move high. So that means it's already in a neutral category. This is the area we're looking for it to come down to because of the commodity factor and pricing there. Even no matter how strong the dollar is, it's going to be hard for the Australian dollar to gain strength. So we are negative. We are looking for a failure here of 76.41 to confirm weakness. 74.07 down here is about the extent of our corrective slide if we get one. It has been a fairly steep climb just in the past couple months, even though this has been in a rally for a year now. And that's the other thing too. Like, we're not trying to call a top. You never try and call a top or a bottom. But for a short-term neutral to corrective period, it's very likely that we could be heading into that, especially as now that we have a lot of Brexit overs, U.S. elections are over, et cetera, et cetera, et cetera. Excuse me. So New Zealand dollar, U.S. dollar. Now this one, ironically, after making a higher move low, made its lower move high, lower move low, lower move high, and it's still looking a little bit worse than the Australian dollar. This is probably because of the dominant trade that Australia has with China and them gobbling up their commodities and with the pricing of things right now. New Zealand is also commodity driven, but it's not under... it has a little bit more reason to have a little more volatility. So as far as being such a tight trade, I think that this downside target area here is a little more likely to see a sell-off here. And should you get the New Zealand dollar down in this area, then the Australian dollar probably won't be hitting the dollar or being hit as hard by the dollar. If the New Zealand gets down to here, I would expect this to be a very good target zone for it to bounce off of. This was a steep trend. You can see that we've taken out already one trend line here with where we had this low and then this lower move high. Now we made this lower move low. We fall through by attrition no matter what in the next couple days, just by going sideways. But this next low is key. If we take out this low here from last week at 70.89, I think you're going to see a nice little pop, hitting support rather. All right, now let's look at the U.S. dollar, Canadian dollar. So the U.S. dollar, Canadian dollar, this has been in a free fall for a year. This one as well, we're looking for a potential
I would say more neutral trade than bullish trade. Here's another reason being commodity prices are going up, oil especially being one of them. Now we have this issue with the XL pipeline. And that's going to take a little bit longer to, I think, really impact the Canadians as well as the U.S. But it is impacting things. Dollar strength is going to be rough against the Canadian dollar, especially as we start cutting production of oil and we keep doing what we're doing right now in the past couple of weeks. So that's probably why you're getting this lift. I wouldn't expect a major rally in the U.S. dollar Canada. This is the key area to get above. It's a little jumbly, this band, $1.2841 down to $1.2830, or excuse me, $1.2790. This whole area is going to be really choppy. You can see we're buffing up against it right now. Now, the thing you got to take into account is we've been making lower move lows and lower move highs. If we get into this band, we come off of a lower move low and we make a higher move high. That doesn't make us bullish. It means we're bullish in the short run, obviously, but I'd say most likely you'll see a neutral trade develop. Now let's look at the U.S. dollar Mexican peso. We had a buy signal here triggered a few days ago. This is a bullish engulfing line back here, and boy, did it pop. This is the one reason why I think you're going to see more of this dollar correction is solid. This currency has beaten up the dollar for the past few months as well, and this was on a tear against the dollar before coronavirus. But then it got all the way up to, what was it, 25 pesos to the dollar back in the spring. Now here we are riding these lows. I would say in front of spring break and whatever, and the fact that there's the surging of coronavirus is less likely to have tourism going to Mexico. So I think that you're in the short run, you have a really good chance at hitting this upside target zone. We're just below these two key pivots here at 20 pesos, 20.26 pesos and 20.39 pesos to the dollar. This little resistance band here, trading above here, should build, meaning buying momentum would start to fuel a rally that definitely, I believe, could hit this 20.79 peso area. That's when it'll probably run out of gas and go sideways for a little bit. If there is a true rally in the dollar, though, then this would be the reason, one of the markets that will be showing that. We're going to look at the Dixie real quick. So the dollar index, which gave us a bullish engulfing line buy signal back in the beginning of January, so far, as you can see, we made a lower move high, a higher move low, a higher move high, and right now we've made a higher move low. As long as we do not take out the lows set last week in the dollar index, we have a good chance at driving this dollar index up to this 91.73, up to 92.36 as far as the index value is concerned. That would be just in line with what we need to defend this dollar strength, okay? Meaning that the euro, the pound should be under pressure. The Swiss should have a nice corrective move into that one area where I told you we'll probably end up seeing a sideways trade develop, okay? So, and should that occur, I would think that you're probably going to see the same thing happen with the yen, as well as with the Australian dollar and the New Zealand dollar. But we're no longer on that. If you're a dollar bearer, that you are buying all the rest of the world's currencies, there is a divergence. So don't be surprised if all of a sudden you see strength against the Australian dollar, New Zealand dollar, and the yen, and then weakness against the pound and the Swiss and the euro. So, and just also like we have the North and South American trade zones that are, I mean, we're only dealing with 3 currencies there, just like with Europe. The thing is that we will definitely be seeing more of an impact on that trade zone because of, like, you think about coffee, a lot of the commodity pricings. You have a lot of mining in South America. As these things happen, a lot of your lesser currencies like Brazilian Royale, et cetera, are going to impact the U.S. dollar as well. You have coffee prices that are rising, potential bad situation for crops, meaning higher pricing for commodities. Brazilian Royale being a bull against the dollar doesn't help. So, you know, that's where we'll see if these things start to come back into place. And I think you're going to see that where we are going to see that divergence. And especially you're going to start to see there's not shortages because of shortages. It's going to be shortages because of pricing that's going to develop as we head into the rest of 2020. So let's go back to the Euro US dollar. As we started out here, we haven't really had much of a movement on the day. A little bit more positive than when we first started. we'll see how things go with that. Let's see, do we have any questions out there? Let's see, no, you guys have any questions on Twitch? Let's see about YouTube, if you guys got any questions over here. No, no one on YouTube with any questions, huh? Boy, you guys don't have very many questions today, huh? That's crazy. So anyhow, we have all these signals that you guys can look at today. And the question now is what will happen? Well, now remember, today's kind of a quiet day for numbers. We now have finally got the balancing of the inauguration and things like that. So we're going to start to see some stability, I think. And I think we're going to start to see markets free flowing, which means that we're not going to be so reliant on just the mainstream media push of one view or another. Elections are off the table. Now it's about actions. We have a new president. Let's see what he's going to do. We already have seen some action. And it's definitely starting to send a shakeup. It also has put a stop on the dollar bears being able to pound the U.S. dollar. I don't know if you've noticed this, but the dollar bottom, like we showed you with the dollar index back at the beginning of January. So this is not necessarily the beginning of a big bull market by any means, but we are probably set up to where over the next month or two, it will be in the better interest to follow dollar bulls and dollar bears, and especially as certain commodity pricing start to get out of whack. So we'll see how these things develop. Let's see, Broken Doctor, do you do short-term trades? I do, absolutely. Remember I showed you the hourly trade that we had on here. This was a trade that we put on the 22nd. We had gotten short here. What was it? Yeah, around 4 a.m. Well, it was so that was that was in the middle of the night. Excuse me, back on the 22nd. Kind of rode this on Friday. Took a little heat this morning, Sunday night when the market first opened up, but then it fell out of bed with a nice little move. I mean, it was up at $1.2180. Now it's trading at $1.2135 after hitting $1.2111. That's not bad. Short term, with the way it's setting up on the hourly, we are now done with this trade. So in fact, this thing here, hourly trade set up, we can start to erase all this stuff. So yeah, I do short term and long term trades. It all depends on the signal. So for instance, typically I do daily. Hourly I do, but I have a lot more of a systematic method, more of a discounting which keeps me out of more trades and gets me into more trades. So mostly I manage trades though that I'm planning on having on for at least 3 to probably 8 days, sometimes upwards of a couple weeks. I also trade options too and option spreads, so there's time decay that I'm looking to capitalize on. So it all depends, but when I get these signals, that's when I'll jump on them. Like for instance, with this euro US dollar signal, when this bearish engulfing line came in, I shorted this market a couple contracts so I had different targets. So I had these two targets right there. So one's a shorter term, one's a longer term, obviously, trade. The risk was the same on both contracts. At the same time, I also traded in the futures and also some binary options, and I did a credit spread in the futures market as well that I sold, meaning that I took money right off the bat. I knew what my risk was if this market would have rallied, which it didn't. So the credit spreads came out. Those were nice little winners. I already exited those and the futures contract, especially because when we were coming into the election, I didn't want to have that kind of volatility risk. Whereas with the futures pricing versus the cash FX pricings for liquidity. So yeah, so that I think should answer your question as far as how often I trade. But no, I don't just trade just to trade, and I don't just start looking for things for no reason. Like I wait for my setups. I have a plan in place, so when certain signals get triggered, I know exactly how to find my risk, how to define my targets, my trade entry, and then what to do after. It's very robotic, and that's what you have to do and maintain that kind of outlook. So let's see, any other questions? We're 25 minutes into this webinar, so I think we're probably going to lose some people, or no one's going to want to watch it for much longer than this one. So anyhow, since there's no questions, we reviewed all those markets. Oh, actually, you know what? Let us look at one last market. This is something that's very interesting. I know a lot of you guys, you watch the cryptocurrencies. So when you go to our forex-trading-unlocked.com website, when you go along the navigation bar, go down to, this is just a Bitcoin only page. I mean, you can always put the symbol in on any one of the charts on the site. But look at this, it's pretty interesting. So if you look at this on a, let's get the volume down so you can see this. All right, so the middle of January was right around this time here, right before Bitcoin totally topped out. That's when the dollar bottomed. Then a couple of days later, Bitcoin tops out, and since then it made a higher move low, a lower move high, and a lower move low. So this is the opposite of the dollar index right now, almost. You know, like, it's kind of funny how cryptocurrencies, and especially like Bitcoin and stuff that are heavily watched, they didn't have enough time to have enough data to really gauge the volatility and the order flow of these markets. Now that they're maturing, they're still infants, but they are maturing, you can start to look at these things. So right now you can see that the Bitcoin was up higher on the day and now is falling back, and I think that's probably because of the retreat. In fact, why don't we just check something out here? If we look at the hourly, okay, yeah, so the currency markets opened up, and then the dollar had a nice little rally. So this little spike here in Bitcoin is because of the pause now in the dollar as the trading day starts to unload. But look at how it's fallen back from 34. This is a nice little range. This thing trades like a little, it's crazy. So, all right, well, anyhow, we got that out of the way. So for the Bitcoin, though, let's go to this Dixie chart. So here, this is where it bottomed. And then where it made this higher move low, that's where Bitcoin topped. And now, as you can see, this is kind of like this buffering area. It's like the reverse of the Bitcoin chart for this last like week and a half. So a bullish move here for the dollar would most likely mean that the Bitcoin is going to have a little bit of a sell-off. So just to throw that one into here, as I'm sure some of you guys look at the cryptos as well. So anyhow, with that being said, I want to thank you guys very much. We're going to have a couple other webinars dedicated to some of these currencies across the day, and we also have a signal that we're going to put up also to monitor. So hang in there. We will be back in just a little. Hello everyone, this is Teddy Keckstaff from Forex Trading Unlocked, and we are here on for the February 1st to the 5th dollar index Forex market analysis. And before we get into that, we wanted to show you our disclaimer to remind you that this video is for illustrative and educational purposes only. Also, please subscribe to our YouTube channel, Forex Trading Unlocked, and also check out the book, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. With that, let's get into what you are here for. So we have here we go. We have our forex-trading-unlocked.com website pulled up, and we already have the workstation page up, and we will toggle down to our chart of the dollar index. As you can see, in early January, the dollar index had a bullish engulfing line buy signal. That's something you can learn how to trade a signal like that in the book High Probable Japanese Candlestick Patterns. Since that low and that buy signal, the market, the index rather, has made higher move highs and higher move lows, which is indicative of a short-term bullish trend. Momentum is not very fierce. However, with higher move highs and higher move lows, we have to continue to believe that the short-term trend is in place. Right now, we are looking for a challenge of this 90-97 area here, a breakout. Following this arrow would push us up into this upside corrective target zone. The mere fact that if we take out this level, that would mean higher move highs after a higher move low, and stretching this, what I am saying right now, is only a correction. We are not bullish the US dollar overall, but there are some reasons why you would want to look to be more of a dollar bull in the short run over the next, like, say, probably 2 to 5 weeks. Most of it being what's going on with the pound and the euro, and even a little bit with the yen. So we know that we had the Fed meeting last week, and we know that the Fed has a lot of buying to do in the Treasury market. Well, the Bank of Japan confirmed once again last week that just like they've been doing for decades, they're going to be keeping on buying their Treasury bond market, and also keeping rates super low. Then we also have what's going on with the euro in the UK due to lockdown measures and other things that are fueling a high debt load that is just accelerating at a rampant rate, as well as the fact that there's other things that are
making especially the EU very vulnerable as far as we're moving forward and through the first quarter of this 2021 year. The UK does have the one side that the pound has on it is the fact that oil is going up in price. As long as oil goes up, the pound may not sell off as much as the euro. However, the euro, we're looking to press that new lows, which would help to drive this dollar index up towards this 91.73 area. As far as an upside correction is concerned, I think you're going to get capped at most around this 92.36 area. Should we reach the market, reach that area, I think you're going to see a consolidation. Like I said, I'm not overly bullish the dollar, and that would put us into a good area for us to end this correction if that is all it is. So should this current bullish short-term trend be just a correction in the medium term and longer term, then this would be an area where I think you're going to find the dollar index to struggle. You'll probably see a bouncing euro at that point and also a rallying pound. That's if that occurs. We also have an interest rate equation that's going on right now, key off of the 30-year Treasury bond futures. If you see them sustaining a trade above $170, that would probably keep the dollar from really pressing on to higher move highs, meaning that that would help to keep this capped in this upside correction target zone. Should you see a big slide in the 30-year Treasury notes, because we do have divergence between the short-term and the long-term rates, and the reason I'm saying this is because remember that interest rates are a function of currency pricing, so that will impact the dollar index especially over the next couple months as those spreads widen, if they do. So like I said, if you see the Treasury bonds going lower, meaning higher in rates in the market rate, that will probably give a lift to the dollar and also put pressure on the pound, the euro, and the yen and some other major currencies, at least in the short run. And that would give us help to fulfill this little theory that we're going to press this correction up to this higher zone. Should we poke into this area, then I would expect to see a lot of volatility and chopping around. This will probably be your range, this 90 cents, basically 90.03 up to 92.36. I see the dollar index getting really choppy over the next couple months in this area. So that's what we have to look forward to over the week ahead. Like I said, be very cautious and watch this 90.97. If you're a dollar bear right now and the dollar index breaches this and starts making new highs, I would use a lot of caution. So we're going to do individual videos on all the different currency crosses for the week ahead. So we're going to stop this stream, and then we will be coming up with another one in a little bit. But also just want to remind you once again to subscribe to our YouTube channel, Forex Trading Unlocked, and read the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And that way you can learn how to manage these signals in the market as they occur. And I want to say thank you once again. I'm Teddy Keckstedt from Forex Trading Unlocked. You have a great week in the trading week ahead. And remember to always have a plan. And this is Teddy Keckstedt from Forex Trading Unlocked, and we are here for a weekly Forex market analysis for February 1st to the 5th, 2021. Before we get into it, I want to just show you our disclaimer to remind you that this webinar is for illustrative and educational purposes only. Also, please subscribe to our YouTube channel, Forex Trading Unlocked, and also pass it on to your friends in the Forex and trading environment. Also, check out a book, High Probable Japanese Candlestick Patterns. It's available on Amazon.com in paperback and Kindle versions. During this video, we will be showing you all kinds of Japanese candlestick patterns that are shaping up in the marketplace. All right, so with that, let's start our video now. We are at the Forex-Trading-Unlocked.com website. We already have the workstation page pulled up, and whenever you come to our workstation page or any of our pages, you can always tweet them out just like this. You know, you hit that little thing and helps to spread the word about what we got going on here at Forex-Trading-Unlocked.com. All right, so we had the dollar index. The week ended a little bit higher. Dollar bulls are pressing higher move highs and higher move lows. We had a bullish engulfing line that sparked a low back at the beginning of January. As we head into February, we are looking to challenge resistance here at this 90.97 area. Should we breach this level, That would confirm higher move highs and have the dollar index looking for a pressuring move up to 91.73. I think 92.36 will cap any short-term bullish move to the upside. I don't expect this to happen in just a couple days. I think this is something that would probably take about 1 to 3 weeks to manifest. There are reasons that will support the dollar index, and we're going to go into it as we look at these different currency crosses. One of the things you want to look out for is the 30-year Treasury bonds. If they stay above $170, that'll probably make sure that the dollar index will not get any further than this upper range. Should you see the Treasury market start to collapse again and pressure lows, especially if they get below 168 towards $167, that would definitely fuel a surge into this target zone, and then you'll probably see the dollar index chop around this area. Remember, overall, long term, we are a bear, but in the short run, higher move highs and higher move lows confirms a short-term bullish trend. All right, Euro US dollar. This is the #1 biggest weight in the dollar index. As you can see, we had a bearish engulfing line sell signal that was triggered back in the early beginning of January. We have made lower move lows and lower move highs, and now we are chopping around looking for a slide down towards this target area. We have a position where we shorted at $1.2268. And we adjusted our stop down to $1.22 even. We have these two downside targets for both of our trades. 119.75 being the initial one, downside target number 2 being oops, this is the wrong number here. We got to correct this. This is not a 188, it's a 118.89. There we go. That makes more sense. Okay, so this target zone here is where I think you will see this move get pressed into over the next couple of sessions. Especially if you see the dollar index climbing, that's probably because the euro is falling. Now the euro and the UK have a lot of things that have been settled in post-Brexit already, but there's a divergence going on. Oil is helping to keep the pound up. The EU has a lot of things that are weighing on its side in its economic and political divisions right now. Italy's collapsing, their government's collapsing, they're completely broke. Germany's going to have to bail out all these countries, and now without the aid of the UK, it puts a lot more stress on Germany, which is the engine of the euro. So we'll see how this pans out. I would expect to see the euro probably more likely than anything continue lower and make a test of this $1.1975 down to $1.1890 basically. Once it gets down there, that's kind of where the dollar index would be in that little upper band where I just pointed out to you. Should the should the euro US dollar stabilize in this area, that would be one of the things that could hold back the dollar index. But if you see all the other currencies falling apart as well and dollar strength running through across the currency crosses, then I would expect this trend to get pushed out even further. But first things first, right now in the short run, we're targeting $1.1975, newer move lows. Remember, it was kind of quiet to end the week. We'll see how it starts tonight in the Sunday's trade, but I believe that over the next couple of days, you'll probably see it go lower. British pound, US dollar, next on our list. This thing is buffering up against the highs. Key pivot levels. If we challenge $1.3758, it may just kind of breach it a little bit and fall apart and go sideways. It could also instigate another major move higher. However, the UK has its own woes. Like I said, oil is really the only thing I think holding up the pound because the UK, obviously British Petroleum being one of the biggest oil producers in the world. Now, we know that they are no longer going to be expanding or looking for any new drilling around the US, that's for sure, because the current president has eliminated any future permits of drilling. So that is going to come to a close, but that also supports the price of oil. So that's going to probably most likely keep the pound from falling down like the euro may, even though they have all their own economic woes. The thing is that the UK does not have to contribute to all these European Union countries anymore. So I think that's why you're seeing the pound show strength and divergence between the euro and the pound. Now let's go on to the US dollar CHF, meaning the Swiss. This had a bullish engulfing line buy signal at the beginning of the month of January. We have been buffering up against resistance. This key pivot level at 89.23, I think, is the level to watch. A breach of this level confirms new fresh buying and momentum that should pressure around this 89.78 area. This is another key pivot level. However, I'm pretty sure that if we make a higher move high now, that this upside target zone is going to probably come into play for sure. I mean, not for sure, but you know what I'm saying. It's most likely that if the dollar index is rallying, if the euro continues to break and the pound stays where it's at or goes lower, there's a good chance that the US dollar Swiss will also rebound up to this area. We are not, once again, if it comes up to here, that would kind of put the dollar index in that upside target zone as well. This is where you'll probably most likely see the bulls run out of gas and then a sideways trade develop, especially with the Swiss. If there's any market that most likely will not unwind, it will be most likely the US dollar Swiss. All right, US dollar JPY. Let's go to the other side of the world and see what's going on in the Asiatic trade zone. All right. We had a big breakout here in the Japanese yen. We had a piercing line buy signal that occurred at the beginning of January, sparking this low. We've made a higher move. We made a lower move high, followed by a higher move low, and we confirmed higher move highs in the last 2 trading days of last week, especially crossing this pivot here. This confirmed and closed above this line, not just blowing through the higher move highs, but really showing momentum. So this target zone that we have up here is starting to look more and more reachable, especially as the dollar bulls continue to press through these currency crosses. Notice this yellow line here. This yellow line here is a trend line. It's a downward sloping resistance line that comes in from all the way back when this market started falling apart in February of 2020. So we are in a 1-year bear market with the US dollar versus the yen. Have we bottomed? Short term, obviously we have. Will we continue to make a run for higher move highs? I think yes. I think in the short run, over the next 2, maybe upwards of 5 weeks, we'll gradually trade into this upside target zone and then most likely come off of this resistance line. This would also put the dollar index in that higher area like we started out the video. You could realistically see these major currency crosses as they fall apart versus the dollar. This is a corrective move, by the way. We're not bullish the dollar overall. We're just looking for the short-term correction to continue to press on. And by the way, if you hear a snowblower out there, it's because I'm broadcasting in Chicagoland and we've gotten a foot of snow in the past, like, I don't know, 18 hours, something like that. Probably even a little bit less. All right, so let's look at the Australian dollar, US dollar. Now, price of oil has been helping Australia out for a little bit, but this market has been also rallying for the past year against the US dollar, and this one doesn't want to stop. At least that's the way it seemed to be reacting. But it had a dark cloud cover sell signal. That's another high probable Japanese candlestick pattern. That sell signal was triggered also at the beginning of January. So when you see the dollar index, when it has a sell signal or a buy signal, it's very likely that in a lot of your major crosses, should that bottom or top be a good level, that you will see these also happen in these other currencies. Now, unlike the euro and the yen, the Australian dollar is not breaking that hard. However, it did start to tip into our downside target area here of a 76.41. We are now looking for a continuation of lower move lows towards 74.07, somewhere to bottom in this area. As you can see, the market made a high and made a higher move low, then a lower move high, and then consistently lower move lows and lower move highs moving into the last trading days of last week, settling just below here of our downside target number 1. This one, because of oil and it's a commodity-driven country, and because of the current inflation in commodities, especially ones that they produce, that's, I think, giving you a little bit of strength. So even though the bears are trying to hit this market, and they probably will continue to over the next week or 2 to even upwards of 5 weeks, I would not expect a severe slide in the Australian US dollar. Even if the dollar pounds, no pun intended, the pound, the euro, and all these other currencies, and I mean really hits it, like starts blowing through our target levels, then you may see an increased correction with the Australian dollar. But if oil continues to rally and a bunch of other raw commodities continue to go up in price, you're not going to see, I believe, a severe enough slide in Australian dollar, US dollar. Now let's look at the New Zealand dollar, US dollar. As you can see, the New Zealand dollar, US dollar also had a dark cloud cover sell signal at the beginning of January, and now it has made lower move lows and lower move highs. It's pretty neutral as well, just like the Australian dollar. You can see our downside target area here that is down around 69.14 to 68.22. It's probably going to take a little while to reach this area. Like the Australia, it has a lot of commodity-driven reasons to hold it up. So we'll see. This 72.45, I would say, is a key pivot level. Should the market get above here, it will be challenging the high that was set back in January, and then all bets are off the table. So just like Australian dollar, I think you're going to see a divergence between Australian dollar and New Zealand dollar, meaning that they could actually rally while all the other currencies globally are falling apart versus the dollar, meaning because of the commodity rally that's going on in place in the things that they produce. All right, now let's look at the US dollar Canada. This is an interesting bottom that's occurred. We had a head and shoulders here in a violation back on Wednesday with a close that confirmed strength, because you had a head and shoulders violation. See this red line here? That confirmed the breakout to the upside. Also, as you can see, we have these pivots, real type 3 pivots here. The market pierced, but did not settle above this previous high, but it's right there. The fact that it is a head and shoulders buy signal, that gives us a very good reason to believe that the US dollar Canada will continue to press forward all the way up to this target zone. When this head and shoulders formation came through, it also took out this downward sloping resistance, which was keeping the bearish trend intact. This market has been trading lower for a long time. We're not major bulls here, but I think that especially since we have the head and shoulders formation and we've sustained a trade up around these key pivots here from basically $1.2790 to $1.2841, expect a lot of choppy trading in this area. A breach, though, however, of the previous high now, so that was newer move high that was set on Thursday, anything above there, we are definitely going to be bullish, looking for a rally into our target zone over here. All right, so pretty clear on that. Now, for all of you that were looking and thinking about, hey, get vaccines or whatever, however your point is on that, we're not going to go into that, but I know people are thinking about spring break, aren't they? I know the college kids are. So the US dollar Mexican peso was getting beaten up harshly into January, had a nice bounce here. By the way, this is your risk level down here. And you know what we have here? Here's another reason why you got to read that book, High Probable Japanese Candlestick Patterns, because right here we have a bullish engulfing line right there. That's what started this rally here. Let me put this here. Bullish engulfing, oops, line buy signal. All right. So that is the base for our rally now going on in the peso. The key thing was, see this last lower move high? We took that out last week on Tuesday it was, and then continued to press higher. Friday, this was key, coming out of this 2026 to 2039 band here. Above here, this is not only short-term bullish, but that pierced through us all the way up into our upside target zone. Now we are going to widen that up a little bit. So I think that 2079 is probably going to be the cap for this trade, at least in the short run. Now, once again, should the dollar really be rallying against currencies, then you might see the peso back up around 22 pesos to the dollar. So the nice thing is, if you are planning on going down to Mexico anytime soon, your exchange rate is going to be pretty good. You'll get it above 20 pesos to the dollar, which that alone is better than paying 19, 17, 16, which is where it was a year ago, you know, where it dipped. So it's good to see where it's at for those who are looking to go on vacation. So the key thing is, I think you really, really want to watch out for the Euro US dollar once again, as we have these sell signals in place. We are pushing these levels are not far. If you look at the market settled at $1.2132, so you're looking at basically a little bit more than $1.50 break in the euro, and that would then once again probably push the dollar index where we started higher. So as you can see, this upside correction zone for all these markets where they're trading right now, whether they have to go up or down, meaning that they are, whatever way that is in the correlation with the dollar being bullish, US dollar bulls pushing up into this upside correction zone should continue to lay pressure on all those currencies and help the dollar index climb up to that level. So just remember always, once again, to watch our videos on YouTube. You can do that by subscribing to our YouTube channel, Forex Trading Unlocked. And also remember to read the book, High Probable Japanese Candlestick Patterns. It's available on Amazon.com in paperback and Kindle versions. And with that, you can learn how to apply these buy and sell signals to your own trading. And it works in the Forex market, stock market, option markets, you name it, it works in all of them. All you got to do is have a good trading plan and follow the rules. With that being said, I want to thank you very much for your time here. Forex Trading Unlocked, always check us out for your... We are here for a Euro US dollar Forex market analysis for February 1st through the 5th, 2021. Before we get into that, we want to just remind you that this webinar is for illustrative and educational purposes only, by using our disclaimer here. Excuse me. Then we have a little promotion here. Please like and follow us on YouTube. Forex Trading Unlocked is our channel. Pass it on to your friends in the trading community, and also check out the book, High Probable Japanese Candlestick Patterns, which is available on Amazon.com in paperback and Kindle versions. One of the reasons why is because you'll learn how to trade the signal we are about to look at right now. All right, so we have the forex-trading-unlock.com website pulled up, which you should go there for all your Forex trading information and needs. We have the workstation page also pulled up. We have a Euro US dollar chart. And as you can see, we had a bearish engulfing line sell signal that was triggered in the beginning of January. Since then, we had made a lower move low, a lower move high, and now we are chopping around for direction. We had a sell signal, this bearish engulfing line, obviously. We have our original risk level was up here to $23.53. Now we have our stop adjusted at $1.22 even. We have two trades on. One is targeting $1.1975. The other one is targeting $1.1889. This downside target range is probably the extreme of what I think you're going to see as far as a break in the euro. Let's take a look at the dollar index real quick and you'll see why. As you can see, the dollar index looks like an upside down version of the euro. Usually that's because the euro is the biggest component in the dollar index. Not that they're identical though. However, should this dollar index continue to be a bull, which we think it will be, and get above this 90-97 area, well then that would mean that the euro US dollar most likely would be heading down through this $20.50 level, and that would have us leaning on our $19.75 first target zone. That would be a good kind of like buffer zone, and I think it would probably chop around and still get down to $1.1889, especially if you see an unwinding in the pound, the Swiss, and a bunch of the other major currency crosses versus the dollar. So once again, we have an overall short-term turn in the market confirmed with a bearish engulfing line sell signal. Remember, you can learn how to trade these signals on your own and apply it to your own systems by reading the book High Probable Japanese Candlestick Patterns, available on Amazon.com, and it's in Kindle and paperback versions. Also, if you watch our videos, if you're subscribed to our YouTube channel or you go to our YouTube channel, there's all kinds of lessons that we give that gives you information on how to add these signals to your trading plan. So once again, we are short from $22.68. Looking for that first target of $19.75, and I believe over the next 2 to 3 weeks we have a good chance at least hitting the first target, maybe even this week by the end of the week. As you can see, this downward sloping resistance is pretty steep, so we're going to come out by attrition today on Sunday night when the markets open up. It'll be interesting to see what goes on. Only if we get above, once again, like I said, $21.96, would that confirm higher move highs after a higher move low, which right now it's consolidating because we made this lower move low, lower move high, and then we came down here and made a higher move low. So the question is, as long as we stay below $21.96, we have a chance at taking out this $20 half, and then that would be definitely bearish and confirm our, theory right now that we're going to definitely come down and challenge this $19.75 support band. we'll see what happens. We have a lot of things going on in the world. Now remember, there's a commodity inflation trade that's driving a lot of currencies and giving them strength. So you're finding strength in the Australian dollar, New Zealand dollar, or commodity countries. Also, oil has been helping the Canada and the pound also stay strong versus the dollar. So there's probably going to be a good divergence going on now. The dollar index is going to start to be hard to use as a gauge for any individual currency. You have to look at them on their own merits. And you got to remember also, Brexit's over now. The UK does not have to help fund all these countries in the EU. Right now, Italy is bankrupt and in complete shambles between their politics and their finances. Germany has to bail them out without the help of the UK now. So the stress on Germany and the UK is going to start to show in the whole UK as a whole, and we'll see how that pans out. And that's why I think that right now you can see this correction to the downside be pressured. Okay, so we don't really have anything else to say right now because the markets haven't opened yet. So we'll be updating what's going on with the Euro US dollar as the week unfolds. But right now, as we head into Sunday night's trade and when the European markets open up, we still are a little bit bearish, looking for a pressuring of support and down targeting that $19.75 level. Once again, please check us out and sign up. Subscribe to our YouTube channel, Forex Trading Unlocked, and also check out the book, High Probable Japanese Candlestick Patterns. It's available on Amazon.com in paperback and Kindle versions. And also, should you want to just see what the book is like, you can go to any of our pages on forex-trading-unlocked.com. If you go to products, courses, and services, you look at the little tabs that come up. It says High Probable Japanese Candlestick Patterns. If you go to that page, it will give you the ability to check out the book and read a little bit of it first and see if you are interested in it. All right, with that being said, good luck in your trading week ahead. I think the Euro US dollar bears are going to be on the right side of the market. Looks like a sell rally forecast, at least in the short run. So good luck, and we will see you soon. Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here for a British Pound US Dollar Forex market analysis for February 1st through the 5th, 2021. We have our disclaimer pulled up here just to remind you that this webinar is for illustrative and educational purposes only. And also please remember to subscribe to our YouTube channel, Forex Trading Unlocked, and also check out the book, High Probable Japanese Candlestick Patterns, which is available on Amazon.com in paperback and Kindle versions. So without further ado, let's get into the meat and potatoes of why you're here. We have the British Pound US Dollar. What's going on here? Well, last week it's been buffering under these highs. It set a higher move high. This actually happens to be a sell signal here. We have a dark cloud cover sell signal that had occurred. A dark cloud cover is a high probable Japanese candlestick pattern. So dark cloud cover sell signal. Okay. All right. So where does that have us targeting? Well, right now we're looking to get down into this target zone here, right around $1.34 to $1.34.37, down to $1.33.63. This is our downside target area. We are looking for this to occur over the next probably 1 to 4 weeks. The pound is very resilient and strong as a bull right now, but its slope is pretty steep. So the key pivot here is this current high set last week at $1.3758. All trading above there, even if it's just minor, which it probably will be, as it's been making highs, it's running out of gas. It's just poking highs. And I think one of the main reasons for that is we are in post-Brexit. The good thing is going for the UK and the pound is that they don't have to support the EU. They will be trading with the EU, but since they have left the EU, they are no longer obligated to donate all kinds of funds to bail out all these countries. Like Italy is collapsing, and Germany has to pay for it. So this is something that's giving a little strength to the pound in post-Brexit action because the euro is getting, it's under pressure because of these things. And also, you got to remember, there's a commodity inflation going on across the board where things such as oil and other things that the UK actually either produces or has control over globally in global production, that's helping to give support to the pound in the short run. So where the dollar bulls are starting to wreak havoc in a lot of currencies, they're having a tough time with the pound, and I think it's mostly commodity driven and post-Brexit driven, because there's no reason to be such a bear on the pound because they've done all the right moves with that. However, coronavirus lockdowns and some other things are causing some issues. I would think that you're probably going to see a reversal of tunes going on with that too in the UK, because there was a meeting last week between Boris Johnson and two major UK medical directors and another science director for the UK, and it was all about COVID-19 and the handling of it over the past year, and with certain new findings that they had been staunch against. So it's going to be hard for them to save face when they've been so adamant against certain things. We'll see how that pans out. I don't know if that's really going to impact the currency trade with the pound, but it may help to open things up faster than later, and that's why you think you're going to have a sideways trade. However, we do have the sell signal, so key off of that high right there, and then also this low that was set last week. Any failure from this would confirm lower move lows, which would make us a short-term bear. Okay, so now just like we have this arrow here that goes up to that, now this is another key level. So if we take out this low at $1.3608, we will be leaning on $1.3524. This is a key pivot level. That's why it's marked $1.3758 and $1.3524. They're going to contain this market's trading for the next probably 1 to 2 weeks. A breach of resistance to the upside confirms strength. Remember, the market's been making higher move highs and higher move lows. It is still in a bull market. Right now we have a short-term sell rally forecast. If you look at the hourly, we actually have a sell signal that has gone on yes, it was in the middle of Friday's trade in the during the U.S. session, and it was right here. So right now the market, as it ended the last trading hours of the week, while the U.S. was open and the other markets had closed, this one started to fall apart. It's a short-term hourly sell signal that is complementing a short-term daily sell signal. Now, these are counter-trend trades. This is a bull market, so we're not trying to call a top. What we are calling right now is for a short-term correction, and we are looking for a test of support down to $1.3608. Should we do that and it fails here, that would confirm a lower move low after a higher move high. That would take us off the short-term bull path. Long-term, medium-term, we are bullish to pound US dollar right now. But we are now seeing a short-term shift on the hourly and the daily, giving us a reason to think that support will be tested more than resistance will be challenged. A failure at $1.3608 then would have us leaning towards this next key pivot at $1.3524. Obviously, taking out $35.24 would have us then leaning on our downside target area. These are some key levels. We'll probably bounce off them first before we start to see any type of upside movement. So right now, let's see if we can get lower move lows, because right now we are confirmed neutral short run. Short run on the daily, we made a higher move high after we made a higher move high. We're looking to make a higher move low. Okay, so until we do that, we can't confirm anything. But right now, we have had a higher move high with a higher move low and then a lower move high. Now with the hourly confirming pressure, with that follow through, if that happens to occur when the European markets open up, that will help probably gain a lot of selling momentum. I would expect that your weak longs are going to be tested, and the weak longs will probably be stopped out, adding to selling pressure. And then, like I said, if that starts to build, well, then we'll see how that pans out. But right now, we are a short-term bear. We're a long-term bull for the pound versus the dollar, but definitely in the short one, we're bearish. Real quick, we're going to look at the dollar index. Dollar index is bullish. If you see the dollar index breach this 90.97 area, that means that the pound and the euro most likely are under pressure, just because they're the heaviest weights in the dollar index. Now, the dollar index is a short-term bull. Overall, it's a medium and long-term bear. So that goes that coincides with our British pound US dollar long-term and medium-term forecast, meaning we're dollar bears. But in the short run, on the daily and the hourly, we are looking for a little challenge of our test of support. So another reason this dark cloud cover sell signal here, this is one of our high probable Japanese candlestick patterns. So that gives us every reason to think that the short-term short, no pun intended, is going to help us definitely to make a test and a run at support. So remember, if you want to learn how to trade that signal, read the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions, and also subscribe to our YouTube channel, Forex Trading Unlocked, and also go to our website, forex-trading-unlocked.com. And if you do, you can also get a snippet on the book High Probable Japanese Candlestick Patterns to read. So with that being said, good luck in the trading week ahead. We hope that this has been helpful. Always check out forex-trading-unlocked.com for all of you. Hello everyone, this is Teddy Keckstedt with Forex Trading Unlocked, and we are here today with a US dollar CHF Forex market analysis for February the 1st through the 5th, 2021. Before we get into our analysis, we just want to remind you that our webinar is for illustrative and educational purposes only. Also, we want to remind you to subscribe to our YouTube channel, Forex Trading Unlocked, and pass it on to your friends. And this way you know when we have videos coming out, and you can also see all the other stuff and content we have that's growing on our YouTube channel. Also, check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. With that being said, let's go to our live action screen here. We have the forex-trading-unlocked.com website, and if you go to the products, courses, and services tab, you can see at the bottom when that little drag down thing pops up, it says High Probable Japanese Candlestick Patterns. That's a way you can check out the book and read a little bit of it first, get a taste of it. So we're on the workstation page. We're going to skip past the numbers for the week and just get right into the analysis here. So we have a bullish engulfing line buy signal that was triggered in the beginning of January. If you want to learn how to trade it, read the book, High Probable Japanese Candlestick Patterns. Now, as you can see, this US dollar Swiss has been buffering up against resistance for the past couple weeks. And this key pivot level here at 89.23 is just so hard to cross. We're looking for a challenge of that this week. If we can get above this key pivot level, then we will be leaning on this 89.78, which is a long-term pivot level also. And above that, then it hits us right into our upside target zone, which is our longer term. Oops, let's move this arrow over just a little bit. There we go. The upside target zone is our longer term area that we're looking for. So right now we're looking for a challenge of 89.23 sometime over the next couple sessions. A breach of that level would mean that most likely the weak shorts will be knocked out, causing a little bit of extra fuel to the fire for buying momentum, pressuring the market up to 89.78. I would expect it to become a little dicey and touch and go up here, and then maybe see a range trade develop above 89.23 as becoming support, and then being 89.78 being the next area it tries to get above. Any trading above 89.78 will have us leaning on resistance here, hitting up the bottom part of our upside target zone of 90.26. 90.91 is the extreme for any upside move. Now, there is a head and shoulders formation that is forming. Here's a shoulder, here's a head, here's a shoulder. We just have not had a violation yet. Should we take out this key pivot level, that would confirm a head and shoulders bottom, which the head is a bullish engulfing line buy signal in itself. So you have two big high probable signals then confirming at least a short-term bottom in the US dollar Swiss, and also laying credence to where buying momentum in the dollar should most likely pressure resistance up into or near our upside target zone. That's about all we're looking though for the upside. Let's take a look at the dollar index. The dollar index is kind of doing the same thing. The dollar index here, as you can see, it had a head back here, and it had this bullish engulfing line buy signal. This is also a head and shoulders forming. Should the dollar index get above 90.97, most likely if it does, that means that the euro is making new lows. The pound is either neutral to making new lows, also probably. Now, there may be divergence between those two currencies, so the pound is not the best indicator, but if you see the pound lower versus the dollar, for sure, with the euro US dollar also lower, then odds are that the dollar index will be trading above 90.97 as far as the average is concerned. And what does that mean for the US dollar Swiss? That would mean that this US dollar Swiss is going to be very likely doing the same thing. That would mean that it would have, well, at that point, should have breached this key pivot level here at 89.23, and then I would think there would be enough buying momentum to fuel a spike up to 89.78. Once again, I think this will be an area where you'll probably get a little dicey and touch and go. We are not looking for, like, for instance, if you look at this chart, these big breaks that we had in the US dollar Swiss, we're not looking for a rally to explode like that. However, having this bullish engulfing line and then also having a head and shoulders pattern that will be confirmed if we get above this key pivot level, that's a double buy signal and a very strong technical situations that put the odds in your favor of maintaining at least a short-term bullish move that will breach resistance in a good way, meaning that we should extend the correction definitely up at least towards the bottom of this target zone. But first we got to get above this key pivot level. So we'll see how the market opens up tonight when the European and Asian markets come online. And like I said, if you see the dollar index rallying, making new highs, or if you see the euro especially making new lows and looking to test support in a big way, and the pound as well, if that starts to fall apart, then its odds are that the dollar bulls will have the strength to correct this current upside move up towards our target zone. Now remember, overall, this market isn't a free fall. It's been in a bear market for months. Long term and medium term, we are bearish the US dollar Swiss. But the daily has confirmed a lower move low, higher move high, higher move low, and now we're looking to see if it can make another higher move high. So it's already on the neutral stage when it comes to the daily, and on the hourly, it's definitely bullish the US dollar versus the Swiss. So short term, we're looking for this correction, which we're looking at this as a correction off of this current low to continue. So we're not looking for another run at support right now. We're definitely looking for a challenge of resistance. So we'll see how things go with this key pivot level once again at 89.23. A breach of that will have us definitely over the next 2 to 3 weeks targeting this upper trading band of 90.26 to 90.91. Now, let's just say we do get this and it does happen, and the dollar bulls are really hitting these other currency crosses. We have divergence in the currencies, so if we had, let's say, a major dollar rally over the next month and a half, don't expect the US dollar Swiss just to keep on going. It's a flight to quality currency. If the euro does start to come into problems, which I think it will because of the financial issues it has with losing the UK and post-Brexit, Germany has to support Italy, which is now bankrupt and falling apart at the seams, as well as many other countries. It's going to put a lot of stress on the euro. So you might see a rallying pound and a breaking euro. That would also lay credence to a Swiss trade not going to rally too much, but also probably not come back. We could have a digestive trade between 90.91 and this 89.78 for a month, So we'll see. We still have to get through tonight's trade first and open up the markets, but right now we are short-term bulls. And remember, if you want to read the book High Probable Japanese Candlestick Patterns, you just go to the top of any of our pages, go to the nav bar, products, courses, and services, check out High Probable Japanese Candlestick Patterns. Read the book, learn how to trade these signals. And also, remember, if you want to learn when these things happen, what we got going on with them, check out and subscribe to our YouTube channel, Forex Trading Unlocked. And also, once again, go to Amazon.com and get the book, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. It is loaded with money management stuff, like besides just the trading strategies, the discipline guidelines and things for traders. It applies to all markets. It's a very good read. With that being said, I'm Teddy Keckstedt at Forex Trading Unlocked. Please check us out at forex-trading-unlocked.com every day for your Forex trading needs. Good luck in the trading week ahead. Always make sure you have a trading plan, use discipline, know your risk, and make sure you stick. Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we're here for a US dollar JPY Forex market analysis for February 1st through the 5th, 2021. Real quick, we just want to show you our disclaimer to remind you that this webinar is for illustrative and educational purposes only. Also, we want to remind you to subscribe to our YouTube channel, Forex Trading Unlocked, so you know when we're broadcasting these videos and more. Also, check out our channel. There's all kinds of great content on there. And also, check out the book, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. All right, now we actually have a high probable Japanese candlestick pattern that we're going to show you. So we are at the forex-trading-unlock.com website. We already have the workstation page pulled up, which if you go to the nav bar, it's the first one. You click on that. Also, if you want to read the book, High Probable Japanese Candlestick Patterns, a little excerpt, you go to this product, courses, and services, and you can see at the bottom of that, there's a link to go check it out. All right, now we have the US dollar Japanese yen page already put up here. Now the US dollar yen has been in a free fall for almost a year, and it is in a long-term and medium-term bear market. However, at the beginning of January, there was a piercing line buy signal. The piercing line is a high probable Japanese candlestick pattern. That is this low, and with the way it's settled, it's touched off the beginning of the bottom. Now, one thing also we have here is we have a very interesting little other double buy setup here. We have this here is what? This is a shoulder right there. This first little low right here. And then the low where this buy signal was triggered right here. This is a head. And I think I know that many of you are catching on to where I'm going here. And then this last low here was another shoulder, which gives us what? A head and inverse head and shoulders pattern, correct? And what does that mean? That means that we have a buy signal. All right, now let's take a look at this. So we have the piercing line that was triggered already on, in the beginning of January. And then a week and a half ago, we set this low here. This was a higher move low. Now remember, we had the head, which is our total low here. We rallied up to this point and set a lower move high, still a bear market. Then we came down and made this higher move low. This is our shoulder right here. We pierced this high right here, which now confirms a head and shoulder breakout, okay? And that also confirms more buying momentum, because after a higher move low, we're making a higher move high. So we're no longer on the neutral, we are on a hourly and daily short-term bullish momentum play right now. And especially with the close above this past lower move high, that's significant. We're expecting more follow through to the upside. We're expecting a challenge of this 105.36 area. Now you see this little yellow line back here? That has been going on all the way, if we go back to, oh, look at this, the end of February of last year. So we're pushing almost 1 year on this downtrend. So we're not calling for a bottom, but we definitely have a confirmed short-term bottom. Remember, the overall trend, long-term and medium-term, is still bearish. But right now, we are looking to press this correction up towards this downward-sloping yellow resistance line, holding the trend intact. By attrition, we can go sideways and reach that on its own. But definitely, as long as we're above this 103.33 area right here, this is the key pivot that's holding this rally intact. We are looking for a challenge of 105.36. 106.23 is most likely going to be extreme on any aggressive rally over the next, I would say, 1 to 3, 4 weeks, maybe even 5. Remember that the dollar index bottomed back in the beginning of January, as you can see here, and that had a bullish engulfing line buy signal. Whenever you have one of these signals in the dollar index, that usually means it triggers them and if you get them in other major highline currency crosses at the same time, that usually is a very, very good indication that the dollar has made a short-term top or bottom, depending on the signal. And right now, we are looking for the dollar index to get above 90.97. Should this get above here, there is a very good chance that the U.S. dollar JPY will also continue to maintain its bullish strength. I think all your weak shorts and aggressive shorts now that are like, hey, this market's a bear, or this can't go any higher, they're going to get squeezed. There's going to be a short squeeze that'll drive this most likely up towards this 105.36 area. Then I expect it to get dicey. I don't see us as railing up to 106.23. Anything can happen and will in the marketplace, that's for sure. But right now, we are short-term bulls. We're looking for a challenge of 105.36. Definitely 103.33 is your risk level. You do not want to be long above or below 103.33. Any failure from support here will have us looking for new move lows to take out where the bottom was here, set back at the beginning of January. So this is very critical stuff you got to pay attention to. Please don't forget that. Okay, so that's how we're looking to shape up for the beginning of the trading week for the first week in February. Remember once again to subscribe to our YouTube channel and pass it on to your friends. Forex Trading Unlocked is the channel. And check out the book, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions, so you can learn how to trade these signals or incorporate them into your own trading methodologies. We will be following this trade over the course of the week. If you subscribe to our YouTube channel, you'll be keeping up with our videos. So with that being said, good luck with all your trading. Always stick to a plan, have good risk management rules in place, stay disciplined, and persevere. You'll be fine. Keep on trading and moving ahead. So we will see you soon here. And remember to always check out us and all your Forex trading needs. Dollar, US dollar, Forex market analysis for February the 1st through the 5th, 2021. Real quick, we just want to show you our disclaimer to remind you that this webinar is for illustrative and educational purposes only. Also, we want to remind you to subscribe to our YouTube channel, Forex Trading Unlocked, so that way you know when we have our upcoming videos, and also go to our channel. We have lots of great content there for Forex and other markets. And also, we're going to talk about some trading signals, and they happen to be high probable Japanese candlestick patterns, which there's a book entitled that I have written that is on Amazon.com. You can get it in paperback and Kindle versions. With that, let's get to our trade of the day. Our live action scene here, we have our Forex-Trading-Unlock.com website. We have the workstation page already up, and you can get that through the nav bar. It is the first one that toggles down if you want to pull it up on your own computer. And also, if you want to read an excerpt of high probable Japanese candlestick patterns, go to our product courses and services tab, and at the bottom you can see that listed. And click on that link. All right, now we have the Australian dollar, US dollar pulled up. Now, there's some interesting things that are shaping up in this world when it comes to the dollar and multiple currency crosses. Australia being a commodity-driven country, the price of oil and a couple other commodities are helping to maintain bullish strength. Now, this market has been in a rally against the dollar for a year. It is right now, this is one of the first times in a while, as you can see, where it is buffering off of resistance, and at the most part, it's more sideways than bearish. However, we have a dark cloud cover sell signal that occurred here at the beginning of January. Also, since then, we had made a higher move high, a low, then a lower move high, a lower move low, a lower move high, and as of last week, a lower move low. We pierced through the 76.41 first downside target level. We're looking for a continuation of this trend over the next few weeks to get down to 74.07. If, and this is a big if, this is if the US dollar remains a big bull. So let's go look at the dollar index chart real quick so you can see what's going on in the world. Dollar index was a little bit sideways last week, but still it's coming off of a higher move low, and we're looking for a breach of 90.97. Should the dollar index get a rally above here, that does two things. It takes out this critical pivot. It also confirms higher move highs. Higher move highs after higher move lows is indicative of what? A bullish trend. Overall, the dollar index, just like the Australian dollar, US dollar, it is in a long-term and medium-term trend that is bearish the dollar. However, short-term, as you can see the dollar index, it is a short-term bull on the hourly and daily, and we're looking for this challenge of resistance. Should it do that, we're looking at most likely another run up towards this 91.73 to 92.36 area. If we fail from 90.03 and take out this low from a week and a half ago, that would be very negative. That would probably mean that we would be at the very best sideways, but probably getting back on the bear side of things. So now let's go back to the Australian dollar, US dollar chart. So this is an inverse reflection of what's going on there. We are looking for, once again, lower move lows and a grind. This is not going to probably sell off or move like, say, the euro or the pound or a couple other currencies that are in flux with the dollar. Main reason being is that right now we're looking at this as a short-term correction. We have a confirmed short-term top with our dark cloud cover sell signal from 3 weeks ago. So that's, and also we've made lower move lows and lower move highs, which is indicative of a lower trending market. So on the daily and on the hourly, we are bearish. But once you get into the weekly and monthly, we're still a long-term bull. So I would say that maybe getting into neutral in the medium term, maybe, especially should we hit the downside target area and get down towards the 74.07. But then let's just say that the dollar index really becomes a raging bull. if the commodity inflation rally continues, especially with oil and a couple other of the mining things that come out of Australia, I believe it will be hard for Australian dollar to be so an aggressive bear when it comes to the dollar. I think if anything, it'll hold up and be pretty neutral. It won't slide as severely. We are due for a nice little correction, but because this market has been rallying against the dollar fiercely, and you can see especially the last few months from November alone just into the beginning of January. Look at the slope. Now we took out that slope. We had confirmed once again the trend analysis, which is lower move lows and lower move highs. So we're riding that. Now we did touch our first target. We could stop here and go sideways. Key level to watch would be this 78.05 level. Any breach of this resistance would confirm new move highs and the raging bull is back. Is it going to be extreme or a grind? Who knows? But if it takes out 78.05, you do not want to be short against this level at all, period, because you're just trying to, it's like trying to catch a falling knife to the downside. You don't want to do that, just like you don't want to try and catch a rocket flying to the moon, or stop a rocket flying to the moon. So we are bearish. That's our call for the Australian dollar, US dollar, for the next couple of weeks, especially going into the beginning of this week. We will see what happens tonight when the Asian and European markets come online. And like I said, we're looking for a test of support. Should we take out this low from Thursday also, this is another key level, then I would say at 75.97, a failure from here would have us definitely leaning towards this 74.07 level over the next, like I said, probably 1 to 3 weeks. So with that being said, I want to thank you very much for your time today. Subscribe to our YouTube channel, Forex Trading Unlocked. Pass it on to your friends. Check out the book, High Probable Japanese Candlestick Patterns, so you can learn how to trade the dark cloud cover sell signal. There's also other sell and buy signals in that book, High Probable Japanese Candlestick Patterns, and you can check out a little short read of it on our website, forex-trading-unlock.com. Check out our website always for your Forex needs and information, and to get in touch with us. So, and we look forward to seeing you guys again soon as this week progresses, and look forward to seeing how these trades manifest. All right. So I want to thank you very much once again, and good luck in your trading. Make sure you have your risk managed and your profit targets set, and you have a trading plan. Don't just be willy-nilly out there entering the markets. Otherwise. Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here for a US dollar Mexican peso Forex market analysis for the week of February the 1st through the 5th, 2021. Real quick, excuse me, we want to put up our disclaimer just to remind you that we are going to just be presenting this for educational and information purposes only. Also, real quick, we want to remind you to subscribe to our YouTube channel, Forex Trading Unlocked, as well as check out the book, High Probable Japanese Candlestick Patterns, which is available on Amazon.com in paperback and Kindle versions. And we are going to be actually going over a couple of these signals. All right, we got our live action screen here. We have the forex-trading-unlock.com website already pulled up, and we have our workstation page that you can access from the navigation bar. And we pulled up a US dollar Mexican peso chart, and we have some stuff going on here. So what do we have going on here? Well, we have the bullish engulfing line buy signal right there, and it started in the middle of January and sparked a new rally and made a lower move low on a trending market that has been bearish. And then now, over the past week, we have had broken out to the upside and also gotten into our upside target zone. So I think it's probably going to be a little choppy. I think today what you're seeing is a bit of profit taking in the Forex markets. The U.S. markets, the South and North American markets don't open up for hours yet. We still have the European markets that haven't even opened up yet. So as Asia comes online, I think we have some profit taking going on with the U.S. dollar Mexican peso. On an hourly basis, it's now neutral, but it was in a very bullish way on the hourly basis. On the daily basis, we've been making higher move highs and higher move lows. That is indicative of an uptrend. So since we have hit the target zone, I think that we're going to start to get a little choppy. I would key off of this 20.26 pesos to the dollar and 20.39 pesos to the dollar. This little buffer zone here, I think, is going to contain any real bearish sentiment over the next few days, and expect it to probably make another run for newer move highs. I do believe that 20.79 pesos is about what you're going to see for the any type of really extended move to the upside. Now we have March 21st through April 21st marked here. Why is that? Well, that's kind of like the spring break zone, isn't it? So travel is opening up, and now everything's going to be all mobile and whatever. Everyone's going to be moving around, and everything's all over with coronavirus now for as far as travel and what have you. So I think people, especially the college kids, they're going to be invading Mexico for like there's no tomorrow unless there's restrictions as far as traveling to and from Mexico, most likely coming out of Mexico, which I don't foresee coming because I think they want the U.S. people to come in. And I believe that since we've had a bounce in the dollar index, which we will take a look at real quick, one of the reasons the peso, I think, is falling a little bit against the dollar is because, one, it's been rallying against the dollar for months. And as you can see, the dollar index bottomed at the beginning of January. It's making higher move highs and higher move lows. It's looking to break out to the upside. It is under pressure as we speak, starting off the week, but it is Sunday night, and just the Asian markets have only been open for a few hours. A challenge of 90.97 is in our outlook. Only a failure from this 90.03 level in the dollar index would have us bearish and looking to probably get back on the bearish US dollar outlook. Right now, we are looking for a challenge, like I said, of 90.97. Above here, expect more momentum in the currencies to push the dollar index up towards this 91.73 area, with this 92.36 being the extreme. So let's go back to the Mexican peso. So we have the bullish scenario, meaning that for the Mexican economy, that's a good thing, but as far as spring break, but it has to happen first. Right now, with the lack of people traveling down there and a bunch of other issues, the Mexican economy is definitely struggling very hard. So, and with a lot of things that have been closed down, I'm sure that a lot of the people that send money back to Mexico usually are not able to send as much back as they have in the past, especially with the shutdown of all the restaurants across the country. So, and not to stereotype anything, but we know that there's definitely a lot of people that are in that industry that are of the Latinx population, of which a lot of them do send money back to Mexico on a weekly and monthly basis. So with that being said, that also is probably why you're seeing the U.S. dollar get a little bit stronger versus the peso, because dollars are definitely worth more right now, until like things get back online. However, we did hit our upside target zone, so the trade is off. As far as for the first objective here, I would say that this 20.79 is most likely the extreme of what we will see. Well, I mean, we'll see what happens. It could keep on going for much longer. Now, if the coronavirus actually starts to cause a lot of issues again, then we may see continuation of buying momentum, which will drive this market back up towards 21.5 to 22 pesos to the dollar. However, we are not looking for that to happen in the near future. We're just looking for a little bit of a correction. Remember, like I said, the U.S. dollar peso has been in a free fall for months. So please like and subscribe to our Forex Trading Unlocked YouTube channel. Pass it on to your currency trading friends and other market trading friends. And also check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com. in paperback and Kindle versions, and then you can learn how to trade those bullish engulfing lines that were in the U.S. dollar, or excuse me, the U.S. dollar index, as well as the U.S. dollar Mexican peso. Once again, thank you very much for your time here at forex-trading-unlocked.com. We will see you soon. Always remember to have a trading plan, use discipline, and always know. Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here for a U.S. dollar, Canadian dollar Forex market analysis for February the 1st through the 5th, 2021. Real quickly, we want to show you our disclaimer to remind you that this webinar is for illustrative and educational purposes only. Also, if you haven't done so already, please sign up for our YouTube channel at Forex Trading Unlocked, and also check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com. Paperback and Kindle versions are available. Okay, with that, let's go to the forex-trading-unlocked.com website, and we will already have the workstation page pulled up with the US dollar Canada chart ready to go. We're going to skip past the numbers and things like that as far as that are coming out at economic releases, because we got a lot to talk about here. The US dollar, Canadian dollar, has completed a head and shoulders bottom as of last week, and right now, as you can see, it's trading a little bit lower starting off the week here. But this red line here, this is where you can see how it has taken out the head and shoulders and has launched that. So right now we have coming off that first shoulder. That is our higher move low. And now we are looking to see if we can continue to make higher move highs and higher move lows. As you can see, on Thursday and Friday of last week, we pierced through this $28.30 up to $28.41 range and settled just below it on, or excuse me, just below this first one here on Friday. And now we're trading a little bit below it, which I think right now you're just seeing a little profit taking on this one, and you're most likely going to see some U.S. dollar strength coming in. As far as a big upside turn of events, that is not what we're looking for. We're looking for a breach of the high from last week at $28.87 above there. We most likely will see a little fresh buying momentum targeting this upside target zone at $29.85 up to $30.80. So that is the prognosis to the upside. Key levels to look out for here. We have this $26.81. This here is a significant monthly number as far as being a pivot, and it looks like it found a nice little base here with the head and shoulders formation, which gave us the buy signal. And now with that, if this signal holds, then the upside target zone would be about where that would take it to. Now this is being looked at as just a short-term correction. Overall, remember, the long-term and medium-term trend for the U.S. Canadian dollar is lower. It has been making lower move lows and lower move highs for months on end. The fact that oil prices are going up and the XL pipeline now has been cut off from Canada, that's going to probably bring up the price of more commodities once again, especially oil and natural gas. So, and that's, I would think, going to give the U.S. dollar bulls a little bit of a tough time trying to get a big rally going. I think right now, if anything, what we're going to see is a continuation of the short-term, hourly, daily bullishness that will, as long as we keep making higher move highs and higher move lows, that will keep us in the short-term bullish mode. But remember, that's only on an hourly and an intraday basis and daily basis, because we just bottomed just a little over a week ago. So we have the head and shoulders formation. We have our bullish breakout line that we still are trading above. And once again, unless we fall below $26.81, I think you're going to see that as a support base, to which we will most likely see another run for newer move highs. And especially if we can get a rally above $28.87, that would confirm new highs after higher move lows, which is indicative of what? A continuation of a bullish trend. And then most likely we would see the upside target zone hit right into that $29.85 with $30.80. Like I said, I think this will be the extreme. I'm not looking for any major upside move. This market has been just getting beaten up for months on end. So I think that's really what we're looking at, is a chance for the dollar to get a little bit of a correction. And if you look at the dollar index as well, the way it ended last week, it's kind of in a neutral zone here, but as long as it doesn't fall below 90.03 here, this market will, the index will be bullish. Now, we had a bullish engulfing line buy signal that was triggered at the beginning of January, and we've made higher move highs and higher move lows. So as long as we do that, we're looking for a challenge of resistance here at 90.97. Currently, to start the week off, the market's under pressure, but right now we only have the Asian markets open. European markets are coming online yet in another few hours. So I think you're seeing just a little follow through from Friday, because there's not really that much action going on yet. And especially for the U.S. dollar, Canadian dollar. Now, should we see a little bit of a slide in oil prices, then I think you might have a chance at seeing the U.S. dollar, Canadian dollar continue this rally and definitely hit the target zone, as well as if we see interest rates in the 30-year note, if they continue to stay choppy, and if they fall below 170 basis points, then that would be a bearish indication, especially if it gets back down to 168 to 167. While the short-term interest rates are at the ceiling, that means long-term rates are pushing to try and make rates higher. No matter what the Fed does, it's going to dictate higher rates in the marketplace because of the risk and that is on the table moving forward as we go into the first quarter of 2020 or 2021, excuse me. So that's what we're looking at here for the U.S. dollar, Canadian dollar. And I just want to remind you to definitely subscribe to our YouTube channel, Forex Trading Unlocked, as well as check out the book, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And if you are listening to our stream right now, we will be back in just a few minutes with another live video. We're doing some individual market snippets right now. So we have done a weekly video for market analysis for all the markets already for the week, but now we're hitting on some individuals. So thank you very much for your time, and we will see. Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here for a US dollar South African Rand Forex market analysis for February the 1st through the 5th, 2021. Real quick, we want to show you a disclaimer to remind you that this webinar is for illustrative and educational purposes only. And also, we want to remind you, if you haven't already, subscribe to our YouTube channel, Forex Trading Unlocked, and also our Twitch channel. We have lots of content on the YouTube channel for Forex and also kinds of lessons and what have you. Lots of interesting stuff. And we're always updating and adding stuff every week. High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions, is also something you should take a look at. And now we're going to go to our website. Excuse me. There we are. Now we have the forex-trading-unlocked.com website. And if you go to products, courses, and services, you can see High Probable Japanese Candlestick Patterns there. You click that link, and then you can read a little portion of the book. Also here for market analysis, we have the Workstation tab already pulled up. And we're going to skip past the calendar for the week. And here we have the U.S. dollar South African Rand. Now, this market has been in a bearish way for the long term and medium term, and was making lower move lows with lower move highs consistently up until the end of 2020. Then it rounded a bottom, and since then has had a nice corrective wave all the way up to here. So we've set now this downward sloping resistance line holding the trend intact. From that high, we made a higher move low down here. This now becomes a key pivot for us. Since then, the market has pretty much settled in a neutral to higher trade. So we're looking at these pivots as our big breakout here. So this first one would be right here, and that would have us pressing on this new move high. Obviously, a breach of that level would then have us going higher still. And the same is to the downside. We have this last low from last week that would have us right here pressing support, and if it does, I think that that's going to actually start to set off new move lows and resume the bear trend, because here's the downward sloping resistance. That would be consistent with that. However, since we have been making higher move highs and higher move lows on a daily basis and even on an hourly and intraday basis, we have to think that most likely the trend is your friend, and that we're going to see a run up and take a challenge of this 15.37 level for the US dollar ZAR. If we, like I said, get above here, and that would mean newer move highs, and that would target the 15.68 level. So we don't want to get ahead of ourselves. A rally above there, well, now that would be kind of significant, but might as well, since we brought it up, point out what might happen here. So we'll go to, yeah, this is still the 50% level. Well, no, we can go to 0.618. Okay, let's get rid of this. Wait a minute. Oh, there we go. Okay. All right. So now it's a little bit easier to see. So the 16.21, I think, would be the highest corrective level you would see for the US dollar South African Rand. Now, if you want to look at another reason why this probably is going to challenge resistance, it's because of the dollar index. The dollar index had a low set a few weeks after the US dollar ZAR did, and we had a bullish engulfing line buy signal that sparked a rally, which has now had the dollar index making higher move highs and higher move lows. It is only bullish on the short term hourly and daily basis, not on the long term or medium term. This market has been this index has been in a free fall for a while. But right now we are expecting a challenge of the 90.97 level in the dollar index. And then maybe if we can cross that bridge, that would mean that we are making higher move highs, momentum in the US dollar versus those currencies, or basket of currencies that are sparking that index to rise, would most likely precipitate momentum up to the 91.73 level. Above there, it's going to get a little dicey. 92.36, I think, would be definitely the extreme. So now let's go back to the US dollar ZAR. Okay. And if the US dollar, if the Dixie, the dollar index, continues to buffer resistance, then that would most likely lift the US dollar ZAR. It seems like this is not like it's just following the index, but it definitely is not hurting the bulls here in the US dollar ZAR with the dollar index pressuring resistance. Now, if we definitely take out this 14.94 level, be very careful because of failure from 14.76 and all bets are off. Remember, the long-term trend is bearish. Lower move lows, lower move highs are indicative of a lower trending market. Only on the daily and intraday, and remember I said this rounded out a bottom at the end of 2020, sparked this corrective move here up to this point level, setting this lower move high. Now we made a higher move low over here back in the middle of end of January, or middle of end of January, and now we've gone neutral to set pretty much sideways since then. So let's see what happens. Like I said, a breakout to the upside would confirm bullish strength, and a failure from 14.94 definitely has this market back on edge. So just remember to pay attention to what's going on with the dollar index a little bit. A strong dollar index will usually, I would say, in the short run with this position, with where it's looking at, probably give a little lift to the U.S. dollar South American Rand trade, meaning that the bulls will drive the dollar up and help that little trade going on. So also, we'd like to remind you once again to subscribe to our Forex Trading Unlocked YouTube channel and check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And we will definitely check on the US dollar ZAR later on in the week and see how it's shaping up. And I want to thank you once again for joining us here at forex-trading-unlocked.com. And always remember to have a trading plan, have your risk all set, and know what you're going to do. Don't be subjective while you're in your trading. Have a good set of rules. And if you want to apply some of those high probable Japanese candlestick patterns to your own methodologies and trading systems, I think it's a good idea. They definitely help to be like a double whammy for confirmation. So just like we use that in the dollar index to give us a guide for a low and setting that new trend in place, the same happens in the South American ZAR as well. It happens in that market as well. Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here with a US dollar Turkish lira Forex market analysis for February 1st through the 5th, 2021. And before we get into it, we want to remind you that this is for illustrative and educational purposes. And another reminder is to, if you have not already subscribed to our Forex Trading Unlocked YouTube channel, please do so. Pass it on to your friends in the Forex and online trading community, and also check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. All right, with that, let's go to our live trading screen here. We have the Forex-Trading-Unlocked.com website pulled up from our nav bar. If you go to Products, Courses, and Services, the lower number link there is to High Probable Japanese Candlestick Patterns, the book we told you about. You can read a little excerpt there. And here is how you get the workstation page, which we already have pulled up. So we're going to go past the weekly calendar, and we're going to go straight to our chart here for the US dollar Turkish lira. As you can see, the market has been in a bear trend now for a few months. It's been making lower move lows and lower move highs, which is indicative of what? A lower trending market. As you can see, the market bottomed there at the beginning of 2021, and then it started to make, it made a lower move high here, then it made a higher move low, and then a higher move high, which set us up for neutral trading, of which it has been doing for the most part. However, today, as you can see, this market is on edge, looking to try and make a lower move low. So, is this market going to turn around As you can see, this downward sloping resistance here is holding the trend in a bearish way, but by attrition, just over the next couple days, if we go sideways, we will breach that level and then push that out, which definitely keeps us in the neutral campaign. So we're looking at these as our pivots. 7.546 to the upside confirms new strength and buying pressure, and below 7.2435, we are looking for a continuation of the medium bearish trend. Now, overall, this market had been in a bull market all year up until the fall. In the beginning of November, all of a sudden, this market went into a free fall. So this could just be a correction before it goes making a run for new highs. Let's remember what the dollar index has been doing. It started to bottom in the beginning of the 2021 trading year at a bullish engulfing line buy signal. It's something you can learn how to use in your own trading, or use our methodology in the book, High Probable Japanese Candlestick Patterns. And from that moment on, we've had the dollar index in a little bit of a daily and intraday bullish mode. It has been consistently making higher move highs and higher move lows. However, the long-term and medium-term trend for the dollar index is lower. So I wanted to just to remind you to be very careful of what you do with using the index as an indicator right now, because it's on shaky ground. Right now it's going neutral, kind of like the Turkish lira. If this index falls below 90.03, then all bets are off, and most likely the US dollar bears are going to start really romping on the dollar in many different currency crosses, especially the majors, which will probably have a little bit of an impact also on the US dollar Turkish lira. Now, back to the US dollar TRY chart. Right now we are under pressure, but remember, most of the markets have not opened up yet, so I think it's a little follow through from Friday. The US dollar is under pressure versus most currencies this morning as the markets open up, but it's only the Asian markets that are open. So I think we'll see as and these are also moving into Turkey as well. So until we hit the European trade zone, I wouldn't be overly zealous on this one. But just know that if you're an aggressive bull, then just have your stops right here at 7.2435, because anything below that is very negative, at least in the short run. Because the long-term trend is up. This is a correction that is now extending itself. It looked like it was trying to bottom out, just with like the dollar index has been, but now as the last couple days of trading, as Friday into today, it looks like it's definitely looking for the bears to come back and really make an impressive move to the downside. So it's going to be a little rough right now. If you're already short, just know that you do not want to be short if the market takes out the 7.546 level. Any rally above here would be indicative of probably a beginning of another major wave north, especially when we have to see what goes on now with the coronavirus as we move forward through the first quarter, if things really do or do not start to open up. So we'll see how that ends up happening. But right now, like I said, key off of those two pivots, and we'll be monitoring this trade and see what happens. And also don't forget to subscribe to Forex-Trading Unlocked. .com and get on our email list, and then also go to our YouTube channel and subscribe to our Forex Trading Unlocked channel, and also check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And then you can learn how to utilize those patterns and integrate them into either your own trading methodologies and systems, or to use the ones that we highlight in the book. So I want to thank you very much for your time, and always remember to go to forex-trading-unlocked.com for your Forex information.
Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here for a Forex market weekly analysis for February 8th through the 12th. And before we get into that, real quick, we want to show you our disclaimer to remind you that this webinar is for illustrative and educational purposes only. And real quickly, also want to remind you to, if you have not already subscribed to our YouTube channel, Forex Trading Unlocked, please do so you'll know when our new videos and lessons are coming out, and when we are broadcasting live as well, like we are right now currently. And also check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. We will have some of those signals in our analysis today. So we have the Forex-Trading-Unlocked.com website pulled up, and we already have pulled up our workstation page, which you can access from the navigation bar by going to this market analysis and education, and then you can access that link. So we're going to skip past the numbers for the week and get right to our chart. So we already have pulled up a Dixie dollar index chart to see how things ended the week last week. So Friday was a big sell-off in the dollar. However, the market has been making higher move highs and higher move lows, so I'm looking at Friday as more of a corrective profit-taking day. There was a big move in the euro, and you'll see that as we get into the analysis. So it was really only a few currencies that really generated this big move in the dollar index. I would say it's a short-term reversal. Remember that the overall trend for the dollar index in the long-term and medium term is bearish. However, the short-term daily and hourly is bullish. So I'm looking at this as just a first corrective phase. Now, we already hit our upside target on Thursday, the first target range, and now this I'm viewing as a pullback because we broke the long-term trend with this downward sloping resistance line. This upside target area is now our extended upside target area because we had already hit our initial one on Thursday and actually poked all the way near the top of it. So now we're raising this range because we have this long-term trend that was broken last week. We now have a new upward sloping line that is going to be our support base for the short-term trend. Now we are looking at this as still a corrective move higher. So we're short-term a bear, looking to see how the dollar reacts as we start the week. It's a little on edge, and I expect it to be so for probably into the trading of tomorrow, and then I would expect that we still get another rally and a pop-up to here. As we get into the analysis for today, you'll see why we're coming up with that. So we are just looking at the short-term little slide in the dollar as just that. Now here's the euro. The euro has been in a nice aggressive bull pattern versus the dollar. This is the biggest weight in the dollar index, so this is like a little reversal. There was not a sell signal in the dollar index. It was a reversal day without a doubt, but it was not a sell signal. Whereas we have the euro-US dollar that did produce a high probable Japanese candlestick pattern, which you can read about how to trade that signal in the book I mentioned earlier. And that was our Friday signal. And as you can see today, it is slightly higher. It pulled back a little bit and gave some aggressive bulls a chance to get long, but as you can see, it's not really pushing very much. Now, the U.S. stock market has just opened. We will get into Bitcoin. Obviously, those who are watching the markets today know that Bitcoin had a monstrous rally. That has a little something to do with what's going on with the currencies. Not that Bitcoin makes the currency markets move. However, when people are pulling cash out of the market, it's coming from somewhere. So they're either using cash or selling equities and other derivatives to purchase. And we'll even get into that because now we have funds. And the CME just listed another cryptocurrency on their exchange, which by the way, there is huge margins to try and trade the cryptocurrencies with the futures through the CME. But we'll get into that as we progress through this analysis. So the euro-US dollar has a short-term buy signal that is now targeting this $1.2149 to $1.2198 upside target zone. Should we breach this downward sloping resistance line, which is holding the short-term corrective trend lower intact, I think we will have a good chance at definitely hitting this area. Now, it's going to get dicey above here because should we take out $1.2198, then that really puts us back on the bullish path for the euro-US dollar. So that would have us very bearish in the dollar index then, should we get a rally up past this $1.2198 area. So we'll be watching that over the next few sessions. Like I said, this right now is our upside target zone. We're viewing it as a correction. The dollar is in an upside correction right now, and we're looking at a little short-term profit-taking move to the downside against the dollar for the next couple sessions, and that would give this euro a good chance at popping up. As you can see, since we're talking right now, it actually just lifted just slightly a little higher. They must be listening to me. So we'll see how it gets above this line or does not get above this line over today's and tomorrow's trading session. By attrition over the next couple days, we will get through this. So that still puts this into play. I think you're going to have a lot of resistance at this $1.2149, and if it spikes underneath here, because you can see this last high here, that's right below this $1.2198. If we take that out, that's a higher move high after a lower move low. That would put us on the new neutral campaign. So we could go into a big sideways chop with the dollar index actually for the next couple months. Remember, elections are over. Now we have all kinds of executive orders that are coming into play. So we have to see what kind of ramifications these things are going to touch off in the market. Now, and we still have the coronavirus on the table, but everything's opening up globally. Everyone's resisting now, and except for in the UK and a certain few other countries like Canada and Australia, the hammer isn't really coming down on the people who are resisting. So we'll see what happens if these things open up and we don't have another monster wave like they had supposedly this past year. When you look at the numbers, you're still looking at, they just crossed 400 and I think 20-some thousand in the U.S. You're still looking at less than 0.5% of the population. So that's, we have more suicides and things like that. So it's, I don't know. We'll figure it out later, I guess. But the British pound US dollar is slightly higher also, which is helping to lift the dollar index. Above $1.3760, this market remains a bull. Now, this is the tough part about the pound. It really needs to take out this $1.3567 area to the downside to set new move lows to confirm at least a short-term bearish correction. This market has been a raging bull no matter what for months, weeks, days, into the hourly trade. This is an aggressive bull. So we've had a sell signal here where our pivot point is to the upside. This happens to be a dark cloud cover, which is a high probable Japanese candlestick pattern as well. Let's see, I gotta get this over here. I gotta get this. Okay, so this day right here, this was a dark cloud cover. Oops, not Cyril, sell signal. So far no questions on the chat. You guys are quiet today. You guys must be really interested in what I'm saying. Or maybe not, I don't know. So anyhow, we had the sell signal. We came down to this low that we set last Thursday, and now we have rallied since then. See how the pound was up on Friday, just like the euro was against the dollar? That's why you had such a big move in the dollar index. Notice how this is stalling. One of the big things we have to watch with the pound is the price of oil and a couple other commodities. As long as this bull market is existing in the CRB index, and especially in the fuel sector such as gas and oil, I believe that's going to be lifting the pound, just like it supports the Canada and a couple other currencies versus the dollar. It's a commodity-driven trade. We're going to get into the interest rate factor too. That's going to really make things a little bit snappy with this. But let's clear through this. Unless we get above $1.3760, this market is sideways to lower. We are looking for a test of support again here down at $1.3567. I would watch oil. Should we get a big correction in oil, say maybe a $4 or $5 correction, maybe even or more, which I do not see coming in the short run, that would probably help to create a sell-off in the pound. Even if the dollar is a raging bull, the pound is very strong right now because of that. So I would be very leery and use caution as a seller, just as I would be very cautious buying at these highs. It's kind of running out of gas. Now, if we get another accelerated move higher in oil, then I would probably say that if you're short this market, you're going to get squeezed, and the longs will drive this market above this $1.3760, probably all the way up to $1.39 even. So we'll see how that pans out. One thing that is restricting things and showing some relief is the fact that the Swiss had a major breakout. It's hit target areas that it's kind of hard on the daily to see, so we're going to look at the weekly. On a weekly basis, we are targeting up to this 93.37 area, up to 94.69. This downward sloping resistance line on the weekly chart for the U.S. dollar Swiss is containing the long-term bearish trend. Right now, we are looking at this as an upside correction with the Swiss, just like we're looking with the dollar index as an upside correction. We had hit earlier on the daily the numbers for the U.S. dollar Swiss last week. With this high on Thursday, it blew through them, and now we're kind of waiting for a reaction here. It's most likely going to digest the next couple days. That's why you can see on Friday there was that big sell-off. So I'd key off of that pivot. above above Friday's high. We are bullish, looking for an extended move higher into a more bigger, higher zone that we looked at on the weekly chart. Otherwise, we're looking for a little bit of a consolidation in the short run as the euro and the pound. So as you can see, the Swiss was actually higher, much higher today. Now it's on its lows. That's because the pound and the euro are pushing their highs right now of the day, but they're not that excessive either. So that's why I would view Friday's move as more of a profit-taking correction that will probably be pressed into today or maybe even into tomorrow before we start to see a turn once again to the upside. We have a lot of divergence in currencies, so the dollar index as a whole is hard to gauge a lot of them, but the pound and the euro especially, is one that is driving that trend. What we did have here is an upside breakout. We had a head and shoulders pattern. Here's the shoulder, here's the head, here's the shoulder for the U.S. dollar Swiss. That confirms a big bullish breakout. We had a buy signal besides that came into yesterday or Friday's trade, or Thursday's, and then reversed on Friday. So we hit the short-term targets, but the longer-term targets, like I said, because of this head and shoulder bottom, it's going to take probably a few months to reach those targets. I would not think that it's going to happen anytime soon, but probably as we get into March and into April, we can hit those up more higher price points for the U.S. dollar Swiss. All right, now let's jump around to the U.S. dollar JPY. All right, Japanese yen also hit our target, short-term targets last week, and now is correcting off them. As you can see, the dollar's got a little strength here. We're going to take a look at the weekly chart on this one to give you some points. $1 107.11 up to 108.20 is our upside target range. That would take out this downward sloping resistance line that's holding the short-term trend intact. This market is an overall bear. You can see this other downward sloping resistance line here. We would have to take that out and get above this target zone to become an aggressive bull for this market. But it is having a nice correction versus the dollar. And I think you're going to see dollar strength also continue against the yen for probably the next couple months. So we may have a little divergence where the pound may be neutral, probably most likely, or a little bit stronger versus the dollar, maybe even making higher move highs, while the Swiss may be kind of neutral in a grind, making lower move lows, meaning higher move highs with the dollar versus the Swiss. And the euro could be a chop fest. We'll see what happens. But right now, the euro is probably going to lose a lot of steam because of what's going on. You have the revolts now in Italy, all the businesses that are basically saying, okay, well, we're all opening up and we don't care anymore. Their government has collapsed. Their country is completely broke. Their people they have to open up. They have no other way. They have to start doing things because there's no bailout for them. So before people start starving, they're going to do what they have to do for themselves. And that momentum is growing throughout Europe, so I would assume you're going to see a lot of unrest. It continues in the EU. Remember, the UK, because of Brexit, is no longer part of it, so they don't have to flip the bill. Germany will have to, and that's going to weigh on them. So right now in the US, for the Japanese yen, we're looking for a little digestive phase the next couple of days. Once we get a price point, we'll figure it out. Now, this has been a very steep rally on the daily basis here. So if you look at this trend here, from here to here, you could see it's sliding maybe back down into this area, and then we'll see what happens. We would have to fall all the way back down here below this 103 to 103.5 area before we start to get bearish. So that would be a big correction. That if that happens, well, then we know we're back on the long-term bear. Remember, this is a long-term bear, monthly, weekly, but now on the daily, the U.S. and hourly, the U.S. dollar, Japanese yen is looking to become a bull. So this one is another currency where in the dollar index, which the yen has a heavy weight, will start to help to keep the dollar index positive and keep it from becoming such a bear. So remember, like I said, that is going to be a hard gauge. We have divergence now in the currencies. Coronavirus trade is off the table. We're getting back to trade zones and free market movement again, I think, hopefully. Australian dollar, US dollar is continuing to aggressively be a bull on the short-term basis against the dollar. However, we've been making lower move lows and lower move highs. We are viewing this current rally in the Australian dollar, US dollar, as only a correction. we would have to take out this downward sloping resistance line and then also this 0.7767 pivot point to confirm a neutral to higher trade. Now this market, Australian dollar, US dollar in the monthly and weekly is definitely a bull. This is being viewed as a short-term daily hourly correction phase that we entered at the beginning of January. And right now we are on the hourly obviously bullish, and on the daily we just came off a lower move low after a lower move high. That means the trend is still lower. So we are an aggressive sell rally forecast. This could have been the base and starting another wave higher. Who knows? We'll see what happens. But like I said, right now we are looking for this downside target area to be reached over the next month and a half. But we still have to run out of gas and take out this level here at 75.65 first. That would confirm new lows and really put the downside target area in our sights. So we'll see what happens. But because the dollar seems to be having a little bit of a reprieve, and we'll get more into that as to why we think the dollar will have a short-term little bit of a hit today into tomorrow, but it's only that's going to run out of gas and come back in the dollar's favor. So we're building it up for this, and we're going to get to it in just after we get a couple more currencies. So U.S. dollar, Mexican peso has entered a neutral zone. It's basically going to be hovering, I think, between this 19.54 and 20.59 range for a while. A violation of either level would cause the market to break out and confirm a new trend, but right now we're looking at it basing and going sideways for a while. We'll see what happens if the spring break trade comes in. It's kind of funny, everything's opening up, and then also they're saying everything's getting worse, so we'll see if spring break travel starts to really happen or not. That's going to be a very big thing for them, as well as to see how now I guess Biden's going to overturn the NAFTA agreement that was just negotiated a couple years ago that was better for America. It was, if everyone agreed on both sides, it corrected a lot of bad things, and now I guess that's going to be reversed again. So we'll see. U.S. dollar Canada. The U.S. dollar Canada, this is also like the British pound. Because of oil, it's going to be hard for the Canadian dollar to become a bear and the dollar to be a bull versus it. And now we did set a nice bottom here. We had a nice rally. We hit our target points short term. We did breach the slope of this downtrend has been so severe on the U.S. dollar Canada, and it's been very, very long. This downward sloping line goes all the way back to a year ago. So now we did breach that, and that could be just by attrition, but we are coming off a little rounding low here. Our key pivot here is right here to $27.37. We'll have to watch it. If we continue to take this out, if we hit support more today and we do fall below here, that would be a lower move low after a lower move high, which confirms that this is at least in a neutral to, continuing a bear trend. This may continue. We may see new lows down below $1.26 within the next few weeks, maybe even the next week and a half. Like I said, if we have a big rally in oil, besides the pound getting a lift and then seeing that probably make new highs, you most likely would see the U.S. dollar Canada make new lows. We did have this breach, like I said, this arrow here shows when we came out of the long-term trend, but as you can see, it's more sideways and choppy, so we don't have much to go on there. Let's go back to the euro U.S. dollar and see what we're doing. Yeah, they're still hovering, as you can see. Now let's take a look at what's going on with the 30-year Treasury bond. Interest rates are a function of currencies for pricing. Now the fact that the bonds really took a tank on Friday, now this is ironic. While the dollar was getting beaten down, the interest rates were rising in a big way, making lower move lows, meaning higher yields in the long-term end of the curve. We had this $1.70 and $1.68 as a big neutral zone, holding that sort of dollar could fluctuate and bounce around every which way. Above $1.70, it's hard for the dollar to be too much of a raging bull. However, below $1.68, it's hard to not be a bull on the dollar just because of the fact that market rates are dictating higher rates. It's a function of currency pricing. It doesn't matter with the banks. They can be lending at just above zero like they are or excuse me, central banks, and then the other banks, whatever, they're making their spread. But the market now is dictating no matter what, and it's impossible because we have to not have higher rates come into play now. We have inflation that's being forced by executive orders. We have oil that is now railing. This is being forced because of executive orders. A floor is now being put on the price of oil. So you have, no matter what, now oil will not get below $30, $35 a barrel again for years unless they change their tune on what they're doing in the U.S. So that alone is going to drive inflation in all the other commodity markets, because now you got to remember, heavy equipment, no matter what, it runs on gas. It doesn't run on electric. You can't run big cranes or mining equipment on electric power. It just doesn't work. Not to mention the cost of that would be just completely go against what you're trying to do. So that being said, you are going to see continued inflation in the CRB. If you're not into commodities, that doesn't matter, but for currency pricing, you should be aware of what's going on because it does impact them. Bitcoin had a monstrous breakout to the upside today, obviously, and we'll see how this thing goes. This is another thing, is one of the reasons it probably is getting this rally is that the CME now launched the second cryptocurrency that can be now hedged on a global exchange. The margins to trade these things are outrageous to hedge, so you need deep pockets. These are all whales. However, funds are now getting involved in the crypto space. This is a bad idea on many levels. Everyone that saw what happened to GameStop, fund managers are not traders, they're money managers, they're just used car salesmen who happen to trick a lot of people with a lot of deep pockets and big money into giving them money to manage. They get paid just for holding it. They don't have to do anything and they're making money. Eventually, no matter what, they all blow up because they're not experienced. They do stupid things like go short GameStop without having a hedge. Ironic, hedge fund managers did not have hedges on positions with unlimited risk. Of course, what do they care? It's not their money. So what are they doing now? They're buying, because of these derivatives on them, funds are now having crypto funds and being allowed to invest in them. Universities have their big endowments now are buying into these. So big amounts of cash are coming out of their selling liquidable assets in the real markets and pouring cash into cryptocurrencies. So that's going to definitely weigh on the dollar and other currencies as well as far as liquidity, because now you are tying up major amounts of money into these, well, crypto assets, if you will. So it will not end well. It will not end well, especially for the fund managers and or the people actually who have their money in the funds. But a sucker and his money are parted easily. So remember, the interest rate curve equation is going to pressure the currencies. Most likely you're going to see this euro continue to pressure resistance over the next day and a half. We do have this short-term buy signal that comes up into this upside target zone. So will that happen over the next 2 days or 3 days? Probably not. We're not looking for an aggressive rally to happen, especially right now with the cryptocurrencies moving the way they are. Because here's another thing too, is that if you want to look at how, if you go to our forex-trading-unlock.com website, you can always pan and check out these markets really quickly. Now let me show you something here. When you have the Forex markets here, this will pull all of your Forex crosses where you can just go to them. And if you go all the way to the bottom, you can go to the Bitcoin crosses. So just like we were looking at the Bitcoin versus the dollar, here's the Bitcoin versus the euro. Look at that. It's doing the same thing. It's railing against all currencies, right? Okay, so that's why you're having cash and euros being pulled out and they're being converted to crypto assets, and whoever's selling these things now is hoarding these currencies. Okay, this is a big deal. So at these levels, because Bitcoin is not trading at 2,000 or 400 or whatever, $40,000 or plus a contract, that's a lot of equity at a time to be absorbed. And now you have big funds that are buying at these levels. So what does that mean? Where's their money coming from? They're not sitting on that much cash. They have to liquidate other things. So it's going to put a lot of strains on the markets. It's going to also cause some vacuums. I would expect to see a lot of swinging markets in probably a derivative meltdown that will most likely hit us within probably the next 7 to 12 months. Not anytime soon, but I would say it is lurking in the shadows in a big way, especially as the cryptocurrencies continue to press higher and fund managers start to get involved in this space. So anyhow, I want to thank you very much for your time. If you haven't already subscribed to our YouTube channel, please do, Forex Trading Unlocked, and check out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions, and always come and check us out at forex-trading-unlocked.com for your Forex information and needs, and we will see you soon.
Hello, and welcome to eOptions webinar. We're happy to have you here, and thank you for taking the time out of your day to join us. We're excited to partner again with our speaker, Teddy Keckstadt, a professional trader with over 30 years of experience, to bring you this webinar today on Enter the Options Trading Ring with a Knockout Trading Plan. My name is Gina Bocayas, and I'm with Regal Securities, which is the parent company of eOption and its sister company, InvestTrade. And to provide you some basic logistical information, the session today will last approximately 1 hour. If you have any questions, we're happy to answer them for you. All you need to do is find the Q&A box on your screen and enter those at any time during the presentation. And our speaker, Teddy, will answer all of those at the end of his presentation. Please use the Q&A box and not the chat box, as our speaker won't see your questions if you don't enter them in the Q&A box. You'll be able to access the recording of the webinar in the next few days on our website at eoption.com, and we'll also be emailing you a copy of the recording in the next week. And you can also find it on our YouTube channel if you subscribe to us. And for those of you just joining, we'd like to welcome you to our webinar on Enter the Options Trading Ring with a Knockout Trading Plan. And as eOptions' name implies, we are a firm that specializes in option and stock trading. Our founder was a founding member of the Chicago Board Options Exchange in the 1970s and has been trading stocks and options for nearly 50 years. We charge some of the lowest option rates in the industry. All of our stock and ETF trades are commission-free, are just zero commission for all online trades, and options are just 10 cents per contract plus $1.99 per trade. We also offer a powerful trading platform, mobile app, free trading tools, and live expert support on our trade desk. And that's something we're very proud of, is our excellent customer support, where you can reach out to a licensed broker, a professional with years of experience, and they're happy to answer any question that you have. We also offer a useful options trading tool called Options Play, which scans thousands of stocks each day to highlight potential option trade opportunities for you. Now, this is normally $500 annually, but this is free to all of our customers. We also support option education, and we're glad you can join our webinar today to learn more about using options in your overall trading strategy. And I'd like to now turn your attention to our speaker, Teddy Keckstadt. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from past webinars he's done for eOption, and we're excited to welcome him back today. And just to tell you a little bit about him, he has over 30 years of trading and industry experience. He traded at the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. And he's been an institutional market analyst for over 25 years. He serves as president of Forex Trading Unlocked, and he is the author of the book High Probable Japanese Candlestick Patterns. He also has a degree in finance from DePaul University in Chicago. So without further ado, I'll turn it over to Teddy Keckstadt now. Thank you.
Thank you, Gina, for that introduction, and thank you to all of you out there who are coming to participate and watch this webinar. Enter the Options Trading Ring with a Knockout Trading Plan. Okay, we don't have to talk about myself since Gina gave that fabulous introduction. Thank you once again. Real quick, we have to show you our disclaimer from eoption.com to remind you that this webinar is for illustrative and educational purposes only. Remember that everything we view is in a lag and stuff like that, so for the market data. And since I am doing this presentation, I always throw up my company disclaimer as well. All right, get ready to rumble with options. Okay, so what you will learn today, you're going to learn how to trade stock and other market movements without large capital allocations. Expanded portfolio diversification is something else you're going to learn. How to maximize your potential returns with options. Bear and bull directional strategies will be talked about today. And you're also going to learn to see how e-option can help improve your bottom line with your options trading. So why stock option strategies? Well, first of all, you can lower your cost basis. At e-option, it is only 10 cents a contract, much lower than other firms. Options help you diversify your portfolio because you can trade a much broader range of stocks with your allocated capital, which is also something you always want to be mindful of, because money management is definitely one of your key variables for success in trading and investing. Options allow smaller to larger investors the ability to capitalize on trending markets that are highly liquid. This is a very important cost control. The nice thing about regulated, publicly traded options that you would trade on most equities, they're very, very liquid at all times. Now, what does that mean? That means that the spread between the bid and the ask is usually very, very tight. The tighter it is, the better it is for the customer. The less edge you have to give up. The more edge you give up, the more you will add to your losers and decrease your winning potential. So be very mindful of where you have your liquidity for where you trade and place your options positions is also very important. You know, the tighter your spread, the better your broker, the more it saves you money, increases your bottom line no matter what. Trading in these products is similar to trading in normal equities, but with higher potential ROI and controlled risk. Yes, that's true. Your return on investment definitely has a higher potential with options and option strategies. Okay, today's focus. We're going to talk about credit spreads, which are a type of spread known as a vertical spread. We're also going to talk about debit spreads. They're kind of the same thing. It's just a matter of one you get a credit, one you get a debit. It's pretty much that simple. They are also vertical spreads. We're also going to talk about puts. We're going to talk about calls. We will discuss bullish and bearish strategies, how you would apply which strategy at which time, depending on whether you're bullish or bearish. We're going to show how you can define your risk. We're also going to show you how simple the execution is. And we're also going to evaluate the short-term versus the long-term opportunities with these strategies. Okay, we're going to get to the charts really quickly, but we just want to make sure we have these definitions. Some of you out there are very experienced options traders and have been involved in the market for maybe even longer than myself. Others have probably only been are brand new to it. So we're going to go over these real quick so that you understand the strategies once we get to the charts, what we're talking about. So definitions, buying a call. When you buy a call, that means you have the right, not the obligation, to buy an asset at a specific strike price. That is a long play. If you sell a call, then you give the buyer the right to buy an asset at a specific strike price. That is a short play. Okay, I just want to make sure you're very clear on that. The same goes for puts. If you sell a put credit spread, you sell one put option strike price of an asset below the market, and then you will simultaneously buy a lower put option strike price with the same expiration. Now, ideally for vertical credit spreads, 2 to 3 weeks is the best time frame. If you start to go out longer than that, they are not that good. And we will see through our examples and where the market's at today why that is true. We're going to learn a little bit about the Greeks today. You're going to learn about time decay and theta, but instead of having to worry about all kinds of numbers, you're going to learn visually, and by the time we're done, you're going to be like, oh, I have a better grasp of time decay. Okay, so if you sell a call credit spread, that it would be when you sell one call option strike price of an asset above the current market and buy a higher call option strike price with the same expiration. This also ideally is something that you want to execute with no more than a 2 to 3 week time frame before expiration comes. Now, we're going to talk about debit spreads also. If you buy a put debit spread, you will be buying one put option strike price of an asset below the market, and you will simultaneously sell a lower put option strike price with the same expiration. Now, if you're going to sell a call debit spread, then you would buy one call option strike price of an asset above the current market price and sell a higher call option strike price with the same expiration. Okay, we got through the definitions. Now it's time to have some fun. Okay, directional option plays. February 12th expiration. Today is February the 10th. In 2 days is expiration. When I made up the slides for this webinar, I decided, because of the topics, I looked at the pricing for the options, and now we'll see how things would have panned out, whether you were a bull, a bear, and which play you might have chosen. Okay, so for long plays, one way to be long any type of equity or ETF for that matter, or even other markets, would be to buy a call. The nice thing about when you buy a call is your risk is defined. The only amount of money that you can lose is what you pay for the option, also your commission for the option. That is the most that you can possibly lose by a long play when you buy a call option. Another long play is when you sell a put. Okay. Now, the thing about that is you have unlimited risk when you sell a put. So there is a big difference between when you buy an option and when you sell an option. Okay. But now, as far as being a long play, if you sell a put, that is the same thing as being synthetically long is what it is, but it has unlimited risk. Now, if you sell a put credit spread, which is one of the things we just discussed, your risk is defined. So that would mean that you would take a credit in when you simultaneously sell and buy some put options of the same expiration date, but your risk is defined. So no matter what the market does, whether it stays still, rallies to the moon, or crashes to the floor, it doesn't matter. Your risk is defined. You can only lose the difference of what your credit is, and we'll get into that pricing once we get to the examples. The same thing is for if you buy a call debit spread. Your risk is defined. That is another long risk-defined play. Now, the other thing you could do is you could buy an asset, high capital outlay. That's the problem with that when it comes to when you actually get into only trading the equity itself or the ETF or whatever market it happens to be. As far as short plays, that is when you would sell a call. Now, this is where the risk is unlimited. Once again, when you sell an option, you have unlimited risk if it goes against you. Now, if you want to do another short play, buying a put, there your risk is defined. The most that you can lose is the purchase price of the option plus your commission that you paid. So should the market rally to the moon, your put expires worthless, that is a defined amount of money that you know that you could possibly lose. Another short play would be to buy a put debit spread. The nice thing, once again, about a debit spread is your risk is defined. However, a debit spread is where you would definitely pay to put on the spread. The next one would be to sell a call credit spread. And this is another nice thing about this is even though you are selling options, your risk is defined. So the nice thing about these vertical spreads, if you are selling them, whether they are debit or credit spreads, unlike a put or a call, if you sell them, your risk is defined. Remember, if you're just in a put or a call, your risk is unlimited. This is big to know. Remember all those hedge fund guys that were out there when the GameStop blew up in their face? They were all short a stock. They were not hedged. Shorting a stock has unlimited risk. So those geniuses, and the oxymoron is a hedge fund manager, because hedge fund managers never hedge. If they had some options on, even some way out of the money calls, they would have covered and not have lost the amounts of money that they did in that short amount of time. Of course, hindsight is always 20/20. You think they would know how to do that. So anyhow, if you sell an asset, high margin and unlimited risk, that would mean shorting the stock, like the hedge fund guys that got blown up 2 weeks ago. So that I'm sure everyone knows at least something about that that's watching this webinar. Okay, our first example. Now we can get into the visual aspect of this webinar. Now it'll start to make sense what we're talking about and what we're doing. Okay, Amazon.com, everyone's familiar with the stock Amazon. At the time when I produced this slide a couple weeks ago, Amazon was trading at $3,232.58. Now, here let's figure out what you could do. If you wanted to go short this market, instead of shorting the stock, which we know has unlimited risk, you would buy a put up here. So since the market was at 232, you would buy a put below that at, just above it at 32.35. Now, at that point, that option would cost $139.04. Okay, that's what the pricing is here. But actually, you got to remember, anytime you're looking at options, you have to multiply times 100. So that's a very expensive option, but not as expensive as trying to short the stock, right? So we'll get into that pricing. So one thing you could do here is buy that put for 139.04. Or if you wanted to be a bull, you could buy the 32.30 call just below the market for $147.90, obviously times 100. So that would be right here. We have your 32.30 and 32.35 marked here on the chart. You can see how where the close was of this long down day. This was when the webinar was done. We have above here in blue, these are your calls, and we have your puts marked here in red. Okay, so these would be ways that you could go short or long. Now, that would also, what you could do is you could sell the options. Now, remember, when you sell the options, then you start to bring in that unlimited risk factor. So the same prices would be there, and then instead of paying, you would be bringing in that amount of money. So these first two examples where you're buying either a put or a call because you are bullish or bearish and you want to trade Amazon.com, you don't want to put, obviously either put up the money to buy the stock or have the margin to cover the short. And remember, you better have the margin to cover the short because it is a lot. So you're going to tie up a lot of capital with that. Suggesting to go short the market, buy a put instead. That's what I always say. Never go short the stock market. But that's my own personal opinion. So also the flip side here is you could sell these options. There are reasons to sell options. Just because I'm warning you that you have unlimited risk, remember that most options expire worthless. That has to do with the whole flipping of spreads and what have you. Not everyone is having a hedge on or what have you. There's all kinds of reason for the market mechanics of that. But remember that the ones that do expire and are exercised on or used, somebody had to sell those. So in this case here, you would be bringing in some nice money. If you sold the put, you bring in $13,904. If you sold the call, you bring in $14,790. Not a bad way to start off a trade, right? But excuse me, remember that you have unlimited risk. Now let's go to the credit spreads. 32.35 call for $145 is what you would be selling, and you would be buying the $32.45 call above that for $140. If you did that, you would have a credit because you're selling the closer option for more money than you are paying for the other option above the market. So these are these blue ones. The first one you'd be selling, the upper one you would be buying. Now remember, this credit, this is the difference of what, this is where the only amount of money that you can make on a credit spread would be the money, the premium that you take in from the simultaneous buying and selling of these options. Remember, they also have the same expiration date. And then obviously your commission also would be, that would be the most that you could lose on the trade. And it would also be, that would be the most that you can make on the trade, which would be minus the commission. Now, what you could lose would be the difference in that spread between your strike prices. So in this case, we have the 32.35 call and the 32.45 call. That's a $10 difference right there, okay? So we'll get into the numbers on the next slide, but this would be a little over $5. This would be a $5.40 credit. So your risk then would be a little less than $4 or a little less than $5. Now on the credit spread to the downside would be the put spread where you're long. Remember, when you sell a credit spread that's a call spread, you're bearish.